Tehran, of course, pushing back hard here. The parliamentary speaker, Mohammad Ghalibaf, has dismissed Trump's claims as fake news designed to manipulate the oil markets. But interestingly, Politico also reports today that Ghalibaf himself is being floated as a possible contender as a future Iranian leader. So we're continuing to follow those reports. Meanwhile, Israel's Prime Minister Benjamin Netanyahu also weighing in and making clear that there is no ceasefire on his horizon. Netanyahu saying these strikes on Iran and on Lebanon will continue as he seeks to safeguard, he says, Israeli interests in any potential peace deal as well. He says he's spoken directly with President Trump on that. And then, of course, on the ground, the war also really showing no signs of pausing, at least for now. Heavy airstrikes were reported across Tehran overnight, targeting the Iranian Ministry of Defense and IRGC headquarters. We have been following reports that blasts were also reported over Jerusalem following that Iranian missile fire. And the UAE, Kuwait, and Saudi Arabia all reported intercepting additional Iranian drones and missiles. And we also reported last hour that a projectile targeted a gas pipeline feeding a power station inside Iran as well. That is according to Reuters. And then, of course, on the energy front as well, we have seen prices come off their most recent highs. The U.S. Energy Secretary Chris Wright was actually on CNBC overnight saying that Iranian control of the Strait of Hormuz is an unacceptable outcome. And those comments were also echoed by the ADNOC CEO, Dr. Sultan Al Jaber, who was addressing CERAWeek in Houston by video, going one step further, calling the blockade economic terrorism against every nation, and also warning that there is only one solution, and that is to reopen the strait. Of course, the big question, and in fact, it's one of the questions that the president was asked in the last 12 hours, who will be responsible for safeguarding the Strait of Hormuz when it eventually opens? The president didn't necessarily have an answer to that question. He kind of joked and quipped that maybe he would be responsible moving forward. But of course, this is a big question as we see the real chokehold that this critical waterway is, and the concern that US officials, including the energy secretary, and of course right to the top with the president, have now raised about the future of that waterway being used to hold not just the Gulf states, but also the global economy hostage if it is closed again. So plenty of questions arising again this morning about exactly who will be responsible for safeguarding ships, their crews, and their cargo through the strait moving forward as well.
Dan Murphy, thank you for those updates. And after the announcements made by Donald Trump, it has been an absolutely wild ride for commodity prices across the board, be it oil, be it precious metals. Manisha is here to tell us exactly that. Manisha, good morning. What last 12 hours have been for the commodity markets?
Well, absolutely, Hormuz. We've been all tracking that. And yes, crude oil prices yesterday fell like a rock, as the U.S. president said. But in the Asian markets right now, and this has happened before the New York markets closed yesterday, we are trading 4% on the higher side right now. While the U.S. president has postponed attacks on Iran energy infra by 5 days, we don't have those kind of assuring statements coming in from Iran. Actually, Saudi Arabia agreeing to give U.S. military access to King Fahd Air Base and UAE taking steps towards joining the Iran war does feel like that this may get prolonged going forward as well. Interestingly, when you look at the U.S. oil August futures, they are trading at $80 a barrel versus 92 of a spot right now. So if the markets believe that coming weeks and months could actually ease the situation and there could be enough crude coming into the market, the future contracts trading in the backwardation cheaper than what they are right now is something that the markets are not able to understand at this point in time. Having said that, a couple of statements really. One from the U.S. Energy Secretary saying that the global oil prices have not climbed enough to cause demand destruction. On the other side, there also are statements suggesting that this is going to take months, if not years, to get the oil and gas supply back into the market. So very contradicting statements. And of course, on ground, it continues to be quite a bit of an uncertainty. Quickly on the precious metals as well, you have gold prices, which fell to a 4-month lows yesterday at 4,100, are holding at around 4,350 right now. Same goes for silver as well. At one point in time, we saw 60 breach. It's trading at $68 an ounce right now. Same is the case with copper. We did see 2.5% of a decline yesterday. It's trading 0.5% on the higher side right now. So off lows, but not out of the woods.
Manisha, thank you for that update there. Uncertainty continues to persist across the commodity markets this morning as well. But we all know what has transpired overnight with the announcements made by Donald Trump. But someone on Wall Street may have known this before any of us knew, and that transpired in just a 15-minute window. Now, at 6:50 a.m. local time in the US yesterday, there was a very sharp spike in the volumes of the S&P 500 futures and the oil futures at the same time. Mind you, this happened in pre-market trading. Now, pre-market trading, the volumes are generally illiquid and there is not much liquidity in the market. But at 6:50 a.m., take a look at this spike in the volumes that you see on the S&P 500 futures. Otherwise, it's an absolutely flat line. Then there you can see the volumes on the S&P 500 seeing a sharp spike at 6:50 a.m. There is nothing different in the oil futures as well. Now, on the West Texas Intermediate, if we flip the chart and we go to WTI, a similar spike is seen at 6:50 a.m. here as well. Otherwise, it resembles a flat line on the ECG. Now, it was at that point of time that there was a sign that something was transpiring on Wall Street that others did not know. This was at 6:50 a.m. Just 15 minutes later, Donald Trump puts out a post on Truth Social, and that post says that Iran and the US have had talks over the last 2 days, and as a result of which he has instructed the Department of War to not attack any of Iran's energy installations over the next 5 days. And this is what he said: to postpone and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Immediately after this post, there was a very, very sharp reversal in the futures on Wall Street. The S&P 500 futures were up almost 2.5%. At one point, they were down 1%. Crude prices, which were at elevated levels, fell anywhere between 10 to 15%. Of course, as more clarity emerged and the denial that came in from Iran, the markets cooled off as well, but then still ended higher. Oil prices ended lower. Now, analysts too continue to remain very cautious because Morgan Stanley also says that any further relief rally will require a tangible follow-through on the geopolitical front. Now, the next, of course, comes from Edward Jones, who also said in this note that the cleanest indication of a de-escalation will be whether if crude oil prices flow through the Strait of Hormuz. The third one, of course, came from a brokerage called Citadel Securities, where they say that the conditions of a rally are high, considering one of the largest short positions on the US stocks if the tensions ease. And lastly, Evercore also said that it is almost impossible to tell whether this is a genuine progress or an off-ramp for the war. You may call it a coincidence, but someone who knew made money much before the world got to know of what Donald Trump was up to. But that, we take a break on Power Breakfast. On the other side, we set you up for today's trading session. Welcome back. Now on to action from Wall Street. As we just mentioned, it was a positive session, although all the indices cooled off from the day's highs after Donald Trump signaled that there were productive talks happening between the US and Iran. The Dow at one point was up over 1,000 points, ended 600 points higher. The S&P 500 also gained anywhere between 1% to 1.5%. But how will all of this impact our own markets? Let's set you up for today's trading session with the trade setup, the stocks that are likely to be in the news, and of course the cues from the F&O markets as well. First up, Vivek joins in to get all the market cues that you need to watch out for. Vivek, good morning.
Well, good morning. A vastly different screen is what we are faced with today compared to how we were starting off trade yesterday. A lot more positive. Like you mentioned, most of Wall Street ended in the green, slightly off the day's high, conflicting reports. But despite that, you did see a risk-on rally as far as equity classes were concerned. On the other hand, commodity prices, especially when you're talking about oil prices, they fell almost 10% overnight, leading to quite a bit of relief, especially as far as Indian markets are concerned. Now, remember, US markets and Brent, both of them went in conflicting directions. That's something that augurs quite positive, especially as far as equities are concerned. And that has also translated to quite a bit of a risk-on rally, especially as far as the Asian markets today are concerned. South Korean markets leading the charge, Japan following suit, and the GIFT Nifty also indicating a sharp gap-up rally, a sharp gap-up open for our own markets today. Yesterday was a very weak session for the Indian markets, broad-based selling pressure, VIX at a 2-year high. And today, what is it that we will watch out for on the back of falling crude prices? Expecting a relief rally across most of the oil sensitives. We'll keep an eye out for OMCs, aviation, paints, tire stocks, all of them that use, are directly exposed to the oil market itself. Today, a couple of action as far as the IPO market is concerned, a few listings as well as 2 IPOs that will be opening up. Powerica as well as Saipantel are the 2 IPOs on the radar. We will see a gap up open, but important to see whether there is a follow-on rally or not.
That's the most important question to track. Vivek, thank you for that update. Head over to Upasna now, who will list out the stocks that should be on your radar today. Upasna, good morning.
Good morning. First up, let me start with HDFC Bank. It appoints an external law firm to review Atanu Chakraborty's resignation letter, and the law firms to provide report within a reasonable period of time is what is indicated. Next up is GR Infra. It bags order worth 2,441 crore from NHAI for the construction of greenfield section of NH33 in Bihar. IRFC also in focus as it signs a loan agreement worth 12,842 crore with HURL for refinancing of the long-term debt. Coal India also in focus as it receives in principle approval for the divestment of up to 25% stake in southeastern coal fields via OFS, and in addition there will be issuance of 10% fresh equity shares of SECL through IPO is what the company has indicated. Interglobe Aviation also in focus as the board has approved appointment of Alok Singh as the Chief Strategy Officer with effect from 6th of April 2026. Next up is Birla Corp. It has commissioned third line of production at its Kundanganj grinding unit in UP, and with this expansion, the production capacity will increase by 1.4 million ton. And lastly, coming to all the stocks which are in paints, tires, auto components, and Indigo, as the early resolution of the war should prevent disruption and even the input cost escalation is what we are expecting. So all in all these stocks will be on our radar.
Upasna, thank you for that update there. And lastly, Sudarshan joins in with cues from the F&O space. Well, Sudarshan, good morning. You're looking at a very, very sharp rebound, but the question is, can that rebound sustain? What's the F&O data indicating?
Good morning, Harmas. So as everyone has been talking about, it has become more kind of like headline market, whatever the headlines that we get either from Iran and the US, and the market reacts because it's now less dependent on the data, more on the headlines. But nevertheless, let's talk about the data. And if you take a look at the data on the F&O front, 2 things it's indicating you that first, FI selling continues. Even yesterday also there was huge FI selling both in the derivative market as well as in the cash market, and there was aggressive call writing for on Nifty. If you take a look from the level of 22,600 to as high as 24,000, there was aggressive call writing. And today, while GIFT Nifty is indicating a sharp uptick, at least in the opening trade, we'll have to see if it sustains. But 2 or 3 main key indicators: volatility index, because yesterday we saw a fall amidst heavy, amidst panic, and volatility index had risen to as high as 27. That we have seen the highest level in the last 2 years. Second, rupee continues to depreciate against the dollar. It's hovering around the level of 94. And third, Brent, while it's off the yesterday's high of 115, but still holding the levels of $100. So we'll have to keep a track of all these three main indicators to see any further uptick in the market. Now talking about the FIs. In the index futures, they continue to sell. Yesterday also they have sold more than 1,400 crore. In the stock futures, there was minor buying of 100 crore. They've added long positions of 3,800 contracts, but in front of that, they have added short positions of 13,300 contracts. FI longs exposure 15%, short side exposure 85%. On the put side, 21,500 was the most active, while on the call side, 23,000, 22,700. So for support, Nifty 21,500 would be the extreme support, but immediate support would be 22,470, resistance 23,000. Two stocks remain in the band. You know which stocks.
If we know which stocks are those, the usual suspects. Sudarshan, thank you for that update. Take a break. More news and updates on the other side. Stay tuned. Welcome back. Now, Anil Ambani has proposed a settlement scheme to repay his dues to banks. Central agencies, the Enforcement Directorate and CBI have claimed that wrongful losses to banks add up to around 40,000 crore rupees in the alleged fraud case. The Supreme Court has also pulled up the agencies, saying that the reluctance shown by the ED and CBI to probe the case is unacceptable. Ashmit is now joining in. Ashmit, tell us more about Anil Ambani's proposal and the action in the Apex Court.
Well, Anil Ambani certainly seems to think so. Not just before the Apex Court, we're given to understand that Anil Ambani wrote a letter to the finance minister. That was on the 17th of this month. It was a confidential letter where there was a clear reference drawn to the Sanjay Sara's case. Bear in mind, in November of 2025, the Supreme Court had approved the closure of all investigations, all liabilities against the Sanjay Sara family for a payment of settlement sum of 5,100 crore rupees. That's the example. That's the precedent that Anil Ambani is citing, not just before the court, but also, in fact, before the finance ministry. What he says as a part of that letter to the finance ministry is that, number one, the Supreme Court has already allowed such a settlement to take place. Number two, what Anil Ambani says in the letter is that there were closure of all pending liabilities in that particular case of Sanjay Sara's. And here's the interesting bit. Anil Ambani points out in his letter to the FM that the government, the CBI, ED, SEBI, the Income Tax Department, all the lenders were also a party to the very same settlement, going on to say that as far as the lenders are concerned, in the Sanjay Sarla's case, they were willing to negotiate and that they struck out a deal with respect to that amount in question, which in Sanjay Sarla's case happened to be 5,100 crore rupees. There was no levy of penal interest either. This was a settlement purely done on the principal dues. And finally, Anil Ambani concludes in that letter by saying that he's qualitatively, materially on a different footing, that Sanjay Sarla's were fugitives. He is not a fugitive, and that if in the case of Sanjay Sarla's an accommodation can be made, then certainly Anil Ambani standing on a materially different, on a higher footing, not being a fugitive, certainly legally it is possible to look at to consider such a settlement. So a strong case being made by Anil Ambani for settling the dues in return for closing all cases and all liabilities.
Ashmit, thank you for that update there. With that, we take your leave on this edition of Power Breakfast. From me and the team, thank you for watching. Bazaar Morning Call on the other side sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. Finally, after 24 days of conflict, we're seeing the first sign of de-escalation. Yeah. We'll have to see how that plays out, but at least there is some olive branch or a green signal.
Well, that's right. A glimmer of hope, and that's all what the markets need, right? We've been following just one way. Yesterday was a very rude trading session, and Mr. Trump decided post-market close that he has something to say, and not too bad in terms of a relief, a reason to see a bit of a relief rally. Things still very, very sketchy, but at least we have some bit of positive news, and hopefully there is some hope in terms of a breakthrough.
Indeed. So now Prashant has walked over to the big wall, and he's going to take us through all the happenings over the last 12 hours and what it means for the Lal Street today. Prashant.
You know, I was standing right here yesterday at 3:20 p.m., guys, and we kind of sort of, put the 5% chance, 5% probability that Trump will basically, after what he did over the previous 72 hours, which is, saying that perhaps on Friday he's ready to wind down, and then Saturday going, full force, Delta force, that I'm going to do this and I'm going to do that. Was this just a pressure tactic to kind of back off a little bit? And that is exactly what has happened. Sometimes these things do play out. Now, the problem is that even though, and let's just sort of put the first graphic up, right? And I'm calling it a headline roulette because that is basically what it is. You're watching this headline and that headline, and I mean, it's all a little bit confusing. But Trump essentially signaling a 5-day truce. But more importantly, what he's essentially said, the first part of that post, the Truth Social post, is we are in talks, constructive talks, which are going well to resolve the war. And to that end, I am directing the Department of War, which used to be called the Department of Defense, to halt all sort of attacks on Iran for 5 days. So, so he may change his mind, right? As many people are saying, well, what's to stop him? And he's changed his mind before. I mean, these attacks on Iran happen in the middle of negotiations to begin with. So why should anyone trust him? And that's all fair. That's all absolutely fine. But the point is we sort of, live day to day in terms of incremental news. And the incremental news is this, and the markets are moving. I'll just get to markets in a bit, right? Now, the other reason why people are skeptical, this is of course, the Iran response. So, immediately after President Trump's post, the Iranian speaker of the parliament came out and essentially said that, nothing of the sort, we'll achieve our objectives, etc. But later, Iran's foreign minister, first of all, denied that Iran was in talks with the US directly. But then he acknowledged that countries in the region were trying to get diplomacy going. And I think this is where we are at right now. So countries like Qatar, you look at what Oman's foreign minister has said. Oman's foreign minister, by the way, was in the room when those earlier negotiations were going on, and he was absolutely perplexed as to why the bombings began in the first place. There are talks that Turkey is involved, even Pakistan, for that matter. So, I mean, countries in the region and outside of it perhaps involved, but both talking to each other, to both sides separately at this point in time. Now, Arab officials, by the way, also confirmed it. There's a fair bit of reporting around it. And they're also saying that Iran has set a very high bar for ending hostilities, right? And this is the reason why people are not convinced that this is going to end anytime soon. Because and the question is pretty logical. Why should Iran stop now without inflicting more pain and cost for the global economy when, after midterms, it can be attacked again? Why should it stop without security guarantees, sanctions, etc., being lifted, etc., etc.? So, what Iran is ready to accept and offer and what US is ready to accept and offer, I mean, the gap, of course, is pretty wide. But as I said, perhaps the first step in terms of, it's always going to be one step forward, 2 steps back with regards to any kind of de-escalatory comments. And I think we've seen the first. So let's hope that this really is the first, and we'll see more. Now, Israeli Prime Minister Netanyahu said that he basically, I just want to put this up because he's confirmed that President Trump, he spoke with President Trump about ending the war. British Prime Minister, by the way, also said that UK was aware of talks between Washington and Tehran. So just wanted to put this up that, you know, President Trump didn't sort of imagine these talks, which are absolutely non-existent. There are other countries who are also saying that, you know, something is going on. Now, oil prices, they fell 10%. They're back. I mean, I think this morning when I looked, they were at about just under 100. We're about back to about $104 odd or so. The S&P 1%, the Nasdaq 1.33%. The Russell 2000 was up about 2%. I saw 10-year yields. By the way, the 2-year yield hit 4% and then came off and closed at about 3.85 or so last night. This is the equity picture. Gold prices, they paired losses. They were down 9% at one point. They closed about 3.5% lower. And so this is where we're at. Remember, you know, this is an actual hot war which is going on. And the proof of the pudding is going to be in its eating. So as the day goes on in Asia right now, people are going to be tracking whether the bombings are still going on, the attacks are still going on. And if the answer to those questions is yes, I mean, you know, markets are going to lose steam pretty quickly. So keep that in mind. And that's the reason why I said it's headline roulette more than anything else. The levels will come up on your screen. We closed at the lower end of the falling channel. The Nifty the channel support is 22,470. And the resistance is 22,800. If 22,800 is taken out, the next resistance is the swing high of 23,345 or so. So that's the picture. As I said, watch what actually happens on the ground along with the commentary for a better sense of where we are headed. The implied open is up on your screen. It's around the 22,900 level, which should be about, I think, 300 odd points higher from the futures close yesterday. The positioning and the layout there, Nigel has got that. Nigel, over to you.
All right, before that, let's just do a quick check on Asia, because what's happening is that the gains are dissipating. The Korean markets had opened up strong with a gain of 3.5%, now only up about 0.5%. Similarly, even for the Japanese market, it was up 2.5% at the session highs in the morning, and now the gains are just about 0.5%. Taiwan is actually down in the red. That's lost close to about 0.5%. Hang Seng is holding up, though, pretty smartly. That's up nearly 1%. So it's a mixed picture. There are gains that you can see across Hang Seng, Korea, the Japanese markets, but clearly not euphoric. What could be capping the gains is the fact that crude prices have once again risen. After going down to levels of $91 per barrel, we're now back at 94. So risk on. There's no risk on frenzy, but there is. Some of the markets are in the green, seeing a relief rally. But Nigel, what about the F&O action?
Well, confusion on the geopolitical front continues, with Trump tilting towards smoking the peace pipe. But as of now, Iran doesn't appear to be game to play ball. But today is likely to be more of a risk-on day. Crude prices, yields, dollar index, all of them have cooled off in comparison to what we ended yesterday with. So today, in all probability, it should be risk-on. But the bigger focus is where we end. And the bulls will hope that this kind of gap up that the GIFT 50 is suggesting, we actually close with some solid gains. For me, though, the big takeaway is crude oil prices may not get to that $130, $150 per barrel, which was earlier feared. Remember, on March 9th, we went to that mark of closer around $120 per barrel mark. The Nifty in that session corrected by closer around 400 points. But since then, crude hasn't revisited this mark of around $120, but the Nifty has been falling on fears of that surge in crude oil prices as well as heightened geopolitical tension. As we speak, crude is at around the $104 per barrel mark, but the Nifty has already pulled back considerably from the time we saw that $120 per barrel mark. So the hope is that that feared $130, $150 per barrel mark is not breached, in the times to come. On the flow side, the FIs continue to remain sellers. The DI buying to offset most of the FI selling. But going by the NSDL data, we are bracing for the highest ever monthly FI net sell number reported till date. Keep in mind, the NSDL data comes with a bit of a lag, so the FI net sell number is already approximately 1 lakh crore rupees in a single month. Today, hopefully, there will be some stability in the rupee as well, and that will be the important cue to track from the FI flow perspective as well. Moving to the futures and options space. Well, on index futures, FIs added closer on 3 short positions for every 1 long position. The FI shorts continue to hold at around 85%, while they also wrote closer around 8 calls for every 1 put. So there was aggressive call writing that we saw. And since today's weekly expiry, the call writers are around 22,500, 22,700. They'll be in trouble with this gap up. They could be forced to unwind the positions that we saw yesterday. These writers could be in trouble. The Nifty continues to remain in a range. The recent high, last week's high towards the end of the week, we saw that high of around 23,350. That'll be the first level of resistance. While the Liberation Day low at around 21,700, that is likely to be a very, very firm support. My gut is this Liberation Day low could hold out, and probably a large part of the correction could probably be in the price. Let's see how that goes. The India VIX, though, that's the worrying factor. It scaled to a couple of year high yesterday, but today it'll cool off to start, and you'll want it actually to gradually drift towards that 23 odd mark. Since crude oil prices have dropped overnight, you could see a bit of a trading bounce in various pockets, whether it's OMCs, Interglobe Aviation, as well as Spain stocks. The GIFT 50 is suggesting a 350-point gap up. You'll want to end with this sort of gains, because otherwise the correction has been quite brutal.
Well, indeed, we've erased about 50 lakh crore in market capitalization in the last 24 days since the start of the conflict. Jahangir Aziz, head of emerging markets economic research, JP Morgan, is now joining in. Thank you very much for joining in. How would you read the reversal from Donald Trump? Are we getting ahead of ourselves, or do you think this is the start of the end?
Look, I mean, that has been the market belief for a while, right? So that given the midterm elections, etc., and the political needs, if the economy or the financial market before the economy reacts badly through inflation, obviously, that the president would be scaling back. The question has always been that even if the U.S. scales back, would Iran follow suit in basically letting safe passage through Hormuz? And that's always been the question. I think the 5-day negotiating timeline that has been put forward, let's see how that turns out to be the case. You yourself were talking about how the market really moved up at the beginning of the trading day, and then by the end of the trading day, you saw things quieten down a bit. If you look at calls, if you look at puts, they didn't really move very much, not anywhere close to what a news like this would have actually, most likely would have entailed.
Yeah. So skepticism, right, Jahangir, in that sense. Absolutely that's the case. So fog of war, whatever you want to call it, and no clarity yet. So oil, at the end, for financial markets, there is the cost is coming through from energy prices and oil and everything which comes out of oil. That's the trajectory seems to be a lot higher for a lot longer. Jahangir, is that correct? What's the base now for you?
Yes, so we don't really have, I mean, there's too much uncertainty to talk about a baseline, right? I mean, Friday there would have been one baseline, and then Monday we would have to turn to another baseline if we were going by changing forecasts. So I think here is the arithmetic that we are working with, right? The arithmetic is the following, that there are 60 million barrels a day that goes through the Hormuz Straits, of which mitigation, for example, with reserves from OECD, reserves from China, reserves from Indonesia, Malaysia, and other small countries, plus additional flow through the pipeline from Saudi Arabia to the Red Sea, all of that can sort of take down another 6 million barrels. So if Hormuz remains closed, then there is a $10 million barrels a day gap between supply and demand. And this is the near-term arithmetic. And if you look at oil prices, let's take 100 was the average between Friday and today. Brent prices, that isn't really reflective of this 10 million barrel shortage. What is reflective probably of that shortage is what is priced in Dubai and Oman, which is clearly much higher. So life will be somewhere in between the two of them. In the event we end up with a $10 million barrel shortage, and that's where I think the uncertainty is. How wide is the range? Where does it fall? And I think that's what we're grappling with. So that's the first part. The second part of the argument is that let's assume that the war comes to an end. Let's say that we go back to Hormuz being opened. But even then, given the shock and the disruption that has been caused in the months or in even the years following, I think almost every country is going to increase their amount of reserves so that future prices will not only reflect the current supply and demand, but also this additional demand of increasing reserves. I think that is going to be the case for almost everyone.
Hi, Jahangir. Good morning and good to see you. Ben, what about the Indian rupee? I mean, that showed some signs of stability at around the 92, 93 odd mark, and now it's pulling very, very swiftly towards the 95 mark. There are fears with regard to the flows not coming in. The deficit number could be a little bit larger, and maybe economic growth does slow down as well. But do you think it's extended itself a little bit too much, or on the downside, and there should be some stability, some reason to pull back from here?
Look, I mean, I've always made the argument that if you look at the actual current account deficit, even if you add the current oil prices and the added current account deficit, India in the past would very comfortably fund that current account deficit. It used to be 1% before this oil price shock. Maybe it's gone up to 1.5%. Who knows? But let's say it's 1.5 percentage point. If 1.5 percentage points of GDP was the current account deficit in any year, most of us would say that was a very, very good year. The problem is that even with this low current account deficit, India's unable to fund it even before this oil price shock happened. So clearly, if you're just looking at flows, I mean, if you look at current account, the usual driver of the rupee, you will shrug your shoulders and say, yeah, I mean, all of this is overdone. But then the question is, what's really happening at the capital account? And I think much less is being focused on the capital account than we should be focusing on. And a particular aspect of the capital account is the fact that foreign direct investment has been skating water. And that's really where the problem is. It's not so much that, portfolio inflows are not coming in. If you have interest rate differentials of this kind, portfolio inflows won't come in. I mean, we know that. It's really where the foreign direct investment is skating water. That's where the problem is.
So how do you model the macros, Jahangir, in such a situation? As you said, right, the key question is whether Iran will follow through and open the Strait of Hormuz. Israel and Iran have been fighting now for 47 years. Even Israel has to yield and accept. So how does one go ahead? I mean, what are the base cases? What are the assumptions that you are making when you model?
So when you model it, I mean, look, regional conflicts, however, detrimental it is to the region, are almost always regional conflicts, unless there is a global variable that connects the world. And in this case, it is clearly oil. So oil is the driver. As I was saying, that even if we do get a resolution, yes, I mean, there's going to be a short term. There's going to be a drop in oil prices simply because there is many tankers sitting waiting to move out of the straits. But in a medium-term basis, I think the $60 oil that we were looking for, based on just supply and demand, I think that just gets pushed up. So we have this factor of oil demand. And then, as you talked about, there is a growth destruction. And we haven't seen that growth destruction as yet. We've seen little bits of that happening. Market clearly is right now pricing in only inflation spike. Look at the movements in the short-end rates. No one is really focusing on the growth impact. Obviously, if the conflict lasts, if we get a sustained spike in inflation, there will be the growth impact that's coming through. In the case of India, I think, you've heard me many times talking about how much of India's growth is driven by what happens to WPI. And WPI literally is driven by crude oil. This time around, unlike the previous 2 years when crude price was on the slide and it boosted growth up, I think 2Q growth in India is going to take a tumble simply because of the same statistical problem that we've seen over the last 2 years, because WPI is going to rise.
Yeah. Jahangir, we leave it there. And I think It's just crazy amount of news and headlines, right? I mean, as someone said, and I just go back to that, thinking about that line that someone said, well, human beings are not built to track this amount of news flow, right? And just sheer dissonance hitting you from all sides. And you're supposed to sort of react and comment on it or whatever. I mean, it's just crazy, absolutely crazy. But it's been like that for a while. Thank you very much for being here and appreciate your time here as always. Well, I'll just quickly run you through the interactions lined up on the program today. So coming up at 8:35, we have Sandeep Parekh of FinSec Law Advisors to discuss SEBI's board meet outcomes. 9 o'clock, we'll be joined by Jonathan Barat of ETO Markets. Oil is in focus once again. Tahir Badshah joins us at 9:20 with Invesco Mutual Fund. He's a market master of the day. 9:35, NLC India management joins us on F527 Outlook and beyond. Management of Titagarh Rail Systems. You'll hear from them at 9:45 on the business outlook. And Lata in conversation on the impact of Iran war and US macros with David Merkel of Goldman Sachs. So that's a big global face you will hear at 10:15 or so.
All right, time for a short break. But when you come back, we'll go full tilt on the stocks that we'll be tracking for today in our special Top 10 segment. We're looking at OMCs, CGDs, city gas distribution companies, that is, tire stocks, auto ancillary stocks, Interglobe Aviation, all of them will be doing well. So they'll open up in the green. Exporters, Asian Paints, Coal India, IRFC, and Tata Power. All of them will be reacting favorably to the news flow. Take that break. You come back. We get into further detail on all of these names.
Welcome back. Let's talk stocks now. Our research team is standing by with CNBC TV 18's list of top stocks for the day. We'll track the gyrating move seen in crude prices. From a high of 115, we went down to levels of sub-100. The low was 91.7 and now back again. How should oil and gas companies move? Sonal now joins in with her analysis. Sonal.
Well, you know, there's been a lot of volatility in crude oil prices as well. The talks around de-escalation that led to crude oil prices fall sharply below that $100 per barrel mark. But then again, things changed. There was a statement coming in from Iran as well, and that's when prices jumped back to levels of $103 per barrel. But still, it is a relief from the levels that we saw yesterday, right? Additionally, we did see gas prices fall overnight as well. And we do know that there are two LPG tankers carrying 92,612 tons of LPG passing through the Strait of Hormuz to come to India. So that means there could be more supply of LPG, which has been an issue in the country so far. So this is some positive sentiment that has come by, and considering that it impacted oil and gas space the most, expect some relief in these stocks today as well.
Okay, all right. Thanks a lot for that, Sonal. Well, hopping across to Sudarshan. He's tracking a few more companies, tire stocks, auto ancillaries, as well as Interglobe. Morning, Sud.
Good morning, Niall. So all the companies which are dependent on crude derivatives might see a relief rally today and tracking the fall in the crude prices that we have seen overnight, while in the morning trade, crude is sharply off lows and currently trading around $104 per barrel. So I've just taken some of the major input costs. So starting with the auto companies, steel forms almost 50 to 55% of the overall cost, and trend in the last few weeks, as far as steel price is concerned, it's been largely stable, and it's the same for aluminium and copper. Freight costs have increased, and that forms almost 3 to 5% of the total cost. And also rupee depreciation also is going to be an overhang for the auto companies because of the dollar denominated cost increase because of rupee depreciation. Coming to tire companies, natural rubber forms 30 to 35% of total cost, and price in the last 2 months has seen an increase of 10%, and synthetic rubber forms 10% of the cost, and that also has seen an increase mainly because of an increase in the crude price. Last is airlines. All the costs for the airline companies have seen an increase, whether you talk about ATF, aircraft lease, insurance, or the crew cost. Everything has seen an increase. But for today, I'm going with the green because of the fall in the crude price.
Thank you very much for that. Over to Ria now. She's tracking some exporters.
Well, yes, good morning. Exporters will be in focus today since the government has restored the full export incentives under the remission of duties and taxes on exported products scheme amid the ongoing conflict in West Asia. Now, remember, last month the government had halved the rate of duty benefits, but now they have said that full benefits will be restored with effect from the 23rd of Feb up until March 31st for all eligible export products. Now, it is to be ascertained going forward what will happen post the 31st of March. But for now, this is a positive development for all of these companies, and exporters will see reduced tax burden as a result of this.
Okay, got it. Thanks a lot for that, Ria. Well, hopping across to Upasa, there's some positive news flow on both Coal India as well as IRFC. Upasa, take it away.
Good morning. First up, let me start with Coal India. It has received in-principle approval for divestment of up to 25% stake in southeastern coal fields via OFS, and in addition, there'll be an issue of 10% equity shares of SECL via IPO is what the company has indicated. Next up is IRFC. It has signed a loan agreement worth 12,842 crores with HURL for refinancing of the long-term debt. So all in all, these two stocks will remain on our radar today.
Thank you very much for that. Manglam now joins in. Manglam, Asian Paints has effected a price hike.
That is correct. So last week we had a bunch of other companies announce 2 to 3% sort of price hikes. Asian Paints had gone ahead and announced a price hike in 2 phases on April 10th and April 21st. The quantum is between 6 to 8%, and this is on account of the ongoing geopolitical uncertainty, the increase in packaging costs and increase in the cost of crude as well as logistics. So all these factors. The smart thing here is that a lot of the premium products have been, the price hikes have been effected from April 10th, and a lot of the volume drivers and some of their fringe products like adhesives, etc., waterproofing, etc., have been on April 21st. So what this means is that they get the maximum benefit of a price hike on their premium portfolio and the maximum benefit of volumes by, in delaying the price hike on those volume drivers as well. So this balance is fairly good. Importantly, the decline in crude prices from highs yesterday would be a further tailwind. So let's see how this pans out. April 10th is where the companies announced price hikes from. The other parts of the industry have done 2 to 3% with a promise of increase later. So Asian Paints, instead of doing 2 to 3% twice, they've done 6 to 8% just once. See green on that stock.
Got it. Okay, all right. Thanks a lot for that, Manglam. Going back to Vivek. Vivek, Tata Power, positive news flow?
Well, that's right. Positive news flow. Remember, the company had earlier intimated the exchanges that they had reached an agreement with the Gujarat state government for signing a supplementary PPA to supply power from the Mundra power plant. So today there has been an update saying that the company has gone ahead and executed the supplementary PPA with GUVNL. Now, along with that, the company has also told the exchanges that the company is going to go ahead and execute similar supplementary PPAs with the other states. So there are 4 other states: Maharashtra, Rajasthan, Punjab as well as Haryana. Just to give some perspective, 50% of the power offtake from Mundra goes into the state of Gujarat, and the remainder 50% goes into the 4 other states. So this is a positive development. Remember, the company made close to 1,000 crore loss on the bottom line due to non-operational of Mundra power plant. So this definitely is positive as far as Tata Power is concerned.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are oil. All the companies which will benefit from the decline in crude prices versus yesterday's level. So oil marketing companies, CGD, tire stocks, auto ancillary, Interglobe Aviation, exporters, Asian Paints, Coal India, IRFC, Tata Power, all these stocks could open up in the green. We don't have any stocks, at least based on news, which is likely to open up in the red. But now let's talk about commodities and currency. Manisha now joins in for a complete roundup.
Well, thank you so much for that. I'll start with the crude oil prices, where it continues to be a very, very volatile market when you look at last 12 or 14 hours. We did see crude oil prices trading at 113 same time yesterday. It's trading at 103 at this point in time, with 4% of gains coming in. The U.S. president saying that he's postponed attacks on Iran energy infrastructure by 5 days is what the markets have reacted to, while, of course, there are various theories going around that the prices started to correct even before that. Well, Saudi Arabia and UAE taking a step towards joining the Iran war as per various reports is something that the street will watch out for in various details. But interestingly, even as when you look at the U.S. crude oil prices, they are trading at $92 a barrel as of today. But when you look at the August futures, that is trading at $80 a barrel. So it's trading in a backwardation right now, with the markets believing that once the dust settles, you could perhaps be looking at weaker crude oil prices going forward. Having said that, when you look at the metal prices, well, some bit of a support coming in here as well. Copper is trading a percentage point higher. Gold prices, after hitting $4,100 an ounce yesterday, are trading at $43.50. Same goes for silver as well. After hitting $60 an ounce yesterday, it's trading at $68 an ounce at this point in time. Of course, for the month of March, it's very sharply in the negative, but some support in Asia has continued today.
Yeah. Manisha, thank you very much for that. So there is, of course, oil in focus. By the way, there are also reports coming in that a large U.S. refinery in the U.S. is seen, unrelated to the war in Iran, etc. But this is an onshore refinery in the U.S. Which has seen an explosion. We don't know the scale, the damage, etc. But apparently it's a very large one. So, that news comes perhaps at the worst possible time. When supplies are anyway tight. So that's on the refined product side. It's the refinery. So we'll keep a track of that as well, whether that is likely to have any impact whatsoever. 103, 103.5 or so is where Brent is trading at right now. We'll take a break. Sandeep Parekh of FinSec Law Advisors on the SEBI board meet outcomes. Stay tuned, coming up.
Welcome back. You're tuned into Bazaar Morning Call, and for starters, it's appearing to be a better morning today because the gift Nifty is suggesting at least some green. Well, one big stock that will be in focus will be HDFC Bank. So Sudarshan joins us with some bit of the news flow that we got in, as well as it's been a volume buzzer. Sud?
So the fall in HDFC Bank is important because mainly its weightage in both Nifty and the Nifty Bank. Though as far as the stock is concerned, it's at 52-week low. It's amongst the, if you take a look at all the Nifty stocks, it has fallen the most. It's in the top 5, and it's down 12% in the last 4 sessions. And if you talk about the valuations, currently price to book value for FY27 is 1.8 times, much below the 5-year average, that is 2.7 times. And the fall started after the news flow that started on March 18. Late night on March 18, we got the news of Atanu Chakraborty, who was part-time chairman and the independent director. He tendered his resignation. But the most important part was the reasoning of the resignation that he has given. He said certain practices not in congruence with the personal values and ethics in the last 2 years that he held that post. And after that, K.K. Mistry was appointed part-time chairman, and that was approved by RBI for next 3 months. Next day on March 19, HDFC Bank CEO spoke to CNBC TV 18, and he said there was no friction between him and Atanu Chakraborty, and he tried persuading him to remove some of the contentious lines, and those lines have caused a little bit of stir among stakeholders and the investors. As far as the bank is concerned, he said foundation of the company remains intact. Now today the latest update has come that HDFC Bank has appointed external law firms to review Atanu Chakraborty's resignation letter and law firms to provide report within a reasonable period of time. Now, if you talk about delivery and volumes of the stock, so stock has been falling with healthy delivery volumes. So yesterday also, delivery percentage was at 61% versus 1 month average of 58%. If you talk about the derivative data, we continue to see long unwinding, and volumes of last 3 sessions have been the highest that we have seen in last 6 months.
Thank you very much for that. In fact, yesterday, post the SEBI board meeting, Tuhin Kanta Pandey was also asked about this particular issue. And what he said is that independent directors are required to adhere to a certain code of conduct. If there are certain concerns independent directors have, then it should be recorded in the minutes of the board meeting. Listen in to those comments because they come specifically for HDFC Bank.
Vote for IDs under Schedule I-4. Where IDs are required to adhere a certain code of conduct. And IDs have, where they have, in this code, it's written that where the IDs have any concerns about the running of the company or a proposed action, ensure that they are addressed by the board, and to that extent that they are not resolved, insist that their concerns are recorded in the minutes of the board meeting.
Absolutely. And, SEBI has eased the norms for FPI transactions, permitting the net settlement of funds for transactions by FPIs. Just want to play out, SEBI Chairman Tuhin Kanta Pandey on this particular issue as well.
Currently, FPIs settle their transactions with custodians on a gross basis, which results in additional costs for FPIs, including funding costs and foreign exchange slippages. Recognizing these concerns and with a view to enhancing operational efficiency and reducing cost of funding for FPIs, it has been decided to permit net settlement of funds for outright transactions done by FPIs in cash market. And what are these outright transactions? That is transactions in which there is either purchase or sale transactions, but not both in a particular security in a settlement cycle.
Sandeep Parekh, managing partner FinSec Law Advisors, is now joining in. Sandeep, there is this one, the comments that he made on HDFC Bank, which we played earlier, and the second one is the net settlement for FPIs. Now, it seems like a market-friendly move, especially on high-volume, volatile days, like your index expiry, rebalancing, etc. How significant is this move for FPIs, this net settlement?
I think it's a significant move, really, in terms of because money has a cost attached to it, and I think one day, if you're looking at thousands of crores, it is a big number even for one day. So it really makes the entire process more efficient. At the same time, it doesn't increase risk to the system. because there is a sale transaction of in stock A and a purchase transaction in stock B. So, subject to the sale getting executed, there is no requirement if it's the same amount. There's no requirement to put up that money because you're expected to get money. So it will bring in a lot of efficiencies for the FII. So it's kind of a net benefit without kind of additional risks being introduced to the system. So I think it's a great move.
Okay, and on HDFC Bank, separate, there's one part about what Tuhin Kanta Pandey said, that if there are any concerns, independent directors have voiced them, recorded in the board meeting. But separately, the bank has also intimated to the exchanges that they've appointed external law firms to review the letter of the chairman. What exactly what exactly do you think the lawyers will be able to help in this particular situation? What does review the letter really mean?
No, I'm not commenting on HDFC Bank because I sit on the board, so
all right,
I won't comment on that.
Sure.
Sandeep, just to go back to the first point, that net settlement point, morning Prashant here. So you're saying that you don't have to wait for the money to come into your account for you to be able to do the next leg of transaction. You sold something.
That's right.
And you can do it immediately. That's what it means after execution?
That's what it means. I think the original restriction came as a consequence of not allowing intraday transactions, that you don't want FPIs to come to the market and punt.
Yeah.
But there's frequent rebalancing that is required. So, if, for instance, if they're following an index, they remove something from their holding and buy on the same date. It has to be the same date, and that adds the cost of getting in funds which are not required, right? So instead of 100 crores required to purchase and net zero required, ultimately you saving that float of 100 crores for one day. So I think it brings in a lot of efficiencies for the FPI.
That's true. But that efficiency, is it available for local investors, you and me, Sandeep? No, right?
Yes, it is. It is available. It is available.
I think there is some percentage you can sell. You sell, say, 100 rupees worth. You're able to use some 50 rupees, 60 rupees worth of stock, right? And the rest comes in, T+1, T+2, depending on what stock it is.
No, for retail as well, as soon as kind of you sell something, you get credit. Again, may depend from broker to broker. But most brokers do provide, the exposure of the amount that you sold, because it's guaranteed payment, right? The clearing corporation is guaranteeing every trade, so there's no chance of failure. So, yeah.
Yeah. Okay. Fair enough. Maybe it's a broker to broker kind of thing. The other point on this net settlement business, Sandeep, is there has been. And I was told this, that there is worry around what's happening with all these high frequency algo. I mean, the J and Jump, Citadel kind of institutions in the market, and what they did. There's a SEBI order which Anand Narayan had passed before he sort of retired. Will this incentivize and make it easier for those firms to operate? Because they are in and out 1,000 times a day, right? So if you're saying now that you don't have to bring in fresh capital, every time you sell, you can use that amount for the next leg of transaction. So does that work?
No.
Yeah.
No, so it doesn't help them really, because this is really not intraday transactions, which FPIs are not supposed to do, right? So it can be another entity which does intraday, but usually, it's usually a local entity which does intraday, because FPIs are not allowed. So this will really only help people who are actually doing delivery trades and they need rebalancing their portfolio. So it's not meant for intraday trades in a single stock.
I see. So this is only for cash market, not for futures and options.
That's right.
Yeah.
Cash market also, remember, it's not applicable to intraday trade of stock A. It's only when you buy A and you sell B is when it's the benefits really percolate.
I see. Anything else out of that board meet, Sandeep, which caught your eye?
So I think, So I think the other thing is, I think the code of conduct has been implemented, which is, I think, quite a, I would say quite a bold and needed change in the way, SEBI looks at its own internal governance. So I think it's a very important signal to the market that all the issues which happened in the last regime would get cleared up. more transparency, more accountability. So I think it's a great move. And I think the third thing is the fit and proper guidelines which have been amended, which essentially say that, till the time you're convicted, we'll hold you not guilty of a crime, right? So all the bars from acting as an intermediary, etc., only apply if you're either debarred by a regulator or there's a formal conviction. And I think that's a fundamental rule of law that you're only liable if you're held guilty by somebody and not before that. So the question of FIR and charge sheet causing an intermediary not to be able to register, not to be able to do business has been done away. It's a great move, I think, in my view, because everybody is considered to be innocent till they're proven guilty.
Got it. All right, Sandeep, appreciate you joining in and giving us your quick take. We look forward to chatting up with you in the coming days as well. Thanks a lot for joining in. Well, let's welcome Mayuresh Joshi, Director Research Marks with India, who joins us on the show. Hi, Mayuresh. Good morning and good to see you. It's going to be an interesting trading session. Crude oil prices have cooled off, at least from yesterday's high. They're perking up a little bit right now. But what's your view, particularly on a frontline name like Interglobe Aviation? One would think that, this one has corrected a large deal from the top. And near term, there are headwinds, no doubt, in terms of capacity, in terms of ATF price hikes. However, it's the market leader. And it's, valuation-wise, it's at least a little bit more palatable. Your take?
Morning, Michael. Yes, a sense of relief, at least for today, in terms of what is happening with crude and global markets, as well. Asian markets have probably opened far higher with the news flow coming through. For Interglobe in particular, you're absolutely right. I think there are headwinds and there is a tailwind as well. If crude cools off, a large component for aviation companies, almost 45% of their input cost is determined by the ATF prices. And therefore, if crude cools off, based on all the events unfolding over the next few days, I think that will be a confidence booster, because as input costs will go lower, the expectation in terms of better stability in terms of numbers should largely get played out. Secondly, I think in terms of all the issues that the stock was probably facing over the last few months, and the regulatory penalties and fines as well, the expectations in terms of as the escalation probably comes down, and if that happens, I think the routes that will probably open up specifically to Europe and the Middle East, which are more profitable routes compared to the domestic routes, I think that can start adding in terms of EBITDA contribution as well. And therefore, all the key parameters for aviation companies in terms of available seat kilometers, the revenue per seat kilometer, should largely start improving. But there are a lot of ifs and buts, Nigel, attached to it. Therefore, I think taking a call in terms of holding it in your portfolios or adding it in your portfolios from a long-term perspective, we still will like to wait and watch. From a swing perspective, yes, I think that can be a tactical case.
Yeah, got that. Mayuresh, morning, and that's something to track. Just a quick word, Mayuresh, on the levels itself at that, if you have any thoughts. The Liberation Day low was about 21,800, 21,743 to be precise. This morning we'll start a little higher at about 22,800 or so, if the GIFT Nifty is correct. Just your assessment of this entire thing, if there is a way to do it. Or you think, the better thing to do is, start to pick up things you like at sensible prices, as we've discussed in the past as well. Mayuresh, what's your feeling?
Morning, Prashant. I think levels can be broken down based on the news flow that can probably come to effect. To define a level probably becomes an impossible task. However, I think if the headline index corrects further, another 4-5%, I'm not saying that it will, but if it does, I think the forward multiples will then start factoring in earnings growth of around 10 to 11%, assuming that the escalation continues and the second order effects in terms of inflation, growth dynamics going lower, etc. start playing out, and earnings recovery probably gets delayed and pushed back to H2. So I think it will become attractive levels. And therefore, I think certain sectors which are probably holding up relatively stronger compared to the rest of the pack at this juncture, sectors like pharma as an example, sectors like energy, and with energy, I think select power themes can continue doing well. And therefore, I think your positioning should be that you should start gradually entering these stocks within this sector itself, because here I think the earnings growth will remain reasonably strong. The second element, Prashant, is that you never know. I mean, if the de-escalation happens faster than one probably thinks and on the right track, staying underinvested in these markets might mean that you will probably miss out on the first leg. We're okay with that, because I think what will probably happen is that you will still get your chances, but at least there is some element of surety that I think the worst is probably behind that, and there is some element to look forward to in terms of sectors probably doing.
Yeah, no, got that. You know, what we'll do is we'll take a break. There's, by the way, an order for Kalpataru. Kalpataru has received an order for about 4,400 crores for their transmission and distribution business. We'll try and speak with the management a little later on the program as well. Take that break. Mayuresh, of course, is with us. We'll also connect with Sudeep Shah of SBI Securities and Mitesh Thakkar for technical trading ideas. So that's coming up.
Welcome back. In conversation with Mayuresh Joshi of MarketSmith India. Mayuresh, we were just discussing HDFC Bank. So Sudarshan was telling us that how the stock has corrected 12% in the last 4 trading sessions. Valuations are now at 1.8 times versus a 5-year average of 2.7 times. There is more news flow. The company has proactively hired an external law firm to understand and review the situation surrounding the chairman. What are you all advising from an investment point of view?
Morning, Rima. No, I think two things. One, I think in terms of the price performance over a longer period of time, it is where it was 5 years back. Obviously, I think the regulatory developments and the issues that have now surrounded the bank over the last few days, the valuations, in no other words, have become very, very attractive, both on a standalone basis and even if you add the subsidiary component to it, valuations still remain very, very attractive on a consolidated basis. However, like we've seen in the past, where corporate governance issues and allied issues probably start creeping in for banks, the confidence to come back from an investor perspective takes time. The second element in terms of the core banking performance itself, My own sense is for larger banks with larger deposit bases and larger balance sheets, how is the deposit accretion going to come about is something to be looked out for. Because clearly, I think if deposit growth lags, the overall headline number that we've seen in the past, the entire scenario in terms of how numbers will play out over the next few quarters start dwindling a tad bit. And therefore, I think credit deposit ratios might start coming off. You might have better showing in terms of names, asset quality, etc. However, I think from a core performance perspective, I would still like to track, at least for the larger banks on the private space, how deposit accretion is probably happening. So you'll get your incremental bounces as the market probably bounces back. But is there going to be a steady state recovery going forward? We'll still wait and watch. So as I've discussed in the past, I think something like an SBI from the public sector space, if it pulls back, I think this is one stock that we'll keenly keep on a radar to probably add on declines.
Okay, all right. Got that. So add the stock on decline. What about tech, Mayuresh? Yesterday that was actually the outperformer for majority of the trading session. Towards the end, there was big selling that suddenly crept in. So I think that index as well went on with a bit of a cut. But it was relatively outperforming. Even if I look at it, month to date, the tech index actually has done relatively better. What's your view on tech and what do you like from there?
So Nigel, again, I think looking at the markets and the way they are reacting in terms of news flow, it does become a defensive bet of sorts. However, our own sense is that the kind of disruptions that AI is probably creating at this juncture and how the companies are probably gearing up in terms of organic growth as far as AI is concerned, it's still a long, long way to go. And therefore, I think at Markets with India, I think our take has been that we'll keenly watch out for Q4 numbers. What we are also looking at the global scale, as far as the US and the European markets are concerned, we are also keeping a close watch in terms of the announcement that all these hyperscalers have probably done in terms of their capex plans. And therefore, how numbers will play out from a Q1 perspective. So both from a global as well as the domestic perspective, we are keenly watching out for Q4/Q1 numbers, which will give us a fair idea in terms of how the entire sector and the industry is moving. Management commentaries across domains, across various companies will also give us a fair idea in terms of the outlook for the sector over the next 4 to 8 quarters. So I think we'd wait and watch both on the local and the global scale for this quarter's numbers to come.
Right, Mayuresh, we'll talk again. Thank you very much for this morning's conversation. Appreciate it. And let's hope that some of the gains last as we start up. We'll take a break. We're back. We'll get you some technical trading ideas. Midesh is going to be with us. Sudeep is going to be with us as well. And we'll also have Jonathan Barat of ETO Markets to put the spotlight on oil prices. So stay tuned. Coming up. Welcome back. I think we are hitting market pre-open in about a minute or so. The market open still about 15, 16 minutes out. Well, in the wake of Atanu Chakrabarty's resignation as the part-time chairman and independent director, HDFC Bank has appointed external law firms to review his resignation letter. Shireen is now joining in with more details on the story. Shireen, good morning. Take it away.
Good morning. This is really an attempt to find closure in this matter, is what I'm given to understand, and quell the uncertainty that Atanu Chakrabarty's resignation has raised. So essentially what has been done is that law firms have been appointed, and the reason why it's law firms is because HDFC is, of course, the ADR is also listed, and it is, of course, listed here. So I would imagine that there are two aspects that are being looked at this point in time. Now, what is this law firm essentially going to do? It is going to review whether there is need for any strengthening of the governance processes. It's going to be a reflection and an assessment of HDFC Bank's internal processes. I would imagine, since Atanu Chakrabarty's resignation letter did not highlight any specific instances of the incongruence that he talked about when he put in his resignation letter, this is essentially going to perhaps go over minutes of the board meetings and so on and so forth to review whether there were any concerns raised, how those concerns were addressed, and essentially recommend to the board any ways of strengthening internal processes and so on and so forth. There is no timeline that has been specified as of now, but I would imagine that this is going to be an exercise that the bank would want to close as quickly and as early as possible. So the appointment of external law firms is a proactive measure that's been taken by the bank. It will independently look at the aspects that have been mentioned in the resignation letter. The aim is to ensure an objective and fact-based assessment of what has transpired. And the idea is to ensure that this is a measure and a step to benchmark HDFC Bank with the highest governance standards. That's essentially the plan at this point in time.
All right. I think the stock is up about 2% as the pre-open is kicking off. Shireen, thank you very much for that. That's helpful and important to take note of. Well, 759, 760 is where the stock is opening up at this point. Things will settle about 5-6 minutes in, and you'll get a better sense. But I think it's important also to look at the Nifty, the pre-open, right at the word go. The rupee should come up. It's at the bottom of the screen. So it's a 30-odd paisa strengthening in the rupee. So it's been one way, very fast. And you're saying you're going the other way a little bit. So 93.64 compared to 93.98. So some relief for the currency. And let's just look at the Nifty as well, because both are, of course, related. 1.6 higher, so that's about 400 points up in the initial first rates as far as the pre-open goes. 22,873 is the Nifty pre-open. Let's just put the Nifty Bank pre-open rates on the screen. Yeah, let's just keep those up at the bottom because that is going to be useful in that sense. 1,600 points on the Sensex as well. Sudeep Shah of SBI Securities and Mitesh Thakkar of Bonanza Portfolio are with us with what they'd want you to do in terms of trades. Gentlemen, good morning. Good to have both of you here. Mitesh, you go first. How are things starting up? And, you know, is this a gap up to be faded or to be trusted?
Morning, Prashant. So I think, while there's a good gap of about 350, 400 points, I think the most important test would happen if the Nifty were to face yesterday's gap down. So till that gap is filled, which means that Friday's low of 23,114 is captured. I think, I'll be slightly, not very comfortable with going aggressively long. I think let's fill the first gaps. Believe that there was some exhaustion gap, and exhaustion gap gets typically filled in about 3 to 5 days. So if that happens, then maybe we'll turn the short-term view on the positive side. Till then, I think I'll still hold my horses. Though on stock-specific basis, you can have some longs and stocks which are oversold, reversing from support levels can still be traded. But on the index, a good reversal will come only if we start getting past 23,120.
23,120. That's the important mark. Got that, Mitesh. Thanks for that. Sudeep, what about you? How are you feeling about this morning? Green after a while, and it could be bright. But is this a shorting opportunity?
Good morning, Nigel. It's really good to see green at the opening for a while, but how long it sustains is very important. And I agree with what Mitesh says that 23,100, 23,150 are on my radar also, these levels. because unless and until these levels are captured, there could be sudden bouts of selling pressure from higher levels, and we are not yet out of the woods. So what I feel is that the range has become a bit bigger, and so is the volatility. So 22,600, 22,700 on the downside would act as a strong support, while any signs of, say, positional bullishness should only be taken once Nifty crosses and closes about 23,100, 23,150 band.
Got it. So we have a consensus here, 23,100, 23,150. Both our technical experts suggest that's the next barrier. Mitesh, has come across to you. Give us some trading ideas today.
So Nigel, an all-buy list, especially from IT, which would benefit from rupee depreciation, and oil refining, which would, benefit from crude oil prices coming down. So BPCL is the first stop on the list. Buy here with a stop loss placed below 266 for a target of 285 to about 288. HL Tech, it was a call in yesterday's closing bell as well. That's a buy with a stop at 1344 for targets of around 1390. ABB is something, which has actually maintained its uptrend in this entire decline and now is at about 34 exponential average. So that could bounce back very well. So buy here with the stop at 6,004 for targets of 6150. And another stock which has maintained its uptrend in this falling or declining market is Coal India. That's a buy with a stop at 449.5 for target of 468.
Okay, got it. Sudeep, what about you? What are your trades?
Prashant, limited buys, as I'm not too sure about the trend between 22,500 and 23,100. So there are two stocks which have by far outperformed the markets and have held well even in the intermediate fall when the mid-cap as well as the broader markets have corrected. So the first one on the buy list would be Cummins India. Now, if you see Cummins, it's in a medium to long-term uptrend. There was some kind of a profit booking move from 5,000 almost till 4,400. And yesterday we have seen some kind of a support zone closer to 4,400, 4,450, which was the prior breakout zone also there being formed. So what we feel is that Cummins can be bought with 4,400 stop loss on the downside for a target of 4,650, 4,700. The second stock that we like is from the pharma space, that is JB Chemicals and Pharma. So that also is in an uptrend on the weekly as well as on the monthly charts. And yesterday, some sort of a profit booking move had happened. But despite that profit booking move, the swing lows of 2050, 2060, which is the 20-day exponential moving average, also was held well. So we feel that this can be bought with a stop loss at 2060 on the downside for a target of 2140 and 2170 on the upside.
Okay, got that. Sudeep, thank you very much. Mitesh, thank you very much. We'll speak again. Appreciate your time here for now. Well, oil prices fell sharply. I think the low that futures on Brent hit was about 91.70 or so. But we're back at about 100 plus, around 100 plus. Now, President Trump essentially saying that the Strait of Hormuz may be jointly controlled by the US and Iran. I mean, listen in, and we'll sort of get in Jonathan to comment on this.
Be jointly controlled.
By whom?
Maybe me. Maybe me.
Not the United States.
Me and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. Look, and there'll also be a form of a very serious form of a regime change. Now, in all fairness, everybody's been killed from the regime. They're really starting off. There's automatically a regime change. But we're dealing with some people that I find to be very reasonable, very solid. The people within know who they are. They're very respected.
All right. We await clarity, but at least I think the takeaway is that he's hinting towards some kind of de-escalation. At least that is the hope. That said, let's get in Jonathan Barrett, CIO of ETO Markets, who joins us on the show. Hi, Jonathan. Good morning. Crude oil prices have pulled back. From an Indian equity market perspective, that's good news. But what do you think? Is this pullback in crude oil prices short-lived? And what are you working with in terms of a range, say, in the next few months, given that there are some signs of de-escalation?
Yes, good morning. Look, I think you can never trust what President Trump says. On one hand, he's looking for de-escalation, and then on the other hand, he's sending more troops to the region. So it is a concern. We really don't understand the process to which he's following, particularly when Iran rebut what he's actually said. so that no negotiations are actually happening. Surely we'd love to see that to occur, but I think at the moment you can't really trust as to what he's actually saying with any relevance to the situation, because the markets did react to the commentary. The question is whether or not the markets see truth in the commentary that he's actually said.
So what are you working with in terms of levels, just for the near term?
Yeah, look, I think the good thing about the range now, and we do have a range, so I think that's important. When you look at Brent, I think you're 115 on the top side, and when you look at the downside, that's 100 or just below that, 91, 92, as we said. So that's an immediate range. I do like the markets to actually fill in gaps. So I do think that there's a little bit more pain to the top side to come until we can actually get clarity with what he said. So the good thing is that we have a range to which we can deal with. We're at the lower end of the range. So I think having longs in at this level is not too bad until we get some clarity. But mind you, you have to be right on your game, because the crude oil price can move around on a dime.
All right. So the upper end of the range is around $120?
115, I think you can probably say. Yeah, and the downside's around that 91. I know it's wide, but we're getting a lot of volatility there, as we know, each day.
That'll be good, actually. The upside is capped at around $115 per barrel, because on March 9th, we went all the way to around $120 per barrel mark. And from then, the equity markets have been fretting that actually things could really go out of hand. But $115 on the upside, I think it's not such a bad outcome. That said, let's talk about a couple of other asset classes. What about precious metals? I'm not sure whether or not you track that one. But, gold has pulled back 20%. You have silver that's pulled back big time, more than 35-40% thereabouts from the top. What are you making of precious metals and levels out there?
Yeah, look, I think the precious metal complex is very, very interesting at the moment. On one hand, you're having a stronger dollar, and that stronger dollar saw gold and silver under pressure. But on the other hand, we have those inflationary pressures now coming through, or about to come through the economy, and that should see a restore of value back into gold. I think the interesting thing, and what caused a lot of these equity markets to come under pressure, were the economic cycle, the inflationary aspects as a result of the high energy prices filtering in and equities come under pressure. The data we've had from the States has all been data that hasn't had any of these new energy levels baked in. So the next round of data next month will be very interesting for the market, because then we'll see the higher cost of energy actually filtering into these inflationary numbers. And a result of that, you'd have to be confirmed that they will be higher rather than lower. And at that stage, we might get a little bit more of a bout. When it comes to gold, still a store of value. Our view is the inflationary pressures will remain there, and gold should continue to trend higher.
So you'll be a buyer at gold at these levels?
Absolutely. Buy a dip at this level. You do have a range for gold, and I think that's important to note. Like with any market, if you do have a range, it's good. We do have that low, which we had last night, which was, I think was around about that 4,120 odd. That is the lower end of the range. Immediate resistance is 4,500, and a break of that, then we could challenge the new highs. But we do have a range, and we're at the lower end of the range at the moment, so happy to be buying.
What about silver? It's not an asset for the faint-hearted, an asset that moves from around $35, $40 all the way to $120, and now it's back down to $67. Where is that one headed?
Look, I think if anything, once again, if you take the war out of the equation, the demand dynamics far outweigh a lot of other demand for commodities, and you have to go back to your old analysis as to the reasons why you bought silver. That analysis is still there. So when you look at the green economy and where we're going, then the demand for silver continues to be there. So I do think that dips once again on silver remain the way to go, and remain long silver if you can hold on to it and your trade is not leveraged. But I do think at the end of the day, silver is the better bet over gold.
All right, Jonathan, thank you very much for joining in. Crude ranged by gold and silver, preference for silver over gold. Let's get in some 9-10 calls. Mitesh? All right, we've lost that connection. By the way, just need to highlight that there is some confidence coming back into Asia. The Korean markets are now up over 2%. Taiwan was down 0.5% when we started the show, and now the Taiwanese market is back in the green, and the Japanese market too is picking up pace. But let's talk about Asian Paints. That's a stock in focus. Mangalam joins in.
Well, the company's announced a 6 to 8% sort of price hike that has come in two phases from April 10th and April 21st. And this will be across their portfolio. The company's trying to balance this to maximize, revenue as well as volumes and have limited impact on trade channels. And more importantly, a large part of this is on account of increasing geopolitical concerns and increasing raw material prices due to geopolitical concerns and packaging as well as logistics. All the other paint companies had announced 2 to 3% price hike already, with another one likely. Asian Paints has done with one across two phases, so that's a positive. Overnight decline in crude and, winds of de-escalation perhaps are tailwinds as well. So all these factors, given the stock that has corrected about 11% from the peak in this month itself because of higher crude prices, should bounce back today.
All right. Well, I think a couple of seconds to go for market open, and we have the rates which will start to come up. What do we have? 22,850, that's about 1.5% higher. The Nifty Bank is up about 1.6%. 52,200. You've got the small cap index, which is up about 1.7. The mid cap index, which is up as well. And there you go. So 1,300 stocks are higher, 200 stocks are lower. And this is starting on a strong note. I mean, of course, now the thing to do is to hold on to these gains and protect these gains, defend these gains through the course of the day. That's the job. 22,888 on the Nifty to begin this session. Let's just look at what's coming up as far as the Nifty heat map, and then we will see where this is showing up the most. So Asian Paints, Shriram Finance, Titan, Indigo, Ultratech are some of the names which are starting in the green. There's one name, Power Grid, lone loser on the Nifty, which is starting in the red. But it's an absolutely green-looking screen with a healthy market breadth. It was too early. We're just sort of out of the gates right now. But I suspect yesterday it was 10:1 by close, declines to advances. It'd be somewhat on the other side this morning. Rima.
Well, Asian Paints is the big winner, 4% up on Asian Paints after the 6 to 8% price hike. Auto names are in top gear. The Nifty Auto Index itself is up close to about, 2% now up on the Nifty Auto Index, with names like Tata Motors Vehicles, Eicher Motors, Bajaj Autos, passenger vehicles, CV, two-wheelers, all rising in trade today. Shriram Finance is now the big gainer. That's up 4%. This is a stock which had fallen nearly 20%. If you'd counted till yesterday's closing, it was down 18-19% from the start of the conflict. So Shriram Finance is coming in for some buying. You've got gains in defense names. BEL right on top, 2.5%. Geo Financial has got strength. Eternal seeing buying. That's up 2%. Titan up nearly 3%. Ultratech Cement 2.5%. A couple of these pharmaceutical names in related healthcare. Dr. Reddy's, Apollo Hospital seeing buying. They're up 2.5%. IT is on the flattish side, but there is green. So TCS and Infosys are up 0.5%. Reliance Industries also holding on to the green line, a gain of 0.6%. Power Grid was up 1.5% yesterday. It was resilient in an otherwise very weak market, but today it's giving up some gains. So 3%, 300 points now up on the Nifty, 22,800.
Well, that's right. A few stocks actually that deserve special mention. Saman Capital volumes very, very high for the first couple of minutes. Remember, that's waiting by for the green signal from the regulators as well. The deal that was announced, stock has seen a sharp correction from 190 to around 130 rupees. That's going to be a stock actually to track from here on. So we'll keep an eye out on that. GMR Airports is up close to 3.5%. Massive volume on that particular name as well. And NOSIL as well for the first minute of trade. Volumes are extremely high on that name. So just keep an eye out on that one, up close to around 3% or thereabouts. On the flip side, Gujarat Alkalis, I don't know what's going on there. Volumes very, very high. For this month itself, it's up close to 25%. It's down close to around 4% as we speak. So some kind of profit taking is what we are seeing on that name in today's session itself. The Nifty still holding on to gains, in terms of number of stocks advancing. It's totally opposite from what we saw yesterday. You had just around 2 stocks that were advancing yesterday by the time we wound up. Today, you have just a single stock, which is Power Grid, which is in the red. 49 stocks in the green. And some of the stocks that pull back, they're seeing a fiercer bounce in trade. Case in point being Asian Paints, Bajaj Auto, as well as Shriram Finance. Prashant.
Okay, I think we got the first solid kind of gains coming through. Shriram Finance, by the way, is an interesting stock to look at, right? I mean, I think yesterday hit about 880-ish or so, and it's back at about 912 at this point in time. So 35 odd rupees higher on Shriram Finance at this point. I think the open offer for Shriram Finance was about 840, and it got pretty close to it, within about 30 rupees of it. And now back above 900 once again. So 500,000 plus shares traded on Shriram Finance right now. Mark Matthews of Bank Julius Baer and Company is with us with what he's making of things. Mark, welcome back to the program. It's been a while. Thanks very much. And so much water under the bridge, or rather oil under the bridge. Actually, no oil under the bridge. But Mark, what's your prognosis of the situation? Is this going to be a prolonged shock for world markets? I was just looking at GDP growth forecasts from Goldman Sachs. Was what they've put out this morning. More cuts in the last 10 days to global growth forecasts. And India, perhaps, India is seeing, according to them, their own forecast is seeing one of the steepest cuts, GDP growth, 5.9 real. Mark, what's your sense?
Of course, this is a very fluid situation, but my sense is in the last few days that Donald Trump has become very clearly wanting to end the war. And if you don't mind, I'll quote from an article that was published in Axios early this morning by Barak Ravid, who's their go-to reporter on government leaks, which are usually authorized. So basically, he says that the Americans have been in touch with the Speaker of the Iranian parliament, and the Iranians have been forthcoming, and the Americans want to move as well because they don't like what oil prices are doing and what the markets are doing, and they're working toward an in-person meeting possibly later this week. And according to Trump, Iran is committed to not pursue nuclear weapons or to enrich uranium, hand over its existing stockpiles, be low-key on missiles, and open the Strait of Hormuz. So if I was in Iran's shoes, I would see it in one of two ways. On the one hand, I don't think they want to become another Ukraine. And at the beginning of the Ukraine war, the Ukrainians had tremendous success. There was a deal that they could have done with Russia. They chose not to, and the war is still grinding on 4 years later. And so I think the Iranians must recognize that Trump will reach a tipping point that he won't be able to come back from, and he will have to commit to this war long term. And if I was them, I wouldn't want to have him reach that tipping point. On the other hand, it's very clear they profoundly distrust him, and they will want a deal with ironclad guarantees that the Americans cannot renege. And that kind of deal would typically take a couple of weeks to negotiate. Apparently, once again, there's various media sources saying that Trump wants this deal by April 9th. So the situation's fluid, but I could see how both scenarios are possible. On the one hand, I think both would like to see this war stopped. Of course, almost everybody in the world wants to. On the other hand, can they actually, make a deal? If I look at the precedents for Donald Trump, I do see one precedent where, with the immigration issue, he started off strong, and then he unfortunately allowed the Department of Homeland Security to hire a whole bunch of basically rough people and they ended up being chaotic and a big mess. But when he saw that, he stopped it. He fired the Secretary of the Department of Homeland Security and purged about half of the field officers. So there is a precedent for him realizing that a mistake was made and stopping it in its tracks. And therefore, I want to say that I am hopeful. Market is clearly not hopeful because U.S. futures are down today. But I think there is a possibility they can come to some agreement.
No, market clearly is not convinced, skeptical, a lot of confusion, a lot of pushback. And that is also fair. But yeah, I mean, one step forward, two steps back, it's always going to be messy, right? Any kind of ceasefire in that sense. I mean, it's not going to be straight cut. No ceasefire works like that. We'll see if there is a ceasefire over the next few days. Mark, just a quick word on India, Mark. You'd been, over the last many years, quite bullish, and then you kind of turned a little sober in your views with regards to expectations. You know, one of the hardest hit markets. I mean, even before this conflict began, the broader market had sold off. And what the conflict has done is that it's taken the large cap stocks down as well, some 13-14% from the all-time highs. So your view on India?
Yes. By the way, just to clarify, no ceasefire in the next few days. I think that April 9th is the deadline we should be looking at, which is a few weeks. But anyway, yes, I think what is notable about the Indian market is how the large caps
Mark, if I can just ask you, Mark, sorry, what is April 9th? I mean, what's
that is the deadline that Trump is apparently set to have a deal with Iran.
Okay, I thought the deadline was. I see. I missed it.
But there were some reports overnight that
keeps moving.
That from Israel side.
Yes, I know what you mean. Initially, it was supposed to be this morning, and then it was supposed to be 5 days.
Yeah.
If you the sources, which are coming from Israel, are basically saying that he sees the possibility of doing a deal, but he realizes it can't be done in a few days. So he's given it until April 9th. But with India, I wanted to say that I am interested in how the mid and small caps have held up relatively well. To me, that shows that there aren't really many sellers on the domestic side. The sellers, I'm amazed, frankly, are still coming from the foreign side. But where we've been hurt overseas is primarily in the rupee. And I confess that I didn't expect the rupee to keep going down so much. I hope it isn't some kind of unstated policy to allow a devaluation to make Indian exports more competitive. I've heard that, people speculating as such, because then we wouldn't really know where the floor is. But if I think that the chances are better that the oil market will normalize, and in fact, as a house, we do believe that our oil price forecast 3 months from now is in the high 60s. So it's lower than where it is today. Then I would expect India to be one of the biggest recovery stories from that, because it's obviously gone down more, and so is its currency on the back of the high oil price.
Mark, hi. Morning. This is Rima here. You know, what's not getting talked about a lot on account of the war is the private credit situation in the US. And there have been multiple firms, the latest being Apollo Private Credit, which has halted redemptions. How worrying is the situation? Have you all done any kind of analysis? And is that something which is going to hurt once we stop talking about the war?
Yes, we have done analysis, and our analysis leads us to conclude that the market is exaggerating the systemic possibilities, which we don't see. We think that really for this to be a systemic issue, you need a recession, and we're not forecasting one this year in the United States. No doubt there are some skeletons in closets in the private credit markets because they have grown so very quickly. But I don't think it means there's a skeleton in every closet. And the way the market is being priced now, I think assumes a much bigger problem that exists. These funds are being gated because there's a rush to get out. And the problem is that, you know, when you can't get out, then everybody wants to get out. But they do that so that they don't have to become forced sellers of assets, and they can do it in an orderly manner. And by the way, they're not breaking any rules. These were in the covenants that these funds set up. So I think that's one where we have a strong view that the headlines are exaggerating the nature of the problem, and we think prices are are also.
All right. Just trying to look beyond the fog of war whenever it comes to an end. The trades which were doing very well were these AI trades. So when you look at the emerging market basket, it was Korea, Taiwan, the semiconductors there, which were the favored stocks. Again, once the war comes to an end, will it go back to that AI trade, or will there be a churn in the way investors look at emerging markets?
I think there will be a change, the whole AI trade kind of peaked out in the second half of last year in America, and then laterally beginning of this year in the hardware space here in Asia. But in a nutshell, I think the market has shifted from viewing AI as this infinite possibility and wonderful to somewhat dangerous. And of course, there's a social aspect of that in terms of the implications for taking away jobs, particularly from young graduates, that's been widely discussed, but also the tremendous spending that the hyperscalers are doing in hardware, which arguably has quite a short shelf life, has decreased their free cash flows. And the whole thing that made U.S. technology so attractive was their incredibly strong free cash flows, which they used in part to buy back shares and pay out dividends. So the free cash flow as a percent of income has literally collapsed among the hyperscalers. Now, we think that the CapEx is going to peak in the second half of this year. And when it does, people will shift away from looking at this decline in free cash flow because it should stop declining when the CapEx stops, when the CapEx peaks. And they'll go back to looking at valuations. And there I can say that, amazing but true, the big technology companies in America, excluding one or two like Palantir or Tesla, are actually not expensive. They are in the 20s PE rise, and yet they still have very strong double-digit growth. And so even NVIDIA is now down to trading at about 23 times 12 months forward earnings. And the rest of them are, sort of between 20 to the high 20s. So when we do go back to looking at the valuations, I think we'll find that it is a compelling story, but I don't expect that to happen until late this year.
And you expect the FIs to come back to India? The currency seems to be exaggerated on the downside, which makes risk-reward a little bit more favorable. FIs underweight on India. Maybe the rupee has extended itself on the downside. And hopefully earnings growth comes back. Do you expect the FI flows to turn?
Well, everything you say, I agree with, Nigel. And so intuitively, one would expect that. I've never really understood why there was so much selling of India. I mean, the only thing I could think of was that, number one, it had become rather expensive sort of 2 years ago. We've cooled off since then. Actually, it's not really an expensive market anymore. The forward PE ratio is below 20 times. I know some people who've just been perennial India bears, friends of mine, fund managers, who, by the way, are Indian. So they just always felt it was too expensive. I'm noticing that they are now starting to get interested in it, these long-term bears on India, because they're seeing, the currency's gone down so much, and the stock market is re-rated to, I wouldn't call it a cheap level, but it's not expensive anymore. So I definitely think there is potential for the market to turn around based on its fundamentals.
Thank you very much for joining in, Mark. Always a pleasure chatting with you. Let's invite the management now of the NLC India on the show. Prasanna Kumar Motupalli, Chairman and Managing Director of the company, is now joining in. The three chat points that we'd like to discuss with him: one, power supply demand trends, the operational timelines for the key plants, and the IPO timeline for the renewable energy arm. Thank you very much, sir, for joining in. We just concluded our inaugural Bharat Electricity Summit 2026. And the plans are grand. We planned, at least for India, we're planning to double the total installed power capacity. And this is driven by a near 30% surge in demand. So can you tell us, for NLC India, what is going to be your capex for this year, next year? For 5 years, you've shared a number of, I think, 1.17 lakh crore. Is there going to be a change in that? So just take us through the big picture first in terms of capex for you. Sir, I think you're in mute.
Since the beginning, NLC India always balance the conventional capacity addition and renewable capacity addition. We believe that going forward, both are required for the growth story of the country. So at present, we are having around 6.8 gigawatt of total power generating capacity, and we want to take it to 20 gigawatt by 2030. And at present, we are having 1.7 gigawatt of renewables, and we want to take it to 10 gigawatt, almost 7 times by 2030. And for all these things, the capex requirement is around 1.25 lakh crore in next 4 to 5 years. And also in the mining capacity, also from the current capacity of 50 million metric ton, we want to take almost double it by 2030 to almost 100 million metric ton per year. So in all the 3 areas, the active works are in progress. The projects are in going on as per the program. And we are hopeful that we will be completing these projects within the timeline.
All right. Hi, sir. Good morning. Good to hear your thoughts as always. Well, for a business as yours, the targeted regulated equity is one of the most important aspects from an investor perspective. What is that likely to be, say, in the coming year, FY27?
Actually, by 2030, we are targeting regulated equity of around 19,000 crores. And by 27, our now the Ghatampur third unit also gets added. So it will be increased by around 1,200 crores. But our target is to take the regulated equity to around 19,000 crores by 2030.
And right now, what is it at? 1,200 crores gets added next year. But currently, what is it at?
Yes.
Right now, sir, what is the regulated equity of the company?
Our regulated equity right now is around 9,200 crores, and that will be increased by around 12 crores.
Got it, sir. All right. The other big expectation from the street is the renewable vertical IPO. I've been pushing you the last few times, and I think the last time you told us that hopefully in the first half of the next fiscal. Do you think that's when we see the IPO coming in terms of your renewable business? And give us a sneak peek into what could the potential size be.
We formed a 100% owned subsidiary for the asset monetization. And all the activities are in fast progress. We got the exemption from the government for the asset transfer, tax exemption for asset transfer in shortest possible time. And there was approval from the cabinet also for the 7,000 crores investment. And we are targeting to bring IPO by around September or October of the current financial year. And although the total value is around 7,000 crores, but it will not be in at a stretch. We will be going for a percentage around 25 to 30%. That is not yet decided. And that is expected by around September, October of this current financial year.
Okay. And you're looking to sell 25 to 30%?
Yes.
Okay. And no fresh issue over here?
No, madam.
All right. And the size is 7,000 crore rupees?
7,000 crore is total. Out of that, we will go for around 25% to 30%.
Oh.
Got that. So one worry has been that despite higher operational capacity in FY26, your revenue and profit growth has not been moving in step with the growth in capacity. Can you explain that? And how is demand for you? What is the growth rate that we're seeing?
In the initial first half of the financial year and in this quarter 3 till quarter 3 also, there was the reduction in the power demand because of the favorable weather conditions. So because of that, there was some shortfall in the generation. But in the recent past, the power demand has increased, and going forward also, we are expecting good power demand. So the financial performance and operational performance will be better than the last financial year. We are confident about that.
Got that. And sir, on account of the war, has there been any impact, direct, indirect, on your fuel costs?
Madam, most of our the thermal power stations are pitted power stations with captive mines. So we don't see any effect upon the fuel supplies or costing. And even our coal-based power stations are also having sufficient quantity of coal, more than 30 to 40 days. So we don't see any effect of the war on the operations.
Okay, all right. So one quick question with regard to this renewable energy. What is the plan? I think 8 gigawatt is what you were targeting, right? In terms of capacity. Could you help us out with the plan out there? What is it at? What is the capex you'll incur? And by when do you get to that 8 gigawatt?
We started the year with around 1.4 gigawatt installed capacity. And now we added around 350 megawatt in the current financial year. Now we are at around 1.7 gigawatt. And our target is to take this to 10 gigawatt. Almost 6 to 7 times we want to increase this capacity to 10 gigawatt.
Okay.
So to reach this 10 gigawatt capacity, we formed joint ventures with the government of Assam, government of Rajasthan, and we are in the process of forming joint venture with Maharashtra and Odisha. So with all these things, we will be able to adding more than 10 gigawatt capacity. Already around 4.5 gigawatt works are in progress. In Rajasthan, 810 megawatt. In Gujarat, 600 megawatt. Howrah, that is about to be operationalized. So overall, around 4.5 gigawatt are in pipeline, and almost the entire 10 gigawatt is under planning stage. So our requirement, the capex requirement for this capacity is around 25,000 to 30,000 crores. And we are hopeful to manage this through our whatever IPO we are planning, as well as the internal resources.
Okay, just a quick word, sir, in terms of the total quantum of coal that you produce. What is it on an annual basis?
Our coal production target is 20 million metric ton.
20 million. And how much is sold, sir, in the open market? How much is sold in the open market?
Last financial year till now, this financial year till now, we sold 8.5 million in the market with a revenue of 1,382 crores.
And some part of this produce that you have, as you said, 20 million is what you'll mine. I think you'll end up the year by selling in the open market around, what should it be, around 11, 12 million tons?
No, around 9 to 10 million metric ton.
Okay, 10 million tons. Out of the 10 million tons, how much is sold by the e-auction route?
No, I'm talking about whatever figure I am giving, that is through e-auction route one only.
But the entire amount
and
goes
the other than this, we are giving to NTPC, we are giving to DBC, and we are sending to our own captive plant in Tuticorin.
Okay.
So the e-auction coal figure is only that's what I was telling, 8.5 to 9 million metric ton.
Interesting. And how much have prices moved up, sir, on e-auction? The reason I ask you is because global prices of coal had moved up substantially. And there should be some kind of rub-off in India. May not be this quarter, maybe in the coming month or so, but have you observed any kind of change?
Yes, actually, this financial year, in the initial quarters of this financial year, there is comparatively lesser demand for coal. That's why the prices were also on lower side. But now, with the growing demand and growing demand for power, the prices are gradually increasing in the e-auction route also.
Want to quantify it, sir? Because demand was very weak. But in the last 1 month, has there been any notable price move, 5%, 2%, 10%? If you could give us a rough number on e-auction realizations?
So e-auction, actually, there are a number of tranches of e-auction. So exactly percentage-wise, we cannot tell. But it is in upward trend, and it is expected that it will further go upward.
Okay, fair estimates, sir. Always a pleasure talking to you. Thanks a lot for giving us an insight into business, your IPO plans, as well as a brief insight on the coal business as well. For the time being, though, we slip into a short break. On the other side, we have the management of Titagarh Rail Systems who will be joining in to discuss on their business outlook and the road ahead for the company. Welcome back. This is Corporate Radar, and you're tuned into CNBC TV 18. Well, the markets have come off a little bit from the top. ITC is the stock that slipped considerably. I think from the time we started off, that's down close to around 2% from the day's high. Coal India as well, after being a relative outperformer, this month the stock is actually up 3.5% while the markets have corrected. That's coming for some profit taking. So both those two have moved lower. But let's focus on the oil and gas space. CLSA has maintained its high conviction outperform rating on ONGC, while Goldman Sachs says the risk reward has turned less compelling for oil marketing companies. Sonal joins us with a quick analysis on all those companies. Sonal?
Thank you for that. Well, interesting note from CLSA where they have raised target price on ONGC to 415, reiterated their high conviction on the stock, and they say this has been the worst performing exploration and production stock since the war began, as investors feared a new windfall tax on higher realization. But this fear of new windfall tax, it is because of what happened back in July 2022, where we did see additional taxes because of high crude oil prices. However, there has been a new law. We've been talking about it since the time crude prices have been higher, which does not allow government to impose windfall taxes on higher realization for these exploration companies. And now that stock is pricing Brent at $63 per barrel, they believe there's a 65% upside in a scenario where they're using $90 a barrel. So they think it is valuing itself at a lower level, and that's why they think a 15% rise in gas production in the next 3 to 4 months and over 50% jump in new well gas prices will be the other trigger, apart from higher oil realizations as well. They are raising FY27 Brent to $89 per barrel, increasing EPS by 34% on the stock, and for FY28 it is lifted to $82 per barrel, which would mean a 14% rise in EPS from current levels. So they are quite positive on this name. Oil marketing companies, third downgrade coming in, target price cutting coming in. We had HSBC, Kotak Institutional Equities, and now it is coming from Goldman Sachs. They say risk reward has turned less compelling. Marketing margins, we have been telling how they've turned negative for petrol and diesel, and they're impacted because they're not able to pass it on to consumers at retail level. And crude and product prices at gas stations also remain at the current levels despite higher raw material prices. Goldman Sachs has downgraded HPCL to a neutral from a buy, target cut to 310. For BPCL, the same downgrade in ratings, target cut to 340, and for IOC, the target has been cut to 110. However, for Reliance, they have increased the target to 1,910. They maintain their buy. And for ONGC, they have a sell rating and the target price is 245. So different view coming in from CLSA as far as ONGC is concerned.
Thank you very much for that. A couple of other stocks are reacting to brokerages. Pull up Apollo Hospitals, that's a big mover. Citi has a buy call, target price 9,600. Citi has basically added Apollo Hospitals to their pan-Asia focused buy list because they're saying their hospital business is resilient. Their pharmacy business, has profitability inside the digital profitability, and valuations are also below long-term averages. So Apollo Hospitals is a big mover, and Titan is the other one, where CLSA has an outperform call and today raised the target price further to 4,996. But Titagarh Rail Systems and BHEL have planned a JV for maintenance of Vande Bharat sleeper trains. This is a stock which is down 30% so far in 2026. Sumesh Chaudhary, Vice Chairman, Managing Director of Titagarh Rail Systems, is now joining in. Thank you very much for joining in. Now, this maintenance JV with BHEL for Vande Bharat is a little different from the usual business of manufacturing. So I get that it makes sense as an add-on business, but what is the capital allocation? What are you hoping to achieve? What are the terms of your JV? What is the revenue accretion going to look like?
Yeah, so good morning. This JV is actually a part of the larger contract that we, along with BHEL, had signed with the Indian Railways to manufacture, supply, and maintain 80 Vande Bharat trains. That's a total of 1,280 coaches over a period of the next 4 or 5 years. And then we have to maintain these trains for the next 35 years. So the total contract value, which was about 24,000 crores, out of that about 10,000 crore was the supply and 14,000 crores on net present value was the maintenance contract over the next 35 years. And this maintenance contract could have been done by the consortium or by a joint venture to be constituted by a consortium. So both us and BHEL have decided to form this joint venture, which is a 50-50 joint venture, which will actually take up that part of the contract which has been awarded to us.
Got that. So a 14,000 crore opportunity over the next 30-35 years for BHEL and Titagarh Rail, 50-50. Is that correct?
That's right. So it's 14,000 crore is not the opportunity. That's the contract. That's the contract which we have already signed on a net present value. So this will get adjusted by the price variation that will happen over the period of time based on the wholesale price index. So that's the contract that we have.
Okay. And how is this going to accrue to you? Will it be equally divided every year? Or as the trains age, there will be more work required in terms of maintaining it, and therefore the amount that you get towards the end will be more on an annual basis, not adjusting for inflation. But take us through how the revenue accretion for you will come, and what are the kind of margins you will enjoy on this?
So the revenue on this is approximately 4% of the value of the train. So we sell each train for about 120 crores. And 4%, about 4% of the value of the train is given to us every year per train for the AMC. That's how the value will accrue in this joint venture. So once we have supplied all the 80 trains, then the entire 80 train portfolio will be under the AMC coverage, which will be serviced by the JV. The entire 80 trains would get supplied by about 2030 or 2031, thereabouts. And thereafter, the entire revenue starts accruing. Maintenance is a more profitable business than OEM. Worldwide, AMC is a more profitable business. So, we are expecting that the margin profile in supply of rolling stock is anything between 12 to 15%. In maintenance, it is better than that.
Could you give a number for the margins on maintenance?
It would be premature to give a number, but it would be definitely much better than the OEM margins.
And when would the revenue accretion start? You said it's dependent on the supply of trains once you've supplied the entire lot.
Not the entire lot. It is actually on a phased-wise manner. So when we supply the first train, let's say the first few trains that will get supplied in FY27, the revenue of that will start getting accrued from FY28 itself. So it is on supply of the trains, the revenue starts getting accrued.
So have you all modeled?
Revenue, as you had asked.
So you all would know, right, how many trains you're planning to supply in FY27, how many in FY28. So just going by that modeling, what is the AMC revenue we should expect for Titagarh Rail FY27, 28, 29, 30?
So we are expecting to supply about 3 or 4 trains in the FY27, and then next year it goes, so that it's already in public domain. We had also given it in our strategic plan, the delivery schedule that is there for the contract. The first year we have to supply about 3 or 4 trains, which is in FY27, and thereafter it goes up to about 12 trains or 16 trains, and then 24 trains per year. And the entire 80 trains will get completed by FY31.
All right, I'm Mr. Chaudhary. Good to see you in, sir. Titagarh Naval, they have given a corporate guarantee to bid for some ONGC tenders. Could you tell us what is the quantum of this? What is the size of opportunity? And by when do you expect to see some kind of outcome from this particular, deal that you're doing?
So as we had discussed earlier, we have, we were in the shipbuilding business, which we have now demerged and put into a 100% owned subsidiary, which is carrying out the shipbuilding business. And, shipbuilding as a sector is an extremely promising sector. And this is a tender which was floated by ONGC to procure bulk carrying specialized vessels. As per newspaper reports, there are about 5 or 6 companies that have bid for it. So we expect that the finalization should happen in a few months. And we would be very keen to take this forward.
Okay. Just one final word then. On account of the war in West Asia, has there been any impact on your business? And if yes, could you explain how?
I really don't think that any sector or any individual is really not impacted by this unfortunate war. There have been problems in terms of getting consumables, gases for our welding and all of that. We are managing. There have been impacts that we've had to face on various production cycles. Of course, shipment cycles are getting disturbed. So, while this is something which is impacting us, it's not something which has come down like a ton of bricks on our sector as of now. But we are watching carefully what happens and how things unfold.
To what extent has production been hampered so far in the last 24 days?
It is sporadic. There have been a few days where production has actually come to a grinding halt. I would not say it has come to a complete stoppage over the last 24, 25 days, but yes, it has been impacted on a few days because of the supply chain constraints.
Is it possible, sir, to put a number to the production loss so far?
No, we'll not be able to give a number to that, but we are trying to maintain it by way of trying to work on weekends and so on and so forth. So at this point of time, we'll not be able to give a exact number to it, but definitely we'll come back once we have complete clarity. And we are only just about a week away from the end of the quarter or the month, so we'll definitely come back with numbers there.
Outside of this particular impact on your business, how has the quarter been? What are the key highlights of Q4?
Quarter has been pretty much as per expectations. Both our businesses, the passenger rail system and the freight rail systems, is going on as we had envisaged. Apart from this, the month of March for wagon production primarily, the supply chain constraints which have impacted slightly. But apart from that, it's pretty much as per expectations.
All right, very quickly, sir, you had indicated that the trial production of wheel sets, I think, would start in this month. Has that happened?
It is going to be starting either this or next month. So that's what I had indicated. And we are well on track that we will start the trial production by April.
And what is the capacity, wheel set capacity, and how do you scale that up?
The total capacity of the joint venture, this is a joint venture, as you're aware, between us and Ramakrishna Forging, and the total capacity that is there is about 220,000 wheels per year, which will be in 2 phases. So the first phase will give us about between 80 to 100,000 wheels, which is the one that will come into production now. And of course, the normal ramping up cycle that is required will be taken. But we'll start the trial production in April. So we have a contract, an offtake agreement of about 80,000 wheels per year for the next 20 years from the railways. That, in any case, will be catered to by the first phase, and then the expanded capacity will also take care of our or export or other requirements.
Okay, all right. Thank you very much for that. Appreciate your time here and good speaking with you. That's Titagar Rate Systems with Perspective. By the way, I just want to highlight what's happening in the broader market. NOSIL, I just want to put that up. NOSIL was up 10% yesterday. It's up another 10% today. And that's a pretty large move. I mean, I think it was $140 day before yesterday's close, and it's at 176 right now. So that is NOSIL. Humongous volumes on this one. The high, by the way, it was $330 in August of 2024. So it's done pretty poorly since then. But last 2 days, very, very good. JBM Auto is another one which is coming up with some gusto. It's the second largest volume-led gainer right now. And Tejas Networks, right? I mean, it's the low was about 399, back at about 430 or so. But the recent high was about 530. So this is again a completely bombed out name, but from the lows it come up very, very sharply from 300-ish levels to about 550. Sold off to under 400 and back at about 431 now. What else? I mean, a lot of these silver ETFs are jumping. Silver B is about 5.5% higher. And actually across the board, between 5 and 6% gains. There is HBL Engine, which is up about 5%. The only reason I'm mentioning this small company, but it's got very large volumes for now. Acuitas is up about 7.5%. Tata Motors commercial vehicle business is up 5%. And there is Electra, which is jumping about 7% higher as well. About 1,100 now. From 5 or 6 days back, stock was about 890 odd rupees or so. So, I mean, there is a fair bit which is happening. Aeroflex, for example, is another one which is coming up about 6% or so. So from about 190-ish levels to about 240 in short order on this one. So this is the bulk of where volumes and price action is coinciding. Interglobe Aviation is another one. I mean, fell under 4,000 rupees yesterday. Is there any relief? Sudarshan is here with what he's got in this one. So over to you.
So today it's one of the top Nifty gainers, seeing a relief rally as crude has come off yesterday's high of around $120 per barrel, currently trading around $104 per barrel. But again, it's off lows, overnight lows that we had seen around $96 to $97. And if there is any further de-escalation in this war, that will help if there is any reducing the input cost increase. So what are some of the major input costs? The first one is ATF, which forms almost 40% of the airline cost. And recently, government has also announced the increase in the ATF price from rupees 5,215 per kiloliter. That was the increase that was announced on 1st March. But oil marketing companies have not fully passed on the global benchmarks yet. So next increase that will come on April 1st will be watched out very closely. Second is aircraft leases. That also has seen an increase, and it forms 15 to 18% of total cost. And the increase mainly because of the rupee depreciation that we have been seeing over the last few weeks, and currently rupee is hovering around 94 against dollar. Third is war risk insurance. Earlier this cost was negligible, but now it has become a mandatory line item that will also going to increase the cost. And last one is crew cost, or say longer routes. That forms almost 10% of total cost, and because of this war, rerouting has increased, and it has added 1 to 3 hours on mainly Gulf and Europe routes. So over the last few weeks we have seen a major increase in the cost as far as the airlines are concerned. That was the reason stocks like Indigo, SpiceJet, all these stocks have been under pressure. And today, because of crude coming off highs, it's seeing a relief rally.
Thank you very much for that. Kotak Mahindra Bank is another one holding up quite smartly. Nomura today has upgraded Kotak Mahindra Bank to a buy with a target price of 445. They also like Axis Bank and ICICI Bank in the private sector banks. HDFC Bank should also come up for you on your screen. It's gotten hit hard, 12% decline in the last 4 trading sessions. And this morning, HDFC Bank has opened up with a gain of 1%. Chandan Taparia of Motilal Oswal Financial Services is now joining in. Chandan, 200-point gain on the Nifty. We started off with a 350-point up move, but now it's holding up smartly. Nice gains, but not quite the morning surge.
Yeah, good morning, Rima. Thanks for having me. So the structure of the market is negative. Index has been making lower top, lower bottom on the weekly chart from last 6 to 7 weeks. we have noticed that every bounce is being sold in this entire sequence of lower top, lower bottom. And I believe the market has to surpass the hurdle. Then only the stability will be back. Otherwise, the meaningful bounce is being sold. So I believe till Nifty doesn't surpass 23,150, 23,333, the medium term and the short term trend could remain negative to retest the recent low near 22,500 to 22,200 marks. So as of now, the weakness persists. Market needs to surpass the hurdle. Then only the stability will be weak. Otherwise, better to be with the immediate trend that is negative. India VIX is near 25 marks. Till VIX doesn't cool down, we may see the volatile swings, but trend is negative, so upside should be kept as of now. Now, looking at the Bank Nifty index, it has been underperforming the broader market now. The weakness remains intact, has been making lower top, lower bottom. However, it recovered by 700, 800 points from lower levels, but hurdles are not being surpassed. So till Bank Nifty remains below 52,500, upside could be kept to revisit the recent low near 51,500 to 51,100 marks. So in both the indices, as of now, the structure is weak, but bounce could be sold. So we need to play the stance accordingly. But at the same time, as already we have seen selling pressure and most of the indices going into the oversold. So position sizing, one can reduce slightly looking at the entire market scenario and the higher VIX level.
Yeah, no, absolutely. Stocks, Chandan, hi, morning, quickly. What would you recommend?
Yeah, Prashant. So I'll mix with buy and sell both. First, that is buy on Apollo Hospital. Comparatively, need to focus on the defense and defensive counter. So Apollo Hospital recently corrected from 78.50 to 7,100 levels, but now getting an early sign of negating of lower top, lower bottom. In fact, the mechanical indicator like RSI is getting some crossover, some short covering is visible in the counter. So looking for a surge in the stock towards 76.50, one can buy with support of 7,200 level. Second trading idea, that is Cummins. Major trend is range bound comparatively, holding above its rising support trend line with the hold near 50-day mark. A small follow-up could negate the lower top, lower bottom on the weekly chart, and counter is comparatively resilience at the time of market decline. So can see some recovery with support of 44.80. One can look for an upside target towards 47.80. Negative ideas, that is sell on Muthoot Finance. Weakest counter has been making lower top, lower bottom. 2 weeks back, it witnessed recovery, but that was sold, forming the negative price pattern. So weakness could continue. One can sell with a stop loss of 31.20. It can go down towards 2,900 levels.
Okay, all right. Chandan, we'll leave it there. Thank you very much for that. We take a quick commercial break here. Well, we come back and swing back to commodities and what's top of mind there. Manisha is here with exactly that. Stay tuned.
Welcome back. Some gains are fizzling out. The Nifty's dropped below 22,700, now up less than 200 points. But let's talk about commodities. Manisha is now joining in with her take on crude oil prices and natural gas.
Thank you so much for that. Well, yes, we're trading 4% on the higher side for the crude oil prices in the Asian markets right now. That's exactly how we shut New York in the markets yesterday, and that's how Asia has opened. Very, very steady there. And this is after that whole big move that we saw in the markets come in yesterday, where from a near 8% plus to a down minus 10% is how the crude prices really reacted. This was after the US president postponed attacks on Iran energy infrastructure for 5 days. Iran, in the meanwhile, has denied any talks to end the conflict. The US president's statement, they said, is seen as an effort to support or stabilize the oil prices and the other markets as well. The street also is looking at Iran launching new attacks on the US targets. Israel, in the meanwhile, has continued to attack or look at a strike against Iran. In the meanwhile, we also have seen Saudi Arabia and UAE wanting to join this, and Saudi Arabia agreeing to give the US military access to its King Fahd Air Base. So markets are looking at more concerns rising into the space, and is the reason that the 3-digit crude oil prices have just continued to sustain within there. Add to that the fact that you're also looking at the US oil August futures trading at $80 a barrel versus the spot, which is trading at $92 a barrel here. So what we are looking at in case of crude oil prices is a big backwardation. Well, actually, when you look at end of December, the December futures, that is trading at around $78 a barrel. So we're looking at a big backwardation on every future month forward there. The global oil prices, in the meanwhile, have not climbed enough to cause demand destruction, is the statement coming in from the US Energy Secretary as well. There have been various statements coming into the markets there, but adding to this reaction has been the explosion at the Valero refinery in Texas, US. Now remember, this is one of the biggest ones in the US markets, and with what we've seen happen in the Middle East, in this adding to that, you should be looking at perhaps premium continuing in case of the crude oil prices there. Valero refinery, by the way, processes nearly 435,000 barrels per day into gasoline, diesel and jet fuel as well. So this is a bit of a setback that we're looking at in sense of refining numbers coming in from that refinery therein. It's not just crude oil. Take a look at the natural gas prices, and the supply from West Asia continues to collapse because of Strait of Hormuz, and that has led to the global LNG exports declining to nearly 6-month lows there. Markets also are looking at Qatar Energy, which says that the damage on the Ras Al Afan LNG complex will cost them $20 billion per annum there, and it would take nearly 5 years to repair. So that is your gas impact as well coming in from one of the major gas fields in the world there. The Europe gas storage also has continued to decline. Remember, the winter is just about ended, and it's only 29% full, and it's 10% lower than where we were in the previous year. And with the kind of concerns that we're looking at, I'm assuming you were looking at higher prices in oil and gas for some time to come. Take a look at what we've done in sense of prices on a month-on-month and YTD basis. So there you have the US crude prices up by 59% vis-a-vis 70% of gains in Brent, because Brent is where all the Middle East impact seems to be coming in from. On the yearly basis, we are up by 40% for US crude and 47% up for the Brent prices there. It is the Urals, which is the Russian crude prices. This has gained 107% in year this time. It's up by nearly 78% in the last 1 month as well. The gasoline prices have continued to gain 80% up in this year till time. That is heating oil for you, more than 100% of gains coming in for that one. Even coal, for that matter, has gained up by 31% in this year, 20% of those gains coming in the matter of last 1 month itself. And this is ethanol futures from the US markets. Well, as you can see, everything that comes in the category of energy has been gaining. So 14% up on a month on that, and 25% up for this year as well. So energy continues to gain much higher.
All right. Thanks very much, Manisha. For that, that's Commodities in Focus. We take a break. Our special segment is the economy. Lata discusses the impact of the Iran war on US macros with David Miracle of Goldman Sachs on the other side. Stay tuned.
Welcome to It's the Economy. Even as President Trump did an unexpected volte-face, if you can call it, and announced a 5-day pause to hostilities on Iran, Israeli Prime Minister Netanyahu says just a few hours ago, and I quote, "We are continuing to strike in both Iran and Lebanon. We are smashing the missile program and the nuclear program, and we continue to deal severe blows to the Hezbollah." The markets are kind of seesawing between the optimism exuded by President Trump's statement and the warnings in Netanyahu's statement. To understand all these signs from an economy point of view, joining me now is David Merkel, the chief US economist at Goldman Sachs. David, good morning. Thank you very much indeed for joining us today. Well, first up, is one of your cases, if not the base case, that America may at some point in time withdraw from the war, but Israel may continue, going by these two statements? Okay, we are trying to reconnect with David Merkel. There was an unfortunate disconnect even as we were speaking. But as I was telling you, at this point in time, the Indian markets are unsure. Indian markets and global markets are unsure how to react to what seemed like a very emphatic pause announced by President Trump yesterday evening. We saw the Nifty itself rise at one point by 700 points. And after the Israeli statement came in, Prime Minister Netanyahu's statement came in saying that they will continue hostilities and they have already killed 2 nuclear scientists in Iran. The picture becomes a bit murky. Is it that the war ceases completely or for 5 days? Or is it that US aggression ceases but Israeli aggression continues? And what after this 5-day period that the President Trump has announced? Do hostilities resume? Do talks resume or continue? Is it the famed taco trade at play? Or is it not quite that? Because a war has started in Iran, in West Asia, and that may continue irrespective of a taco prevailing as far as the US is concerned. Then what happens to oil prices? What happens to the Strait of Hormuz? And what happens to the various economies? The financial markets at this point are in a state of flux, unable to make out what is the exact state of the progress of the war, the end of the war. Things have gotten murky. It seemed emphatically clear, say about 12 hours ago, that the war is probably winding down, but that's not the state that we can be sure of after the recent statements from Netanyahu. Why don't we just listen into what President Trump had to say?
Be jointly controlled.
By who?
Maybe me. Maybe me.
Not the United States people.
Me and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. Look, and there'll also be a form of a very serious form of a regime change. Now, in all fairness, everybody's been killed from the regime. They're really starting off. There's automatically a regime change. But we're dealing with some people that I find to be very reasonable, very solid. The people within know who they are. They're very respected.
Okay, we played that statement, and by then we have connected to David Merkel. Thank you very much, David, for your patience. Well, first up, how do we understand? Do you think that there is a chance that the US winds down its involvement, but Israel continues the war, and therefore Hormuz remains a problem?
Yeah, and thinking about the economic implications, we've mostly thought about it in terms of how long oil exports through the Gulf remain disrupted. In our base case, we do expect the Strait to be disrupted for about 6 weeks in total, so still a few more weeks. We think that the risks to that lean toward longer. In our base case, we expect oil prices to rise somewhat further in March and April, and only to gradually come down over the course of the year. And because we think the risks of disruption are tilted toward the upside, that this could last for longer, we think that oil price risks are also tilted toward the upside, which would, of course, have larger consequences for inflation and growth in the US, the economy I cover, but everywhere else in the world as well.
Okay. Do you think that the domestic deterioration in the economy will be strong enough for President Trump to stop the war? to withdraw from the hostilities?
So hard for me to know what the White House is planning, but I would say in the US, as in many countries, the price of gasoline is very salient. People feel very strongly about that. It has large political consequences. We do have the midterm elections coming up. So I would think any politicians would be concerned about a big increase in gasoline prices ahead of elections.
Okay, fair enough. That's what I guess the world is counting on, that President Trump is also heading for an election much later in the year. You know, I read your report. Your base case is for crude to average $98 for 2026 and for crude to fall to $71 by the end of this year, by calendar 2026. Your worst case is that crude averages $110 for 2026, and by the end of the year, it goes down to $76. Now, at the moment, are you more in your base case, or are you worried that it might be the worst case?
So I would say we're still in the base case, but we also still see the risks as tilted toward a longer disruption. And in terms of the economy, the place that you're going to see this have the largest and most immediate impact is on headline inflation. In our base...
Oh, I'm sorry. We lost that line yet again. But let's see if we can be lucky in a bit. The to and fro of the statements are now beginning to have a negative impact on the Indian markets as well. As we saw, we began with a bit of a thump, but the markets started losing ground after that very good gift Nifty start is not something which we could maintain, and we are seeing levels of profit-taking come in. It's much more so in the currency. The currency began rather strongly at 93.34. Remember, yesterday we had gone up to 93.94 at one point in time, just before close. The currency strengthened to 93.34, but as you can see, the dollar has once again become expensive, and we are heading closer to yesterday's closing levels, which is about 93.94 levels. So the market is still in a state of, whether to believe the hostilities are over or whether it will, wind down. Do we have David with us? Okay, we are still waiting for David to come in to reconnect. Just a word on the bond markets as well. The bond markets have actually taken it very, very badly. At this point in time, we are at 6.85%. Before the war, the 10-year yield was at 6.7. So you can imagine the amount of yield increase that we have seen, 15 basis points. For India, of course, the impact on inflation is going to be very, very strong. And the 15 basis points is reflecting the fact that already gas cylinder prices have been raised as well. We are going to see perhaps sooner or later a whole host of intermediates getting expensive. Actually, one of the companies that gets impacted would be Asian Paints, because a lot of the intermediates they use are crude derivatives. Mangalam is here joining us now on how Asian Paints may be impacted. Mangalam, while we wait for David, your thoughts?
Well, a couple of things that are positive for Asian Paints right now. The stock had already seen a bit of a correction because of higher crude prices, like you've been pointing out, and a weaker rupee does not help some of their, imported products as well, and some of the packaging too. The company yesterday announced a price hike in two phases between April 10th and 21st, and the price hike across the portfolio would be 6 to 8%, with some part of their portfolio, the likes of thinners, etc., would be a little more than 6 to 8% as well. What the company's smartly done here is, with these two phases, it's tried to navigate through any sort of challenges that would be in passing on these price hikes, or taking away the shocks from the system. And more importantly, a large part of the value products have been given a higher price hike in the earlier part. And then you have putty, etc., the ones that give you a lot more volume. That has happened on April 21st. So basically, the company is trying to optimize for both volume as well as value through the 6 to 8% price hike, which otherwise could be a bit of a shock to the system, especially at a time when demand is not necessarily its best and competitive intensity is high as well. All the other companies had announced a 2 to 3% price hike with a promise of another one going forward as well. And add to all of this, crude prices have slid overnight, though still holding above that $100 per barrel mark with a weakening rupee. All these factors should benefit Asian Paints, and which is why the stock is high by about 2.5% as well. Brokerages have written on that as well. They've taken note of this price hike. Macquarie has an outperform view, with a target of 3,100 rupees on the stock. Remember, the stock at 2,100 rupees offers, as per Macquarie, an over 35% sort of upside.
Okay, thanks a lot for filling in, Mangalam. We hopefully have David on a better line now. Okay, David, what are you expecting from the Fed? Do you think there will be inflation fears, or will growth worries be more and the Fed may cut more than earlier anticipated?
We've pushed back our expectation of Fed cuts to September and December. I think in the near term, even before the war and the spike in oil prices, there were different groups of Fed officials who had quite different takes. Some were more concerned about near-term labor market weakness. Others, we heard in January and February in their speeches, felt like the Fed should be on pause for a longer period of time until we'd made more substantial progress on inflation getting back to 2%. Now, the war is going to make those activity and unemployment fears worse, but it's also going to push up inflation. So I think it makes the decision even more difficult for them. The reason that we are still forecasting a couple of rate cuts this year is mainly that we think the labor market will soften a little bit further. Unlike the FOMC, which has the unemployment rate flat at 4.4% this year, we expect it to rise another couple of tenths. And also because I think that we are still making progress on underlying inflation. Admittedly, this is increasingly becoming a murky topic with tariffs and energy price spikes both affecting inflation. But I think the kind of underlying longer-term trend inflation pressures reflecting things like the strength of the labor market and wage cost pressures actually do look pretty benign.
Okay, so your expectation is 2 rate cuts from the Fed into calendar 26?
That's right. We're expecting those in September and December. I'm not certain about that, even if we do get the economic outcome that we're expecting, with inflation coming down, just not coming down that much because of the energy price pass-through to the core, and the unemployment rate rising, but only rising a couple of tenths to 4.6. I would fully anticipate that different people on the FOMC would disagree about what to do in that scenario. But I think those two trends taken together would make a reasonably compelling case for a cut in September. And then we expect a second one in December to address those labor market concerns and get the Fed funds rate back to what I think the Fed sees as a more neutral rate of about 3 to 3.25.
David, now let me come to the 10-year yield itself. We saw it going beyond 4.4, and even now it's trading well north of 4.3. And the worry is not just inflation, the worry is the US fiscal deficit. So do you think that the deficit, which could have only gotten worse because of the war, will keep the yields very high? What is the kind of range you are looking at for the 10-year?
I think the most immediate driver has simply been that the market is no longer expecting the Fed to cut interest rates in the near term, and has even been entertaining the prospect of hikes in the near term. For many central banks around the world, that might turn out to be the answer. I'm pretty skeptical that hikes are a serious possibility. So I think that repricing at the front end, which is to some degree spilling over to longer term interest rates, has gone too far. I simply don't think it's right that the Fed is more likely to hike than to cut, as market pricing now implies. In terms of the fiscal deficit concerns, that might be part of the bigger picture issue. I don't think that's been the most immediate driver. I agree that there is a long-run fiscal sustainability problem here. The market has at various points over the last few years focused on this and then eventually moved on. Increased spending on a war. Wars have been very costly in the past. That is the sort of thing that could catalyze investors to take a closer look at these long-term fiscal sustainability concerns. But I don't think that's been the main driver of longer-term rates recently.
Okay. Well, we will have to leave it at that. I take your point that the pressures of likely slowdown in the economy and job losses is, likely to make the Fed cut more rather than less. We'll have to see how that plays out. Thank you very much, David. We do hope that we'll have you later on a better line. Thanks a lot for joining us. We have to wind it up on that note on Bazaar. Chartbusters after the break.
Donald Trump announcing a 5-day hiatus in the West Asia war pulls the market back up. Key indices mirror the global relief rally. Volatile moves continue ahead of Nifty expiry. Autos and PSU banks lead the charge.
Rising raw material costs trigger price hikes at Asian Paints. A portfolio-wide price hike in the vicinity of around 8 to around 6% effective April onwards follows the 2 to 3% hike that was implemented earlier. Additionally, shares also gained following Macquarie's outperform rating.
Crude tumbles nearly 11% overnight as US President Donald Trump indicated that talks between US and Iran were productive. Prices, however, back above $100 in early Asia trade. Tires, aviation stocks and paint stocks all higher today.
GR Infra bags a 2,440 crore HAM order in Bihar from the National Highway Authority of India. Execution timeline for the project set at around 910 days from the date of appointment. The stock, however, sharply off opening highs, now currently trading in the red with a cut of around 2%.
Navratna CPSE IRFC inks a 12,800 crore rupee term loan agreement with Hindustan Urvarak and Rasayan Limited. The deal is among the company's largest refinancing initiatives. The stock up 2.5% in early trade.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets are trading in the green, but the gains from the highs of the day are nearly half of what it was. Remember, last evening there was some hope, and you had the GIFT Nifty that surged 800 to around 1,000 points, and now you're sitting with a feeble 160-point gain. Mangalam, you'll have to thank God for the small mercies. 150-point gain is at least green. However, it's not a convincing up move is what we're seeing. But I think, some clarity should emerge in the coming days and something's got to give.
Take that point, Nigel. There was a big euphoric move yesterday when the first post from Donald Trump came. Thereafter, there was some moderation as the response from the Iranians came. And that's exactly how, maybe this situation will pan out, where it won't be one clear binary event where the war suddenly ends. There will obviously be some sort of give and take, and that's what the market is reflecting. Currently, 150 points higher, and that's why, despite the sort of up move that we've seen in the market, the VIX isn't down much. Yesterday, it was up above that 26, 27 sort of zone. Still now, it is holding above that 25. So that's another level that we are monitoring going forward, along with crude and, the other parts of the market. But good time to welcome Dharmesh Shah of ICICI Securities for a quick technical check on the market. Dharmesh, the big fall that we saw yesterday, and after that, there was some attempts of a recovery of almost about 100, 150 points from the lows. Do you think after this sort of de-escalatory winds that have started to blow, the market may not have rallied and gone back to its earlier levels? But do you think we've put a low in place?
So yeah, good morning, Mangalam. Absolutely, I think so. The way the market behaved yesterday, it looks like more of a capitalization yesterday happening for the market, where you see the most of this net of advance and declines of total CNX 500 was around 470 stocks decline on a single day. So if you look at the historical data, whenever such scenarios happens with a reading of more than 460 to 480, we see generally the market has a tendency to form a bottom in the coming weeks. At the same time, if you look at the market breadth, the percentage of the stocks which are trading over the 200-day moving averages are now just 15% of the total CNX 500. Now, again, looking at the historical data of last 20 years, whenever this percentage approach towards this level of around 12 to 15%, market generally has a tendency to form a bottom or durable bottom, I would say. And generally, we see the return for next 6 months have been around more than 20%. So we believe, I think so, 22,000 to 21,900 remains to be the very strong support for the Nifty. Again, a 200-week exponential moving average, which has been working fine for last 20 years. Remains to be the very strong support for the Nifty, and eventually I think so the more important point to look out going forward will be 23,300, which is again the last Friday's high, also the Thursday's high. If we eventually breach above these levels of around 23,350 on the higher side, we should see a more of a short trading happening for the market. Till then, I think so the market should trade in this range of 22,000 to 23,000.
So 21,900 is an important mark on the downside, right, Dharmesh?
Absolutely. Yeah.
And the percentage of stocks that are trading below their 200 DMA, that's at around 15%, 85%.
Yes, the percentage of the stocks which are now currently trading above 200-day moving average are only 15%.
15%. Got it. You know, Dharmesh, you mentioned some data point where the markets will give you 20% return in 6 months. I'll tell you what, the street will be happy with mid-single digits as well, going by the kind of sell-off that we have seen. But we've taken your point on board. What you're trying to drive home is, in the near term, we are oversold, and you're seeing firm support at around 21,900 to around 22,000. Got that. Fill us in with a couple of individual stock trading ideas.
Yeah, absolutely. Nigel, if you look at the market, I think the telecom as a space has been relatively outperforming even in this current corrective phase where Bharti Airtel, again, I think so. If you look at the weekly chart, I think so. Again, the last week low has been protected even in this such a corrective phase. So if you look Bharti Airtel again at 1784, it looks to be, I think so, the stock finding the support at 20-month moving average in the last 4 instances, and finally it's seen a more of a gradual up move. We believe for the market in the current context, I think so Bharti Airtel remains to be on the safer side, the target of around 1940, keeping a stop loss of around 1684.
All right, we take that point. Thanks a lot, Dharmesh, for joining in and giving us your views. What we'll do is take a short break on that note and come back on the other side. It's been a while since we discussed the primary market action. Powerica is a company that joins in to discuss their IPO, the listing and business model. Stay tuned for that. Welcome back. The market's holding up with about 130 points in terms of gains. Let's get cracking on the primary markets then. Power solutions provider Powerica's 1100 crore rupee IPO opens for subscription today. Price band up for you on the screen between 375 and 395. The company serves as a key OEM manufacturer for Cummins India. Let's understand how the business is shaping up. More importantly, what their post-listing plans are. They're seeking a value post-listing at around 5,000 crore rupees at the higher end of the issue price. 700 crore of the 1100 crore is fresh, whereas the rest would be going to the chairman and managing director, basically the promoters, Bharat Oberoi, who joins us in the studio. Thanks a lot, Mr. Oberoi, for joining us in the studio. You know, the obvious question is that 85% of your revenue still comes in from diesel genset.
Yes.
And that has about a 10% sort of margin.
Yeah.
15-16% or about 20% as of the first half of this year comes in from wind power.
Right.
That has over 35% margins.
Right.
So what kind of revenue growth are you projecting here?
So, we are looking at to be steady the same way.
80-20?
Yeah, exactly. It'll be more or less the same. Obviously, there's going to be a lot of addition in our windmills, but obviously, again, on the Cummins side also, there's going to be a good growth through the new initiatives of data centers and, and so much more infrastructure, etc., that the government has to add for the country.
Okay, all right. But, some believe that maybe it's a bit of a risk to have so much of dependence on one particular client. What do you have to say about that? A lot of hard work would have been put in to get this client on board in the first place. You could tell us a bit of a backstory out there. But now suddenly most of the money is coming from them. So how do you...
You mean from Cummins?
Yes, exactly. 80-85% coming in from them.
Yeah, absolutely. So again, I would like to reiterate over here that relationship, right, is more... is for our coming years, for our future. We look at that relationship for the next 20, 25 years. We have spent 40 years. The bucket that Cummins offers us, the engineering that they offer us, it's on top of the league in India today.
So you don't believe that it's a risk?
Absolutely not.
Is there any sort of peg to Cummins in the sense that, okay, this is the kind of margin that they will give us? Because what we're trying to understand is 85% of your revenue
very
is one
closely,
client.
and there's nothing like this. There's a market out there, and we do get a fair share of profit from them. And obviously, and because being Cummins, we also get certain times we get our premium as well.
Just one point: Cummins is using your products only for their domestic business, or they use it even for their export international business?
No, that's separate. They do that separately.
So they are sourcing from you purely for their domestic business?
They're not sourcing from me. I'm sourcing from them. I'm sourcing the engine from them.
Okay, and it's across all the gensets, across all the new norms, etc. Because if it's just one...
Absolutely, CPCB 4 up to 750 kVA. And now even above that, okay, we have from 1,000 and above, that's also been emissionized.
Yeah.
Especially in the states where the law has already been enforced, especially in the north, and now moving even the south has started. So we are emissionizing the 1,000 and above kVA as well.
So let's get this clear. You buy from Cummins.
Yes.
All the OEMs.
Okay.
I'm an OEM. I buy from Cummins, yes.
And you sell to?
I sell to all the customers in India.
And
so our customer base today through our CRM would be anything, live would be anything above 55,000.
And at what rate is the demand for your end product, for the industry growing at? And what is your likely growth rate going forward?
It's going to be between 10 to 12%, right? As I said, the segmentation, if you want to take, you can take it across the segments. We are seeing growth across, obviously, data centers being the fastest now.
Okay, a quick word. You're raising some money from the market as well, right? As a reward, you'll be taking some home because you build the business. But there's a fresh issue as well, and that money goes back to the company. So break that up for us. How much will be used for debt repayment? Will you be debt-free post that? And interest savings will be how much?
So we're going to be totally debt-free. 550 is going to go immediately from the 700.
Yeah.
The rest will be left with us for our corporate.
So 550 crores is the debt repayment.
Yeah.
At a rate you would be borrowing
8%.
at 8%.
So about
approximately
35 crores.
35 to 40 crores.
Crores of saving.
Of interest saving.
Per year. Yeah.
All right. And the remaining 150 crores?
That's going to go for other activities of, like a few, one factory. We're doing some small expansion over there and other corporate purposes.
But in the power business itself, I got to ask you this. While it contributes a smaller part to your overall business, the capacity utilization factor is around 32%.
Of what?
That's normal. The assets as on September 30th, average CUF was close to around 32.8%.
In which case are you talking the factories?
Yeah, the factories. The plant availability is 98.7%, but CUF is 32%.
Our factory utilizations are up to 82%.
Got it.
For two factories. The third one, the expansion is happening.
Now, Mangalam, I think, is referring to the power side of the business. The total installed capacity at this, 330 megawatt?
Yeah, that.
330 megawatt. And I think in line with normal businesses, it doesn't function at optimum utilization.
No, but that's the win business.
Exactly,
That's the model of the
right.
business.
So that's what we
are running at a PLF now, right? The PLF is very important for the wind.
Yes.
Got it.
All the new machines are going to give us more than 34%.
Exactly, that's what I wanted to know.
Yeah,
so currently it's about 32%, 33, 34% is what it's likely to be.
Yeah.
And there would be an incremental benefit on your operational performance because of that, right?
Definitely.
How much are your margins likely to go from here?
See, these are all PPAs.
Exactly.
Which have been signed off already. So our average PPA now is going to be about 3.42, 3.45, which is, much higher than any other renewable is going to give you.
Okay.
And these PPAs are all for 25 years.
Okay. And when is there'll be an upcoming tender as well that you'll be participating in?
We already have 330 running.
Yes.
50 underway of WIP, maybe just November completion. 100 more we have already won. That will come into play again by next year end.
Okay.
That will also be operational. And as per the RHP, another 100, 150 will be done by 2030.
2,500 crore revenue in the next fiscal with about 15 to 18% sort of margins possible.
Yes.
And net profit this year, obviously, the first half,
doing very well,
130 crores. You add another 35, 40 crores of interest cost savings. So about 300 crores profitability is possible by FY28?
Yes, for sure. I think the EBITDA for going forward looks promising.
All right.
All right, Mr. Oberoi, we appreciate you joining in. Like your confidence as well. Hopefully the street backs you up in terms of this issue.
Thank you so much. Thank you.
But thanks for joining in, explaining your business to us. We wish you well. And on the day you ring that bell at the bosses, we request you to join in on Chartbusters at 10:30 a.m.
And then we'll press you more for the numbers.
Thank you so
All
much.
the best.
Right, thank you so much.
All right, on that note, we'll slip into a short break. Come back, we'll continue our focus on markets. Stay tuned. Welcome back. You're tuned into Chartbusters. You're on CNBC TV 80, and the market continues to hold in the green. We're up close to around 180 points or thereabouts. But Asian Paints, that one's higher following the 6 to 8% hike. Mangalam, you picked up the details. There are a couple of brokerages that have written on it as well. Some relief for a shareholder. For a customer, whoopsie, it's getting more expensive.
For a customer, it is getting a little more expensive, but customers are used to paying a higher price. Remember, in September, the GST cuts happened. So in their minds, they have a price which they're comfortable paying. It was lower earlier, now it's higher. Be that as it may, currently oil is still at around $104 per barrel. So let's see how that goes. The company has gone ahead and announced price hikes on account of their, the inflation that we've seen in key raw materials due to the geopolitical uncertainty, the packaging costs, logistics costs, all of that. all the other paint companies that announced a 2 to 3% price hike earlier, with another one likely, what Asian Paints has done is they've said 6 to 8% starts on April 10th and goes all the way. The second phase happens on April 21st. What they've basically done is that some of their premium products, they've priced it 6 to 8% higher on April 10th. So you get that 10 days additional worth, revenue. And some of the volume drivers, the likes of putty and some of those ancillaries, they've actually taken it to April 21st. So until then, the volumes for the company also go up. So it's basically a balance between value and volume. And the fact that crude has come off from the earlier highs that we saw is a benefit. The stock had already seen a 10% correction this month. So all these factors working positive for Asian Paints. Macquarie has an outperformed, rating a target of 3,100.
All right, let's focus on Coal India. Then Nuvama, they've maintained their cautious stance on Coal India. They are highlighting that the company's narrative of higher volumes and stronger e-auction prices may not play out on expected lines. This is primarily due to the excess domestic supply, the rising competition, and relatively subdued demand. They also make this point that e-auction realizations are likely to stay range-bound. And they point out that the March 2026 e-auction premium was in the vicinity of around 35 to around 40%, which is broadly in line with what we saw in the previous 9 months at around 37%. Though they mention also that volumes could see some kind of an uptick, though premiums haven't really moved up by that much. On the volumes growth, they say that remains a concern. FY26 is yet to show any kind of meaningful traction, and the projected 4% CAGR over the next 2 years, that's at risk because of the rising output from captive miners. So volumes as well may not look up. Additionally, they go on to state that the cost pressures loom. Wage revision for non-executives is due from the middle of this year. Even when we had spoken to the management, they had mentioned that July 2026 is when we could be expecting wage revision. And the company may not be able to fully pass on this impact of rising wage cost. As a result, the earnings growth is expected to remain muted. With the next few years, the EBITDA growth could grow at just around 4% CAGR from around FY26 to FY28. Overall, Nuvama, they are maintaining a cautious stance. They have a reduced rating, target price at around 384 rupees per share.
All right. Take that point, Nigel. Thanks a lot for that. So that's about Coal India. But IRFC is the other stock which is higher on the back of a refinancing deal with HURL. Let's understand the specifics of this transaction with Upasna. Upasna.
Well, certainly the stock remains in focus today as it has signed a rupee term loan agreement worth 12,842 crore with HURL for refinancing their long-term debt. Now, mind you, this transaction is one of the largest transaction that the IRFC has taken in terms of its refinancing initiatives. And from this, the main strategic move of the company is moving from just a railway financier to a broad-based infrastructure financier as well. This single 12,842 crore deal is one of the largest, is what the company has also indicated, and it will overall nearly add about 4% of the AUM, which currently stands nearly at 4.75 lakh crore as of early 2026. Now, lending to a Maharatna-backed consortium allows for a record capital deployment while maintaining a 0% GNPA record that the company already has. So overall, certainly a positive deal. The stock remains in focus on the back of this, but currently a bit off from the morning highs that we've seen.
Okay, all right, Upasna, thanks a lot for that. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour comes up next.
You're watching us here on Trading Hour. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me is Hormaz Fatakia. Currently, the markets are holding well in the green, but fairly off highs this morning. But more importantly, not as big a move that we're seeing as one was expecting last evening when the post from Donald Trump first came about de-escalation. So the market's higher, but tentatively so. And that's reflecting in all the other asset classes as well. So crude is off highs, off the about $112 barrel mark that we saw yesterday, but still holding well above that 103. And similar is the case with the rupee as well, closer to record lows on that that counter. And we have the Nifty Bank as well, which is outperforming today. But again, like I said, tentatively so. Doing well for the market. That should come as a bit of a relief. But should this be a relief rally or not is something that we will know only later in today's trading session as we move towards the weekly options expiry as well. But a bunch of stocks on our radar moving around. Let's go across to Hormaz. Hormaz, nearly 2 stocks advancing for every 1 stock, which is declining today.
Well, after a 1 for 14 yesterday, you would take that as of now, but it's an unconvincing move on the upside, as Mangalam just highlighted. And if you can see, the index is significantly off the highs of the day. The GIFT Nifty at one point yesterday was up 750 points, and after a 600-point drubbing yesterday, the index is barely managing to hold on to a 150-point gain. Then if you take a look at the Nifty, that's down from the highs. Where you take a look at the rupee, that has reversed course again after the initial appreciation that you saw of around about 0.5% and has now reversed most of its gains. It's back towards those 93.85, 93.90 levels. And same is the case for oil as well. Now, if you take a look at oil, at one point yesterday, Brent was around 114.15. It slipped to sub 100, but it is still now back above the mark of $100, as is NYMEX is back above $90 as well. So crude prices may have eased, but they haven't declined substantially for there to be any sort of relief whatsoever. They still remain at elevated levels. You look at the Nifty newsmakers today, and there are a bunch of these names. Look at Asian Paints after the price hike, Indigo after the crude, L&T after the news developments as well, and ONGC as well among the newsmakers today. Still after that bullish note that came in from CLSA earlier in the day on ONGC, expecting an upside of close to 60%. And on the banking stocks, the banking side, Kotak got an upgrade today. That stock is doing well for itself, around 2% higher. HDFC Bank, after 4 days of drubbing, is up around 1.5%, and ICICI Bank too is off the highs of the day, still holding on to gains of about 0.5%. No changes in fortunes for the oil marketing companies though. Another downgrade coming in today from Goldman Sachs, and well, after the cool off in oil prices, with around about 1% or 2 higher is HPBP, but they are down almost 25 to 30% in the month of March. What continues to do well are these 2 mobility names, JBM Auto and Olectra Greentech. Both of them off the highs of the day, still holding on to gains of 6 to 7%. They had a very, very good month of March as well. The index may be higher, but there are some names that are bucking the trend, if you could call it that. Coal India, after that cautious note from Nuvama, down 3. Muthoot Finance, no let off in the sell-off in gold prices, still down 2%, and Power Grid as well, trading around a couple of percentage points lower. And lastly, some names at 52-week lows. Fino Payments Bank continues to grind lower, 12% down on the stock, now the top loser in the broader markets today. TTK Prestige is down 5.5%. That is at a 52-week low after the surge that you saw a couple of weeks back. And KNR Constructions too, not having a very good day today, 3% lower on this one as well.
That point. Thanks a lot for that, Hormaz. But oil companies are on our radar. CLSA this morning has written, and they've maintained their high conviction outperform rating on ONGC. Goldman Sachs also says the risk reward has turned less compelling for oil marketing companies, the 3rd or 4th brokerage to say so. Sonal joins in with more details. Sonal, it's long upstream and perhaps short downstream.
It is, and that is considering the crude oil prices and the gas prices, that the way they have moved, and that's why CLSA maintains the high conviction bet on ONGC. In fact, they've gone ahead and increased the target price on the stock to 415 as well. They say amongst the global exploration and production stocks, ONGC is trading very cheap, and it has seen the sharpest fall since the war began, because there's a fear that there could be a new windfall taxes. However, we've been highlighting that as per new rules by the oil ministry, windfall taxes cannot be levied on higher realizations on oil and crude oil prices, and that is a reason why CLSA has turned positive on the stock. They say that with stock pricing in Brent at $63 per barrel, it offers a 65% upside from current levels if we assume Brent would be at $90 per barrel mark. The other key triggers would be rise in gas production from the new basins, which would increase gas production by around 15% in the next 3 to 4 months, and over 50% jump in new well gas prices as well as per the new gas formula. They say the increase in EPS would be to the tune of 34% if they see Brent at $89 per barrel for FY27, and it would increase by 14% if the Brent assumptions are at $82 per barrel for FY28. So that's about ONGC. It has been outperforming in a very, very weak market. But if you talk about oil marketing companies, after HSBC, Kotak Institutional Equities, it's Goldman Sachs now which has cut target price across the board for all these three companies. They say marketing margins have turned negative. We spoke about it yesterday. -1 for diesel, in the negative for petrol as well. And that is the reason why they continue to see lower margins, because retail level prices have not increased. They remain very flat for now. For HPCL, it has been downgraded to a neutral from a buy. Target cut to 310 rupees. BPCL, the same downgrade in rating. Target has been cut to 340. For IOC, target has been cut to 110, and it has been downgraded to a sell as well. For Reliance, on the other hand, they maintain their buy with a target price of 1,910. But for ONGC, they have a sell target with 245 rupees as the target price. So while CLSA is bullish on ONGC, Goldman Sachs is not. But the fundamentals, in a way, are supporting ONGC with higher crude oil prices, gas prices as well, and no fears of windfall taxes anymore.
Take that point, Sonal. Thanks a lot for that. That explains why, despite the moderation in crude prices from the peak, the stock is still higher today, and we haven't seen a formidable upside in some of these oil marketing companies either. Though, just watch out for a couple of these stocks as we look at the Nifty Bank. It is, slightly off highs, but still closer to around that 500-point gain. We have Maruti Suzuki too, which is trying to inch higher from today's lowest point. HDFC Bank is the other one, higher by about 1.5%. But retail investors, they remain net buyers despite Nifty sell-off in March so far. Hormaz has got the details. Hormaz, the discipline of retail investors continues.
It does, and the big question has been all this month that what have retail investors done in what has been an otherwise very, very forgettable month for the index. Now, this is data from Anand Rathi Wealth, and the net outcome of this is that retail continues to remain a net buyer in the month of March, and this is despite the index correcting as much as around about 10 to 11% in the month so far. And this is data until the 19th of March, when we had at least 13 trading sessions in the month, of which retail was net buyer in 5 sessions and a net seller in 8 of them. But the net buying figure outpaces the sell figure in the 8 sessions. Now, if you take a look at the biggest selling days that retail had in the month of March, you take a look at the 2nd of March, that was the first reaction that the markets had after the war began in West Asia. That day, the Nifty was down over 300 points. That was the day when there was selling from retail investors with close to 3,500 crores. And of course, they chose to pair some positions as well when the index went higher. On the 16th of March, when the Nifty was up around 250 points, they chose to sell worth over 3,300 crores. On the 10th of March, when the Nifty was higher, 250 again, they chose to sell around 1,500 crores. And then on the 12th of March, when the Nifty was down again on around about 200, 225 points, there was selling of close to 570 crores from retail investors. But take a look at the buy figures. Last Thursday, the index was down almost 800 points. That was the biggest fall that the index had this month so far. That 800-point fall saw retail buying worth almost 6,700 crore rupees in the month during that trading session. On the 13th of March as well, when the index was down 500 points, there was buying worth close to 300 crores. On the 11th of March as well, the index was down 400. There was buying of around 3,200 crores. And on the 6th of March, which was Friday, going into a weekend, 300-point fall on the index, buying seen worth close to 2,000 crore rupees here as well. So buying the dip has been the trend, but they have also chose to pair some gains as and when the opportunity has come up. And you take take a look at the other market participants as well. According to this data, FIIs continue to remain net sellers. There's almost 83,000 crores worth of selling. Mutual funds have been buyers. They've been buyers of around 66,000 crores, but they have not managed to match the FII selling pace. Insurance companies have been buyers, and AIFs have been the ones that have been net sellers in the market during the month of March. But as of now, the retail discipline, as you mentioned, that continues in the market, and that is what has somehow kept the market afloat, if not surging higher at least.
Take that point. Thanks a lot for that. For all the FII selling, there had to be some counter absorption, and that has happened from the domestic investors and retail investors as well. We'll take a short break, come back, focus on the bond markets with Manisha Gupta on the other side.
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. Shifting focus to the bond markets. Manisha is here with the latest from that space. Manisha.
Thank you so much for that. Well, India bonds yields have hit a one-year high. We're looking at some bit of an easing and yields recovering slightly. That is after the US announced a 5-day postponement to the military strikes in Iran. Though nothing much has changed because Iran continues to attack various military bases of US. There has been constant attacks from Israel as well on Iran. So nothing really has stopped on ground. Having said that, what is also bothering the money markets is this slight rebound in the equity markets. The Indian rupee, after hitting those constant all-time lows, it seems to be stabilizing in the day today as well. And then in the markets yesterday, we also saw SEBI board approving tighter disclosures, FBI netting, and that is what the markets seem to be reacting to as well. It also is about the FPI outflows that the Indian markets have continued to see, and the rupee weakness that has seen a decline of nearly 3.5% in this year, also weighing onto the bond markets there. The street is also looking at the strength in US dollar index holding around that 100 level, and the dollar demand that also seems to be coming in from the FPIs, and of course importer buying of dollar is putting pressure onto the Indian rupee as well. The investors at this point in time seem to be pricing in a rate hike due to concerns about inflation. That is because of the rising fuel prices. Crude, remember, is trading above $100 a barrel, has been at that level in the last 1 week as well. And we have seen crude oil prices gain up by nearly 40% in the last 1 month, stoking inflation and the fears that you could be looking at the rate cycle totally changing. The market participants in the meanwhile also are expecting the 10-year yield to touch 7%. That is in a scenario if the war persists for a longer time. Also, the 1-year OIS rate have surged by 50 basis points to almost 5.98% since the war is broken out. Take a look at the liquidity situation as well, and that tells you on how the Indian markets are, and of course the reaction that we've seen come in for bond as well. So the system liquidity has moved to a deficit due to the tax outflows and of course also because of the forex interventions. So on March 22nd, we stand at a deficit of around 65,000 crore rupees. If you look at the 1st to 15th of March, that is the first half of this month, the average surplus used to be at 10.5 lakh crore. So that's yet another thing that seems to be weighing on to overall markets there.
Manisha, thank you for that update there. There's some bit of buying emerging on the index from lower levels. We are back at that 22,700 mark right now, so 190 points higher, although we are still off the highs of the day. But a good time to get in what the FNO trends are indicating. Of course, today being the weekly expiry as well. Mangalam is here with all of that. Mangalam.
Well, you know, the markets are higher, but if one had to qualify that, one would say that it's tentatively higher. The high today was closer to 22,900 thereabouts. Today we're at 22,700 for the frontline index. The Nifty Bank is doing well today. And now over the last 15 minutes or so, we've seen some of the IT pack stocks also, the likes of Infosys and TCS, come up in trade, and that's supporting the index all the way up to 22,700. The Midcap index as well doing better. The market breadth, yes, there are 2,000 stocks which are advancing for about 900 stocks which are declining, would make your portfolios feel slightly better, some balm on frayed nerves. And, the India VIX also, while it has cooled off, it is still above that 25 mark. So it's not necessarily all roses right now, but the market is higher and tentatively so. Today is high, 22,900. Once the Nifty crosses that, only then we can see a bigger move. And maybe if we do that, then a lot of punt buying which is taking place ahead of expiry at the 23,000 call would come into picture. So that's something that we will monitor today. As of now, today is high, seems like a bit of a resistance or supply zone, while 22,500 to 22,600 is an important support zone that comes in for our market as well. So 22,700 is where the fulcrum is. But if we sustain above 22,900 towards expiry, one can't rule out a big melt up as we move forward, largely because of the shorts that are already present in the system. A lot of fresh shorting activity has been visible in Power Grid as well as Coal India in today's trading session. There's been a brokerage downgrade on Coal India, but Power Grid has been a bit of an outperformer. If the other parts of the market are doing well, then these are coming undone. And a lot of the shorts were caught on the wrong side for a lot of these PSU trades. RVNL and IREDA are the ones which are fairly well bid in today's trading session, and shorts caught on the wrong side, short covering out there.
PSU stocks seeing some short covering. Mangalam, thank you for that update there from the FNO side of things. So 22,715 now, so around about 200 points higher. It's about 70-80 point up move that we've seen in the last few minutes on the index. So it'll be interesting to see how this shapes up as we go into the weekly expiry. Take a short break, our big story segment on the other side, and we focus on consumption stocks in the light of the ongoing West Asia crisis. We also take the discussion forward with Abneesh Roy of Nuvama Institutional Equities and Abhijit Roy, the MD and CEO of Berger Paints.
Well, there's been a decent uptick in the market over the last 20 minutes or so. The Nifty is now trading with gains of over 200 points as against 130 points when we started the show. The important contributor to this last 15-minute of uptick is the IT pack. Yes, the banks were already outperforming, but now look at the intraday chart of the Nifty IT, and there you see a big, zoom up coming in, and a large part of that contributed by Infosys as well as TCS. So if this sector continues to do well as well, maybe the up move sustains. So the tentative nature of the up move also perhaps gets curtailed out here. HDFC Bank is the other one, which has taken the Nifty Bank's gains to upwards of 1%. So index heavyweights doing well. HDFC Bank up almost 1.8% after the big gash that we saw last week. And we have the IT pack doing well too. So all of that have resulted in a near 220-point gain for the Nifty. But now it's time for the big story of the day. It is crude consumption and color. Let's talk about consumption first. The stock that is doing okay-ish right now is Titan. It is, close to around 1%, 0.5% higher, though off morning lows. A large part of that could also be because of the gold prices that we've seen. But apart from that, we have CLSA that is bullish on the stock. There's a note that has come in this morning where they have put out their expectations for the fourth quarter. And what I'm looking at is an outperform rating and a target price which has been raised to sub 5,000 rupees versus 46.74. What is this predicated on? They expect the company to deliver a 43% sales growth in the fourth quarter. They expect growth to be driven by the jewelry sector, and at the same time, it would be about 58% ex-bullion, a large part of which on account of the rise in gold prices. Watches business grows at 12%, eyewear grows at 17%, contraction in jewelry EBIT margins to about 10.4% versus 10.6%. That's on account of higher gold prices, higher contribution of gold, and perhaps some competitive intensity as well. They've raised their FY26 to FY28 EPS estimates by 5 to 6% to reflect faster sales growth and slightly lower margins for the jewelry business. All of this means that the stock is well bid in trade today. But that's not all about consumption. We'll talk a lot more about this as well. For that, we'll welcome the first guest on our big story today. That is Abneesh Roy, who's the Executive Director of Nuvama Institutional Equities, joins us for a quick, sense on what the sector is doing. Abneesh, let's start with crude oil. It is still at $104, yes, off highs. Do you think we made a moderate sort of range now and everyone will start to price themselves accordingly? We've heard of price hikes coming from Asian Paints. Earlier, we had other paint companies announce as well, maybe a 4 to 5% sort of price hike from across the board. That's a possibility?
Yeah, sure. Good morning and thanks. Yes, we expect that because most consumer companies have, say, 1 month to, say, 45 days inventory, now the price hikes are happening and Asian Paint has announced 6 to 8% hike. This will kicking in April. So my sense is edible oil companies and paint companies have already announced, and rest of the FMCG, my sense is soaps, for example, or even hair oil companies, they use a lot of LLP. We will see in such cases clearly 3-4% hike. Rest of the FMCG, my sense is, will need 2 to 3% hike in Q1. If this situation continues, because around 20% of the raw material is linked to the packaging, which is linked to crude. Apart from that, detergent players will also need hike because that's again linked to crude oil. And even for liquor companies, glass cost is indirectly linked to crude. So all those things will need higher inflation. Broader FMCG, you're right, will need around 2 to 3% inflation in Q1.
All right. Meanwhile, there is news that has come in. Swiggy has hiked food delivery platform fee to about 17.6 rupees from sub 15 rupees, 14.99. Remember, Zomato too last week had affected this price hike in terms of platform. But the question here is, whether this is dynamic or whether this is static going forward. It is a lever to improve the food delivery performance. The fact that one player has done it would also mean that the others would do it, and that's exactly what has happened right now. Platform fee for the food delivery business has been hiked by Swiggy following what took place on Zomato last week. The other sector on our radar right now is the paint space, and Asian Paints is among the top Nifty gainers today. The company yesterday sent out a letter to their dealers saying that there would be a price hike between 6 to 8% for most part of their portfolio and a little more for thinners, and this will be done in 2 phases, April 10th and April 21st, 2026. The companies tried to, mitigate the volume value risk and also smoothen it out via announcing it in 2 phases. Abneesh, your call on Asian Paints. You've initiated a trading buy on Asian Paints because of this.
Yeah, so that's purely because geopolitical can change very quickly. But 2-3 good things, Mangalam, is if you see last 4-5 years, we have seen that if volume growth of paint industry for say Asian and Berger is say X percentage, their value growth is generally X minus 5. Now what will happen, because these paint companies have taken broadly 7-8% hike by Asian Paint, and Berger will also take one more round of hike, that's my sense. We will see that in FY27, if volume growth is X percentage, and my sense is we can work with a 7 to 8% volume growth in FY27, the sales growth should be a bit higher than that. That helps in operating leverage. And even for the new players, if you see for the first time, they have seen this kind of volatility. So my sense is they will also take more price hikes, and there could be a bit more rational play given the kind of extreme situation we have seen. These are the 2-3 positive. Apart from that, Asian Paint took the price hike, I think, at the end. That shows the aggression. In the legacy player, Asian Paint has been slightly delayed. I think that's a demonstration of aggression, which I think is a positive for Asian Paint from a market share perspective.
But would these price hikes, Abneesh, suffice to overcome or offset any potential operational impact on the EBITDA or on the margins, considering the higher prices? If not in this quarter, because the impact has only been felt in the month of March, maybe in Q1 of FY27, does that have an impact on the margins, these higher prices, and if these prices remain higher for longer?
Sure, good question. My sense is they will need one more hike. How this works is initially when sharp inflation happens, consumer companies will lower the promotional intensity. So all those dealer extra margins which were being given because of the new player, I think that will reduce. Apart from that, this 6 to 8% hike has happened. If you see how the maths works, 40% of the raw material for paint company is linked to crude oil. And if that 40% say remains at a 50% higher, because $60 to say $90, if that remains, that's a scenario. I think that works out to 40 into 50. So around 20% hike in that kind of an extreme scenario. As I said, it will also include the dealer incentives and promotional intensity being reduced, which is generally not visible, but that's a dynamic number. Apart from this, clearly, the rest of the raw material is titanium dioxide and rest. I think that's very different supply-demand situation. Apart from this, please note, consumer paints once in 5 years, and out of the total painting cost, only half is paint cost, half is manpower cost. So my sense is if consumer behavior is once in 5 years, I think this kind of a price hike will be absorbed, given the entire industry will take. But yes, one more round of hike will be needed if crude remains at $90-95 for the longer term.
What is your call on Pidilite right now? Because, VAM prices are also somewhat linked to crude, and crude has seen a big spike. Pidilite, obviously, the management had guided for their margins to stay in the upper end of that 20 to 24% sort of range. They managed double-digit volume growth, but do you think there is a downside risk to the margins?
Yes, there can be slight downside risk because Pidilite is operating at the top end of the margins, and they are beyond the top end. One difference between paint company and Pidilite is Pidilite generally likes to take a longer term call on the raw material pricing. So you will see one kind of a price hike by Pidilite generally in most years. Unlike that, paint companies can 3-4 hikes also if needed. So that's the behavior of the two industries. So I will expect that, of course, Pidilite has even higher pricing power than paint because they have a 70-75% market share. But they like to take a more delayed and nuanced call, given it's a single player, large player industry. So yes, I would expect some compression in margins if this continues, but they will aim for a close to double-digit volume growth and near the top end of the margins. Currently, they are even beyond the top end of the margin. So I think, yes, some compression can happen. I don't think that's a big concern.
All right, Abneesh, hang in there. You might want to stay on for the next conversation and listen into what the other Roy, Abhijit Roy of Berger, has to say about the current situation on crude consumption and color. If you have a question or two, we may patch you on to ask a question to Abhijit as well. With that, we take a short break. On the other side, we continue our big story. The management of Berger Paints joins us. Abhijit Roy. Welcome back. We are discussing our big story, crude consumption, color, and the second guest on our show now joins us, Berger Paints. Abhijit Roy is with us. We discuss, obviously, the current crude scenario, the demand sentiment, competitive scenario as well, all these and more, the impact of high input cost environment. Obviously, we were speaking with Abanish Roy as well. So he's still with us, listening into this conversation, and if he has a question or two. So both the Roys on. I'm tempted to crack a pun here, but let's go to Abhijit first. Abhijit, you know, how's the RM basket changed for you in the last month or so? How much of that has been passed on? How has trade reacted to it? And is there a likelihood of another price hike coming now that, you know, the price stays above that $103 per barrel?
So, Mangalam, you know, prices are fluctuating on a daily basis almost, you know, because the oil prices keep fluctuating. Typically in the industry, if you look at it, you know, the pass-through rate is about 30% for the paint industry. It will vary, you know, depending on the type of products being sold by a company. But on an average, you can say is around 30%, which means that if there is a oil price increase of 40%, 30% of that, which is about 12%, will be the impact in terms of raw material price increase. So that's on an average how it will be. In our case also, it is more or less around those levels. So as of now, you know, the prices have gone up to 110, then it slipped down to yesterday to, you know, 90s, mid 90s. Again, it is back to around 100. So the effective price increase so far, I would say, is around that, you know, 12-13% mark. What we have done is we have taken announced one price increase, which is, you know, effective tomorrow. The second one will come in, you know, effective the 30th. And then subsequently, we will look at the prices, you know, how it is operating, what is the situation, has the war cooled down or is still on, and then take a call again in the month of April. Possibly we will take one more price increase after that. So typically in paint, you know, we take in stages, you know, that's how it has been always. And we are now going to take it. First stage will come in effect tomorrow itself. That will be part of the enamels and certain other portfolio in the waterproof range. And in the second stage and the 30th is, you know, all the premium and luxury emulsions where we will take up the prices. This will cover part of the price increase that has happened. Fortunately, we had built up a lot of stock because our April is big. So typically we have some stock with us, the finished goods and raw materials. So that will last for us some time. So in terms of impact on the bottom line, we will not have any adverse impact, possibly a little positive in that way.
Right. So if you could, you know, notify the quantum of price hikes that you've taken. Abhijit, one is effective tomorrow. Another is effective in the middle of April. What is the quantum of this price hike? And the third one, if you're looking at?
So tomorrow is around 1.5%. You know, the one which is on the 30th of April will be another 2% possibly. So it will be 3.5% of coverage. And then on the April, possibly around the 9th or the 10th, you know, we will have the balance about 3 to 5%, depending on where the things stand at that point of time.
Abhijit, has there been any pushback from dealers with regards to the price hike? Has there been any demand impact now that you have informed them that there will be price hikes, and which of course they take effect, one tomorrow and other two at the end of the month? Has there been any thing that you have been hearing on the ground from your dealers?
So there's, you know, typically when the price hikes are announced, the dealer tends to stock up. Specifically, you know, the material which sells well, you know, so they know that if it is stocked up, you know, they will be able to liquidate that. So we saw, you know, increase in demand for some of these products which we have, you know, announced price increase for. So that stocking up is happening, and, you know, we are already on a very healthy wicket as far as those products are concerned, where we are going to take a price increase tomorrow. So that's what has been the impact. So the reception has been good. You know, over the years, the paint industry, you know, had inflationary trends, and whenever this inflation happens, people do tend to stock up material of those brands which sell well, you know, and so therefore there is an advantage to that extent. Also the fact that, you know, some of the smaller players tend to get affected much more. So some of that will shift possibly to the organized players once again, as it had happened in the case of COVID. So some impact, positive impact might happen there.
And what about volumes then, Abhijit? You had mentioned previously that you will get to double digits. Do you stick to that at the end of the year? And what about margins this time around, and more so in the first quarter, because that will be the full impact that you see, because this is just 1 month.
Yeah, so this month, I think we should be comfortable. We are looking at double-digit growth rate for this month, and that should happen both in volume and value terms. So that is most likely to happen this month on account of the price increases announced. There will be some positive movement there. And the margins, as I said, will be slightly positively impacted because we are carrying old stock, which are at old prices, and we are taking these 2 price increases, so it will have some positive impact there. So from that perspective, this month is fine. Next month, it will all depend on where the prices stand as far as raw material is concerned. The next quarter, I am saying. We will have to wait and watch and see. As I have already mentioned and always maintained that this is a responsible industry. We do take price increases as and when required and do pass it on. Yesterday, the leader announced the price increase effective 10th of April of about 6 to 8%, and then another one on 21st of April of another 6 to 8% for a different range of products, but the bulk of it will be taken on the 10th of April. Pidilite announced the price increases today. They haven't announced the quantum, but they announced that on 10th of April, they will take the price increase. So overall, if you look at it, the industry will tend to pass on the price increases. So that's
understandable. That's totally understandable. And one would have imagined it to not happen given the current competitive scenario. We'll talk about that in just a bit, but we do have Abneesh with us as well. Abneesh, you've been listening into this conversation so far. Your views, and also if you have a question for Abhijit.
Yeah, I have a question for Abhijit. Hi, Abhijit. See, generally, Abhijit, we see that market leader takes the move first. This time we have seen you be among the first to take the hike. Then I have seen that Asian Paints hike is on the higher side versus your hike. So if you could comment, will this lead to some market share erosion in the near term to the market leader, given they have taken the hike a bit later? And second is, the new players have not seen this kind of volatility ever, because last 2 years we haven't seen this volatility. You and market leader have seen this multiple times. Would you expect that competitive intensity from the new player can potentially reduce? You have discussed the local players, but on the new player, would you expect that to happen?
Right. No, to answer the first question, we saw these price increases happening, and it was pretty substantial. For enamel, for example, the prices had gone up hugely. From 35-40 rupees a liter, and it was obviously, even if it cooled down, because normally these oil prices fluctuate very wildly, and they do tend to come back again. So if it moves up to 110 and then it drops down to 90. That is a possibility which is always there. But from 72 to 90, it's still a 30% jump. And that 30% of 30% means 9% impact will be there no matter what happens, even if after the cooling happens. So we took a call that, there's no point delaying on this, and therefore let's jump in and take those price increases of those products where we have a much stronger presence on the ground. And therefore the dealers will be forced to stock our material. The rest we did not, we delayed it, till the leader took it. So that's how it is.
All right, Abhijit, Abneesh, pleasure having you today.
Actually, he didn't answer on the competitive intensity. Abneesh asked him about that. Yes, and I wanted to add to what he said on the market share bit as well. Do you think you will continue to hold on?
So as far as we are concerned, I think we will temporarily gain some market share. That is not something which is permanent in nature. But this month we will definitely have a little bit of an advantage. As far as the new entrant is concerned, Avnish is right that it's a difficult situation, because they haven't got used to it. But I presume that being in the industry, they will have to, follow in the similar lines. But when they will take, what they will do, they haven't announced as yet. So possibly, there will be some announcement in a day or two.
But competitive intensity in general, has it been high for you or has it been low? Because, not only is Birla Opus there and it's increased its presence in the East via the plant, you have murmurs of stronger positioning coming in from JSW Axo Combine as well. So how's that played along, and with the aggression that Asian Paints has shown?
So, it has remained more or less static, for the last few months. I would say there has been no significant increase or decrease in the intensity of competition. More or less it remains where it was, say 5 months back, so no major changes has been observed so far. Yes, so Birla has gained market share, over the period, but over the last 3-4 months, more or less, the figures are hovering around the same levels for them. It's not jumping up anymore, which I have mentioned in my earlier, interview as well. So it's static in terms of growth rate. It is not accelerating anymore. So the competition intensity remains at earlier levels. Nothing, which is worrying as such.
Right then, now we'll take your leave, Abneesh and Abhijit. Thank you so much for sparing time and joining us and take us through the industry trends as well. Paint companies announcing price hikes. Take a short break. On the other side, continue our conversation on the markets with Somnath Mukherjee from Ask Private Wealth. Stay tuned. Welcome back. Continuing our conversation on the markets with Somnath Mukherjee from ASK Private Wealth. Somnath, good morning. Thank you for joining in. This unconvincing move that you've seen from the lows, the uncertainties have still not ebbed. What do you do in a scenario like this? For a long-term investor, do you think this is possibly the right time to accumulate?
Good morning. There is no timing element to investing for investors. Traders, different ballgame altogether, but for investors, time in the market is rather more important than timing the market. And I think these are the episodes, these are the pivot moments which remind everybody how important time in the market is, rather than trying to time the market in terms of an entry, sometimes also in terms of an exit. So yeah, from a meta standpoint, is this the bottom? Is this the end? I think we should be humble enough to say we don't know. I don't think anybody does, and hence it's a bit of a fool's errand to start trying to time the market basis a whole bunch of variables where we're not even very sure on where the end game of this war is, which is the proximate reason for all the ruckus that we are seeing across asset markets today.
In a scenario like this, then, Somnath, what are those sectors that you are putting money to work, if you have put money to work at this time?
Right. So I think, barring the point about sticking to discipline and sticking to long-term investment processes, regardless of market cycles, things that look well right now, it's clear that inflation is something that is going to be front and center. Interest rates are going to be something that is front and center. High interest rates are something that's going to remain front and center for quite some time. It is important, therefore, to look at portfolios to see if there are representations that benefit from high inflation, from high interest rates in the portfolio. Hard assets look good. Metals, precious metals, especially gold, look interesting as well. These are anyway supposed to be very core strategic parts of portfolios. If they are not there, then time to start building up positions. If they are there, depending on how much there is, one should start either adding to them or at least looking at ways to beef up those exposures.
In that case, now we're heading to the cusp of another earnings season, Somnath, and considering the uncertainty surrounding us right now, what are the kind of earnings growth that you're penciling in for this quarter and for FY27 as well?
Yeah, so this quarter will have a limited impact because remember the war started only 3 weeks ago. So 2/3 of the quarter would have been over. So to that extent, this quarter in most cases should have a more limited impact than the next quarter. The question from really an earnings perspective is how much this war disrupts not just the prices of energy, which is the proximate sort of worry factor for everybody, but also how much disruption to supply chains have happened. For example, the Pars gas field shared by Iran and Qatar, the Qatari energy minister disclosed that 17% of Qatar's capacity has been taken off stream. It's anybody's guess how long it takes for that supply to come back on stream. And, that goes down to things like feedstock for fertilizer, for specialized chemicals like helium, and so on and so forth. One can keep going on and on. So a lot of the earnings going forward will be dependent on how badly the supply chains have been disrupted and how soon this conflict comes to an end so that the supply chain disruptions can start getting healed. I think earnings right now, what one needs to look at is more about the redundancies built in individual corporate supply chains and balance sheets to take care of the obvious disruptions that most corporates will be facing today.
All right, Somnath, thanks a lot for joining in. Short but effective conversation. The market continues to move higher right now. A lot of these platform companies are spiking. Eternal is now at the high point of trade with a 3.5% gain. We're seeing Meesho come back into favor as well. Along with that, we have Urban Company, which has shown a noticeable spike in the last few minutes as well. Misho is up nearly 6%. Urban Company is the one that should come up for you, up 3%. With that, we are out of time on this edition of Trading Hour. You stay tuned. Halftime report comes up next.
Stocks perk up after Trump calls for a 5-day pause to the war in hopes of talks with Iran yielding a deal. IT, healthcare, industrials and financials are prominent gainers while utilities drag.
Asian Paints will hike prices by 6 to 8% from April 10th. Berger Paints to expect to hike prices in steps as the Iran war has led to a cost escalation of 12 to 13%. Berger says the industry will pass on cost increases as sales volumes stay strong.
HDFC Bank has appointed a global and a local law firm for an objective and fact-based assessment of aspects mentioned in its ex-chairman's resignation letter. Sources say the proactive step can help quell speculation.
SEBI Chairman Tuhin Kanta Pandey comes out strongly against HDFC Bank Chair's unsubstantiated insinuations, saying independent directors must act responsibly. The regulator's board, meanwhile, approves netting off for the FPIs and defines a code for its members. Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Ekta Batra. A lot happening again at the West Asia front. Some relief rally that has come by. As we speak, the Nifty is above the 22,800 mark. It did come off the highs of the day. The high today was 22,899. So we did come off from those levels. But again, there's some buying that we are seeing from the lower levels. Across the board, it is a green-looking screen. We do have the advanced decline ratio, which was in the favor of declines, 1:20 yesterday. So we do have it looking quite green today. 3 stocks in the green versus 1 in the red. Private banking index, PSU banking index, IT, you name a lot of it, all of them are in the green today. But again, whether we'll sustain or not is the big question, because as we proceed further, Ekta, we'll see statements change. There'll be a lot of updates that would come by. And yes, a new series, that is something we'll be tackling as well.
Hi, Sonal. Yes, absolutely. You know, the headlines change by the minute when it comes to the West Asia conflict and the way the commodities as well as the bond prices and the equities react to it. But to put it into perspective, on a year-to-date basis, we're still sitting with cuts of around 13% for the Nifty. For the mid-caps as well, we're down around 12%. So yes, while today's gain is good, we do have a lot to tread in terms of winning back those kind of gains that we've seen or losses that we've seen through the year. But let's tell you, in the next 60-odd minutes, we do have a packed show. We will be connecting with Abhizar Divanji of Newstrat Advisors, LLP, and Sriram Subramaniam of InGovern, as the SEBI chair flags board governance in HDFC Bank. And in our Movers and Shakers segment, we will be putting the center stage on Apollo Hospitals, Asian Paints, IRFC and GMR Airports. In our commodity segment this afternoon, Manisha Gupta will be connecting with Amit Goel of Pace 360 to decode why gold and silver prices are crashing despite the war. Stay tuned for that.
And we now have Vivek, who will be taking us through the stocks that are moving around in trade. Vivek, over to you.
Well, thank you so much for that. You know, it's been a very volatile start to the markets today. It started off in the green, did see quite a bit of a sell-off, but once again in the last hour, we've seen quite a bit of buying emerge, especially in the last half hour or so. In terms of individual stocks, individual sectors that we're tracking, Asian Paints, the first stock on the radar, a sharp price hike is what the company has notified to its dealers. Street clearly likes that, and also crude oil prices falling almost 10% overnight, something that the street takes quite positively. 2 stocks from the broad end of the markets, Electra Greentech as well as JBM Auto. Yesterday in the parliament, the government actually said that they would be going out and rolling AC buses across many cities, and on the back of that increased demand is something both of these companies and both of these stocks are factoring in. In terms of the entire IT pack, again, after a brief respite yesterday or a brief sell-off yesterday, today you're seeing once again all of the IT stocks seeing consistent buying, TechM, Infosys, and even a whole host of mid-cap stocks doing quite well in the session. Premier Energies, you know, this particular stock has been a significant outperformer in the week gone by. Today higher by another 1.5%. DAM Capital has gone ahead and raised the target price here. And 2 stocks from the travel tourism segment as well as airport space, both seeing a bit of a relief rally. Indigo up almost 4%. GMR Airports, a positive note coming in from Kotak. Both of these stocks are doing quite well in the session. On the other hand, a few laggards as well. Chennai Petro, MRPL, stocks seen as beneficiary of higher crude prices. As crude prices fall, these stocks too seeing a bit of profit booking. Coal India, again, one particular stock that's lagging in the session today. Nuvama has reiterated its reduced stance. They don't believe e-auction premiums will add so much value. Sun TV, one of the top mid-cap laggards in trade today. And lastly, Balrampur Chini, this particular stock on high volumes today amongst the top small-cap laggards.
Okay, all right. Well, a lot of buzzing stocks in what is a higher market in today's trading session. So, Vivek, thanks very much for that. We need to take a short break, but just a quick update. Markets move in cycles, and for 26 years, we've been tracking them closely because in volatile times, what investors really need is insight, not just information. And above all, perspective, not panic. If you have a question about your investments, we're here to help with guidance from experienced market experts who understand today's fast-changing market environment. So join our special editors on Your Stocks and MF Corner every day at 2 p.m. and stay one step ahead of the markets. Welcome back. Well, for the markets, it's turning out to be a good session as of now. But just want to point out that while today is a good session, we have to put the rally into context. So, for example, yesterday what we did see is that Brent crude rebounded from levels of around it went down to levels of around $96. Remember, it had hit a high of around 115 yesterday, and post all of the positive sentiment with regards to the geopolitics, it fell to around $96. However, that has now corrected to around $103, as you can see on your screen. Similar case with gold, which rallied to levels of around 4,550 yesterday. Remember, it had hit levels of 4,100 odd, and then it rallied back to 4,550, and now it's come off those highs, currently at around 4,388. Similar case for the US 10-year, which softened to around 4.3 yesterday versus 4.4. That's the high that we had seen yesterday. But today, as you can see, it's currently at around 4.37 versus 4.3. So there is a bit of a hardening which has taken place for the US 10-year as well. Similar case for the Indian markets, where the Nifty hit a low of around 22,471 in yesterday's trading session. Today's high was around 22,900, and today the Nifty is currently trading at around 22,774. So off the highs that we saw in today's trading session. Rupee too has appreciated, but it is at around 93.88. It's off today's high that we saw, but it is still better than the close that we saw yesterday, which was at 93.97. And similar case for the Indian 10-year, which has softened. So it's better than the levels that we saw, which were at around 6.89 yesterday. So currently it stands at around 6.85. So yes, we are better off as compared to the lows that we hit yesterday, but we are off the highs that we saw in today's trading session, or maybe in terms of yesterday's trading session as well. Considering it's so volatile, that's really the name of the game.
And that is exactly what is keeping some of these stocks in focus as well, the ones from oil and gas space. Remember, most of them have fallen 25 to 26%, but that's not the case for upstream companies like ONGC and Oil India. Some interesting notes which have come by. So let's start with the one from CLSA on ONGC, where they reiterated their high conviction on this particular name, and they've increased the target price to 415. They say that this has been one of the worst performing stocks in the E&P, or the exploration production space, globally as well, since the time West Asian war has started. And this is because despite higher crude oil prices, there is a fear that maybe there could be windfall taxes and higher realizations as well. But we've been pointing out, right, that there is an oil ministry rule that no more windfall taxes will be levied on these companies anymore. And at current price, it is factoring in Brent at levels of $65 per barrel. That means there is $63 per barrel. That means there is an offer for 65% upside, considering that crude prices are at elevated levels. The other triggers would include that gas prices, they are expected to rise from the new wells, and also gas production would increase by 15% in the next 3 to 4 months. So CLSA says that they are raising FY27 Brent assumptions to $89 per barrel, which would mean an EPS upgrade of around 34%. For FY28, at the Brent levels of $82 per barrel, EPS would mean 14% rise. On the flip side, we have a negative note coming in for oil marketing companies. Third one in a row after HSBC and Kotak cut target prices. We have it coming in from Goldman Sachs. They say risk reward has turned less compelling because marketing margins are now impacted because they're not able to increase retail prices both at the pump and generally largely for other customers as well. Yes, there was an industrial price hike, but that is not a big part of their overall volumes. So for HPCL, there is a downgrade to neutral from a buy. Target price has been cut to 310. For BPCL as well, there is a downgrade, target price cut to 340. For IOC as well, there's a downgrade where target price has been cut to 110. However, for Reliance Industries, there's an increase in target price to 1,910. They maintain their buy. And in this case, ONGC is a sell for Goldman Sachs with a target price of 245. So they do not see the conviction that CLSA sees there. But that's what makes market, right? Different opinions. But despite the rise or the fall in crude prices overnight, ONGC is still higher, hasn't fallen as much as the markets otherwise and the sector peers as well. That's because no fear of windfall taxes anymore. And that is working well for the stock.
Okay, all right. So that's the entire oil and gas space that is in focus that Sonal's tracking. But let's talk about HDFC Bank, which continues to be in focus after all of the news pieces from last week. Now, SEBI Chairman Tuhin Kanta Pandey reiterated the code of conduct for independent directors. This is after HDFC Bank's chairman resigned, Tanu Chakrabarti, last week, citing concerns over values and ethics. Pandey said that any concerns they have should be recorded in the minutes of the board meetings. Listen in.
Vote for IDs under Schedule I-4, where IDs are required to adhere to a certain code of conduct. And IDs have, where they have, in this code, it's written that where the IDs have any concerns about the running of the company or a proposed action, ensure that they are addressed by the board, and to that extent that they are not resolved, insist that their concerns are recorded in the minutes of the board meeting.
All right, that's the word coming in from the SEBI chairman on the HDFC Bank event. To take the discussion forward, we have with us Abhisar Divanji, founder at Neostrat Advisors LLP, and Sriram Subramanian, who's the founder and MD at InGovern. Gentlemen, good afternoon. Thank you so much for joining us today. There's been a sharp stock reaction to this resignation that came in from Atanu Chakrabarti. There have been a lot of to and fro. HDFC Bank has then appointed a lawyer as well to investigate the matter in terms of resignation. Before I ask you about the specific case, I just wanted to understand from a broader perspective. Abhisar, let me start with you. If an independent director raises concerns publicly, but there are not many details because we did not have what really happened underneath, right? Should there be an accountability for market impact? How do companies go about it? How does the board go about it? Just writing it as a minutes of board meeting, does that help?
Oh, first of all, you talked about somebody going in publicly talking about what happened in a board meeting. I think that needs, in my opinion, should not happen. And if it does happen, it should be a fairly desperate situation which has been through all the other channels that are available. So, for example, as Mr. Pandey also rightly said, first thing you do is if there are disagreements, those disagreements get recorded in the minutes, which are a matter of record. Once they are recorded as minutes, it's obligatory on the board to take particular action around some of those things, or either ignore them or do something about them, but deal with them. Now, I think it's a very confidential matter for boards to deal with disagreements. And those disagreements need not have to be spilled into the public. The second thing, of course, there is a regulatory interface available. Now, you're talking about HDFC. It's an RBI regulatory interface available. So if the board is found not to be doing much, then there is an SSM in the RBI's parlance, or a responsible officer of the regulator, whom that issue can be highlighted from a governance perspective, but then it has to be something which has to impact the larger stakeholders, which the independent directors are responsible for. So I think there is a mechanism to go through it. If it generally comes into the public eye, and because of that there is a loss in this particular case, loss of reputation and loss of stock-related issues, then very frankly, there could be ramifications, and one needs to hold them to it. It's not that an independent director just needs to be heading to the public to talk about his grievances.
Okay, absolutely. That point is taken, especially when you're as large and important a private bank as HDFC Bank is. Mr. Divanji, just to take that point forward, what is your view on the steps that HDFC Bank has now taken in order to get an external law firm in order to assess the dealings with regards to the ex-chairman?
I think that's good. Yeah. I mean, I think HDFC did everything right, in a sense that first, when this thing did come out, a few board members got together and decided to approach the regulator. The regulator acted swiftly, got a chairman in. That was extremely important. After that happened, I think now what they've done next is formed a committee. Formed a committee which is looking into what these allegations mean. And hopefully the next step will be either to get back to the people or to get back to the regulator on what the outcome is of those findings. I think it'll be important for them to come out, now that it's already out in the open, to come out with what their findings are once the independent committee lawyer look at it.
Take that point, Abizar. Sriram, let me get you in the conversation as well. As Abizar mentioned, you cannot just directly go to the public, right? There has to be a process which is to be followed. So one thing, it has impacted the stock price, and as Ekta mentioned, it is a big bang that we are talking about, right? RBI has to be involved as well. What do you make of the steps that HDFC Bank has taken going the legal way here? And what does it mean for other companies as well? Because at the end of the day, independent directors also hold an important responsibility.
Good afternoon. Definitely, independent directors hold a responsible and accountable position. They are accountable to the company. They are accountable to all shareholders. So to that extent, Mr. Atanu Chakraborty's letter was very cryptic. He could have detailed it out. Subsequently on TV, he said that there were no material impact for the reasons for his resignation. So all this meant that HDFC Bank has to act, or at least show to the public. Even the management coming and giving commentary that there are no material issues out there will not satisfy investors, because any management would say that there are no material issues. But at the end of the day, there was something out there that pissed off, or that was the last straw on the camel's back that forced Atanu Chakraborty to resign. It could well be an ego issue. It could well be some particular data sharing or data that is sought which were not shared. So all these have to come out. HDFC Bank has done the right thing. As Abhijit said, they called a board meeting, they appointed an interim chairman. They have now, of course, I had called for a committee of independent directors to sort of put out a white paper. They have now appointed a law firm to put out a report. Whether that report is just for the consumption of board members or for the consumption of public, I think that needs to be seen. I hope they put out at least the gist or the main findings of that report out to investors, so that investors can be satisfied. Because there is something that forced Mr. Chakraborty to resign. Be that as it may be, it could well be a data issue, or it could well be some issues that he raised which were not addressed.
Mr. Devanji, just on the point that Mr. Sriram mentioned, that we don't know what the issues are. There are already articles floating around, trying to assess what might the issue be, from, say, possibly some kind of, issues with the UAE operations to other issues. What do you think could have been maybe the straw that broke the camel's back in this case?
Very, very difficult to say. It could be one issue, could be multiple issues. I don't think it's for us to guess. I think what we should really focus on is how these things precipitate. And that is, goes back to the crux, that the importance of what an independent director needs to do is basically figure out how the company is governed and how it is strategically managed. Operational management related issues are not the forte of a board. And while, we have law which kind of goes little against it, because it says that even for a check bouncing case, a director can be held liable, ought not to be. Independent directors ought not to be. Ideally, the job is to make sure that the management remains sane. And if that is, for example, not satisfactory, a board member has to raise it to the chairman, who will moderate the affairs. If the chairman is not comfortable, then he needs to go up to either the stakeholders, primarily if there is a large stakeholder to them, or actually go to a regulator and house grievances. Putting it out in the public sometimes is mostly the last straw that one does. Now, if you're saying that this issue, we would have reached that last straw, maybe we would have. But there is no indication that the regulators knew about it.
Take that point, because it came directly to the public, and that's why the shareholders were also a little taken aback with what happened. And as Mr. Sriram said, the shareholders did not believe the management at that point in time because of whatever the letter stated as well. Mr. Sriram, last question before we let you go. In that case, since this exit made so much difference to shareholder value as well, what is this one reform that we can see in some of the rules for independent directors? As Abizar said, we do not have the check bouncing rule applicable to independent directors as well. So do you think we need some changes in the corporate law as well when it comes to independent directors to make things more efficient?
I think already the rule is out there. It has to be enforced in that sense. There has to be pressure on independent directors to put out detailed reasons thereof. SEBI has been pushing for it, but the independent directors usually give a one-liner for personal reasons or for health reasons, etc. And while they continue to be on other boards when they claim that they are on health reasons. So there has to be a pressure by investors. And there has to be a practice. I think it has to be adopted practice, it's going to take time to change that practice.
Okay, all right, Mr. Devanji, as well as Sriram, thank you very much for joining in and giving us all of that perspective. So definitely an evolving story, and maybe the details from that particular assessment of the resignation is something that should be made public according to the experts who are tracking this very closely. HDFC Bank currently higher by around 2.3%, but if you look at it on a month-to-date basis, that particular stock has lost around 14% of its market cap. We'll take a short break, but up next, Sachitana Notekar of Trade Bulls will join in. He has some trading calls. Welcome back. Well, there is definitely a recovery which is taking place from the day's lows. So currently at around 22,852. Remember that the high point for today was around 22,900 currently for the Nifty. So we're just inching back to those levels. But again, it's a scale off that we've seen just in the past couple of minutes. So you'd have to say a little volatile on the upside, but nonetheless, the trend seems to be moving on the upside at this point. We have the Midcap index, which is now up around 1,000 odd points, up around 2 odd %. We have the Bank Nifty, which has gained around 790 odd points as well. We have the frontline stocks, which are rallying as we speak. So just about 4 stocks in the red within the Nifty space, to put it into perspective. We have Shriram Finance, which is your top gain on the Nifty, up around 5.3%. Incremental buying coming into the likes of Eternal, Apollo Hospitals, Asian Paints. So all of these stocks are now close to the high point of the day. Good time then to get in a technical check on the markets, considering this sudden bout of enthusiasm that we've seen, with the advanced decline ratio also at around close to 3:1 at this point for the Bombay Stock Exchange. Sachidanand Uttekar joins in. Sachidanand, well, you've joined in at a very opportune time. The markets are seeing a quick surge on the upside. How would you approach the markets at this point?
Good afternoon, Ekta. I think the bounce back is ripe, and I think this is a very good opportunity again to create some fresh short positions. If you look at the major structure, I think the structure still remains weak. Time and again, we have voiced out the opinion that the 5-day exponential moving average area for the Nifty is an ideal zone wherein fresh shorts should be deployed. So I think after a severe downside, what we have observed here is that the weakest pocket, which has been IT, it has been leading this particular bounce back. So and that's why we believe that the bounce back that we are seeing may be a bit fragile, and we may see the Nifty again, trending on the lower side in a day or so. So I think 23,000, 23,040 is an ideal zone wherein fresh short positions can be deployed unless we don't see the Nifty, sustaining or closing about that 23,260 mark. The chances of a reversal look, bleak, and we may see the Nifty again, trending lower towards 22,260, wherein we have some confirmation of a trend target on the bearish side. So as of now, I think if you look at the India VIX as well, it is still comfortably trending about the 25 mark. We have still not seen any respite there, and that's why we believe that markets are still volatile. It's better to stick with the major trend, which is still on the negative side. So this is a good, healthy bounce back that can be utilized to create fresh short positions. One can keep a stop loss at 23,260 on closing basis and utilize this particular rally to create some fresh shorts near 23,000.
Sachidanand, there's a query that I wanted you to address, but going by what you said right now, I think you would say otherwise, because Jitesh Bali is writing to us from New Delhi with an investment query. He says he wants to invest more in Nifty 50 stocks. He asks if he should add more banking stocks in his portfolio. Of course, this query is from a long-term or a fundamental perspective. But Sachidanand, in the short term, you're not so positive.
Yes, I think the major trend is still weak on the weekly charts. We still don't have any major confirmation of a trend reversal or a stable move. I think it's better to, prepare a list, but it's better to wait for a clear-cut, reversal development, or at least on the price front. So we still don't have any major confirmation here. So it's better to keep the, list ready, but, wait for the confirmation of the trend. Every day we are seeing some news flow and the markets are reacting to that. But if you look at the major thrust, it still remains on the lower side. So it's better to be cautious and wait for, meaningful signs of recovery or stable, price action. And after that, I think it will be better to deploy some aggressive long positions.
Okay, all right. Better to deploy some aggressive long positions. So that's the word coming in. Your stocks today?
Since the view is more on the bearish side, we are looking for opportunities wherein the pullback has been very significant. I think BSE is something wherein we have already seen a good, strong pullback. But if you look at the daily chart, it is displaying a fresh negative crossover on its 5 and 20-day exponential moving averages. Recently, we saw this particular support at 2800 getting breached, and we saw a quick swing on the lower side. So I think it's a good rally wherein fresh short positions can be redeployed. The stop loss for the trade can be placed at 28.22 on closing basis. We are expecting a swing towards 26.40 on a positional basis, eventually towards 2600. The other stock which has been fairly negative, but the move has been very gradual. The base at where Bharti Airtel is positioned right now, I think this particular base is also fragile. So one can create some fresh short positions in Bharti Airtel, keeping a stop loss at 1816 on closing basis. And we may see a final drop towards 1740 in a week or so.
Take that point. Thank you so much, Sachidanand, for joining us with your picks and specific queries that we got from our viewers as well. But what is the F&O action looking like? We've seen that recovery on the markets as well. Mangalam is joining us with more details. Mangalam.
Well, twice today, the Nifty has moved towards that 22,900 mark, and from there, we've seen a smidge of a decline, still holding very well in green, and a large part of the up move came in just the last 5 minutes or so. The important part, however, is that while the Nifty is doing well, it's been led by two index heavies. One is the Nifty Bank, which after a lot of underperformance lately has come back, and that's thanks to HDFC Bank. The other one is the IT pack. Somewhere around 11:20, we saw an up move in the IT stocks, and now the IT index is the one which is leading the frontline index up as well. And it's not only the large cap ITs. You have Infosys, TCS, HCL Tech, all of them doing well. Even the mid cap IT stocks are buzzing in a little more than the frontliners, as usually is the case. So first source, persistence, emphasis, all of them doing well. A bit of the up move can also be attributed to some of the short covering that we've seen in 22,500 calls. All of them were playing for some sort of resistance coming in around that 22,700 mark. But now those guys have been caught on the wrong side, so they're covering their positions. We've seen some writing at the 22,500 put telling you that the base of the market has now moved higher by about 300 to 400 points as well. But importantly, now as we're very close to the 22,900 mark, remains to be seen what happens to the 23,000 call writers, because there are a lot of them ahead of expiry today for a small pop. If the market continues to sustain above this 22,900, 22,950 mark, towards the end on expiry, we may see a big melt up. That will be largely on account of these 23,000 call writers unwinding their positions. But until that happens, today's zone of between 22,900 to 23,000 could be a supply zone for the frontline index, and that's something that we will monitor. Platform stocks, they are buzzing as well. That tells you the health of the market, because as soon as there was some weakness, these stocks were beaten down a lot more, and now as soon as there is some relief, these are the ones that are buzzing around as well. Not only are we seeing up moves in Eternal and Swiggy, which are F&O stocks, even the cash stocks, look at Meesho, Urban Company, both of them spiking in trade. Just the final stock that I'll be monitoring, because this is a very stock-specific market, is United Spirits. Was under a little bit of pressure yesterday, now has come back with a fair amount of gusto, fresh long positions being added on them. The big trigger for them would be over the next few days, if we hear any sort of clarity coming in on the value unlocking or selling of stake in RCB ahead of the IPL. So that would be an important monetization event for the company, and that's why the stock perhaps seeing some fresh bits.
Okay, all right, Mangalam. Thanks very much for that. So those are a lot of the buzzing stocks. Just want to point out that something like a South Indian bank is also buzzing in today's trading session. It's the best gains, or it's a multi-month high for that particular stock. Even NOSIL is seeing a gain of around 7% So buzzing on good volumes for that particular counter, up 7.5%. We take a short break, but up next, Manisha Gupta will join in. She has with her Amit Goyal of Pace 360 on our Commodity Corner, discussing gold and silver prices. Stay tuned.
Welcome back, and joining us on the show now is Amit Goel. He's co-founder and chief global strategist at Pace 360. Amit, hi, thank you so much for joining in. I remember our previous conversation where you did mention that you're not very comfortable with the way the gold and silver prices are rising. Well, the reason for the decline isn't something that we waited for, but there is a sharp decline in both of these precious metal prices for various reasons, of course. How are you reading this current markets with West Asia conflict ongoing? And what's your sense, especially when it comes to currency, gold, and then silver?
Thanks for having me on, Manisha. So my sense is that gold and silver have become the ultimate risk assets, and they have been behaving like a risk asset now for many, many months, much before this current episode where they have come down. The up move that happened between the second half of last year till January end of this year, it moved. That move happened basically in congruence and in correlation with the other risk assets like equities and industrial commodities. So, I have mentioned many times before that what is everybody's safe haven is not a safe haven anymore. It becomes an ultimate risk asset and finally a bubble. So I think at their peak in January, gold and silver both had become bubbles. And this bubble is going to take a long time to get deflated. So we are nowhere close to the long-term bottoms. But having said that, Manisha, because we have become bullish on risk assets in general over the last few days, so we started buying gold and silver about 3 days back. And yesterday we bought very aggressively, not with a long-term horizon, but with a 1 to 2 month horizon, because when the war subsides, and the inflation, the bond yield fears, and the fears of disruptions, they sort of fade away. My sense is that equities will go back up, and gold and silver will go back up, and dollar index is probably in that case headed down. So this is the reason why we bought gold and silver yesterday, and I do believe that we are headed for a meaningful upward move in gold and silver over the next couple of months.
So you said you're buying it for with a couple of months of horizon, Amit. What is the target that you're putting in for gold and silver then for these 2 months?
So let's say in dollar terms, gold is about $4,400 right now. So my sense is that we could be headed back towards $5,000 within the next couple of months.
Okay.
And silver being a higher beta commodity would probably go up more. So let's say from 69.5 or thereabouts, it could easily go back to about $85, $86. And I think they would probably hit resistances at that point. And from that point onwards, we'll probably start betting on a long-term move down in gold and silver. We are absolutely steadfast in our opinion that over the next 1 to 1.5 years, we'll see a lot lower prices on gold and silver, but it is time to play for a meaningful correction on the upside.
Amit, when you talk about dollar index declining, what levels are we looking at onto that one? And if you look at it from a point of view where the crude is trading on a higher side, inflation concerns are on, the US debt markets, the US debt for that matter at around 39 trillion, something that we haven't spoken in a very long while. Would you say those are a few factors that would continue to weigh as well?
Of course. So there are times when long-term fundamentals take over, and there are times when short-term greed or fear takes over. So I think the world has been just completely overwhelmed with feeling of greed and fear as far as the financial markets are concerned over the next 4 weeks. Fundamentals will eventually, they will sort of take over. And my sense is that dollar index, which peaked out at about 100.50, about, I think, last week, it should be headed back down to somewhere between 97 and 98 levels over the next 1 to 2 months when the geopolitics normalizes, which would probably result in a decent enough rally, not just in gold and silver, but in other metals, also equities, not just in US, but in India and in most other parts of the world. So I'm looking at a Goldilocks scenario sort of kicking back in for the short term or sometime over the next 2 months. And once that cycle has played out completely, The long-term fundamentals will take over, which are definitely not good. So we are definitely expecting a US recession within the next 12 months, which has got nothing to do with the geopolitics.
Okay.
We definitely expect a US recession. We definitely expect a deflationary bust in the world over the next 12 to 18 months.
Okay, Amit, thank you so much for joining us. So after a while, an asset class stops becoming a safe haven, but can become a bubble. That stayed with me. Thank you so much for joining us with that conversation. Thank you, Manisha, for taking us through that. By the way, important flashes at the bottom of your screen. Our colleague Yash will bring us all the details on what's happening with Cello World and the fact that promoters are looking to sell stake in this company. We'll slip into a short break and we'll get back with more details on the other side. Welcome back. Well, let's talk about some exclusive information. Sources tell CNBC TV18 that promoters are looking to sell a controlling stake in Cello World. Yash has more details on this story. Yash, over to you.
Well, that's correct. That's exactly what we've been given to understand from our sources, that the promoters of Cello World are looking to sell a controlling stake in the company. The promoters put together, the entire family holds about 75% stake in Cello World. and they would be looking to sell anywhere about 51% of that stake to other investors, and intend to continue with the balance 24 or 25% stake depending on the kind of interest which they get. What we've been given to understand is that the promoters of Cello World have appointed bankers to run the stake sale process. Feelers have also been sent to large private equity players like Kedara, Blackstone, Temasek, Advent, Amundi PE for acquisition of this controlling stake as far as Cello World is concerned. And since the promoter group itself would change and it's a larger transaction involved in this particular deal, this deal is also likely to trigger an open offer when it comes to Cello World. As I said, 75% owned by promoters. At this point of time, a controlling stake would mean about 51% stake, promoters wanting to continue with the balance 25% stake. We've written to Cello World on this thing, on this story. A response from the company still remains awaited.
Okay, all right. Take that point. Thank you so much for bringing us those exclusive details, Yash. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific actions. Stay tuned for that.
Welcome back. Well, let's look at one particular stock, Apollo Hospitals, which is buzzing around in trade. There is a positive report which is coming from Citi, which has a buy and a target price of 9,600. They've added it to their Pan-Asia focus list as a buy. Apollo remains a preferred pick in the Indian hospital space with a positive stance predicated on a structurally resilient hospital business, fast-growing pharmacy business with digital profitability in sight and valuations which remain below long-term means on an absolute as well as on a relative basis. So that's Citi being positive on Apollo Hospitals. And what else is positive is definitely the markets. The Nifty has recouped itself back to 23,000 on an intraday basis. It's off those levels, but nonetheless just about hovering around that. The Midcap index too at the high point of the day, now showing a surge of close to 1,400 odd points. With that, it's a wrap on Halftime Report from Sonal and the entire team and me. Thanks for watching. Business Lunch up next.
Market at day's high as stocks perk up after Trump calls for a 5-day pause to the war in hope of talks with Iran yielding a deal. IT, healthcare, industrials and financials are prominent gainers while utilities drag.
Asian Paints will hike prices by 6 to 8% from the 10th of April. Berger Paints also expects to hike prices in steps as the Iran war has led to a cost escalation of 12 to 13%. Berger Paints says that the industry will pass on cost increases as sales volumes remain strong.
HDFC Bank has appointed a global and a local law firm for an objective and fact-based assessment of aspects mentioned in its ex-chairman's resignation letter. The proactive step can help quell speculation.
SEBI Chairman Tuhin Kanta Pandey comes out strongly against HDFC Bank's chair's unsubstantiated insinuations, saying that independent directors must act responsibly. The regulator's board, meanwhile, approves netting off for FPIs and defines a code for its members. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Hi, Hormaz. Good afternoon. Hi, guys. I mean, Trump's comments coming in last night, boding well for the markets, everything in the green. Nifty nearing that 23,000 mark.
It's a proper expiry day that's playing out, and what's more important is the fact that we have back-to-back expiries, considering Thursday is a holiday. So the Sensex expiry of Thursday gets pushed to tomorrow, and today, of course, being the weekly expiry of the Nifty contracts as well. So as of now, the index is at the highest point of the day, or near the highest point of the day, 460 points higher as we speak. Still has not recovered yesterday's drop. That is one bit. Yesterday the index was down 600 points, so we're still up. We've recovered almost 80-85% of it. And there are two more factors that are still bothersome. The fact that crude oil prices have not cooled off substantially whatsoever. They may have eased from yesterday's levels. They were up around 114, 115 yesterday. Now they are at 102. At one point they were at 104. So they are still above $100 a barrel. That's crude for you. The other one is the currency. At around 11.30, the rupee, after that initial appreciation that it had seen towards the levels of 93.60 odd, that has not shown any signs of it. They're still at 93.76. So the currency has appreciated, yes, not as much as you would have expected. Oil prices have not eased, but of course it is expiry today. So a bit of short covering that you can see. Of course, the Nifty RSI was in oversold territory as of closing yesterday. We'll see how the second half pans out.
So oil and rupee key to watch over the course of the next few hours. But you know, every sector is in the green. IT was one of the top moving indices today. It's about nearly 2.5% in the green. Infosys, HCL Tech Mahindra, all of them gaining between 2 and 4%. The auto pack is now the top gaining index, which is gaining about 2.5%. You know, Eicher Motors, Hero MotoCorp and M&M, all of them up over 2.5%. Private banks also doing very well. HDFC Bank, if you take a look at that stock, it's gaining about 2.6%. And you know, this comes after the big cuts that it's seen in the last few sessions. Kotak Mahindra Bank and IDFC First Bank, all of them gaining over 3% in trade as we speak. But moving on to the biggest geopolitical developing story that we are tracking at this hour, US President Donald Trump calls for a 5-day hiatus in the West Asia war, sending equity markets higher, as we've pointed out. Remember, Trump went from a 48-hour ultimatum to a pause in the conflict. In fact, in a post on Truth Social, he also claimed to have had very good and productive talks with Iran, signaling a de-escalation. However, Tehran calls Trump's claims fake news used to manipulate financial and oil markets. This as the Israeli Prime Minister Benjamin Netanyahu struck a calibrated tone to back a diplomatic breakthrough while making it clear that military operations will continue unabated. Meanwhile, a response to ANI asking about talks between US and Tehran in Islamabad later this week, White House Press Secretary Carolyn Leavitt said that these are sensitive diplomatic discussions and that the United States will not negotiate using the press. Speculation about meetings will not be deemed as final until formally announced by the White House.
And oil prices are back above the $100 a barrel mark after tumbling last night after Donald Trump extended that Iran ultimatum. The markets are also pricing in the potential of a reopening of the Strait of Hormuz. In fact, Donald Trump also said that the Strait of Hormuz may be jointly controlled by the United States and Iran. Listen in.
Be jointly controlled. By who? Maybe me. Maybe me. Me and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. Look, and there'll also be a form of a very serious form of a regime change. Now, in all fairness, everybody's been killed from the regime. They're really starting off. There's automatically a regime change. But we're dealing with some people that I find to be very reasonable, very solid. The people within know who they are. They're very respected.
Meanwhile, US President Donald Trump has also suggested that the Strait of Hormuz will be opened once a deal is made between US and Iran. US Energy Secretary Chris Wright addressed this in an interview with CNBC. Take a look.
These are early on in the negotiations. I certainly don't want to get ahead of the president there, Sarah. But clearly the world has seen allowing Iran to control the Strait of Hormuz, as they have on and off for decades, is just an unacceptable outcome. We need to have an end with some assurity that you can have free flow of shipping traffic in and out of the straits. Not just for the United States, but for all the Gulf nations, certainly all the nations of Asia and Europe and around the world.
Is the way this ends and the U.S. victorious, that they no longer have the control over the Strait of Hormuz?
Well, their country's still going to be there, but we need to be in a position where their ability to threaten the Straits of Hormuz is either gone or dramatically reduced from where it's been the last few years, the last several decades.
And that is the view coming in from Energy Secretary Chris Wright. Let's also now get you the latest that's transpiring from West Asia. Dan Murphy is joining in with the latest updates. Dan, with the pause that Donald Trump announced last evening, since then, what have been the major developments that have taken place?
Well, it wasn't just the dramatic reversal in fortunes that we saw for the markets. It was indeed quite a significant diplomatic shift that's now taking place across the Gulf here. As you've been reporting, President Trump really stepping back from the brink, at least for now. He's postponed these threatened US strikes on Iranian power plants for 5 days, citing what he calls very good and productive talks aimed at a total resolution of this conflict. It's understood that envoys Steve Witkoff and Jared Kushner reportedly conducted talks Sunday night with what Trump called a respected senior Iranian official, but of course, who that is at this point remains to be seen. And as you've also been reporting today, Tehran has been pushing back hard on this. The Parliament Speaker Mohammad Ghalibaf dismissing Trump's claims as fake news designed, he says, to manipulate the oil markets. Interesting to also see Politico reporting today that Ghalibaf himself is being floated as a possible contender as a future Iranian leader. And then inside Israel as well, Prime Minister Netanyahu also making clear there's no ceasefire on his horizon. Netanyahu saying these strikes on Iran and Lebanon will continue as he seeks to safeguard, he says, Israeli interests in any potential peace deal. And as you've also just heard, the US Energy Secretary Chris Wright telling CNBC that Iran's control over the Strait of Hormuz is an unacceptable outcome. The ADNOC CEO, Dr. Sultan Al Jaber, here in the UAE, also took it one step further at the CERAWeek conference in Houston that he was addressing via video message from the UAE. Of course, he was invited to the conference. He wasn't able to attend because he decided to stay back to deal with the crisis at home. He called this blockade inside Hormuz economic terrorism against every nation, and also warning there's only really one solution, which is to reopen the Strait of Hormuz. Those comments are being very closely watched here in the Gulf today because they are among the strongest that we've heard so far from any senior business leader in the region, and of course really reflects the crisis facing not just the energy companies but also these economies in the Gulf that rely on a free and open Strait of Hormuz in order to conduct business and to keep their critical oil flows flowing around the world. President Trump was also asked who could be in control of the strait and if and when it would reopen. He didn't necessarily have an answer to those questions at this point. And of course, on the ground as well, the war also really showing no signs of pausing as well. Overnight, we were reporting on heavy airstrikes that were heard in Tehran, targeting the Iranian Ministry of Defense and the IRGC headquarters as well. We also were reporting blasts that were heard over Jerusalem following Iranian missile fire, and the UAE, Kuwait and Saudi Arabia all reported intercepting additional Iranian drones and missiles as well. The other piece that I haven't mentioned is a brand new Wall Street Journal report that no doubt you've seen today, suggesting that the Gulf states may be nearing a decision to get involved in this conflict. They are, of course, deeply concerned about the ongoing threat that Iran continues to pose to critical energy infrastructure in the region. And of course, a decision on whether or not to move forward to actively engage against Iran among the likes of the UAE and Saudi Arabia has not been made yet. But of course, this report really reflects the angst and, in fact, the anger that the Arab leaders and indeed the mood among the population in the Gulf capitals is really at right now, given the fact that we have seen this conflict continue to run for 4 weeks now with no resolution. So all eyes are on the Gulf response over the next 48 hours. All eyes on President Trump's Friday deadline as well, and whether or not we'll see some kind of negotiated settlement in this conflict being reached. And of course, all eyes are on Iran, where we still don't know exactly who the president and his team are speaking with. It's back over to you.
Dan Murphy, thank you for that. And last words from Dan there, very pertinent. Nobody knows what's transpiring currently. But just pull up MCX before we go into the break. As flashes on the bottom of your screen from Money Control, the SEBI panel has backed the phased entry of FPIs into commodity derivatives. And that is a story coming in from Money Control. The CDAC has suggested allowing FPIs to participate initially in non-agri commodity derivatives and initially into metals and energy products as well. So that is the story that Money Control is picking up currently. So 2.25% higher currently is MCX, recovering from the lows of the day, Arundhati.
Absolutely. But moving on, it's time now for views from Bank Julius Baer and Company's Mark Matthews on what he makes of the ongoing conflict and where oil prices could be headed. Take a look.
The Iranians must recognize that Trump will reach a tipping point that he won't be able to come back from. And he will have to commit to this war long term. And if I was them, I wouldn't want to have him reach that tipping point. On the other hand, it's very clear they profoundly distrust him. And they will want a deal with ironclad guarantees that the Americans cannot renege. And that kind of deal would typically take a couple of weeks to negotiate. Market is clearly not hopeful because U.S. futures are down today. But I think there is a possibility they can come to some agreement. As a house, we do believe that. Our oil price forecast 3 months from now is in the high 60s. So it's lower than where it is today. Then I would expect India to be one of the biggest recovery stories from that, because it's obviously gone down more, and so is its currency on the back of the high oil price.
Now, Defence Minister Rajnath Singh has chaired a review meeting on India's defence preparedness in the wake of the recent global and regional security events. The meeting was attended by the Chief of Defence Staff, General Anil Chauhan, the 3 service chiefs and the DRDO Chairman Samir Kamath. The meeting follows statements made by the Defence Minister at an event in Uttarakhand on the 21st of March, where he had reaffirmed that the Indian standing on the conflict remains clear, a solution through dialogue and diplomacy. Also important to note that Prime Minister Narendra Modi will be addressing the Rajya Sabha today.
On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Keeping it with the West Asia war, the rub-off impact of the war can be seen across sectors and companies which have begun tackling the impact with price hikes. Asian Paints has gone ahead and hiked prices in the 6 to 8% range. Following that, 2 to 3% hikes taken across the industry. We also spoke to the management of Berger Paints on their price hike strategy. Take a look.
So tomorrow is around 1.5%. The one which is on the 30th of April will be another 2% possibly. So it will be 3.5% of coverage. And then on the April, possibly around the 9th or the 10th, we will have the balance about 3 to 5%, depending on where the things stand at that point of time. So typically in paint, we take in stages, that's how it has been always. And we are now going to take it, first stage will come in effect tomorrow itself. That will be part of the enamels and certain other portfolio in the waterproof range. And in the second stage and the 30th is, all the premium and luxury emulsions where we will take up the prices.
Now, SEBI Chairman Tuhin Kanta Pandey reiterated the code of conduct for independent directors. This after HDFC Bank's chairman resigned last week. Athanu Chakrabarti cited concerns over values and ethics. Pandey said that any concerns they have should be recorded in the minutes of the board meetings. Listen in.
Vote for IDs under Schedule I-4, where IDs are required to adhere to a certain code of conduct. And IDs have where they have, in this code, it's written that where the IDs have any concerns about the running of the company or a proposed action, ensure that they are addressed by the board, and to that extent that they are not resolved, insist that their concerns are recorded in the minutes of the board meeting.
SEBI eased the norms for FPI transactions, permitting the net settlement of funds for transactions by FPIs. Listen in to what the SEBI chairman, Tuhin Kanta Pandey, had to say.
Currently, FPIs settle their transactions with custodians on a gross basis, which results in additional costs for FPIs, including funding costs and foreign exchange slippages. Recognizing these concerns and with a view to enhancing operational efficiency and reducing cost of funding for FPIs, it has been decided to permit net settlement of funds for outright transactions done by FPIs in cash market. And what are these outright transactions? That is transactions in which there is either purchase or sale transactions, but not both in a particular security in a settlement cycle.
We'll take a short break for now. More news and updates follow on the other side. Stay tuned. Welcome back. Shifting focus to the pharma space now, buzzing with news around the weight loss drugs and their entry into India. The drug regulator has stepped up monitoring the GLP-1 supply chain following reports of unauthorized sales and improper use. Timsy Jaipuria is joining in with more details on this. Timsy.
Well, that's right. Regulatory surveillance over weight loss drugs, that is GLP-1 drugs, has been heightened, confirming a CNBC TV 18 news break of earlier today. Health Ministry in a statement said that CDSCO has intensified monitoring of the supply chain of GLP-1 based weight loss drugs. The monitoring is based on concerns over unauthorized sale and misuse of GLP-1 drugs. In collaboration with state regulators, CDSCO has initiated a series of targeted actions to curb possible malpractices across the pharmaceutical supply chain and prevent unauthorized sales and use. CDSCO has already conducted 49 inspections and audits. These audits were being done on agencies such as online pharmacies, wholesalers, retailers, and wellness clinics. These inspections spanned over multiple regions across the country and focused on identifying violations related to unauthorized sale, improper prescription practices, and misleading advertisements and marketing. Further notices have also been sent to defaulting agencies and entities. CDSCO has issued notices for irregularities in sale and promotion, in addition to the advisory that it had initiated earlier, reiterating that there is a ban on surrogate advertising and off-label promotion of these drugs. CDSCO says that these medicines are prescription only and a strict action will be taken on all the defaulters in the coming time as well.
All right, Timsy, many thanks for those details, but let's take a look at the market. The Nifty was just above that 23,000 mark, but right now at 22,985, near the high point of the day, about 480 points in the green higher. Sensex is about 1,576 points higher. The Midcap and the Nifty Bank faring better than the blue chips. The Midcap index about 2.7% in the green. All of the sectoral indices, if you take a look at it, all of them doing well today. The auto pack leading from the front, about 2.6% higher. We've got the IT names that are also doing well. So almost all of the market in the green. If you take a look at that advanced decline ratio, we've got 2,495 stocks advancing for 516 stocks that are declining. But that's how the markets are fared. We'll have to see what happens over the course of the next hour. Midcap radar will take all the action forward.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vivek Iyer. Starting the show with the Nifty at the day's high. There's been a massive recovery since 12:30, I believe, and it has continued. It's a 500 point uptick on the Nifty as we speak. 1500 on the Midcap index, and the advance decline ratio, which was at 1:20 in favor of declines yesterday, is in favor of advances at 5:1. So decent start. Well, we'll have to see whether that sustains or not.
Absolutely right. Good afternoon, Sonal. What a recovery we've seen, especially in the broad end of the markets. Advance decline ratio, especially in the broad end of markets, very much skewed in favor of advances. But a lot lined up on the show, some important conversations. So let's start off with the top headlines. Market trails near the day's high as stocks perk up after Trump calls for a 5-day pause to the war in hope of talks with Iran yielding a deal. IT, healthcare, industrials and financials are prominent gainers while utilities drag.
Indigo and GMR airports gain in trade on back of hopes of easing West Asia tensions. Interglobe Aviation has brought in aviation veteran Alok Singh as its chief strategy officer to strengthen its leadership team.
Food delivery platform Swiggy and Eternal gain over 3% each in trade after both companies hiked platform fees. The move seen as a key margin driver.
And shares of Sirma SGS zoom in trade on the back of a bullish note from Investec. The brokerage upgrades the stock to a buy with a target of 945 rupees, citing attractive valuations. Okay, all right, those are the top headlines. Of course, the big talking point has been the massive recovery that we're seeing with Nifty above the 23,000 mark at the day's high. And we do have most of the components contributing to that as well. All the sectoral indices are in the green as we speak. The mid-caps high by 3%. Nifty Autos, which has been a laggard this entire month, is up 3% in trade. Small caps also adding to that. And we'll have a discussion on how to go about your mid-caps and small cap investments also here on in the next segment. But a decent looking screen now.
Absolutely right. And what a recovery. Some of the names, that were sold off the most post, the escalation of the war, names like L&T, names like ABB, they are the ones that are leading the market recovery higher. L&T at the day's highest point, up over 5%, ABB up over 3%. But these are some of the larger names that we're talking about. Ria is standing by the wall. She has on her radar a whole host of mid-cap stocks that are moving around in the session today. This is our special segment, Mid-Cap Movers.
Well, hi Vivek. Starting off with the gainers in trade today, we have BLS International up roughly 13% in trade today on the back of very strong volumes. Alkyne Amines as well up all over 9% at this moment. We also have Electra Greentech as well as JBM Auto performing well in today's trading session as the government has announced that they are going to deploy over 10,000 ACE buses by 2027. And Vishal Megamart also performing well in today's trading session, up almost 7%. Moving on to some other gainers today, there's Premier Explosives as well as Apollo Micro, both performing well among the defense pack. There's also Indigo as well as GMR Airports gaining in trade today. They are seeing a bit of a relief rally today, and there are also positive brokerage notes for each of these. Jeffries as well as Kotak have a buy call on Indigo as well as GMR respectively. Asian Paints is also gaining in today's trading session on the back of the fall in crude oil prices, and they have also announced a 6 to 8% price hike. So that is what is leading to the rally in Asian Paints today. Moving on to the Nifty Auto Pack, that has been the top sectoral gainer today. Tube Investments, Uno Minda up roughly 4 to 5.5%. Even Eicher Motors, Hero Motor as well as Motherson performing quite well today. Moving on to the losers then, we have OneSource Pharma, Finolex Industries, Chennai Petro, Coal India as well as Castrol India that are on the losing side today.
All right. Okay. So those are some mid-cap movers in trade today. Thank you so much, Ria, for joining us with all those details. Let's now welcome Shrikant Chauhan from Kotak Securities for a technical check on the markets. Shrikant, good afternoon. We've seen that recovery. Do you think charts suggest now we could continue that, sustain that, or you think it is still time to be cautious?
Good afternoon, Sonal. So, well, for Nifty, it recovered very well from the lows. It was around some 22,600 levels. From there, all the way it recovered and surpassed the level of 23,000, which is positive. And in last 15 days, we have never seen such type of recovery, like after hitting the intraday lows, crossing the intraday highest level. So this is happening after a very, very long time, which is positive and which gives confidence that the market can move towards the levels of 23,400. Now 23 23,400 and 23,500 going to act as major resistance in the near term. And on the downside, 22,600 should be the final stop loss for holding any long position.
Okay, Shrikant, what a recovery we've seen. What are the stocks you're betting on to make a bit of a comeback? All longs on your portfolio or any shorts?
No, I think the way it recovered and the way it is like on the verge of crossing a gap that the market, bearish gap that the market has left, I am of the view that we should look for adding some stocks because we can expect some sideways sort of activity or maybe stock specific activity in the near term. We are specifically bullish on Eternal. The stock is around 237, 238. It is forming some higher bottom sort of formation and volume is also like quite considerable. So from here, the stock can move towards the levels of maybe 250 and 255. We can keep a stop loss somewhere close to 230 for creating any trading position. But if there is a medium to long-term view, then I think at this level, Eternal is quite attractive. The other stock on which we are bullish is TVS Motors. And there also we feel that the stock has completed its downward correction. And in fact, it is forming some higher bottom sort of formation after a very long time. The stock has corrected to its important support levels. But otherwise, the stock was completely trending. So at this level, at 3,500, the entry, I mean to say buying looks quite attractive. We should look for buying at current levels with a stop loss close to 3,450. And we can again expect on the higher side 37, 3750 sort of levels.
Okay, take that point. Shrikant, thank you so much for joining in. So those are some market technicals. We'll slip into a short break. When we come back, we'll get you more on the market, stock-specific action, and a market conversation going on as well.
Welcome back to Midcap Radar. Well, as the show suggests, the focus remains on the mid-cap and small-cap space. We've lined up a very interesting conversation for you. Aniruddha Naha, CIO Alternates, PGIM India Asset Management joins us. Well, thank you so much, Aniruddha, for joining us. First up, over the last 2-3 weeks, we've seen a bit of a carnage, especially as far as the mid-cap and small-cap space is concerned, and with valid reason, given the fact that you're expecting quite a bit of erosion as far as earnings are concerned. At the current junction, what is the kind of approach you're suggesting to look at this particular space?
Thank you again for this opportunity. I think we continue to remain positive. Clearly, it is a one-off whether this resolution in the Middle East happens or not. But whenever it happens, I think the bottom is already should be the bottom. There might be a quarter or so where earnings will get impacted, but the market is forward-looking. We believe there is a lot of opportunity across the mid and small cap, especially the small cap space, where valuations have been beaten down. Earnings continue to sustain and have been reasonably strong across, even at an index level. So we will use this opportunity to build portfolios over the next probably 3 months. And we are telling investors, if anyone is looking to invest into the markets, the mid and small cap would be the space where you would see earnings and hence a follow-on kind of return coming through in the next 3 to 5 years.
Okay. Aniruddha, we have seen some issues come by, and you have spoken about it as well. Considering the uncertainty that we are seeing, we'll see some earnings cut as well. What valuations are mid and small caps trading at versus the historical averages that we are seeing? And is positive trends being seen across sectors, or are you bullish in certain sectors or spaces that we'll discuss in the course of this conversation as well?
So this is a very interesting question. I think so on a long-term basis, valuations, even after a cut in earnings, will look reasonably positive vis-a-vis its own history. So today, the small cap index is definitely cheaper than probably what it was over the last 3-4 years. The mid-cap index, in spite of a cut of probably a 10-15%, would look better than what it used to be. And this, mind you, cut in earnings will be very temporary in that sense whenever the conflict, because there are some value chains which have got impacted. It will take a couple of quarters for things to come back. But if someone takes a 3-5 year view from here, we believe this segment is extremely well poised for earnings growth. Whether it is going to be broad-based, our sense is mid and small caps have never been broad-based. It is, frankly, the diversity itself. There are opportunities at a stock level or a sub-sector level to that extent. So we continue to be positive on certain sectors, whereas we are holding back on certain names, especially on the financial side in the mid and small cap, more so on the small cap side, because we believe there could be certain impacts on margins, etc. But other than that, segments where we believe there is a big opportunity which would play out over the next 3-5 years, I think textiles is something which is looking very good. The tariffs issue have been resolved. Capital goods, I think auto, I think a large part of the pain in if crude sustains and doesn't move up too much, we believe auto ancillary could be another very interesting space to look at with a 3-5 years perspective.
Okay, Aniruddha, couple of interesting points you made. First up, you said that you continue to remain cautious as far as the financials are concerned. Explain to us a little bit more, are you worried about the interest rate cycle? Are you worried about margins speaking out, especially as far as the NBFC space is concerned? And within the BFSI basket, where do your preferences lie, or is it a complete avoid?
Sure. It's a very relevant question. See, once you go down the market cap into the mid and small cap space, the pricing power to that extent is a little detrimental to vis-a-vis the larger players. And hence, if your 10-year or the yields keep moving up, which we are seeing, there would be margin pressures out there. There would be clearly the uncollateralized book is something that we are keeping a very close look on as to how the credit cycle plays out there. And we've seen one of the most pristine asset quality cycle play out already. We believe incrementally things could actually start moving into a little bit of a negative territory there. So there would be margin pressures, there would be an asset cycle playing out. And the competitive intensity, if there is a bit of a slowdown in the economy, I think so they will find it reasonably difficult to compete with the larger players. In the financial side, we like the non-lending financials. So anything related to the the market or the financialization of savings that we say, That is a segment we believe there has been decent amount of correction in that space, and that could turn out to be a very interesting space. And you've got a lot of options out there in the mid and small cap space.
So when you're talking about options, after the earnings cut that could come by and we could see a recovery, because the hope is, of course, and it should happen, that the war would not continue for a longer period of time. In that case, do you think the recovery will be led by the mid and small caps, or do you think large caps would be the one that would take a lead?
See, very tough to say which will move initially. But I can tell you over the next 3-5 years, the earnings trajectory, and this is not something that we are quoting. We are just quoting from Bloomberg, let's say. Bloomberg clearly says the mid and small cap over the next 3 years has an 16 to 18% kind of earnings growth, or even higher. The small cap space has an earnings trajectory of almost more than 22% over the next 3 years. Vis-a-vis the large cap being at about 10 to 12%. Even if it hits at 12%, that will be great. And if you look at it, the fall has been more so in the mid and small cap space. So into a recovery with the earnings trend that plays out there in the mid and small cap space, we would bet on the mid and small cap space definitely over the large cap space.
Okay, Anuruddha, one last question. What is the kind of assumption that you're making, especially as far as crude price is concerned, given the fact that you are at this point of time looking to take a bet on a lot of the crude sensitives? You spoke about tires, you spoke about autos, auto ancillaries, even OMCs, some of the smaller paint companies. So what is the kind of assumption that you're making, and will you add these names now?
See, this is actually, it's very difficult to make an assumption, especially given the volatility and the Middle East situation. What we are betting on is, if crude doesn't move up too much from here, or we are probably topping out, I think a lot of these will play out. If the conflict continues, and that's a binary event, it is extremely difficult to make a call on crude there. Can crude move to 120, 125? Yes. But I think so all bets would be off if it moves beyond 125.
All the bets would be off if it moves beyond 125. So that's a level which would be a risk for earnings growth outlook for the mid caps and the small caps going forward. Always a pleasure speaking with you, Anuruddha. Thank you so much for joining in with your thoughts. And we'll have this conversation again, of course, when things improve globally and geopolitically as well. Let's slip into a short break now. When we come back, we'll get you more on the markets and stock specific action on the other side. Stay tuned. Welcome back. You're still tuned to Midcap Radar. While we talk about midcaps and how the market has been falling, one stock quietly made returns of 20% in last 2 days, and that's NOSIL, which is a chemicals company. And there has been some positive news flow that has come by. Now, remember, this company makes chemicals which is used in auto industries, rubber manufacturing, and there has been a notice. The Commerce Ministry has notified anti-dumping duty on rubber accelerators from countries like China, US, and European Union. This is something that the company was expecting because they're also expecting some notification to come by for imports from Korea and Thailand. And letters were sent, and this investigation application was made by NOSIL to the Commerce Ministry as well. Now, remember, all these products which would be in the rubber accelerator segment is around 40% of their top line. So, if imports start coming in less because of higher anti-dumping duty, this would have a positive impact on 40% of their portfolio. And this is applicable for the next 5 years, which starts from March 2026, which is this month. So, a definite positive which has come by for NOSIL, and that's the reason the stock is up around 5% or 6% today. And this week itself, it has taken or has seen returns of 20%. So, some positive news flow here.
Absolutely right. Almost 6% higher on very good volumes and an outperformer, like you mentioned. But another stock today that's doing very well is Syrma SGS. This on the back of a bullish note from Investec. Upasana is here with more details.
Well, certainly, it is a double upgrade from Investec this month, and the target price has been raised from 885 per share to 945 per share. Well, the brokerage says that the company has taken various corrective measures in the last 18 months, such as curtailing the low-margin telecom business, even scaling up its non-consumer business, that is the auto and industrial segment, adding export customers, and also various acquisitions done by the company. And the benefits of this correcting measures are clearly visible, such as company's revenue growth has also improved by 40% in the last 2 quarters. EBITDA margins has seen a sharp jump, that is from 6.3 in FY24 to as high as 10% plus in last 2 quarters, and the order book has also seen a good growth of nearly about 40% since FY24. Now, the brokerage believes that the company's guidance of 10% plus EBITDA margin and even 25% revenue growth in FY26 is much reasonable and doable. And it has also mentioned that unlike other PCBA companies, Syrma has not seen any deterioration in its balance sheet. It projects a 30% PAT CAGR from FY26 to FY28 with further improvement in the company's ROEs, which is projected at 15% plus. It also believes that the company's foray into new segments such as PCBs and copper-clad laminates is in a measured manner, and the brokerage believes this is comforting. Now, talking about the valuation currently, the brokerage says it at an attractive level of nearly about 26 times FY28 2 years forward. So, all in all, certainly a bullish note coming from Investec on Syrma SGS.
Well, thank you so much, Upasana, for highlighting this particular note, and Syrma SGS, one of the outperformers in the session today. Well, I've been tracking GMR Airports, a very interesting note coming in from Kotak Institutional Equities. They've gone ahead and reiterated their buy stance on the company. They have a target price of close to 112 rupees a share. They've spoken about 3 key factors that the street is worried about, and they say that GMR is relatively insulated from these 3 risks. What are the risks? Number 1 is the ongoing West Asia conflict. Number 2, impending tariff outcomes from upcoming control periods as far as airport prices are concerned, and also potential competition coming in from the newly launched Jewar Airport. What they say is that at the current market price, the stock does not factor in any upside at all from pending legal cases. Now, talking about the West Asia conflict, they say that they anticipate close to a 7% cut in EBITDA in FY27 from an assumption of 1 quarter loss of passenger volumes due to the ongoing conflict. So they say that the real impact over time, however, will be limited to 2%, given the fact that there is higher aero tariffs that will now start kicking in. On talking about tariffs itself, they're talking about the control period tariffs, especially in comparison to Jewar Airport, and they say that the new tariff forwards will not impact the EBITDA growth much, especially regarding Jewar as well as Hyderabad. And lastly, they say, remember, GMR Airport has several pending legal cases, number 1 being the asset-based calculation, and also a case relating to Delhi International Airport as well. They say these cases appears skewed in favor of GMR Airports, and on the back of that, they reiterate their bullish stance. The stock higher by almost 5% today and doing very well in the session. Well, a couple of other stocks that we will look at. Asian Paints, one particular stock that's seen the company has gone ahead and notified its dealers that they've taken price hikes. That particular stock is up almost 5%. Alchem Labs, the other stock, doing very well, up almost 2.5% in the session today. Motherson Sumi, even a Sona Comstar, a whole host of auto ancillary stocks seeing quite a bit of a recovery rally in today's trading session. And L&T again has cooled off a little bit from the day's highest point, but is being seen as the barometer as far as any news regarding West Asia tensions is concerned. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra and joining me today is Mangalam Malu to answer all your queries. We've been getting a lot of them, mutual fund related, what category you should be looking at. We have one person to answer all of them, and it's Chintan Haria, who's the Principal Investment Strategy at ICICI Prudential Asset Management Company, joining us to get all your queries answered about portfolio construction, which categories are best to look at in volatile times like this, and if you're a beginner, where should you be investing? Chintan, thank you so much for joining us. It's always a pleasure speaking with you. And you know, in times like these, we've had conversations, understanding where to go about when it comes to investing. And there's so many categories and different asset classes that we are looking at. So let's get started with the first query, because we have received a query from Ronita Karar, who's writing to us from Hyderabad. Says wants to invest in mutual funds and adds that the goal is to buy a house. And side by side, he says he wants to accumulate a corpus of around 1 crore rupees. He's saying since he is a beginner, which types of funds he can ideally look at. So what categories would you say should be looked at?
Thanks, Sonal, and hi, Mangalam. Essentially, it's an interesting question because first up he's mentioned he's a beginner, then he wants to buy a house, and he also wants to do savings. Perfect. He's not talking about spending, he's talking about saving. That's a good start. And also from a beginner's perspective, like you mentioned, there are so many options in mutual fund, but we've always believed that all you need to focus on is asset allocation. And within asset allocation, with so much news, ups and downs, and we've seen the markets being volatile, I think the best way to start is through hybrids. And within hybrids, of course, you have the entire dynamic asset allocation category. So whether you're doing SIP or lump sum as a beginner, you should look at the dynamic asset allocation bucket, first of all, because pure equity obviously is not something which you immediately start with. You need the balance of both equity and debt when you are investing with a long run view. And to reach about, I think 1 crore was the corpus mentioned, I think you'll need to save about 50,000 rupees for 10 years with the expectation or assumption that markets would give you 10%. That's when you reach about 1 crore. So it's not a shortcut. And then probably you'll have to think about your house. So it's probably a little time away, but yeah, you can possibly look at saving 50,000 over 10 years, assuming you'll get 10% return, you'll reach that 1 crore corpus.
That's interesting. You're saying 10% because usually, you know, a lot of people would come and say that the Nifty itself has compounded between 13 to 15%, etc. So 10%. Is that you're scaling down the long-term projections of returns because of...
it's just an assumption, right? If you get more than that, obviously you reach your goal 100%. Faster. And what will happen in the future, we don't know. But yes, India is growing in double digits or likely to grow in double digits. So we do hope that the long-term returns of the investors are good. But the fact is that you have to invest wisely. And you have to invest with asset managers or fund managers who are professionally doing it.
Right.
So that's the only two caveats I would like to have.
100%. I take that point on board as well. And that brings us to our next query as well. Ronak Prasad, he writes to us from Bihar. He says that equity markets have witnessed strong momentum in sectors like banking, capital goods, infrastructure. And he asks if this momentum is sustainable going into the next financial year. If there will be a rotation into the sectors, IT, FMCG, if he needs to position his portfolio accordingly. Now, that's very interesting because, you know, oftentimes we've seen that the laggards of the previous few years typically tend to outperform after a while. But do you think one should look at investing like this where you shift or look at sectors or allocating your wealth at times when you see momentum or when you move out of momentum? You just have to balance it out, right, I guess?
Yes, I think the one word which encompasses everything that you're talking is mean reversion.
Yeah.
The only issue about mean reversion is that it takes patience and you have to have the ability to take pain, which you and I as individual investors may find it a little difficult. Even seasoned investors find it a little difficult. So if you want to do investing sectorally, and rightly mentioned that sectors like banking, capital goods, etc. have done very well in the last 3-4 years as India has probably progressed in terms of its growth. Capex-oriented government-facing companies have also done well. The only question is, do you have the patience and the fact that it takes time? And maybe sometimes the trend goes on for 4 to 5 years. So if you basically investing and you are early, say for example, you invested in PSUs in 2018-19, you had to wait till 2022, almost 3 years. Very few people are able to do that. And hence I'd say going the sectoral path is definitely something which you can look at to generate more returns. But that's after you probably spent 13, 14, 15 years in the market investing in hybrids and then in pure equity.
And generally thematic funds, you know, people chase those trends. What are your thoughts on that? Because oftentimes the launch of a thematic fund also denotes the topping out of returns in that sector somehow.
So, yes, I mean, demand creates its own supply and supply creates its own demand. But the fact is that if, as an investor, you're looking at investing momentum driven, you're obviously risking your portfolio towards a downside risk, which we've seen in the last maybe 1.5 years, where everything that was supposed to have momentum has kind of failed, and only a few sectors have actually done well. So picking up the sectors is not easy. It's an art which you best leave it to fund managers, and hence diversified funds would do the job for you. But yes, if you want to create long-term alpha, then in fact there are thematic funds also which are available, or fund of funds which are available, which are doing just this for you. So instead of you picking it, let the experts pick it.
Okay, so you actually answered the next query that we had. I would just read it out because two of them have sent it on thematic funds. One of them is asking whether they can invest in sectors like metals, we have real estate and infrastructure as well, given that they are cyclical in nature. And the other one is coming in from Yasmin Jain, writing to us from Mumbai. She says, given the rally in sectoral and thematic mutual funds, she's worried about concentration or concentrated exposure and higher volatility. So she asked if these sectors are suitable for long-term wealth creation, or whether she should stick to diversified equity funds or use sector funds only tactically. So coming back to this again, we have had conversation on sector and thematic funds as well. Last year and the year before that, there was a slew of NFOs in thematic funds only, and we saw a lot of inflows coming in from there. That rally has fizzled out now to a bit. But do you think when we look at somebody's portfolio, there should be some exposure to sectoral funds? Of course, it'll be managed by someone experienced, but if somebody's starting out fresh, they should not look at it, or it could be a part of their portfolio a little bit.
So I think if someone has spent enough time in the market, an ideal portfolio, right, and there's no ideal, but an ideal portfolio would have your dynamic asset allocation funds or the hybrid funds. Then you'll have some passive funds to make up for the gold, silver, etc., and also some broad market funds within the passive funds you'll have. You'll have small and mid-cap funds to a certain extent. And then, of course, you have the sector and thematic funds, which probably can be up to 15 or 20% of your portfolio. If you can actually pick them, they can generate good alpha for you. And most of the alphas which fund managers generate are from picking the right sectors at the right time, right? Yeah. And within the sector also, you need to then pick up the right stocks. So you are right that asset allocation plays a very important role. And within asset allocation, a tactical allocation towards sectoral does make sense. Look at the last 12 months. If you were in IT sector, obviously you've taken the pain. The question comes, is IT sector worth looking at it right now? Again, if you have the ability to take pain, something which was 20% of an index, today has come down to almost 9% to 10% of the index. Underweight, under ownership, those are recipes for something where if something goes positive, because AI-related negative news has derated IT sector. If that does not play out, then our IT sector is cash rich and it can actually do well. So the point is, you create a portfolio in a way that you're not always chasing the laggards. At the same time, you basically have a balance of something which is steady. And there, I think banking and financial services in India being, if India has to grow, banking and financial services has to grow. So that's something which is giving you a base. Around that, you build the entire bucket. But yes, if you look at infrastructure, metals, they've done so well in the last 1.5 years, they've been cyclicals. One thing one should remember is that these stocks look cheap at the peak of the cycle because their earnings are the best. And at the bottom of the cycle, they look most expensive because their earnings are low. So each sector has a way of kind of, manifesting itself in terms of valuations, and it needs expertise. So
no, we understand. We take your point. You're convincing the convinced where it does take expertise. But what's interesting is that when we said that, sectoral, and you gave us the example of IT, it's been underperforming right now. Still, we don't see any IT thematic funds being launched right now at the bottom of the cycle, if one were to believe that this is the bottom of the cycle. But your point on 15 to 20% allocation to one sector is very well taken. In fact, a lot of our viewer queries today are focused on sectoral, allocation itself. So Tina Kapoor, she writes to us from Delhi. She says, as a beginner, how much of her portfolio should be allocated towards sector-specific mutual funds? You've given a rough rule of thumb, and you believe that this applies to investors at any stage of their investing? Because as a beginner, why should you have any less or more exposure than as a professional? Just give us a sense.
So if it's in fact, the way I look at it is that if you have the ability to pick the right trends, which comes after a lot of experience, then you can increase the weightage of sectoral and thematic. But in the initial phase of your career, you'd want to be with diversified funds. To answer your point on the IT sector, I think IT as a sector and thematic is available for more than 20 years, just that people have probably not invested it in a big way. But both on the active and passive side, you have technology and IT related funds available today.
Okay, all right. The sector fund conversation goes on, right? Because there's been so much interest. But again, as you said, experts or expert opinion is needed in order to ensure that your investments go right. But we'll do one thing. We'll slip into a short break. On the other side, we'll continue our discussion on how to invest into mutual funds, how to do portfolio or asset allocation in volatile times like this. Stay tuned for that conversation.
Welcome back. This is Mutual Fund Corner that you're watching us here, and with us is Chintan Haria of ICICI Pru AMC to answer all your queries. We've answered a bunch of them related to AMCs as well as related to the kind of money that one has to put in funds, sectors, and a lot of that. The question now is between equity and debt. A lot of people wonder whether debt is it a good time for one to look at debt as an investment bet? Because if you ask someone about for the last 2.5 years, they'd say that debt is an untouchable given the sort of great returns that we're getting in equity. Now you have equities which have underperformed, there is capital loss, there's time correction. Do you think debt is a good place to be?
So Mangalam, I think last 2.5 years, if you actually look at the markets, the returns have not been that
great. But the narrative was that
okay, this is a great time. Because 2021 to 2024 was such great returns. Even today, if you look at 5-year returns, they look good. But we've seen smart money actually chase credits, the performing credit space, which is becoming quite popular among larger investors. Those who have been heavy equity investors will also move towards that. So the performing credit space on the debt side is gathering momentum. And the fact that people have moved so much towards equity that they've forgotten debt is also not a bad time. And hence, if you look at a smarter way to invest in debt is through the hybrids itself again. So while I may have spoken about hybrids for the 4th or 5th time today, in hybrids you are getting debt handpicked by the fund managers, so you are getting equity and debt together and in a tax efficient way. So I think hybrids become a good choice for you to start investing incrementally, even if you want to invest in debt. And within hybrids, then you have lots of buckets, like, where the debt component can range from, say, 20% to 50%, 60%. You have enough funds within hybrids. But yes, you should allocate to debt today. But given that the markets have fallen so much in the last 1.5 months, so, I think hybrids is a better way to invest. But in the long run, if you're looking at investing in debt, then the performing credit space for those who have the kind of waiting period, because these come in as close-ended funds, you have to wait for probably 3 to 4 years before your money starts to come in again. So that's a space where we are seeing a lot of interest.
And instead of going to hybrid, is there a possibility that one, looks at the rule of thumb, basically 100 minus your age goes into equity and the rest goes into debt? You look at performance credits as a component, and then you look at diversified equity MS as a component, and you do it yourself instead of giving it to hybrid.
Yeah, you can do that. If you're taking performing credit on one side, then you're getting slightly higher yield, and that kind of making up for the inflation which may kick in. And the world which we are in right now, most probably it looks like inflation will be higher. Higher inflation is good for equities in general, unless it becomes too high. And so equities should also get the benefit of a slightly higher inflation. But yes, performing credit in a space where India is growing, it looks like a space where people should allocate going forward.
Okay, I think we need a separate full episode on how to go about it, because debt gets a little complex at times. People think equity is the easier way to go at times. But having said that, we've spoken about debt, we've spoken about equity. We have to talk about precious metals, gold and silver.
Of course.
What's happening there? We are seeing it fall from the highs, of course. Everybody knows that. Gold ETF flows, after touching those levels of 24,000 crore rupees, surpassing equity flows, came off sharply in the month of February. Now in a market like this, where even safe haven assets are not safe anymore, how do you go about it?
So I think enough in the last 3-4 years was spoken about gold and silver, and I think the pinnacle was in the last 4-5 months, where we saw a lot of selling in equities by HNI and retail to invest in the gold and silver ETFs. That kind of was chasing momentum, as we said, and that would have hurt a lot of investors. We tried our best to caution them that there can be worries around investing in silver when it has done already so well. But again, I think after the fall that is seen, the sharp fall, there may be a semblance of stability around silver, which should happen right now. We'll have to look at the demand and supply. For 4 years, we saw silver demand being more than supply. At a time when prices were in the range of $40, $50, it overshot. Now it has come back to about $65, $66. If the demand remains okay, then maybe silver remains a certain allocation. I'd mentioned about 3 to 4% allocation in silver is okay. And gold, of course, whenever we've seen a kind of global risk off, gold does dip, and then obviously it's the first to recover. So we saw it in 2008 also, because when all financial markets are interlinked, gold has come down. It happened even in COVID times. So I think the correction in gold, if you are underinvested or if your allocations to gold are zero, then you put in, but we must remember that gold already is more than twice its all-time high. So it's not something which is cheap, or it's not something which is available at a very low level. But you can invest a little bit slowly if it corrects from here in a meaningful way.
So would it be via gold ETFs, or would you look at the hybrid way yet again?
I think multi-asset funds are the way to go. Allow the fund managers to choose how much gold they want for you in your portfolio. So yeah, it's quite efficient way of allowing, without you taking the risk, let the fund manager decide how much allocation should happen to gold also.
If one had to make a great recipe of a portfolio, what would you say would be, I mean, again, rule of thumb, we're not talking, everyone's risk reward
is different.
Is different. So how much equities, how much debt, how much gold, if at all, real estate via REITs, etc. How do you do that?
So I think equity is anywhere between 60 to 70% is a good starting point for most of us. And I think as many interactions that I've had with investors across India, normally 60 to 70 is the upper limit normally where people are. There are many are 30 to 40 also. And then, of course, 10 to 15% in bullion, depending on which stage of the cycle we are. So there was a time where bullion could have been even 20% 1.5 years back. Today, you have to bring it down to maybe 8 to 10%. And the rest, of course, goes between REITs and WITs, performing credit, etc., about 15 to 20%. Depending on your risk appetite, you can invest in that. Having said all of that, instead of you doing all of it, just give it to multi-asset. You're fine. Just give it to multi-asset fund, you're fine.
So, while we talk about multi-asset allocation funds, which would, of course, take care of your long-term investments across asset classes, there are times when things are very uncertain. The times that we are in right now, you want to keep some liquid funds with you as well.
Yes.
So do you think right now, instead of keeping it in your savings bank account where you're getting maybe 3 to 4%, liquid funds would make sense, or arbitrage funds would, for that matter? But then that STT hike came by and we thought a little bit of impact in returns would come as well. I'm talking from a short-term perspective, not long-term right now, because we do get a lot of queries on how to park the short-term funds as well. Do you think arbitrage liquid continues to be the go-to place, or considering the volatility that we continue to see, just stick to whatever you have and don't make too many portfolio changes?
No, I think from an efficient investing perspective, from a taxation perspective, arbitrage funds would make sense. If you have a more than 2-year horizon, then income plus arbitrage schemes as a flavor has come in. But for most investors, I think arbitrage funds would make sense from a parking perspective, and then you can use them from an STP perspective also if you want to invest in equities.
Okay, all right. So the crux of the matter is, of course, volatility will continue to happen. What Chintan said is go buy hybrid funds if you are a beginner. If you want to allocate to your precious metals precious metals as well, go buy multi-asset allocation funds. Let's expert do their job when it comes to volatile times. And of course, debt is a category that you can look at as well. And the ideal portfolio mix, of course, it's personal finance, so it's different for different people with the risk capabilities that they have. But it makes sense. So thank you so much for joining us today. Always a pleasure speaking with you. But before we end the show, let me take a minute to say why MF Corner, our endeavor has always been to simplify mutual fund investing and bring relevant insights to our viewers. And in this journey, we have had a trusted partner in Bandhan AMC. Today, as we mark 3 years of this partnership, we celebrate a shared commitment to making investing more accessible and understandable for investors across the country. So let's hear from Vishal Kapoor, who is the CEO at Bandhan AMC.
It's been a strong and meaningful 3-year partnership with MF Corner, where together we have consistently worked towards simplifying mutual fund investing for viewers. At Bandhan AMC, our focus has always been on building trust and delivering value. And this collaboration has been an important step in that journey.
All right, with that, we're out of time on this edition of Mutual Fund Corner, but you stay tuned to CNBC TV 18. We'll keep tracking markets, and we also keep tracking mutual funds, and take care of your personal finances. Thank you for watching.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng is up around 1%. The Taiwanese index also trading with gains of close to 0.5%.
Oil prices, they fell 10%. They're back. I mean, I think this morning when I looked, they were at about just under 100. We're about back to about $104 odd.
To that extent that they are not resolved, insist that their concerns are recorded in the minutes of the board meeting.
It's going to be a reflection and an assessment of HDFC Bank's internal processes, I would imagine.
22,850, that's about 1.5% higher. The Nifty Bank is up about 1.6%.
Oil marketing companies have not fully passed on the global benchmarks yet. So next increase that will come on April 1st will be watched out very closely.
Company yesterday announced a price hike in 2 phases between April 10th and 21st. And the price hike across the portfolio would be 6 to 8%.
And if you take a look at the Nifty, that's down from the highs. Where you take a look at the rupee, that has reversed course again after the initial appreciation that you saw.
Well, there is definitely a recovery which is taking place from the day's lows. So currently at around 22,852.
The promoters are put together. The entire family holds about 75% stake in Cello, and they would be looking to sell anywhere about 51% of that stake.
CDSCO has intensified monitoring of the supply chain of GLP-1 based weight loss drugs.
500-point uptick on the Nifty as we speak, 1,500 on the Midcap index, and the advanced decline ratio, which was at 1:20 in favor of declines yesterday, is in favor of advances at 5:1.
Okay, that is the day so far, and the market, of course, up 400 points, not 500, but not bad either. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me, my colleague Rima. Rima, hi.
Hi, rebounding quite nicely. It comes after many days of losses for our market. We've come off about 100 points from the day's high. The high today was 23,057, so about 100 points off from the highs, but still holding up very nicely. 2% gain on the benchmark indices, 1 hour to go. The Midcap index is up almost 3%, 2 3/4 of a percentage point. The advanced decline ratio holding quite nicely, and broad-based gains visible today. Banks are finally doing well. The Nifty banking index is up 1,300 points. It's also the expiry today.
It's also the expiry, absolutely, Tuesday. But, the market wants to believe that what we have seen over the last, 16, 18 hours, basically, is the beginning of the end of this, conflict in the Middle East. I'm referencing that Trump tweet. And I think about an hour and a half back, there was another, a social media post, or maybe it was actually a story, but it was in Israeli media, which essentially said that, Iran's, the new supreme leader wants to talk, wants to negotiate. Remember, but it was in Israeli media, reference to Saudi sources. The market, nevertheless, took off. From that point, it took off very, very sharply. But we've not really heard from people like the foreign minister or the speaker of the parliament in Iran, etc. People who've been regularly commenting have been in the thick of it over the last many, many days or so. So we'll see. But 400 points, there is the expiry factor, I'm sure. But of course, there is also the other factor, which is that, for the first time, at least from President Trump, we've heard de-escalatory comments. Whether it'll happen, not happen, as I said in the morning, watch the headlines, but of course, also what happens on the ground with regards to the actual fighting and whether there is, a slowdown in that, and that will give more confidence to the market. Well, let me just quickly run you through what's lined up here before we go any further. Key indices, of course, doing very well. Sectors, pretty much all of them in the green. Paint makers are up. Actually, Asian paints is up 4%. The others are up more like 1.5%, 2%. It's just a complete flip, right? When oil goes down, oil consumers do well. We'll, of course, also touch upon the IT services space as we inch closer to the quarterly results. And JP Morgan's got a note out. GMR Airports is another one which we will talk about. Kotak has got a note. So all of that here over the next 60 minutes or so. How should you position yourself is the question. Mitesh is with us with that answer. Mitesh, hi, good afternoon. What's your sense?
I believe, Prashant, that this market is going through what we talked about as a pullback, and we discussed 23, 120, 150 as the zone, which the Nifty needs to clear and close about to suggest that at least there's a temporary arrest of this declining movement, which has not happened as yet, but still watching it out. So that's the level on the upside. Otherwise, in case you fail that, if today and for tomorrow as well, we might come back to 22, 600, 500 zones at least. Having said that, I have one buy and one sell call right now. On the buying side is Infosys, which is a conditional buy. If it starts getting past 1300, buy with a stop at 1288 for targets of 1330. And JSW Energy is a sell with a stop at 495.5 for targets of 465.
Mitesh, after a long time, there is a buy coming in on an IT name, Infosys. It's just a rebound from oversold levels. Any thoughts on other IT names which you are tracking very closely? Because across the board, you are seeing a pretty good bounce back. So there is Latent Force, First Source, eClerx, Mastech, Emphasis, Persistent, all up 3-4% today.
IT, one, I think, very clearly was one of the first sectors to correct and therefore more oversold than some of the other stocks and sectors. Two, I think the rupee depreciating factor also kind of helps IT stocks. So keeping both these things into mind, and given the fact that the hourly chart was showing first signs of reversal, yesterday we had a buy on HCL Tech, today it's Infosys. I think that's where one trading space where traders can, possibly look at exploring some long positions, at least to counter the kind of shorts they might have on index and other sectors.
Okay, we'll come back to you, Mitesh. For now, let's talk about MCX shares in the spotlight. We understand from sources that SEBI-appointed CDAC has backed the proposal to permit FPIs in commodity derivatives. That's gotten MCX excited today. Yash joins in with the details.
Well, we had reported this exact story last week where we had spoken about the Commodity Derivatives Advisory Committee, or CDAC, meeting and discussing the proposal of allowing foreign portfolio investors, or FPIs, into commodity derivatives. Now, what we've been given to understand from our sources is that CDAC has given its approval. In fact, it's backed allowing foreign portfolio investors in commodity derivatives market. What we've been given to understand is that now CDAC has asked exchanges to give suggestions in terms of what the regulatory framework around allowing FPIs in commodity derivatives could look like, and exchanges are expected to reply to CDAC with that particular framework. Also, what we've been given to understand is that CDAC has suggested allowing FPIs first in cash-settled commodities like gold and silver, and then going on to other commodities as well, like Brent, as well as base metals, is what it is currently considering. SEBI chairman also on March 2nd had alluded to this very development, which was expected in the next few days. Back then, he had said that they will consider allowing FPIs in options trading in commodity derivatives very soon.
And this is a story which, of course, we've been tracking for a while, as Yash said. Yash, thank you for that. Dharmesh Kant is with us, Head of Research at Chola Securities. Dharmesh, good to have you with us here. There's a 4% rally coming through, a 100 rupee gain. Any thoughts? First gold and silver, and then perhaps, agri, I think, is going to be a strict no-no. But other non-agri commodities, but gold, silver first, but they're also the most heavily traded, right? And perhaps an oil. Dharmesh?
Yeah, Dr. Prashant, thanks for having me for the show. It's a good step in the right direction, and it will add liquidity and more, solid pricing as far as gold and silver is concerned, along with oil. So, because of domestic bias, the depth of liquidity was not there, and it was more used as a hedging mechanism by large corporates. So, I think with retail participation and more FIs coming in, will add to the liquidity out there. As far as pricing is concerned, gold, silver, and oil is dictated by international pricing. So nothing, changes out there on the pricing front. But definitely good for the exchange, more revenues for them. And at the same time, since it will add more liquidity and depth to the market, good for the brokers as well.
By the way, Europe is absolutely flat at open. The CAC is 0.06%. The DAX is down 0.5% and FTSE is up just about 0.1%. But bear in mind, most of the European markets finished with solid gains yesterday because that Trump announcement about that 5-day ceasefire not attacking the energy infrastructure in Iran came during market hours when Europe was still trading. So there was a U-turn in European markets and the share prices there. But today, there is no follow-through buying. So opened up on the flatter side, negative for the German index. Just wanted to quickly update on that. But moving on now to Asian Paints. That's announced a 6 to 8% price hike across its portfolio, citing rising crude and raw material costs on account of the war. Manglam joins in with more.
Well, we got a great rule of thumb by the management of Berger Paints this morning where they said that for every $1 increase in crude, 30% of that is actually an increase in the raw material basket for paint companies. So a 40% increase in crude ever since the announcement or the tension started, that equates to about 12% increase in their raw material basket. So to that extent, companies have taken their price hikes. Raw materials account for 55% of the overall cost price for the company. So that explains the 6 to 8% sort of math. Asian Paints has announced this in two phases, one on April 10th and thereafter April 21st to obviously, one, smoothen out the dealer risk, at the same time, maximize value and volume growth for the company as well, and not just give one jarring increase. All the other paint companies had already given a 2 to 3% price hike already, with another one likely with effect from tomorrow, and in some cases with effect from the 30th of this month itself. And Berger Paints themselves joined us and said that they are looking to announce another paint price hike on the April 9th day as well. But importantly, crude prices sliding overnight from the peak also is an additional positive. From the start of this war situation, most of these paint companies are down anywhere between 12 to 15%. So the fact that they were lower and now that they've taken price hikes and crude prices are lower as well, all of that does well for them. Demand situation has been okay so far, with the companies citing no major problems. And the first quarter is something which is a bigger quarter for the paint companies. So let's see how this pans out. Macquarie has an outperform rating on target with a target price of 3,100 on Asian Paints, and that explains why the stock, after having fallen a lot, is currently up around 4.5%, among the top Nifty gainers today.
So tomorrow is around 1.5%. The one which is on the 30th of April will be another 2% possibly. So it will be 3.5% of coverage. And then on the April, possibly around the 9th or the 10th, we will have the balance about 3 to 5%, depending on where the things stand at that point of time. So typically in paint, we take in stages, that's how it has been always. And we are now going to take it. First stage will come in effect tomorrow itself. That will be part of the enamels and certain other portfolio in the waterproof range. And in the second stage, in the 30th, is all the premium and luxury emulsions where we will take up the prices.
Dharmesh, solid company Asian Paints, but the stock hasn't done anything. The 5-year CAGR is minus 2% for Asian Paints. And now, of course, it's navigating this crude price increase. They're passing it on. High valuations has always been a concern. But what would you advise on Asian Paints?
I think it's more of a trading pop-up which we can see, and definitely the downfall will get arrested because the stock price has already seen a correction and now they all have taken a price hike. So every player has taken a price hike. So it neutralizes the competitive intensity to that extent. But having said that, the competition in the paint space is getting more, hotter, and it will be difficult for paint companies to command the valuation premiums which they used to command. So I mean, the revenue run rate growth organically and inorganically put together can be 12 to 15%. And with your cap on the pricing ability and the input prices are panning out. So just for a trading play, it can be there up for, 3-4% more on the taking. But structurally, I think they are in a spot, and time-wise correction is what will happen out there.
Okay, by the way, IT earning previews have already started coming in. We've got about 2 weeks, but the first of the IT previews is out. It's from JP Morgan, and it's come even before the quarter has come to an end, and we have the actual INR rates. But they're saying the focus this time is going to be on the annual guidance because there is so much pessimism surrounding Indian IT. People are questioning the long-term relevance of the Indian IT industry, and therefore they believe that the companies the guidance is going to be critical because that will signal the growth acceleration or any sort of confidence. Not that JP Morgan's expectations are very high, so they're only penciling in a 2 to 5% revenue growth for Infosys in terms of an annual guide for FY27, HCL Tech 3 to 6%, and for Wipro, Q1 guidance will be -2 to 0%. They're saying Q4 should be a healthy quarter, but below earlier expectations for some of the companies, and those numbers will also come up for you on your screen. So for TCS, 0.6%, for Infosys, HCL Tech, Wipro, it will be a negative growth quarter. Some mid-cap companies like Persistent, Tata Tech are likely to fare well with a 4.5% revenue growth. Now, JP Morgan believes that the Indian IT companies are going through 3 phases that any company, when there is a technology change, goes through. The first phase is deflation, which is where they are in currently, when the loss of revenue due to the new technology overpowers the incremental revenue that comes in. That's where we are currently. Then comes digestion, where it sort of balances out. And then comes the reflation, where the new work, because of the new technology, kicks in. And they think, at least as of now, we don't know the timing at which the third phase will come in. So which is why they've lowered expectations. They're saying large caps over the medium term will only grow at 3%. Earlier expectation was 4%. Mid caps will grow at 5%. And they're saying it's going to be a while before the companies can get back to their long-term average growth of 7 to 8%. They don't see that happening in the near term, which is why they've cut the target multiples. That said, they do expect the rupee depreciation to cushion some of the earnings downside, but they haven't mentioned the extent to which the INR depreciation will play a role. But just wanted to highlight that's JP Morgan note. Today, of course, the sector is doing well. It's up nearly 2%. Across the board, you are seeing some gains coming through in the large cap names. Dharmesh, pick and choose any stocks that look attractive to you. Orient Pro is a stock that you've liked in the past, but have you widened your ambit to include any other IT names or any which you've not bought, but they are looking attractive to you or interesting to you?
Yeah, I mean, on the IT space, a couple of things which are playing in the favor is, one is the steep correction has already happened. Second is the currency depreciation, which is playing out. And third part is most of these IT companies have announced their collaboration with some AI. And through that, they want to, enable all their products with AI feature being built into it. So by all the points of JP Morgan, which they have highlighted, and that the annual guidance which they give when they outlay their quarterly earnings will be very critical to watch forward to. And their body language and how much emphasis they are giving on the adaptability of AI-enabled features and the scalability of that. Having said that, the third point which they have highlighted, that there will be a reflection point, and from where again the growth and the margins will come into play. That is where I have my own doubts on. So as of now, Rima, I mean, we do expect some, because of all these factors playing out, there would be, and currency depreciation already in the swing, there will be some trading play out there. 5-10% can be the at best, price appreciation out there. But we have not, widened the coverage. In fact, the coverage which was there on Persistent, Coforge, we have stepped out of that. But we are maintaining Orient Pro Solutions as a coverage on there, and we have a buy rating on that. They have won recently a big order of 350 crores of data center as well. So those put in place, we'll see the quarterly update on Q4, and then we will take our call. But largely, it seems unlikely that we will be widening our coverage of these stocks.
Okay, the IT index is down 3% since the month of March. In the month of March, while the Nifty 50 is down nearly 9%. Moving on now to the other big story. Sources tell Money Control that private equity fund Blackstone held talks to join the consortium of Aditya Birla Group and US sports investor David Blitzer as a partner to submit a joint bid for RCB. Everyone's watching that. The IPL begins this Saturday. Ashwin joins us on the phone line with what he's picked up about RCB and in whose hands it's going to go to. Ashwin?
Good afternoon, Rima. So, these are indeed the slog overs of this fascinating M&A tussle that is playing out as far as the ongoing sale process for Diageo-owned Royal Challengers Bengaluru is concerned. Remember, it's Diageo's arm in India, United Spirits. So RCB is a subsidiary of that entity, and that's the connection to the parent Diageo. Now, what we're picking up from our sources is that the world's biggest private equity giant, that's Blackstone, they have held talks to join a consortium of the Aditya Birla Group and David Blitzer, Who's David Blitzer? He's a prominent and widely respected American sports investor. So that's what we're given to understand, that Blackstone could potentially join that consortium. In fact, there could also be a fourth player who could join that consortium. So that's one point. The second point that we need to keep in mind is that the ArcelorMittal promoter family, that's Aditya Mittal, he's leading the interest as far as the sports bets are concerned. They are also likely to throw their hat in the ring for RCB. Now, these are the two new bidders that have emerged this week. But let's not forget, this is potentially a four-way race, because last week there were two other bidders that had thrown their hats in the ring. One was the consortium of Manipal Hospitals, Dr. Ranjan Pai and KKR. And the second one was Swedish private equity firm EQT, which decided to join hands with Premji Invest, which is the family office of Wipro founder Azim Premji. So we are now looking at a potential four-way race between these strong consortiums. The ask on the sell side since the beginning has been around $2 billion, but suitors are of the opinion that the team could be valued anywhere between $1.5 to $1.7 billion. But those were earlier expectations. Now the competitive intensity has gone up, and who knows, these consortiums may be willing to pay a premium, maybe in fact even more than $2 billion. But we'll have to wait and watch for that. For now, ArcelorMittal has declined to comment. We are awaiting a response from Birla Group and Blackstone. Fascinatingly poised right now, guys. Back to you.
Yeah, no, absolutely. And Ashwin, thanks very much for that. So there's global interest, right? I mean, and some of these names like Blackstone, the biggest of the big out there. Dharmesh, this is, of course, what does it do for interest in the space? And of course, I mean, listed companies, right? There's this one, but there is also CSK, India Cements, etc. in play. So just your thoughts, if you've put any value, assigned any value based on these IPL franchises.
Prashant, it's more of a one-time kind of a gain. It's not a recurring income. So, I mean, the valuations can be very high. I mean, let's see how it plays out. But as far as United Spirits is concerned, the business is not panning out that well. I mean, the competitors are giving it a tough stance, be it Radico and the others in the foray. And until, the business picks up, for us as an analyst, it doesn't make much of a sense on a long-term basis. But one-off games can always be there, and some trading bump up can be seen. So in the split space, we like Radico Khaitan, followed by Tilaknagar Industries. That is where we think the real money can be made, because their businesses are doing pretty well, and their product launches are also doing fairly well.
Okay. The other story that my colleague Yash had put out is on Cello World, where the promoters of Cello World are looking to sell a controlling stake in the company, and feelers have been sent out to Blackstone, Temasek, Advent, Amundi and Kedara for a potential acquisition of a stake. The stock is up 2% today. But Dharmesh, this is a stock which has done nothing. I remember the listing. It was towards the end of 2023. The issue price was 600 plus. The stock today is down to levels of 400. It's gotten hit hard, 35-40% lower than the issue price. Valuations were expensive to begin with, but after the correction, how does the stock look?
I mean, it's more of a flattish kind of a story unfolding. I mean, on the numbers front also, they have not done anything great out there. And it's, very interesting, at the same time, very surprising to know that promoters want a heavy exit from the company. So why they are doing so, it also puts a question mark on the business, because if financial promoters are going to take over the control of the business, so historically we have seen wherever it has happened, the company has not, performed that well. I mean, the case in point being, if I may say so, the fight between Eternal and Swiggy. So Zomato has performed far better than Swiggy. So we as a house, we like, promoters who has a thick and skin into the game, rather than being financial promoters. So this is one more negative to my mind for Cello World.
Okay, 648 was the issue price for Cello World, and now it's at 400 rupees. That's a 38% decline from the issue price, and the stock has been listed for a little over 2 years. Thank you very much, Dharmesh, for joining in. One more stock, Urban Company, is seeing some buying again towards the end of the trading session. Urban Company is now up close to about 4.5%. Motilal Oswal today has initiated coverage on urban companies. They're saying it's convenience at a pricey valuation. Neutral call. Target price on this is 125. Stock is at 115. They're saying the home services marketplace opportunity is about $60 billion, which the company is trying to capture. Get into a break. On the other side, Varun Goyal, Senior Fund Manager, Mirae Asset Mutual Fund, joins in.
Welcome back. Varun Goyal is Senior Fund Manager, Mirae Asset Mutual Fund. Varun, good afternoon. Good to have you with us here. Thanks for joining in. We're getting a bit of a bounce today, so it's looking better. 22,900 nearly, not at the day's high, but not looking all that bad either. You know, irrespective of this war now, whatever happens, what is looking attractive fundamentally and valuation-wise, Varun, now? Which pockets? Because, you know, we've heard this from others as well. So would love to hear your thoughts. If you want to go down to stocks, that'll be great, but do whatever you can.
Yeah. Good afternoon, Prashant. Thank you so much for having me on the show. I mean, the way we are thinking about it is that it's a temporary disruption of 1 to 2 quarters from an earnings point of view. And if you look at, in a lifetime of a company, or 1 or 2 quarters earnings should not lead to a 25 to 30% price damage. And in a lot of cases, we have seen price damage either equal to that and more than that. So I think as a market, overall, we have seen significant value emerging. I think if you look at, let's say from a bond yield versus the earning yield gap, I think for Nifty, that gap, with a bond yield at 7.8, you're looking at sub 2%. And historically, whenever that gap has gone below 2%, the subsequent 12 months should, have turned out to be very positive for the market. So I think, and I think this number looks even higher for the small cap space. So I think across the board, we are seeing, opportunities emerge. Yes, there can be dislocation for next 1 or 2 quarters, but I think several sectors have beaten down quite a bit. There's widespread fear of NPAs and credit costs going up, and that's why we believe banks and NBFCs have corrected quite a bit. In our view, it is unlikely to be the case that we see such a large damage, so we're clearly positive on that space. I think auto and auto ancillary, again, as of now, we see demand holding on quite well, and we believe that the OEM sales numbers will continue to be robust, and therefore that sector again looks pretty interesting. And I think there's several bottom-up opportunities across sectors, where we have seen significant price damage, and therefore I think for medium to long-term investors, this is a good opportunity to add up to their portfolios.
Have you spoken to any auto ancillary companies? Anyone at Mirai? They're looking to hike prices effective 1st of April on account of raw material costs. Will that in any way dent the volume growth, the recovery? And if once the earnings come out and there is a decline in the earnings, so some pressure that we see, earnings miss, is that a buying opportunity?
Yeah, so Rima, there are two ways to think about it. I think at this point of time, the economy is fairly well stimulated. We have seen significant monetary and fiscal stimulus in the last 12 months. So as of now, our base case remains that the demand will continue to hold. In fact, for all the industries which use crude or gas as a derivative, we'll see price hikes across the board. Whether it's paint, whether it's auto, and several other sectors. And some of that, if the consumers are willing to pay for that. That would kind of take away a lot of these concerns about margins and volume growth. So of course, we have to wait and see what eventually is the impact. But if this crisis is short-lived, 1 or 2 quarters, then broadly we believe the numbers will hold up. And as such, these are great entry levels to add on to some of these names.
Any other sector or theme that you'd like to highlight, which is attractive now after the correction?
So I think broadly the CapEx theme remains interesting. I think what we have seen is that hard assets will continue to see fairly good earnings growth, whether it's power, infrastructure. I think with the current geopolitical scenario, defense remains a must-have kind of a sector in your broader portfolio. So I think that's a theme which will come back. We have seen almost 6 quarters of correction and consolidation, and a lot of valuation froth has gone away from the CapEx theme. And we believe that incrementally that sector will start to do well. If you look at healthcare, I think that sector earnings remain unimpacted. Now, I think a healthcare space like hospitals, diagnostic labs and all will continue to see fairly robust earnings growth. And while there has been price damage, we do not see any significant impact on earnings. So some of those domestic oriented stories, even domestic formulations as a theme should continue to do well.
Where do you stand on private sector banks, particularly what we've seen in the case of HDFC Bank?
I think broadly, for tier 1 banks, we believe that the correction has made the entry levels fairly attractive. If you look at the credit growth, it has been holding on quite well. I think last fortnight we were looking at 12-13% kind of number. Even if there is some cool off and we remain 10-11% kind of system-wide credit growth, most of these tier 1 banks should deliver a mid double-digit kind of earnings growth. There is no sign yet of a credit cycle. We don't think this crisis can lead to widespread increase in NPAs and credit costs, and therefore we believe that the sector remains attractive for medium to long-term investors.
Yeah, got that. So a base case is that demand generally remains same. By the way, Varun, have you looked at the real GDP growth forecasts from Goldman today? They're at 5.9. I mean, when you get to the 5 handles, it's a little, and of course, it's all contingent on when the war ends. But that's not great, right?
So Prashant, as you rightly said, it's contingent on how long this lasts. So if I were to go back to COVID times, right? So let's draw a parallel. At that time, we corrected 40% from the peak, and within 6 months, the markets went back. And I think the dislocation this time should be much less severe than that. So fundamental way in which I would look at this crisis is that, even if your earnings are badly impacted for 1 to 2 quarters, if you do the DCA valuation of a company in its lifetime, that is a few percentage points of its overall value. And therefore, there is no reason for a lot of these stocks to correct 20, 30, 40%. So I think that's the fundamental premise. Yes, in the short term, will we see increase in fiscal deficit? Can crude oil prices and energy prices stay elevated for next 2, 3, 4 quarters? They can. And that will have some bearing on CAD, that will have some bearing on fiscal deficit. But I think a lot more than that has been penciled in.
Okay, got that. Thank you very much, Varun, for that. Appreciate it, and good conversation. Well, Hormuz is here with the spotlight on the top movers in the market. Hormuz, tell us more.
The kind of moves that you are seeing on the benchmarks, you'd want to put some of the spotlight on the beaten down names on the index. But start off with a broader market name first. NOSIL is one name that has been making waves over the last couple of days now. It's significantly off the highs of the day, still up around 4%. It's the second straight day of gains. It has gained in 7 out of the last 8 trading sessions. Now, in this 8-day period, the stock has gained well over 30%. And the volumes in the last 2 sessions have been the highest on record. And even in today's session, we have had more than 7 crore shares that have been traded on NOSIL compared to a 20-day average of just around 40 lakh shares. And 9% of those shares have been marked for delivery so far. And today's turnover is around about 2/3 of its free float market cap. The turnover has already crossed close to 1,300 crores among the most traded names on the small cap index in today's session. The index name I wanted to put the spotlight on is Asian Paints, and the biggest single day gain in the last 4 months now. Volumes, well, they've been okay-ish. 12 lakh shares have been traded. The 20-day average is around about 9 lakh shares, 8.5 to 9 lakh. Around about 40% of those shares that have been traded so far marked for delivery. The stock is below key moving averages. The stock had fallen to a 52-week low yesterday, and from there on it staged a bit of a rebound, is up around 4.5% today. And despite that, it's still down around 20% for the quarter so far between January to March, and it is turning out to be the worst period it had since October to December of 2023. And lastly, Alkyl Amines is the top gainer on the Nifty 500 today. This is the biggest single day gain since April of 2020, so the biggest move in 6 years. Volumes are the highest in 3 months, and the volumes have seen a very sharp jump after 2 p.m. It's almost a one-way vertical move upwards. 20 lakh shares have been traded so far on Alkyl Amines, most of which have come in the last 60 minutes. The 20-day average is only 41,000 shares, and 15% of those shares are marked for delivery so far. The stock is nearing its 50-day moving average, which is at 1483. This still remains below key levels, but the kind of underperformance that the stock has seen, even after this move, the stock is still down for the month of March and is now reported losses for 9 consecutive months in a row. Today's session, though, belongs to Alkyl Amines, 17% higher.
Thank you very much for that. That stock is down 37% in the last 3 years. So the underperformance is not just for the day or for the last 9 months. It's been underperforming now for the last 3 years now, 37% lower. But of course, as he said, the day belongs to Alkyl Amines. Some more stocks then, just to run you through some of the action that's taking place. On the way up, you've got Tech Mahindra building on gains. That's up nearly 4%. Buying emerging in Dr. Reddy's. Apollo Hospitals has been a big mover. Citi today added Apollo Hospitals to their focus list for Pan-Asia. So Apollo Hospitals has been higher. Pan-Asia focus list as a buy because they say this business, the hospital business, is structurally resilient. That's reason number one. A fast-growing pharmacy business with digital profitability in sight. And the third reason they say for Apollo Hospitals is valuations which remain below long-term mean on an absolute and relative basis. So Apollo Hospitals is a big mover. But Mangalam now joins in to get us the latest trends from the F&O space.
Well, less than half an hour to go for the market close, which means that this is the expiry run that we're seeing for weekly options expiry. The Nifty is doing extremely well, closing in on that 22,900 mark, meandering around that. A large part of the up move was led by some of the call writers who covered their positions by being caught on the wrong side. Now, the IT stocks and the Nifty Bank together doing well for the frontline index is holding well. The only couple of things that we need to watch out for from here on, the India VIX still at elevated levels of 25. Yes, it is off highs given the sort of move that we've seen already. But, it does tell you that maybe the up move that we are seeing is tentative and may not see a big runaway move until the India VIX cools off. So that's something that we will track. The other factor that would make bulls feel happier is a lot of these index heavies contributing to today's gains. HDFC Bank, L&T, Infosys, however, they've all been underperformers in the past. So does this rally mean that it's just a bounce off the lows, or there could be more from here on, is something that we will be tracking. As of now, ahead of expiry, the call which is most active is 23,000. Writers on that may not get a lot of premium at around 3 to 4 rupees for the next 20 minutes or so. So maybe there's some bit of punt buying which is taking place out there. So let's see how that pans out right now. The premium is all but eroded on the 23,000 call that expires in 20 minutes from now.
Absolutely. Mangalam, thanks very much for that. We'll take a break. We're back with a quick check on what's happening with dealing rooms. So Nimesh joins in for D Street Chatter. And of course, with some trading ideas coming up after that as well. Okay, well, D Street Chatter is the segment right now that we're going to focus on. Nimesh is joining in with what's the buzz and what kind of flows will we see when we get those flows? Will they correspond to this 400-point bump, Nimesh? What's the chatter?
Unlikely, Prashant. So it looks like today's pullback rally is more so of a short covering rally, and that to in the crude beneficiaries. So that's the overall feedback. Of course, IT has helped the markets or the Nifty to bounce back sharply. But from a flow perspective, my sense is FIs are still better sellers and better sellers into the large cap names. So I need to see what the data pans out. But at least the initial feedback in the morning was that the FIs are better sellers. It won't be that large as what we saw, 10,000 crore plus, but a decent sell number is a sense that I picked up from the institutional desk. As I said, a bit of covering into the crude sensitive. So those are benefiting in today's market. Even the broader market seems to be seeing a bit of a pullback rally. Yesterday was was a pure capitulation across the board, whether it's large cap, banking stocks, mid or small cap. I mean, looked like, yesterday there was a capitulation from retail HNIs, the smarter fund managers, smarter investors as well in the yesterday's fall. A bit of pullback from those levels clearly because of the noise that we're seeing in the global market with regards to the geopolitical risk. Still, the risk persists, so not sure whether that's an end to it. But today's pullback seems to be more of a short covering rally and a bit of relief into the broader market names as well, because they looked extremely oversold.
Yeah. So this is mostly covering, and that too oil sensitives more than anything else. Nimish, in terms of stocks, what's on the list?
Well, the first on my list is Linde India. We normally don't talk about this name, but it's buzzing in trade today. Very sharp recovery from yesterday's fall, up 8% last when I checked. Volumes also picked up. And for Linde India, the very near-term trigger would be the independent valuers report with regards to a potential merger between Praxair and Linde. That's been a long-drawn battle with the minority shareholders. As I said, the very near-term trigger would be as in when the independent valuer report comes out in the public domain. So that's the trigger for Linde India. The second name is Avenue Supermart. It's been consolidating in a very narrow range of late, but my sense is that the large selling from a domestic mutual fund seems to be largely over. And at these levels, a leading long-only FI has an active buyer of late in Avenue Supermart. And the third is CG Power. A big fall yesterday, a bit of recovery in today's market from the lows. And even in CG Power at current levels, at least some of the domestic mutual funds are actively buying into, and there are buy flows as well in today's market.
Okay. This the specific chatter which Nimish is picking up. Nimish, thanks very much for that. And more on some of these names a little later. Mitesh is with us with what he wanted to do. And Mitesh, what do you have?
Well, one, we haven't got a proper sign of a reversal, but it's not that the market is breaking down. It's holding out nicely. So we'll go with some long positions, given the fact that this could be the first day of bounce back. So KEI Industries is a BTST with a stop at about 41.09 for targets of 41.80. And the other stock, which I like, that's BTST on Lupin, which is closing above its all short-term averages. So BTST here with a stop at 2320 for targets of 2350.
Thank you very much for that. GMR Airports, that's the other one in focus. Kotak Institutional Equities has written a note on it. Vivek joins in with the details.
Well, that's right. So GMR Airports, one of the sharp movers in trade today, a very strong recovery from the recent selling pressure that the stock has seen. Kotak Institutional Equity has come out with a very interesting note. They've reiterated their buy stance. They maintained their target price at 112 rupees a share. They've gone ahead and addressed three concerns that they believe has led to the recent sell-off. Number one, the ongoing Middle East or West Asia conflict. Number two, impending tariff outcomes from upcoming control periods of airports that it operates, as well as competitive airports. And number three, the potential competition as far as the Jewar Airport is concerned. Now, along with that, Kotak also says that the stock at this price, or the CMP, is not really factoring in any upside from positive outcomes of any of the legal proceedings that the company is currently embroiled in. Now, as far as the West Asia conflict is concerned, Kotak has gone ahead and tried to quantify the impact. They're saying anticipate close to a 7% cut in EBITDA in FY27, of assuming a one-quarter loss as far as passenger volumes from West Asia conflict is concerned. They say that over time, the real impact would be limited to just around 2%, given the fact that in the coming month, you will actually see a tariff hike, given the fact that the new control period comes into account or comes into effect. Now, along with that, they're talking about the control period tariff orders. Basically, for every 5 years, there will be a tariff that comes across. And they say that tariff orders for Jewar as well as Hyderabad is unlikely to impede the EBITDA growth. And last thing, remember, GMR is fighting various legal cases, and they believe that the market actually is not taking into account the fact that GMR is favorably placed to win a lot of these legal battlings, key amongst them being the TDSAT order on the DIL benefiting from the hypothetical RAB. So this is something that they believe can lead to further upside as far as GMR Airports is concerned.
Thank you very much for that. But back to talking about the war. It's entered its fourth week. And every time, Prashant, we speak to investors and we ask them about how long this war is going to go on. And they said that with the midterm elections looming, they doubt that Trump would want a prolonged Middle East conflict, right? That seems to be one of the drivers. So how, you've done some analysis on the approval ratings.
Yeah, just simply putting up this data. I mean, it's nothing. It's just polling numbers for US presidents. So in that sense, there is no real analysis. I mean, and this is the thing, right? We've been talking about how the real trigger for winding down this war may be in America, right? With how popular or unpopular this war is. And as this data really tells you, I mean, there is no war bump. Usually when there is, and we've seen this because, I mean, we've seen many wars over the last 25, 30 years. When a war begins, there is this general, bump that you get, this nationalistic fervor, rally around the flag kind of sentiment. But that is completely absent. Let me just tell you, right? This is the, what you see in yellow here is the approval rating for US presidents 1 month before the conflict begins. And this is 1 month post the war starts. I mean, the conflict really sort of kickstarts. Of course, it's not been one month now, but this is the latest data available. You just look at this. The last 3 instances, which you can see, this is the Iraq War, 2003. George Bush had 57% ratings. Its presidential approval rating went up to 69% a month after the war began. Back after 9/11, George Bush went from 57 to 89, right? There was tremendous amount of patriotic fervor and kind of sort of, support for the war, etc., etc. And that is George Bush Sr. Back in 1990s, the Gulf War period, 60% a month prior to that particular conflict. It went up to 74%. And now you look at this one, which is the Iran war for Donald Trump. I mean, his approval rating was already middling at 44%. And now that number is at about 42% or so. And that's the reason why I'm saying, I mean, unlike previous conflicts, and the data bears that out, there is no popular support for the conflict in the US in that sense. Gasoline prices are what they are. A lot of the MAGA base, which is Make America Great Again, America First, that support base is also a little angry and miffed, saying, well, this was supposed to be about getting troops from everywhere around the world back to the US and not starting new conflicts. So that's what I'm talking about. Politicians, give and take, everything, I mean, are the same, right, around the world. At the end of the day, they want to remain popular. They want to win elections. And this is not a popular endeavor which we are seeing, with regards to the conflict in the Middle East. I'm not saying based on this data you should believe that this conflict can't go on for another few weeks or perhaps even a few months. I'm not saying that, but I'm just saying that bear this in mind, that and this kind of, I would say, does tally, and this would perhaps be playing on the administration's mind as well. And we, of course, saw that tweet from President Trump. So while we watch the headlines, but remember, the underlying driver in terms of when this conflict winds down may not be actually in the Middle East and what really happens and who's got the upper hand, etc. It may be domestic pressures back home. Back to you.
Well, indeed, sustained low ratings could be a factor in deciding this Middle East strategy. Thank you very much, Prashant, for highlighting that. Let's invite Sudeep Bandyopadhyay. We've got about 12 minutes to go before we wind down trade. Looks like the Nifty is going to end comfortably with a gain of about 400 odd points, holding above 22,900. Sudeep, how would you read today's rebound? Do you see conviction in the up move today? Are people interested in buying after the ferocious correction of 10% since the start of the conflict, or it's still a bit iffy and skeptical?
It's still a bit iffy and skeptical. I think, today's rally or today's upward movement is definitely on the back of, probably we are seeing the beginning of the end of this conflict. But people are not sure as to how things are going to pan out, because we have seen what happened yesterday after President Donald Trump's tweet. Came tweets from Iranian administration and others, which kind of denied any negotiation. But I think there is something happening definitely, and that's the reason why market is expecting that probably this is the beginning of the end. And to an extent, this is why a bit hesitantly, but definitely there is some buying back in the market. At least the the ferociousness of this selling by the FIIs definitely has reduced. Also today being that Tuesday with the FNO closure, so there is some short covering happening, which is also contributing to the kind of mild rally which we have seen today.
And we've got back-to-back expiries because Thursday is a holiday. Thursday's expiry is now tomorrow. By the way, Dow Futures is down nearly 150 odd points. Sudeep, stay on. We need to slip into a very short break. We'll come back and continue our conversation. Welcome back. Winding down today's trading session in conversation with Sudeep Bandopadhyay. Sudeep, NOSIL is popping up on the price and volume charts. Yesterday, there was very large price action. Today, it's price and volumes, price less so, 1.5%, but very, very large volumes. Any idea what's happening here?
Overall, we have been positive again and again. We have been mentioning this, that this is one sector which was a completely bombed out sector. Last 2 years, the results were horrible. But if you look at the Q3 numbers, green shoots were clearly visible. The original logic of China plus one remains very much valid even today. And on top of that, I think the trade deals which we are in the process of executing with EU, as UK, as well as hopefully USA, will definitely help the business. As far as some of these countries, including Mosul, is concerned, close to 50% of the production is exported to multiple markets, and these trade deals definitely help the cause. Overall, I think it's good time with orders flowing in from multiple geographies, and the criticality of Indian these manufacturers in the global supply chain is becoming more and more relevant. Of course, Mosul is in a specialized niche segment, which demand is continuously increasing because of replacement of China, and that's what is happening generally.
TBO Tech is also seeing buying. This is a global B2B travel distribution platform. And perhaps it's been impacted on account of the airspace closure, some flight disruption. Stock today, though, is seeing some buying. It was weak over the last couple of trading sessions, but today on the back of that Motilal Oswal note, TBO Tech is seeing some interest. Apart from that, Sudeep, a lot of these platform companies, so whether it's Urban Company 3.5% up, Meesho 6%, Brainbees Solution for the last 3 trading sessions has seen unusually high volume activity. Any positive bias towards platform companies? If yes, which one? We've spoken about Eternal in the past, but if you want to talk about any others.
Eternal, definitely, so I will exclude that. The other platform company which I like for quite some time has been Delivery. Unfortunately, it didn't perform as per the promise which it had shown initially, even before listing. But I think things have started improving there, and the business has stabilized. The recent acquisition which they made is also going to be revenue accretive and profit accretive as well. So we are definitely positive on Delivery. As far as Grow is concerned, again, we have been very positive on Grow. Capital market, because of all of the turmoil which is happening, it was under pressure. But we believe that there is a secular tailwind behind Grow, and this is going to go places. Look, they're the largest in terms of number of customers they serve on the equity segment, but the opportunity for them to expand on loan against shares, margin funding, as well as wealth management, I think it's significant with the customer base they have. So we are looking at different revenue drivers and different profit generators going forward. So we are positive on that.
Yeah. Sorry, which is the pick out of the lot, Sudeep, you said?
I said, Grow. We said that Delivery. These two, apart from Eternal, of course.
Yeah. Have you looked at HDFC AMC in this current fall?
I did. While we overall like the AMC space because financialization of savings is real, but I think the valuation still looks a little rich as far as most of these AMCs are concerned. So we would rather play the financialization of saving through some of the companies like a Grow or even the exchange space, which we believe will get even more exciting when NSE comes for listing in the near future.
Sudeep, we'll end today's conversation for now. Thank you very much for joining in. We'll continue chatting with you in Markets Forward. Winding down today's trading session, it's a good one. The Nifty is ending above 22,950, a gain of 450 points. Sensex has surged nearly 1,500 points. The key driver was that 5-day ceasefire that Trump announced when it comes to attacking the energy infrastructure of Iran. But we had a gap up opening. Markets built on that. And that, I think, is a positive sign. But this comes after many, many days of consecutive losses from the start of the conflict. Benchmark indices were down nearly 8%. Run you through the big movers. Tata Motors right on top. That's passenger vehicle, 6% gain. Our stocks benefiting from the decline in crude prices like an Interglobe Aviation and Asian Paints higher in trade. L&T was a big mover, 5.5%. Eternal has been seeing buying for the last couple of trading sessions. NBFCs like Bajaj Finance, Shriram Finance, higher in trade. Ultratech Cement up and about. HDFC Bank, which has appointed external lawyers just as a proactive step in terms of corporate governance. HDFC Bank saw some buying. On the way down, some PSUs like Power Grid weak. Coal India also, I think, had a cut. That's the top loser, 3% lower on Coal India. And Cipla, Sun Pharma, capital rotating out of these defensive pharma names, which did well. And now it's moved on to some of these high beta names. So all in all, it's a good close. And the Nifty ending about 100 points shy of their all-time after intraday high levels, but still very, very strong, 2% gain.
That FBI number, Rima, later today when it comes, right? Nimesh was saying, well, his sense is it's going to be not great. I mean, this is largely short covering, etc. But we'll see when that comes out by about 5:30 or so, what that really looks like. But yeah, I mean, this is a good close and looking down and out yesterday, and we're back up a little bit. So actually, I think we are ending where we started. Let me just quickly see. The open was 22,878, and we're higher, right? We're at about 22,960 or so. So this is 50, 60 odd points above where we started this morning. It's not a bad outcome. At one point, it looked like we'd be left with little on the board. At one point, we were up just 1% on the day. We end with just almost 2% right there on the index. So 4:1 in terms of advances to decline ratio, and lots of action in the broader market, broader space, etc. So that's the market for you this Tuesday. Back to watching headlines, watching social media handles and whatnot, right? I mean, that's what tracking markets has come down to, but it is the way it is for now. It's a wrap from all of us here. Thank you very much for staying with us. More coming up on the other side. Markets Forward will prepare you for tomorrow.
Markets hold on to early gains with benchmark indices gaining close to 2%. Nifty settles about 22,950 levels. Midcaps outperform. Crude oil back above $100 per barrel as fading hopes of a Gulf de-escalation keeps supply concerns elevated.
HDFC Bank appoints law firms for a fact-based assessment of issues flagged by the former chairman, Atanu Chakrabarti. The move is seen as a proactive step to quash speculation.
Asian Paints announces price hikes of 6 to 8% starting April 10th. Berger Paints will also follow suit after input cost rises 12 to 13%. Berger says industry will pass on cost increases even as volume stays strong. Paint stocks gain.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear you up for the next trading day. I'm Ekta Batra and with me is Vivek Iyer. Well, Vivek, it turned out to be a session where we did see some amount of recouping of the losses in terms of the market. So we had the Nifty, which ended above 22,900. In fact, it was a second half rally which managed to sustain. We had the mid-caps also, which were up around 2.6%, with what stood out was a positive sustained advance decline ratio. So over 3,000 stocks advancing to around 1,400 stocks declining on the Bombay Stock Exchange. Let's see whether this enthusiasm continues, because we have some way forward to recoup in terms of further losses for the markets. But today was definitely a good day.
Good afternoon, Ekta. Absolutely right. A little bit of a wobbly market in the first half, but in the second half, we did see significant buying emerge. And on the back of that, advance decline ratio, like you mentioned, was very strong, especially in the second half of the trading session. Remember, it was also expiry day, so you did see some rollover positions. What did well? Well, most of the beaten down names, capital goods stocks, especially those with exposure to West Asia, most of those names actually saw short covering as well as a bit of a relief rally, and those are stocks that led the markets higher. But we've got you covered for the next 20 minutes with all the big news and the key developments on Dalal Street, top corporate voices and events to track ahead. Let's kick off the day's market action, and we have a lineup of what's in store for you today. We'll start with the top movers and shakers of the day with Hormuz. We'll decode why HDFC Bank, paint stocks and seller world were up in trade today. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session.
All right, well, on to our first segment of the day. Hormuz joins in from the big wall with all of the top movers and shakers of the day. Hormuz, over to you.
Some respite from that entire red screens that you've become accustomed to seeing over the last couple of weeks now. And leading the rebound were the stocks that led the index lower as well. And HDFC Bank, after being battered for the last 4 trading sessions, emerged as one of the top contributors on the index today, 3% higher. L&T, of course, the West Asia exposures of 5% higher in today's session. ICICI Bank did well, as did Bajaj Finance. Kotak Mahindra Bank, of course, the upgrade coming in from Nomura earlier in the day, but most of the other names falling to 52-week lows and then seeing a rebound in today's session. Oil marketing companies had a fairly decent day, barring Indian Oil Corporation. Both HPCL and BPCL did fairly well today, despite the downgrade that came in from Goldman Sachs earlier. HPCL was up 5.5%, BPCL was up 4%. Indian Oil too recovered from the lows of the day, managed to end above the flat line. Stocks that gained in the broader markets on the back of strong volumes, and BLS International and Alkyl Amines were two names that saw double-digit moves in today's session. BLS International was up 17%, Alkyl Amines gained 14%. Sammaan Capital, one stock that has remained in the F&O ban through and through the March series, also saw gains on strong volumes. And Linde India did well today, 9% higher on strong volumes as well. The stocks that bucked the trend, if you could call it that, in today's session, that Phenolics Industries at one source, the losses not significant compared to the gains. And Coal India, of course, that cautious note coming in from Nuvama earlier in the day, ending 3% lower. And one segment that stood out today were the platform companies. After the surge that was seen in the second half of the trading session, Eternal did well for itself, 5% higher on the stock, as did Urban Company. Still continues to languish around its issue price, though does Urban Company, and Meesho as well, down almost 40% from its post-listing high, but today's session saw gains of around 5.5%.
Well, thank you so much, Hormuz, for joining us and taking us through all of the top movers in the session today. Well, to take the discussion forward, we are now joined by Sudeep Bandyopadhyay of IndiTrade Capital and Jay Thakur of ICICI Securities. Good afternoon, gentlemen, and thank you so much for joining us. Well, Jay, let me come across to you first. Nifty almost has seen a recovery of almost 400 points in the session today. Do you feel that this particular rally can sustain, or do you feel it continues to remain a sell-on-rise market?
Now, I would say that today is the first sign that we have seen this IVs falling after a couple of days of rise in IVs, which we had seen. I mean, it had gone to almost like 34 in yesterday's trading session. It was last 1 year's high. Even if you look at the India VIX, then it had gone to 27, 28, and now it's back. We almost 6.5% is back to 24.9 levels now approximately. So yes, the IV is coming down, cooling off ahead of the monthly settlement. I mean, tomorrow is the Sensex monthly settlement, and next week Monday we've got Nifty monthly settlement. So ahead of that, when you have index shorts of FIs with almost 2.45 lakh contracts, and with this kind of an announcement from the US president, definitely there could be some short covering in place. At least if not, then market would consolidate or take a pause in the overall fall, which would definitely get some relief in the IVs or the India VIX, and market may thereafter trade within the range. Now I think that 22,400, that is yesterday's low, approximately, VIX should be considered as a short-term support, and below that we definitely have 22,000 for this March series, wherein you have the highest put build up as well. So that range definitely till those levels are held, you can expect this bounce back to continue. So if at all there is any dip towards the levels of say 22,700, 600 should be utilized as a buying opportunity in anticipation of some further short covering, at least in the levels of 23,500. The gaps that you have seen, Vivek, on the daily charts, I think those gaps could be filled at least in the near term. 23,500 cannot be ruled out.
Okay, all right. Well, Sudeep joins into this conversation as well. Sudeep, afternoon. Well, it was a good bounce back for the markets today, but are you convinced of further upside?
Well, it's extremely difficult to predict, because to a great extent, this is on the back of the fact that what announcements came yesterday evening from US President. Of course, it was kind of partially negated by the Iranian announcements, but still the market is sensing that this is probably the beginning of the end of the war. It takes some more time, obviously, but I think the process for ending the war has started, and that is pretty reassuring. Also, on top of that, today we had the Nifty expiry, so a lot of short covering did happen. So combination of these two factors led to some amount of recovery in the market. But to say that we are we are clear now and we will keep moving upwards, I think it'll be extremely risky, because there are still many challenges ahead before the geopolitical situation stabilizes, the oil scenario improves, and the Strait of Hormuz, coming to the straight to the point, actually becomes normal. Movement becomes normal. So we have to wait and watch how things unfold over the next few days before we can predict. Of course, this fall gave an opportunity of accumulating from a long-term perspective, and probably some of these recoveries will give confidence to the investors to start buying at different levels, taking opportunity of this overall dip.
Well, thank you so much, Sudeep, and request both of you to stay on with us. Whole lots of questions coming your way. But Asian Paints was one of the top movers today. Remember, the company announced a 6 to 8% price hike across its portfolio, which will be implemented in 2 phases starting 10th of April. Mangalam joins in with more details.
Asian Paints was indeed higher in today's trading session as the companies announced a 6 to 8% price hike across their portfolio, broken up in 2 phases. First one on April 10th and thereafter on April 21st, typical of how it works in the paint industry to smoothen out the dealer and channel inventory, at the same time optimize for both volume as well as value growth. The biggest reason for that obviously is the increase in raw material prices, in logistics costs and packaging costs on account of the current geopolitical uncertainty, and the companies managed to do that. Remember, all the other companies have already announced price hikes to the tune of 2 to 3%. So Asian Paints to that extent is one of the latest to go ahead and make this announcement. In fact, we also spoke with the management of Berger Paints, and they said that for every $1 increase in crude, the paint prices increase, or there's a 30% pass through for paint prices. So far crude has increased by about 40%. Their raw material basket has increased by about 12%. They've effected some price hikes earlier as well, and in 2 phases they are coming on the April 30th, and another one likely to be announced for later on April 9th as well. All of this along with the fact that these stocks had corrected in the wake of the US-Iran issue and the rising crude prices gave some support. The markets did well and these stocks bounced today.
Well, thank you so much, Mangalam, for joining in. And, price hikes across the entire sector is what we are bracing ourselves for. Remember, Berger Paints too will hike prices in a staggered manner. Select products will see a 1.5% price hike starting tomorrow. Another 2% hike from April 30th. The company has also indicated for a further price hike that could be announced on April 9th.
Okay, all right. So that's on Asian Paints as well as Berger Paints. But What would your thoughts be on this, Jay, in terms of the stock and chart check for both Asian as well as Berger?
I think Asian relatively looks better at these levels, although I would say from the short covering point of view, because see, we have seen good amount of short that has got built up here in Asian paints, definitely on account of rising crude oil prices, and obviously earlier it was because of the competitive or increasing competition within the paint market, and thereafter we have seen since past 1 or 2 months the rise in crude oil prices have definitely hit the margins of Asian paints. It's good that they are passing on a bit to the consumers, which will definitely not impact their margins that much. But it seems to be quite oversold as of now. We have seen a positive divergence on the daily charts. The stock has been showing some resilience, I would say, since 9th of March. I mean, when the low on the Nifty was made. Since then, if you see, Asian Paints has not closed below levels of 2150, 2180. Although Nifty post that, I would say must have closed on 3 to 4 occasions below the lows of 9th of March, and is substantially lower than those levels. But still, Asian Paints has managed to hold on to those levels, clearly indicates that there is a good chance of short covering the kind of positive divergence which we see. And the way, crude oil prices as well, I mean, every time it has attempted to move beyond those levels of 119.20, it has failed that because of some of the other news or reasons. This time around too, we saw a sharp fall from those levels wherein the news came in yesterday. So all of this clearly indicates that now from here on, if crude prices have to move, it has to clearly close above the levels of 120, else more or less the pain is over out there. It can be some consolidation. So in that case, short covering until the levels of 2350, 2400 can't be ruled out. Hence, I think the risk to reward in the short term is on the long side.
Well, Sudeep, what is your view as far as the paint space is concerned? While they were grappling with the entrance of Grasim, we are now grappling with much higher input costs. So where do you think the sector is headed from here on? Any top picks here?
Well, I think scenario was very, very challenging till some time back, even without this Gulf, the West Asia war starting, because the competition had become very, very severe there with the entry of multiple new players with large pockets. So the space was really, really challenging. With the Gulf War, obviously, this prices, raw material prices have gone up somewhere between 12 to 15%. We estimate the raw material basket price has gone up. So obviously, they will need to take price hikes, and pretty much that's what they're doing. And this is a good sign. This clearly shows that they are confident about demand. So they are trying to pass on at least a part of the raw material cost increase to the customers without waiting any further. And I think this should stand them in good state, because the predictions, the way they are, that oil prices probably will start coming down once the West Asia issue gets resolved. And if that happens, I don't see them rolling back prices. So this incremental price, which they are now taking, may stand them in good stead in terms of their margins as well as profitability going forward. But the competition remains strong, and we do like the leader, Asian Paints, definitely. And though they have started losing market share to competition, but still, I think undoubtedly, based on last quarter results, we are confident about Asian Paints.
Okay, all right, confident about Asian Paints, but thanks, Sudeep, for that. The other stock which has been in focus and did manage to curtail its losing streak today is HDFC Bank, which has said that it appointed an external law firm to examine the reasons cited by its former part-time chairman, Atanu Chakrabarti, in his resignation letter. The bank said that the firm will submit a report after investigating the concerns. HDFC Bank maintained that Chakrabarti did not mention any practices that were not in congruence with his personal values and ethics. Well, in that case,
earlier today, our colleague Yash, he had an exclusive news break, and shares of Cello World moved higher after that particular CNBC TV18 exclusive. We reported that the promoter is exploring a sale of a controlling stake in the company. Yash now joins in with more details. Yash, are we likely to see a change in ownership of Cello?
Well, that's exactly what sources are indicating to CNBC TV18 at this point of time. The promoters of Cello World hold about 75% stake in the company. What we've been given to understand from our sources is that the promoters of the company are exploring a transaction under which they are looking to sell a controlling stake, which means more than 50% stake in the company, that is Cello World, and continue with the balance 24 or 25% in the company. What we've been given to understand is that feelers have been sent to large private equity players for the sale of this 50% stake or controlling stake in Cello World. Private equity players like Kedara, Blackstone, Temasek, Advent and Amundi PE have been sounded off when it comes to this particular transaction. Also, what we've been given to understand is that these conversations at this point of time are at an early stage. Bankers, though, have been appointed for running this particular transaction. We've reached out to Cello World on this particular development. A response from the company still remains awaited.
Okay, all right. Yash, thanks very much for that. So that's on Cello World, which was in focus in today's trading session. But Sudeep, wanted your quick word on HDFC Bank. Do you think this is possibly going to assuage the investor concerns, if any, around the governance issues?
Yeah, to a great extent. I think this is an excellent step. It definitely projects the confidence of the management in the existing practices, and an independent law firm coming out and doing a review of the the governance practices is definitely a good step, and it will be a vote of confidence for the stock. So I think this is a good step, and obviously the investors will be happy about it. As far as the bank stocks are concerned, I think even at this stage, we do prefer PSU bank stocks. So our preference will be towards an SBI vis-a-vis HDFC.
Okay, all right. You prefer SBI over HDFC Bank, so that's the word coming in from Sudeep. But one stock which I was looking at today was Apollo Hospitals. It gained in trade after Citi has come out with a positive brokerage report. In fact, they have a buy with the target price of 9,600 rupees on the stock. They've added it to its Pan-Asia focus list as a buy. Apollo remains a preferred pick in the Indian hospital space with a positive stance, which is predicated on following factors. First, a structurally resilient hospital business, a fast-growing pharmacy business with digital profitability in sight, and valuations, according to them, which remain below long-term means on an absolute as well as on a relative basis. So that's the word coming on Apollo Hospitals. Quickly, Jay, would you have a call on Apollo Hospitals on the charts?
That looks positive, definitely. In fact, I would say one thing that whenever Nifty recovers, this has been always an, either it performs or matches the returns of the Nifty, or maybe outperforms the Nifty as well. And this time around, it has in fact reversed from the 2 sigma levels on the lower side, 61% retracement of the previous rise as well. So it can inch towards the levels of 8,000, 8,200. So far, we have seen the healthcare or maybe pharma and healthcare as a sector, which has been outperformed the overall fall in the market. I mean, along with the Nifty Power and Nifty Metal as well. So these are the 3 indices I would say that have already outperformed the markets. And Apollo has always been, as I said, one of the outperformers whenever Nifty bounces back. So definitely on the lower side, I would say that 7250, 7300 on an immediate basis should be acting as a support. 8,000 to 8,000 plus levels can be seen in the near term.
Okay, thank you so much, Jay, as well as Sudeep, for joining us, giving us your view on the markets, as well as various individual stocks, as well as the sectoral views. Well, with that, it's time for a short break. We'll get you the top corporate voices along with the key market events to watch out for on the other side.
Welcome back. You're still tuned into Markets Forward on CNBC TV 18. Well, on to the corporate voices of the day. Berger Paints MD has said that the spike in crude oil prices since the West Asia war has increased costs by 12% and said that the industry will pass this on to customers. Despite this, he expects a double-digit volume and value growth in March and will temporarily gain market share due to lower price hikes compared to, say, Asian paints.
And Titagarh Rail Systems said that the new joint venture with BHEL is a part of the 24,000 crore rupees Vande Bharat order. The company will handle maintenance of Vande Bharat trains for 35 years. The company also expects to supply 3 to 4 trains in FY27 and 12 to 6 trains thereafter annually.
Okay, all right. And before we wrap, we'll bring you some key market events to watch out for. Riya Bhatia is here with all of the key events. Riya.
Well, yes, let's start off with the US first. They will be coming out with the crude oil inventory data, CPI data to come out from the United Kingdom as well. The Bank of Japan will be releasing the minutes of its January policy meeting, and ECB Chief Lagarde will be giving her annual speech tomorrow as well. Moving on to India, though, IREDA as well as TVS Motors will be holding board meetings to consider a dividend. And apart from this, LIC Housing Finance, REC, Forgings, NHPC and HFCL, all of these will be holding board meetings to consider fundraising options. Lastly, also keep an eye out on the all-party meeting that the Government of India has called tomorrow at 5 p.m. to discuss the West Asia crisis.
Well, thank you so much, Riya, for joining in and giving us all of the key market events to watch out for in tomorrow's trading session. And also, we will be keeping an update as far as the Truth Social handle is concerned to see what Donald Trump has to say. But with that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: no signs of de-escalation despite President Trump's claims of talks with Iran. U.S. and Israeli strikes target Tehran and other cities. Iran fires a barrage of missiles at Israel and Gulf nations after rejecting Trump's claims of talks as fake news. But President Trump insists that Iran wants to settle. Crude oil prices climb as optimism fades over a possible de-escalation in the Gulf. Brent crude back above the $100 mark. Bahrain floats a draft resolution at the UN Security Council to authorize the use of all necessary means to protect commercial shipping around the Strait of Hormuz. Stocks slide across US and Europe after a relief rally yesterday. Gold prices remain in bear market after declining over 20% from record highs. Markets bounce back after yesterday's brutal sell-off. The Nifty ends above 22,950. Broader markets outperform. All sectoral indices close higher. The rupee ends at 93.87 against the dollar. HDFC Bank appoints a global and a local law firm to review the abrupt resignation of its chairman Atanu Chakrabarti. The move is aimed at quelling speculation. Chakrabarti stepped down after saying some practices of the bank did not align with his values. Facing prosecution over a 40,000 crore rupee bank fraud case, Anil Ambani writes to the finance minister, asks if fugitives like Sanjay Saraf can settle pending cases. Why not me? Seeks a time-bound structured settlement of dues similar to the case of Sterling Biotech promoters. The National Company Law Appellate Tribunal refuses to stay the implementation of Adani's 14,000 crore rupee resolution plan for JP Associates. Also clarifies that any action will be subject to the final outcome of the case. This comes after Vedanta challenged Adani's bid, arguing that its offer is superior. Delhi's Chief Minister Rekha Gupta tables a 1 lakh crore rupee annual budget with a focus on welfare and infrastructure. Education gets the highest allocation of over 18% of the total outlay, but this is still lower than the 25% spent by the previous AAP government. The Supreme Court rules only Hindus, Sikhs and Buddhists can claim to be a member of the scheduled caste community, upholds the Andhra High Court order which ruled any person converting to any other religion, including Christianity, cannot seek benefits as a scheduled caste community member. 66 people are dead and dozens injured after military aircraft crashes in Colombia shortly after takeoff. 125 people were on board. The cause of the crash is under investigation. UP's Chief Minister Yogi Adityanath backtracks after signing a 25,000 crore rupee MOU on artificial intelligence with a little-known company called Pooch A.I. Chief Minister clarifies the MOU is not binding and promises a detailed due diligence. Well, straight to the top story this evening. No signs of a real de-escalation despite President Trump's claims of talks with Iran. Missiles and drone strikes continue across West Asia. Now, Iran intensifying its strikes on Gulf countries as Israel after rejecting Trump's claims of talks as fake news. The Defense Ministry of Gulf nations said they continue to intercept Iranian drone attacks overnight. Saudi Arabia's Defense Ministry also said it intercepted and destroyed at least 5 drones over its eastern region. At least 21 people have been killed in Gulf countries since the conflict began. A barrage of missiles were also intercepted in Israel's capital city of Tel Aviv. However, 3 were injured as missile debris landed in a crowded street, setting several cars on fire and damaging residential buildings. Explosions also shook the central area of Tel Aviv. However, no deaths were reported. Meanwhile, Israel also continued its strikes on Iran and Lebanon as Prime Minister Netanyahu maintained that the attacks will continue until a deal is finalized. Netanyahu has maintained that strikes will curb missile and nuclear program and damage militant group Hezbollah. He added that President Trump told him, and I quote, "There is a chance to leverage battlefield gains into an agreement that realizes the war's objectives," end of quote. Israeli defense officials claim they've destroyed the intelligence headquarters of the Iranian Revolutionary Guard Corps and Iran's intelligence ministry. The attacks on Iran have killed over 1,500 people so far. Explosions also continue to rock the Lebanese city of Beirut overnight. The Israeli military said that strikes killed 1 commander of the elite Quds force of the IRGC. The Lebanese military said that 10 people were killed over the past 24 hours on account of the strikes. The death toll in Lebanon is now close to 1,100. Amidst the strikes, President Trump continues to maintain that Iran wants to make a deal.
To determine whether a broader agreement can be reached, we've had very good discussions, very, very good discussions. And you have to understand, I know my whole life has been a negotiation, but with Iran, we've been negotiating for a long time. And this time, they mean business. And it's only because of the great job that our military did is the reason they mean business. They want to settle, and we're going to get it done, I hope.
Well, that's President Trump with his claims on a deal with Iran. Oil prices, meanwhile, climbing after a sharp fall yesterday. Brent crude is back above $100 a barrel. EU President Ursula von der Leyen has urged the US and Iran to return to the negotiating table, calling for an immediate end to hostilities and the effective blockade of the Strait of Hormuz being lifted. She also condemned attacks on commercial shipping, warning of worsening global economic disruption. Countries are now moving to secure energy supplies. Japan has announced its largest ever release from the strategic oil reserves, with nearly 80 million barrels set to be released to refiners. The move comes as Japan, which imports over 90% of its crude from the Middle East, braces for supply shocks. Vietnam Airlines plans to cancel 23 domestic flights a week from April amidst rising jet fuel shortages. The country's aviation authority is prioritizing routes critical to connectivity and trade. Meanwhile, Bahrain has put forth a draft UN Security Council resolution seeking authorization for all necessary means to protect shipping in the Strait of Hormuz. While backed by the US and Gulf states, the proposal may face hurdles, with Russia and China holding veto power. Now, just 15 minutes before President Trump declared a de-escalation with Iran via a post on Truth Social, the S&P 500 and oil futures witnessed a surge in volumes. Hormuz decodes the unusually sharp movement in the markets and what could have led to that jump. Hormuz, take us through what transpired in that 15 minutes.
We all know what has transpired overnight with the announcements made by Donald Trump, but someone on Wall Street may have known this before any of us knew, and that transpired in just a 15-minute window. Now, at 6:50 a.m. local time in the US yesterday, there was a very sharp spike in the volumes of the S&P 500 futures and the oil futures at the same time. Mind you, this happened in pre-market trading. Now, pre-market trading, the volumes are generally illiquid and there is not much liquidity in the market. But at 6:50 a.m., take a look at this spike in the volumes that you see on the S&P 500 futures. Otherwise, it's an absolutely flat line. Then there you can see the volumes on the S&P 500 seeing a sharp spike at 6:50 a.m. There is nothing different in the oil futures as well. Now, on the West Texas Intermediate, if we flip the chart and we go to WTI, a similar spike is seen at 6:50 a.m. here as well. Otherwise, it resembles a flat line on the ECG. Now, it was at that point of time that there was a sign that something was transpiring on Wall Street that others did not know. This was at 6:50 a.m. Just 15 minutes later, Donald Trump puts out a post on Truth Social, and that post says that Iran and the US have had talks over the last 2 days, and as a result of which he has instructed the Department of War to not attack any of Iran's energy installations over the next 5 days. And this is what he said: to postpone and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Immediately after this post, there was a very, very sharp reversal in the futures on Wall Street. The S&P 500 futures were up almost 2.5%. At one point, they were down 1%. Crude prices, which were at elevated levels, fell anywhere between 10 to 15%. Of course, as more clarity emerged and the denial that came in from Iran, the markets cooled off as well, but then still ended higher. Oil prices ended lower.
Well, somebody on Wall Street clearly knew. Now, the Wall Street bouncing back after yesterday's brutal sell-off. The Nifty and the Sensex holding on to opening gains to close the day 2% higher. Nifty ending above 22,950. All sectoral indices ending in the green. The broader markets did outperform the blue chips. That's the story for you. The Nifty up by 400 points, 13 points higher on the Sensex, 1,100 points high on the Nifty Bank, and 1,300 point gain there on the Nifty Midcap. From currencies to the commodity markets, gold prices continue to be in bear market territory despite paring losses after a steep sell-off. Gold spot has now lost over 21%. It hit a record high in January, if you remember. Silver continues to recover and is currently near the $70 mark. Goldman Sachs has lowered its forecast for India's GDP growth in FY26 to 5.9% from 7% earlier. That's a sharp cut there. Goldman cites currency pressures and rising external risks. It has also predicted a 50 basis point increase in policy rates. Now, as the rupee faces sharp depreciation, that is the cut that's come in there from Goldman Sachs as far as India's growth estimate goes. Amidst rising tensions in West Asia, India continues to navigate LPG supply concerns. Consumers continue to queue up outside gas agencies in select areas across cities as online booking remains affected. The shipping ministry says 2 Indian LPG carriers have transited through the Strait of Hormuz. The ships are carrying 93,000 metric tons of LPG. One vessel is expected to reach Gujarat's Kandla port by Thursday, while the second is scheduled to reach New Mangalore by Friday. Defence Minister Rajnath Singh chaired a high-level review meeting as the situation in West Asia continues to evolve. Top defence officials met to review India's defence preparedness. The government has also called an all-party meeting tomorrow to discuss the ongoing conflict. Pakistan is reportedly trying to broker peace between Iran, US and Israel. Reports say Pakistan has proposed hosting the talks as early as this week in its capital Islamabad, involving senior representatives from the US administration and Iran. The White House has not confirmed whether Pakistan was acting as an intermediary with Iran. US Press Secretary Caroline Leavitt said the situation in West Asia is fluid and speculation about meetings should not be deemed as final until they are formally announced by the White House. Tensions in West Asia force Indian automakers to increase prices. Tata Motors has hiked its commercial vehicle prices by up to 1.5%. Eicher has also increased prices of its trucks and buses by up to 3%. The increase will be reflected from the 1st of April. Both companies have cited rising steel prices and higher input costs as their reason. It's not just commercial vehicles. Even paint makers and quick commerce companies have hiked prices across the board. Shilpa standing by with the details. Shilpa, what does this mean now for consumers?
Well, now it's probably looking like food bills, if you order online, will get more expensive because days after Zomato raised its platform fee, Swiggy has followed suit, hiking it to about 17.58 rupees per order. Now, this effectively brings it on par with Zomato, whose effective platform fee with GST also comes up to about 17.58 rupees. And this, at this price point, is a 7.5 times rise from when platform fee was first introduced at just 2 rupees in 2023. Now, analysts say that these hikes, which both players have rolled out in tandem, are less about demand and more about margins and profitability. Every 1 rupee hike adds roughly about 26 basis points to their take rates, and it directly boosts profitability. And even at about 15 rupees per order, the fee is just about 3% of the average order value, which keeps it low enough to not impact order volumes. So analysts say that for platforms like Swiggy and Zomato, it works as a buffer against rising costs like fuel or delivery payouts, while allowing margins to expand without relying solely on higher order volumes. But moving on, it's not just your food bill, right? Paint companies, they're also raising prices as crude-linked input costs rise sharply due to the West Asia conflict. Now, Asian Paints has announced a 6 to 8% hike in April in 2 phases, and this is across its segments. And this, remembers, in addition to a 2 to 3% hike that other paint companies had implemented earlier. Berger Paints too has hiked prices by about 1.5% effective tomorrow, with more price hikes anticipated by the end of April. Now, remember, higher crude prices are a negative for paint companies as crude derivatives form a key component of their raw material costs. And now paint companies are closely watching the crude oil prices to decide the further course of action through the next quarter as well. Back to you.
All right, Shilpa, many thanks for joining us. Now, HDFC Bank has said it has appointed external law firms to examine the reasons cited by former part-time chairman Atanu Chakrabarti in his resignation. Now, Chakrabarti stepped down after saying some practices of the bank did not align with his values. HDFC Bank has maintained that Chakrabarti did not mention any specific issues or specific reasons that were incongruent with his personal values and ethics. And staying with HDFC Bank, sources say the bank's executive Sampath Kumar may appeal against his termination. Kumar was fired last week after an internal probe found that he and 2 other executives were found mis-selling AT1 bonds to NRI customers. Furkan Morkhan has the details. Furkan.
So what we learn is that Sampath Kumar, the senior most of the 3 executives terminated for the mis-selling of AT1 bonds, will appeal against his termination. Kumar's appeal would be heard by the appellate authority, which in this case is the bank's board. Sources have told CNBC TV 18 that Kumar had no direct involvement in the alleged mis-selling. His was the case of oversight, sources say. Kumar was the group head of branch banking for the West and South zone of the bank. He was also in charge of the international banking operations for the bank. This is what landed him into the problem, as DIFC operations were his lookout. We tried to reach out to Bank and Kumar for the official response on the issue. None of them have commented till now. It would be interesting now to see what Bank's board will decide on the matter. Back to you.
Furkan, many thanks for joining us. In a setback for Vedanta, the National Company Law Appellate Tribunal has refused to grant a stay on the implementation of Adani's resolution plan for JP Associates. The company said that its bid of 12,500 crore rupees was the highest compared to all the proposed plans. Vedanta also added that its bid was at least 1,000 crore rupees higher than Adani's bid. The company further said the committee of creditors had not accepted the highest available value and declared Adani's lower bid as the winner. Now, facing prosecution over a 40,000 crore rupee bank fraud case, Anil Ambani has written to the finance minister asking if fugitives like the Sunday Saras can settle pending cases, why not me? That's the question he's asking the finance minister. He's also written to banks and has sought a time-bound, structured settlement of views. Ashmit is standing by with the details. Ashmit, take us through what Anil Ambani has said in his letter to the finance minister and what is he essentially proposing?
Well, what Anil Ambani has reached out to the finance minister is essentially seeking a Sunday Sara-like treatment for resolution of the outstanding dues. Bear in mind, in November of 2025, the Supreme Court had given its nod for closure of all liabilities, all cases against the Sunday Saras brothers for payment of 5,100 crore rupees. That's the same treatment that has now been cited by Anil Ambani in the letter that has been written to the finance minister. In that letter, Anil Ambani clarifies that, look, as far as the Sunday Sara settlement is concerned, qualitatively it's on a different footing. Sunday Saras were fugitives. Anil Ambani is not. Also then going on to say that this was a settlement, the Sunday Sara settlement, where the center, the banks, the investigating agencies, CBI, ED, regulators such as SEBI, the income tax department were all on board with that settlement. So with that in mind, Anil Ambani is citing that as a precedent, saying that similar treatment should also be meted out to him, to Anil Ambani. And to that end, he's also written to SPI as well as the Bank of Baroda with a proposal for, number one, setting up a lenders committee that will help crystallize the total outstanding dues payable by Anil Ambani as well as the companies that he's been leading. And secondly, to formulate a structured repayment schedule, a resolution schedule, which should lead to elimination of all pending liabilities. That's the proposal. That's what has gone from Anil Ambani to the finance minister and to the banks. The banks, however, are yet to respond to this proposition that has been floated by Anil Ambani.
All right, many thanks for joining us, Ashmit. We'll take a break, but coming up next, UP Chief Minister Yogi Adityanath backtracks after signing a 25,000 crore rupee MOU on an artificial intelligence project with a little-known company called Pooch AI. That and more when we return. Delhi's Chief Minister Rekha Gupta tabling a 1 lakh crore rupee annual budget with a focus on welfare and infrastructure. Education has received the highest allocation at over 18% of the total outlay, but this is lower than the 25% spent by the previous AAP government. Timsy standing by with the details of the Delhi budget. Timsy.
The Delhi government has unveiled over 1 lakh crore rupees of budget for FY 26-27 with a clear focus on welfare, infrastructure and future-ready sectors. This being the second budget presented by Chief Minister Rekha Gupta. Top of the spending chart is education with an allocation of over 19,000 crore rupees, the highest among all sectors at 18.64%. But when given a closer look, this is significantly lower than the close to 25% spend that was earmarked by their opposition Aam Aadmi Party in their last budget of FY 24-25. Some of the other key schemes announced by Delhi government today included free bicycles for class 9 girls, introduction of artificial intelligence in classrooms and medical rooms in all government schools. Healthcare follows closely with an outlay of over 13,000 crore rupees, coming out to be 12.57% of total outlay. And again, if compared to the last budget presented by Aam Aadmi Party, they had also kept the outlay in the similar bracket of about 13%. Some of the other major highlights of today's budget included the proposed medical college at Dwarka, along with launch of the Anmol scheme for newborn screening and early intervention. Infrastructure and transport continue to see strong spending by the government. The government also allocated 2,885 crore rupees for Delhi Metro expansion and 568 crore rupees for RRTS corridors. In addition, significant investments have also been earmarked for road redevelopment, flyovers and a new drainage master plan for the city. On the welfare front, subsidies remain a key pillar. 3,500 crore rupees have been set aside for electricity subsidy, while free bus travel for women continues with an allocation of over 450 crore rupees. The government has also announced free LPG cylinders during festivals.
All right, many thanks, Timsy. Now, UP Chief Minister Yogi Adityanath has backtracked after signing a 25,000 crore rupee MOU on artificial intelligence with a little-known company called Pooch AI. The Chief Minister clarified that the MOU is not binding and has promised detailed due diligence, saying this is only a preliminary first step. Rachna Dhanrajani joins us now with more details. Rachna, this came to light after the Chief Minister himself tweeted about this 25,000 crore rupee MOU. There has been a social media backlash with questions being raised about the company and its ability to execute on this scale. And now a fresh tweet coming in from the Chief Minister.
That is correct. But, you know, this could be one of the most ambitious and closely watched AI bets in India right now, because Uttar Pradesh has signed a 25,000 crore MOU with Pooch AI. Now, Pooch AI is a Bengaluru-based startup that is less than a year old with no disclosed institutional funding and is still largely unknown outside the tech circles. And the scale of the deal stands out immediately. 25,000 crore rupees is about 3% of the state's annual budget and more than 11% of its capital expenditure. And the vision is sweeping. AI parks, data centers, an AI university and an AI city near Lucknow. The government is calling this a step towards building an AI Pradesh. But the company at the center of this has emerged very quickly and pretty much out of nowhere. Pooch AI was founded in June 2025. It runs on WhatsApp, supports over 22 Indian languages and claims nearly 1 million users. Around 60% of those are first-time AI users in regional languages. Now, this is a segment, particularly when it comes to regional languages, this is a segment where global AI platforms have struggled to reach, especially reaching out to the masses. But beyond all this traction, there are gaps. No institutional funding, no known large investors, and no track record in executing projects at this scale, especially when it comes to physical AI, data centers and everything. Now, considering this is a government project, which one can believe would have had other companies in the running for, we have reached out to the UP government to understand the process, but haven't received a response yet. But at the center of this whole story is founder Siddharth Bhatia. He's a BITS Pilani graduate with a PhD from the National University of Singapore with research experience and stints at Google and AWS. He co-founded this company with Arjit Jain, an alumnus of IIT Bombay. Bhatia has also built a high-visibility social media profile, including a widely discussed attempt to bid for Google Chrome for $50 billion when his startup was reportedly at $50 million valuation. This, and along with a series of other viral campaigns, he has a strong social media profile. And the founder is known for more of those things on social media than his startup. Apart from that, just the contrast between the UP ambition and the company's current scale is what has triggered the pushback. On X, the announcement by Chief Minister Yogi Adityanath drew heavy criticism, and so the state government has now moved to clarify. Chief Minister Yogi Adityanath has said this is only an MOU. He's explained that MOU is a memorandum of understanding and is non-binding in nature, and any project will go through detailed due diligence, evaluation and approvals. He also said that if the company does not meet the required criteria, the MOU will be terminated. So for now, this remains a very large headline, an early stage company, a debate around whether ambition, credibility and execution can align. But what happens next will decide the direction of this story.
All right, Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. News will continue right after this. Stay tuned. We're back in a moment on CNBC TV 18 with the latest.
Hello and welcome to Commodity Champions. I'm Manisha Gupta, and the special show that we're doing today is all about the West Asia conflict and the impact that it has had on commodities, which we have seen continue to be very, very volatile. We have seen the West Asia conflict enter a fourth week, and if you look at the gold and silver prices, they have been quite volatile. Silver actually has come off quite sharply from its all-time highs of $120 an ounce to almost $68 an ounce today. It also has to do with the Indian markets, which have seen a sharper cut from an all-time high of 4,20,000 rupees a kg. We are trading at around 2,15,000 rupees a kg at this point in time. Joining us to take that discussion forward is Kishore Runwal. He's CEO at Anmol Jewellers. Mr. Runwal, hi, thank you so much for joining in. First of all, your sense on the very high volatile price moves that we have seen in case of silver, and how are you reading them? We'll try and connect with Mr. Runwal, but in the meanwhile, just let's go and talk about gold to Mr. Chandu Siroya he joins us from Dubai. Mr. Siroya, hi. What are you looking at in sense of gold prices?
Namaskar. Gold prices have been pretty unreasonable, I would say. We see 8 to 10% up and down, and we don't know how to plan anymore. And yeah, this has become actually a game for the punters, and it is actually a very dangerous game right now. We are at $4,401. I believe that gold itself does not have any strength right now because nobody is interested in it. It's a cost to hold that position, and many people are actually cornered in other markets where they have to pay margins. So the most liquid asset is gold. So they have been selling gold and paying their margins. I believe this is one of the major reasons why it has not behaved as it should have. In the case of a war, gold prices is expected to go up, but here we are seeing the contrary. There we are seeing the gold prices go up and down according to the dialogues which are exchanged between leaders, or according to the oil markets, or according to other markets. So I don't know what to predict. I'm sorry, but I really don't know what to predict.
I get your point, Mr. Siroya, because from an all-time high of $5,600 an ounce to $4,100 is what we've seen, trading around $4,400 right now. Well, yes, $100 to $200 an ounce of a movement every day. It seems to be becoming a norm right now. So I won't go into the prices part of it. But what's your sense on the buying? Because you are sitting in Dubai. There's almost no buying that we've seen happen in last 20 or 24 days. Very minimal. We do understand that the discounts have gone down. But what really is the Dubai market like right now?
There has been a change. You see, since the first day of Eid, there has been movement in the market. The gold prices came down. There was a lot of confidence building measures which were taken by the government here. And we saw a good movement of jewelry in the retail sector also. In the wholesale, people have started coming back, but it is not overseas visitors. It is people from the retail trade of UAE and nearby areas who have sold jewelry during these last 20 days. They have come to replenish their stock. So we are seeing a little bit of movement coming again into the markets. At the retail, it is, I would say, it is not satisfactory, but it is better than what we had in the last 2 weeks.
Oh, absolutely. Just to get a sense on the kind of trade that UAE or Dubai would have done since the West Asia conflict began, how would you look at it on a month-on-month basis, almost a month now?
If we are going to compare with February, I can't say anything because we are not comparing apples to apples. It's a totally different scenario. The whole market was closed. There were no flights going in and out for a few days. So yeah, the market is subdued. As I said a few days ago, that the markets were down 80%, but today I would say they are down by maybe 70%, 60%. Things have started moving in. Things have started.
Mr. Siroya, with the way the prices have been moving, would you say more investment demand is what we would be perhaps looking at rather than jewelry demand, or you think it's a mix of both? And whatever buying that we are seeing in Dubai is more about local buying because tourism is still as shut?
Absolutely. Actually, you're very right, because those people who had missed their boat of buying the gold when it was jumping up and it went to $5,500 almost, they felt they had missed the boat. So they are all joining in now and buying kilo bars or buying gram bars, all of them. There is a little demand of jewelry, but the majority of the demand is for pure gold.
And how are you looking at, I understand life in UAE and Middle East is slightly difficult right now, but is life coming back to normal in any sense? And are you looking at trades in any sense picking up with other countries or not yet? That's a complete zero.
No, as far as trade is concerned, we are, I would not say zero, we have just restarted.
Okay.
But as far as life in UAE is concerned, we are all very comfortable. Everybody is here. Nobody wants to leave. In fact, all the flights back are coming full now, because even there is talks of the schools restarting everything. So I think after the post-Eid holidays, which are over as of yesterday, I think there's going to be a lot of movement in and out. And pretty soon we are hoping that if the tourists will start coming back, because when they realize that it is actually a safe country right now.
Mr. Surya, most people do believe that there could be some further pressure coming in for the gold prices, with more money moving towards the US dollar as a safe haven, and then crude continues to be the lucrative trade right now. There's not too much of impetus to be staying in precious metals. With the kind of reports suggesting that we could be looking at a 4,000 and a 3,800, the rally started from 3,200. Are you looking at those levels at all?
I am a buyer from 4,000 onwards. If it goes at 4,000 and below, I will be a buyer, because I believe in the long term, we will see gold going up again. And as soon as this whole political scenario and unfortunate event starts settling, we will see positive movements, because the cost of mining gold has gone up a lot. And I do see that gold will go up again. Yes, 3,800 is a possibility according to all the forecasts. But you see, forecasts are just forecasts, because if you see the forecast in February beginning, people are talking about 6,000 and 7,000, and now they are talking about 3,800. So all the forecasts change according to the situation. But I do believe fundamentally gold is going to become strong again.
What about the jewelry? Because you do diamonds and you do lab-grown diamonds as well. Are you looking at a weaker demand therein? I mean,
you see, as far as jewelry is concerned, it's every woman's friend, and anybody who wants to look beautiful wants to wear jewelry. So I think as soon as things settle down, they will definitely start buying jewelry again. In fact, there is a small trickling amount of jewelry demand coming in right now also.
Point taken, Mr. Surya. Thank you so much for joining in. So some business has started to pick up in Dubai, and as Mr. Surya tells us, that $4,000 an ounce is a good level to buy. And of course, the business is not as usual, but it seems to be trickling in, especially in the last 1 week itself. Well, that's about gold. But remember, it is the crude oil prices that have witnessed a sharp surge since the start of the war in West Asia, and it's about 60% higher in 2026 till time. The shutdown of Strait of Hormuz, a crucial global oil shipping route, oil is shipped, led to a loss of nearly 8 to 9 million barrels per day. The Brent crude prices have jumped about 45% in this year, while gasoline prices are up nearly 40% as well. Oil prices briefly tumbled after the US President Donald Trump temporarily postponed attacks on Iran's energy infrastructure, citing positive talks with Tehran. However, the Brent crude breached the $100 mark yet again after Iran denied any negotiations, dampening hopes of a de-escalation. The global liquefied natural gas exports have also fallen to a 6-month lows. Ras Laffan, the world's largest LNG export hub operated by Qatar Energy, has suffered damage from Iranian attacks. The facility could take up to 5 years to fully recover. Joining us now is Amina Bakr. She's head of Middle East Organization of the Petroleum Exporting Countries and Insights for Kepler. Amina, hi. Thank you so much for joining us here at CNBC India. What's your sense? There are various reports suggesting that there are ships passing through the Strait of Hormuz of the allies or the friendly nations with Iran. Is there any sense that that you would have on how many ships since the conflict broke have actually gone through the Strait of Hormuz?
Thank you so much for having me on the show, Manisha, and appreciate that summary you gave in the beginning, showing how volatile the situation remains across all commodities and with a focus on oil. So as you rightfully said, the Strait of Hormuz remains heavily disrupted. I wouldn't say the strait is closed, but it remains very, very restricted and under control by Iran. Over the past few days, we have been seeing more vessels from what they call friendly states pass through the strait, but the numbers have been very, very few. And if we want to talk about since the start of the conflict, and I'll start with the date of February 28th to date, and we're talking about vessels that are carrying liquids here, it's over 130 vessels have managed to cross the straits. That is according to our calculations. And yesterday we had 2 vessels loaded loaded with LPG that were headed towards India. So there seems to be a trickling of flows, but this is nowhere near anywhere pre-war level, and we don't expect any pre-war level to resume unless we see an end to the conflict. And plus, this is the biggest leverage that Iran has right now. So letting go of that last leverage is, I mean, it's important for the country to hold on to it in order for it to negotiate. So for the time being, we do feel the supply pinch globally.
I mean, just to get a sense of numbers here, you've said 130 ships have managed to cross since the West Asia conflict began. What is a pre-war number really, and how would you look at this 130 ships as a percentage of that?
No, it's a very, very, very small number compared to the flows that we had previously. As you know, the Strait of Hormuz, we had 20 million barrels a day of flows, and that's 20% of the world's consumption. What's coming up now, it's really, it doesn't even come to a fraction of what is needed to supply global markets. And quite honestly, even the solutions that the US is using to ease the price, including the SPR release, including removing sanctions off Russian and Iranian barrels on water, and including all of these, these are all temporary measures. And we have this crisis is twofold. One, you have restricted flows through the Strait, and then you have Middle Eastern producers having to shut in their production because they can't go through the Strait, and they're running out of storage. So by our estimates, we have 9 million barrels a day of crude being shut in by the Middle East, which again, there's no spare capacity in the world that could replace that.
I mean, I take your point well that all the solutions from US are temporary measures perhaps and not long-term solutions therein. From where we stand right now, there are various reports really and various case scenarios being played that if this continues until April end, we could be looking at a 140 and a 150 as well. And if things see some resolution, we could go back to 80, and 60 is a level that somebody was talking to us yesterday as well. How are you looking at both the scenarios, the worst case and a better case?
Well, I mean, of course, the worst case, I don't think scenarios that cite 150 or north of that are unreasonable at this point if the Strait remains in the current conditions, meaning that we're still seeing very, very limited number of vessels pass through. And that would lead to a further increase in the price. And to be honest, if I look at the price today, I don't think it reflects the reality of the situation. This price is still being impacted by sentiment, being impacted by messaging. And we saw very clearly yesterday, just through one message by President Trump on Truth Social, that he was able to drop the price 15%. So again, this is a sway of sentiment, not a change in fundamentals or reality. And I think these fundamentals and reality are just going to catch up with the market. So that's the extreme scenario of having, you know, the conflict prolonged and the Strait being closed. But if we do get a resolution, say, they announced the end of the war today, and I'm talking about all parties concerned here, it's not going to be an instant reopening of all of these facilities that have been shut in. And we don't expect, again, a huge flow through Hormuz to happen instantly. This is going to take some time, weeks and maybe even months. For some producer to restore. And as you rightfully said, for example, in the case of Ras Laffan, they already said it's going to take 5 years to repair that damage.
Just pushing you for a number then, will a resolution bring the prices back to 80, or do you see even lower?
Well, it all depends on the market situation, and we're seeing a huge imbalance happen right now. And if we get into the territory of demand destruction, this is one scenario. And if if the market is facing a severe undersupply situation, I mean, earlier in the year, everybody was talking about a glut. There's an oversupply in the market. Now we're in the opposite situation. So yes, prices will ease, but personally, I don't think they would go back to 60.
I mean, the other thing really is that the market seems to be telling us that there's no fundamentals and no technicals that seem to be driving crude oil prices. It's all about one tweet, one announcement, and one move that seems to be moving the prices right now.
You're absolutely right. It's all sentiment driven. It's all kind of up in the air, and that's what makes the situation very volatile, uncertain, and no one really has any kind of definitive information about the timelines. How is this going to end? When is it going to end? So all of these like kind of raise question marks. And I mean, I've been talking to a lot of traders. I'm asking them, how are you trading in this market? And they've been saying it's been minute by minute. That's the kind of the nature of the trade that's happening now.
Now the volumes are pretty high, and we're looking at near record numbers on some days and some hours, if I can say that. Just one more question. And, you know, as the US president was making that announcement yesterday, even before he made that announcement, we did see the markets start to move in. And there are so many theories going around on, as Iran said, this was perhaps done to support the markets, which the US president succeeded in doing. But how would you read the statement and the market reactions?
I would say that a lot of the messaging coming out is for market management rather than giving us an accurate situation of what is happening. In terms of the negotiation fronts, yes, we do understand that a number of countries, including Egypt, Turkey, Pakistan, are trying to mediate and trying to find a solution here. But there are, you know, we're nowhere near a breakthrough solution. Ending the war is a lot more complicated and involves, you know, various parties. So in terms of the messages that we're hearing, I think it's just to calm markets. And that 5-day window, if you really think about it, that's just taking us into the weekend where we don't trade. So there is, of course, I mean, an element of market management in these messages.
Point taken. I mean, as always, a pleasure talking to you. Thank you so much for making sense of a lot of things that are happening in the oil markets at this point in time. And we hope to speak to you soon again. But with that, we'll go for a break, come back and talk about the silver prices, which have been equally volatile. Welcome back. Joining us now is Kishore Runwal. He's CEO at Anmol Silver. Mr. Runwal, hi, thank you so much for joining in. It continues to be a very, very volatile market from an all-time high of $120 an ounce or a 4,20,000 rupees a kg. We've seen nearly 52% of a decline come in for prices. At these levels, is the demand still coming in, or would you say that this quarter seems to be closing on a very weak note?
Manisha ji, I feel that the markets, as we heard the news of the Trump declaring a 5-day pause at the war, you could see the volatility in the market from 206,000, the swing running to 232,000. We were actually feeling much better as the prices were going down. The market sentiments were feeling better that if the prices go down, the businesses may pick up. But again, just with that one sentimental note of war pausing down, the rates have shooten up, and again 232,000 is the market rate now. So as of now, we feel that March will again, it will take some time again for the rates to go down, settle down, and customers to come back. And we had a good 2-3 days business in the markets. From last 2-3 days, businesses were good as rates were going down. But as of now, we see that at 232, markets again have become slow. People are waiting, and March we see a very slow ending, and at this year we see moderate close of the business this year.
Mr. Runwal, if I just talk about the current quarter that we are in, what kind of sales would you say that we've perhaps seen? 50 to 60% of a normal, or what number are you working with?
As of now, if you see in the closing quarter, 2026, we see from, if you see from December to March, markets have done very, very slow. We see a 25 to 30% sales as of the turnovers have dipped in nearly all the gem and jewelry sector. As of now, we had the IHS exhibition. Their footfall was also very slow. The mood exactly in the gem and jewelry sector is very, very slow, and we feel that if prices go down and coming festivals, if that supports, market should give a new life to the gem and jewelry sector.
Mr. Runwal, you were saying that this quarter perhaps has seen only 30% of the regular silver demand. Having said that, going forward as well, would you say much of this demand would be investment, or do you see silver articles and silver jewelry or other things doing as well?
We actually, in the month of from the December to March, we can see maybe 10 or 15% of bullion business going around everywhere. But the article businesses have gone very, very down. Silver jewelry is moderate, but if customers only are not coming to jewelry stores, even silver jewelry will not help. So even the gold businesses are down due to that. Even silver jewelry is taking a bad hit. So I feel that only 10 to 15% of the businesses is happened in jewelry, and other is bullion.
Mr. Runwal, a final question then. What's your sense on the silver prices going forward from here?
If things get better, I see markets bearish only due to the sentimental news of coming from the war. We saw a rise at 10 to 12% from what low levels have gone. But again, I see a dip. Markets should, in the month of April, should see somewhere near 210,000 to 225,000 range.
Point taken. Mr. Runwal, as always, thank you so much for joining in. So not a very great quarter for silver as a metal as well, whether it is about investment or jewelry. Both those numbers quite dismal there. But with that, that's all the time that we have on this special broadcast. Thank you for watching.
Hello and welcome to this special broadcast on West Asia War. I'm Ashmit Kumar. Now, US President Donald Trump has delayed strikes on Iran's energy infrastructure. He claimed that talks with top Iranian leaders were constructive and positive, but clarified that it was not the Supreme Leader Mojtaba Khamenei. Tehran rejected these claims, saying that the US did not hold direct talks with Iran and called the statement fake news. Iran believes this move is a tactic by the US to buy time while deploying forces in the Gulf and preparing for a massive strike on Iran and also to manipulate oil and financial markets. Despite Trump's claim that Iran wants a deal and that both sides have agreed on major points, this has not stopped United States forces from striking Iran. Reacting to the Iran-US talks, Israeli Prime Minister Benjamin Netanyahu has said that Israel's interests will be safeguarded. As per Iranian media, 2 gas facilities and a pipeline in Isfahan were targeted after Trump's truce announcement. It added that the facilities in central Iran were also partially damaged. Overnight, Israeli-US forces struck several residential areas in northern Iran, killing over 5 people, while Iran launched drones and missiles towards Bahrain, Saudi Arabia, Kuwait, and Israel in retaliation. Now, amidst all of this, the role of one nation has emerged, that's Pakistan. Reports suggest that Pakistan has taken an active role as a mediator and is involved in the Iran-US talks. According to the Financial Times, the Pakistani army chief is speaking with Donald Trump, while Pakistani Prime Minister Mohammad Shahbaz is engaging with the Iranian President Masoud Pezeshkian. Apart from Pakistan, Egypt and Turkey are also engaged with both sides, both countries, to ensure back-channel talks. Well, joining us now to take this discussion forward are with me Yasar Al-Maliki, Gulf analyst with the Middle East Economic Survey. Also with us, Brahma Chelani, strategic affairs expert, and Adam Dixon, Adam Smith, chair of the Panmure House. Gentlemen, thank you so much for sharing your time with us. Mr. Dixon, let me come to you first again. Many are asking the question, how credible, how serious is Donald Trump when he talks about cessation of hostilities? The reason being, what we've seen over the last 24 hours, despite his assurances, Iran media claims that there are hits being secured on Iranian gas facilities, which again goes against what Donald Trump had assured on his post on Truth Social.
So I think in any conflict, there's always going to be, if you like, propaganda from both sides. And as we know how Trump likes to operate, he is trying to, on the one hand, manage market signals. That's clear. But also, I think, not give out too much in terms of what his plans are. And we've seen that from the beginning. And I think the frustration that many seem to have is they want to know, what is the plan for this conflict? What is the timeline? It's as if everyone seems to expect that in a conflict, they're told, well, this is going to happen on day 2 and day 3 and day 4. And I think that's a naive expectation. So, of course, I think, this is a very fast-moving conflict. Of course, there are back channels that we're seeing from various parties in terms of trying to understand where there's room to push Iran in a particular direction, whether that's de-escalation or not. But I think, like with anything that Trump says, you can't necessarily take it at face value.
Mr. Dixon, just a follow-up question to that. The timing of it, again, is what is leading to the suspicions regarding the intent behind the statement. The timing being, of course, the fact that the statement comes in when the oil prices were at an all-time high. They had breached the $100 mark. The timing also, interestingly, is when we are seeing United States ground forces being deployed in the region. We're seeing open source information which suggests that as many as various aircraft, 35 C-17 aircrafts are making their way towards bases towards in Jordan, in Israel, that there are ground forces that are also being deployed in the region. That is leading to give more credibility to the theories being put out that perhaps this is just a wait and watch mode by Donald Trump till at least there is a ground offensive ready to be launched.
I think on the one hand, you could say that that's possibly correct. I mean, it's no coincidence that Trump announced this before markets opened yesterday, and he's trying, if you like, to manage those expectations in the market and potentially buy more time for the USS Tripoli to reach the Gulf area and for other assets to move in the region. But I think it's also important to recognize that there are likely to be back-channel conversations that are happening with various actors in Iran. The bigger question is who is actually in charge, right? And who is actually guiding in terms their Iranian response. And that's why I don't think we actually know the answer to that. And I think, as we see with many authoritarian regimes, is once you start to decapitate and take away that senior leadership, it leads to a more chaotic situation, which is on the one hand concerning, but is also, I think, typical of these very hierarchical and top-down driven societies, or at least regimes.
Sure. Let me also get Mr. Chilani in on this conversation. Mr. Chilani, again, the optics of it, Donald Trump making an announcement, news reports emerging that perhaps Pakistan is likely to play the role of a mediator. Again, what is your understanding of the way things are playing out? How carefully are you suspicious of some of these developments? Are you giving credibility to the statements that are being put out by the White House, by Donald Trump?
Donald Trump has broken all the international norms that relate to peace and conflict. The question that was asked by Mr. Dixon, who's in charge or who's guiding Iran's response? The bigger question is, who's guiding America's response? Is it just one man? Is that one man open to professional advice from his military as well as senior officials in the administration? Or is it just Trump deciding based on his own instincts as to what should be done? And one other thing that we should not forget, that his statements yesterday came just when his 48-hour deadline to, quote-unquote, obliterate Iran's electrical grid was coming to an end. So he basically bought more time for himself, because by then, by Friday, now the five-day extension is up to Friday. By then, Marine Expeditionary Forces and possibly even airborne commandos would be in position in the Persian Gulf. So this could be a ploy. And if you go by his statements in the past, he often engages in public deception. The way he began this war, just when a deal with Tehran appeared to be within Trump's grasp, according to the Omani foreign minister, who was the key mediator between Washington and Tehran. And under the cover of talks, he launched this war. And therefore, we have to be very careful. And his threat to take out Iran's electrical grid is actually an open contempt for the Geneva Conventions. The Geneva Conventions, reinforced by the additional Protocol 1, explicitly prohibit attacks on objects indispensable to the survival of civilian population. Electrical plants underpin basic civilian needs, including powering hospitals, water systems, and sanitation. Their deliberate destruction is unlawful. And here we have the President of the United States openly threatening to completely obliterate Iran's electrical grid.
Right. Mr. Maliki, let me also get your thoughts on the same issue again. This assurance coming in from Donald Trump, how the markets are perceiving it, how the Gulf is perceiving it, and especially in context of what Joe Kent had put out on his social media post, essentially saying that, look, any path towards de-escalation will involve the United States, Donald Trump reigning in Israel. Do you see that happening?
Thank you very much for having me. I mean, let's start with the markets. In the oil market, I think it's been quite hard to see traders trying to price in any sign of de-escalation. We saw prices beginning to go down in terms of oil. On the belief that there could be a ceasefire sooner rather than later. But, as it's seen today, they have gone back up again, and the market remains driven by sentiment. And traders are struggling to price in the situation because it remains extremely volatile and uncertain. So there is a real-time trading headline to headline and contradictory political signals. I think your other guests have covered that quite well. Now, when it comes to the remaining part of your question, I think there remains a large gap between the US and Iran, both sides, on what a ceasefire could be. I think the Iranians have clearly said that they would like to have a political guarantee in any kind of a deal. It's unclear who is going to provide that political guarantee. China has been watching from the sidelines. Russia has been weakened by its war in Ukraine. So this clearly remains a problem. For countries in the region, there are also other considerations. I think they have legitimate concerns when it comes to what happens to the Strait of Hormuz. How is it going to be managed? Any deal that is going to legitimize even partial Iranian management of the strait is not going to be acceptable, because this is, by the end of the day, an international waterway. So again, as you started this segment, this could be a delaying tactic for something else to happen, maybe another round of escalation. And we will have to, basically, the proof is in the pudding when it comes to a ceasefire.
But circling back, Mr. Maleki, to the point about while the complicated relationship exists between Iran and the United States, there's also complications in the relationship between US and Israel. So for any de-escalation to move forward, is it possible without reining in Israel, without reining in Benjamin Netanyahu? And is that even possible given what we've seen over the last 25 days?
I think, we have seen some signs of a fracture between the US and Israel when it comes to the objectives of the campaign. Israel has been very clear on what the objectives are. The objectives are to dismantle the nuclear program, the missile program, and to at least weaken Iran. So after the war, there could be enough dynamics internally for regime change. The US objectives are not very clear. Now, whether what happened with the attack on South Pass in Iran, the processing plants, showed that this fracture has widened. But at the same time, I think both governments were very keen on showing that they are in sync when it comes to this campaign. But yes, it will be there might not be as much enthusiasm in Israel to see this campaign ended early. But again, keep in mind also that Israel is on the receiving end of Iranian missile barrages, and sooner or later the Israeli public would like its government to find a way out of the conflict.
Sure, Mr. Maleki. On that note, let's slip into a very short break. We'll continue this conversation on the path forward on the other side. Welcome back. We're continuing our focus on the West Asia conflict. With us, we have a esteemed group of panelists. First, let's go across to Mr. Adam Dixon. Mr. Dixon, coming back to you, there are reports which seem to suggest that the U.S. is trying to appoint someone, the Speaker of the Parliament in Iran seems to have found favor with the U.S. The question that many are asking is that, is Donald Trump looking for his Delcy Rodriguez of Iran, and is he likely to find such a leader in a much more complicated, complex, hardline society like Iran?
Well, I think the question needs to be asked is, what do the Iranian people want? So we know that the vast majority of Iranians, and we saw this with the many that went out on the streets in January and the many that were massacred, do not like the regime. Notwithstanding, there is a transition that hopefully will take place that leads to an Iran that is more amenable to the vast majority of the population. So to get there, though, it is likely the case that you would hope that there would be some sort of reconciliation where those hardliners of the regime, if they are even amenable, will allow a transition to take place. And I think looking towards those sensible people within the regime that will take part in that is what the Trump administration is looking for. But it's really hard to say at this moment whether a transition will take place. We see that Israel as well as the United States are trying to neuter, if you like, the police forces, the Basij, that have oppressed people in the street and are still threatening to shoot any protesters in Iran. I think once that is relieved, then perhaps they'll see a degree of popular uprising where people do not feel that they're going to be shot or massacred for speaking out against a repressive regime. And who are those hardliners, if you like, who are those within the regime that are amenable to be part of a negotiation to lead to a different type of Iran?
Sure. Mr. Chilani, I just want to bring your thoughts in that we have a situation where, if we take what is happening on face value, Pakistan is supposed to play the role of a mediator. US, Donald Trump is keen on implementing a regime change where Khamenei gives way to a leader who's slightly more palatable to Washington, D.C. How does all of that work as far as Indian interests in the region are concerned, with Pakistan acting as a mediator?
No, whether Pakistan is acting as a mediator, there is no evidence that it's acting as a mediator. These are speculative media stories, and I would wait for things to clarify. But the issue is this, that Trump has boasted of quote-unquote total victory, not once, but at least 3 times in recent days. But it's becoming apparent that the illusion of victory is giving way to unpalatable war realities. And the law of unintended consequences is playing out vividly. If the idea was to encourage a popular uprising in Iran, then Trump and company have done the opposite of what they should have done. By killing Iran's supreme leader, they have actually helped the regime in Tehran to turn grief into mass mobilization. The killing of Ayatollah Khamenei in Shia political culture has been framed as martyrdom through religious symbolism rooted in the memory of Karbala and the martyrdom of Imam Hussein. The regime has helped to draw support from the masses. So this is exactly the opposite of what Trump and the Israeli Prime Minister should have done. They should have, instead of unifying the Iranian society, they should have actually done something that would have actually increased the fissures in Iranian society. But there is a bigger issue
Chilani,
now.
if I can then ask a supplementary question to you, that if you believe that the death and the killing of Khamenei has caused that sentiment within the Iranian society, the question that I then want to ask is that as we speak of de-escalation, does it become that much harder for the Iranian regime, for the IRGC, for Khamenei to come on the same table as Donald Trump?
Now the US and Israel must deal with a regime in Tehran that is far more hardline than the regime whose leadership they decimated. Now, any deal that emerges from dialogue and diplomacy will be worse for Washington than the deal that Iran was offering when the war began. So today, the choices for Washington and Tel Aviv are not choices that look attractive. And we can see certain frustration building up in Washington, in the White House. Incremental escalation is happening. And if the Vietnam War taught anything, it is that incremental escalation quietly turns a conflict into an open-ended war. And there's danger now that this war could drag on.
Sure. Let me take that across to Mr. Maleki. Mr. Maleki, again, a large part of the conversation over the last few days, at least the last few days, by that I mean the last 10 to 15 days, has been about the disruption in energy. Hormuz, of course, being central to that. If we are to take what is happening on face value, that yes, there are talks underway, yes, there's a mediator mediating between the two sides, do you see a resolution where Iran willfully concedes the control of Strait of Hormuz, given the situation they find themselves in with their leaders being decapitated? Is that a position that is even conceivable for the Iranian leadership moving forward?
Yeah, I mean, it is a position that they will have to eventually come to. But I think, just to build on what the other guests have said, the Iranian regime that has emerged so far from this conflict is more hardline. And has been able to raise the stakes and the bets as the US does it. So, over the past few weeks, what we have seen is Iran, showing its capacity to still target the region, to be able to disrupt, even if not physically, the flows through the Strait of Hormuz. Now, what happens is what kind of gains the Iranians can get politically in ceasefire talks. Can they have recently been much more vocal in trying to say that they should have some sort of control over the Strait of Hormuz. So can they implement that in a ceasefire? Can they get the Americans to concede that? I see it as very hard to see, because so many of the regional players are not going to accept that. But say eventually a ceasefire is reached and flows start to resume from through Hormuz. In terms of global supply, we'll have some 6 to 8 weeks to get to back to 70% production in the region, the levels that we have had before. And it could take even longer for for oil production and especially gas production to be restored to previous levels. We saw the attacks on Ras Laffan in Qatar. It will take years to bring back that capacity.
Right, Mr. Maleki. So no easy answers there. And as far as the options before Donald Trump, well, a rock in a hard place. That's what the consensus appears to be, at least as far as what analysts on board are telling us. I'd like to thank all of our guests, Mr. Maleki, Mr. Chilani, Mr. Dixon, for joining us and sharing your insights. With that, it's a wrap on this special edition on West Asia War. More news and updates will continue on the other side.
Let's Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. These days when we talk money, investors have realized that talking about money only purely from an Indian equity market context is many a times not enough. In the last 15 odd months, the Indian market has underperformed global markets big time. And in this entire duration, the US market, for instance, has continued to be fairly Teflon coated. The market has weathered so many storms, whether it is the AI disruption, whether it is, of course, what's happening geopolitically, and now even the war in West Asia, the US market has remained relatively insulated. But this is not a conversation just about the US market. This is a conversation about Indian investors waking up to the need of diversifying their equity bets, the need to perhaps spread your equity investments in markets beyond India, going beyond Indian shores. Now, the problem when we talk about this is not too many Indian mutual funds are right now giving the option of investing in global stocks in a simple way. Why is that happening? What should investors do? And are there new options coming up via the Gift City? That is what we'll talk about on this show today. My guests are Aditya Agrawal of Wealthy.in and Nirmal Bari of PPFAS Mutual Fund. Now, I must say that PPFAS is one of the funds that has started offering some of these new concepts and these new options to investors via Gift City. So this promises to be a really, really interesting conversation. Thank you so much for joining us on the show, gentlemen. Welcome to both of you on the show.
Thanks, Surabhi. Pleasure to be here.
So, okay, I want to take a couple of steps back before we get started. And I think they say that the market is usually the best teacher. And Aditya, opening thoughts with you, because the market has taught the lesson of patience to Indian investors in the last 2 years. So why diversify?
Yeah.
And where to diversify? Let's start right there with the basics.
Right. I think we all often say, right, don't put all your eggs in one basket. I think that is something that we all understand even as kids. And if you even look at the theory of wealth creation, I think asset allocation is one word that we talk about a lot. And we ideally want assets that are uncorrelated. And we saw, for example, first what happened with gold and silver, and then we've been seeing for the last 2 years that how global emerging markets and developed markets have outperformed India. Right. So I think that conversation that I should build a portfolio where I have as many assets as possible, which are uncorrelated to each other. I think that is something that, sort of has proven again itself to be the harbinger of wealth creation, and especially creating a portfolio that is sort of, that is able to test the test of all time. So I would say that's why, global as a theme has emerged very, very powerfully in last 2 years. And as we all know, ultimately investors pay attention to, returns in recent times.
Okay. All right. So lots of important and very important reasons that Aditya highlighted there. Diversification, de-risking your portfolio, looking at markets which are uncorrelated, and obviously developing a currency hedge as well, not holding all your assets in just one currency if it were to constantly depreciate. So these are some of the reasons why we need to look overseas. Let me bring in Nirmal as well. Nirmal, but let's face it, a lot of Indian investors end up doing things because they track price movements. So this whole conversation of investing in US tech really goes back to, I think, 23, 24, when, this creature called NVIDIA was capturing our imagination and the stock would just keep rising and rising. The NASDAQ was soaring. That's when a lot of Indian investors said, hey, I need to be in US tech. I need to have Apple and Facebook and so on and so forth. So let's start right there. Tell us why that is not the way to approach global markets, and how should one look at blending global exposure in their existing India portfolios?
One thing that clearly needs to be there when looking at global is that it should have a very long-term horizon. The investors, if they are looking at one particular stock and investing in that, and if they make some good money in the short term, they redeem, they'll be exposed to very high taxation in India. And short term, when I say it is not 1 year, it is 2 years when we look at global markets. So one should clearly have this, equities anyways are a long-term product of 5 years or more. So build it as a part of your portfolio strategy, as a part of your overall allocation, rather than looking at one index, one stock over a shorter period of time.
Okay, very well said. And those are really important points that you've raised there, Nirmal, including taxation. Must always keep that in mind while we're planning our investments, anywhere, any asset class in any market. So let's get started. First and foremost, let's talk about the impediment. Now, not too many regular Indian mutual funds give us the option of investing in global stocks. Now, on this show, you've heard us tell you about those limits. So let's just quickly go over and revisit something that has been an RBI regulation for many, many years, Aditya, right? This limit of $7 billion that overall mutual funds can't invest in global markets beyond $7 billion. This is a very old limit, isn't it?
Yeah, it is. So, even if you look back at history, as a country, we've always been a little bit cautious about our money flying abroad, right? And it's something that has stayed. Obviously, we live in a different world now. As a country, we've become more powerful. We are, recognized as a world power now globally. But still, that limit is very paltry. So, still, if you look at as a country, our mutual fund AUM is about $1 trillion now. But our mutual funds combined are only allowed to invest about $7 billion. And if you include ETFs, that's about $8 billion. So that's not even 1% of your industry's AUM that is allowed to be invested abroad. So I think those controls have remained. I think there have been talks about relaxing those limits. But I think instead of that, I think this Gift City option, which is where through liberalized remittance scheme, you can actually remit money instead of remitting in the US, you're actually remitting to Gandhinagar, and from there it gets invested abroad. I think that's something probably a very welcome move that government has made, and simplified this whole international investing in last 7, 8, 10 years. So yeah, I would probably say that limit is probably here to stay, but I think government opened up another route to Gift City products, and AMCs like Parag Parikh, DSP, Edelweiss have already launched retail products as well to allow people to invest abroad through the Gift City.
Yeah. I must say, though, Parag Parikh Mutual Fund has been one of the early mutual funds that even within their regular India schemes, they were always taking some exposure in international stocks. And their early bets were in a lot of the US tech names, well before, investing in US tech became fashionable. So compliments to the fund managers who've been picking those stocks rightly. But, Nirmal, come in on this. And now here, let's get a little granular in terms of understanding markets as well. Now, if I look at the last 1 year, then the divergence between India and US is stark. Now, for the reference of viewers, in the last 1 year, the S&P 500 has gained about 20%, the NASDAQ has gained about 28%, and the Nifty has gained only 4%. So it's been a unbelievable year. We don't usually see such huge divergence. On a 5-year basis, the divergence is only 8-9%. The NASDAQ, for instance, is up 70% in the last 5 years. The Indian market, the Nifty is up about 61-62%. So first and foremost, Nirmal, are we in an aberration phase right now? And if we are, then what would you tell investors? Investors tend to move in herds. So following US tech right now in terms of a sort of a bit of a herd mentality, could that be a risky strategy?
Are we in an aberration phase right now? The answer is clearly no. This is how the markets perform. Despite saying that the world economy is very much correlated and all, we have seen that over a period of time, except for very unusual periods like the 2008 global financial crisis or the 2020 pandemic, world markets tend to not move in tandem. So every year, if you look at the history, there is one or the other country which does superbly well, while there are other countries which are way below average. And that is what we have seen between US and India in the last 1.5 years, where Indian valuations have seen a time correction maybe, while US driven largely by the amount of investments that are going into AI and related sectors, have seen those companies surge.
Fair enough. Aditya, so let's get your take. A scientific way of diversifying the portfolio. How much would you allocate outside India right now? And I'm talking about, let's say, the pure equity component out of 100. How much would you keep in Indian equities right now? How much would you give to, say, US, any other geography? And within the US, should it be a broad diversified index like the S&P 500? Let's just go over thematically, in what proportion should we allocate the money?
Sure. So I think fundamentally core will remain India. simply because we are a country that is growing at 7.5%, and we have, by all accounts, we have 15, 20 years of growth ahead of us at a similar pace. So no other country in the world, no other broad index in the world, can sort of claim that. But at the same time, we have certain sectors which we are not exposed to. So I think global tech is one very clear area where, as a country, we have not been able to create those kind of companies and that kind of cash flow profitable businesses. So I think for me personally, and that's what I tell my closest friends as well, and wherever clients seek my advice, that you should limit your US exposure to between 10 to 20%. On slightly on the higher side, if you have plans of sending kids to the US, because as Nirmal also said, there is you're protecting your money against the so there is a hedge to currency depreciation. But otherwise, and I would probably go all in only on just the tech sort of sector of the US, because that's one sector that we don't have exposure to. It's going to be highly volatile because it's like any other thematic fund that we have in our portfolio. So it's going to be very volatile. So it's not something that you can accumulate in one go, and you have to sort of pace it out a little bit, because there'll be buying opportunities, there'll be sometimes profit booking opportunities. So that's probably the only bet that I would take outside of the US, and maybe not allocate more than 20%. Maybe start with 5, but maybe gradually take it up to 20% of my equity portion of my portfolio.
Okay. All right. Got that. So it's very clear that we do need to have some global exposure. The levels can vary. The choice of indices or markets can vary, but we need some global equity exposure. Now, the question is how? We're going to take a break. After we come back, the really interesting part. There are some regular Indian mutual funds that are taking money. We'll tell you which ones they are. But more importantly, a lot of Indian mutual funds are now exploring the route through Gift City, through which you can take exposure to global stocks. More about this after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing how Gift City is emerging such an interesting route for us retail investors to look at investing in global equities, in global stocks. So let's get back to our conversation with Aditya Agarwal and Nirmal Bari. Both of them have been talking to us about the importance of global diversification. And now, Aditya, before we talk Gift City, first just recap for us these few funds in India that are still taking money when it comes to global stocks.
Yeah, so there are actually very few. I think off the top of my head, the one fund that is taking money is the Axis Global Equity Fund of Fund, Global Equity Alpha. And it's something that, but it's such a dynamic environment that today one fund is taking money, and in a few days you will not find that that fund taking money. But one fund that we are seeing inflows on global scheme, global investing theme, is this Axis Global Equity allocation, which is called Global Equity Alpha Fund of Fund by Axis. And Axis, as you know, has launched this product in partnership with Stodders, which is a very well known and global asset management company. So that one fund is definitely taking money right now.
Okay. All right. I think we have a few other names on the screen as well. But again, I mean, these things can turn any day. Any day the funds can decide to switch off the tap. So make sure you check. Some of the names are on your screen. Now, gentlemen, let's talk about what Indian asset managers are doing in GIFT. Now, we know that the Gujarat International Financial Technology Center, the IFSC, is India's big financial global hub. And all kinds of financial products are available in GIFT. But just explain to us, Nirmal, what are Indian asset management companies doing? Regular Indian mutual funds, what kind of structures are they setting up in GIFT City so that someone like me, someone like viewers of this show, they can take part in global markets?
Sure. So that's a great question. The first thing is that till last year, about a year back, all the FMEs, the fund management entities that are present in GIFT City, instead of AMCs, they are called FMEs. They had the option of launching only an AIF, where the minimum ticket size was $150,000 US, which made the accessibility very limited. Now, last year, the new FME regulations came in, which provided sufficient clarity on retail funds, And after that, there was some tax clarity which came in last year in the month of April. Post that, quite a few FMEs have started making a move towards launching retail funds. We have also launched a couple of them in the last month as well. Now, what a retail fund is basically for to simply put, it is the counterpart of mutual funds in India. It has similar simple onboarding process as the Indian mutual funds. It also has uh, lower ticket sizes, significantly lower ticket sizes as compared to the AIFs, which makes it affordable for a large segment of the population. And the ticket sizes can gradually keep going down as well. Right now, most funds are at 5,000 US dollars. The final thing is it further simplifies life for Indian investors because the taxation is at the fund level. So the whatever the redemption proceeds that the investors receive at the end are net of tax for them.
Okay, so let's try and understand these structures and the nature of these funds in a little more detail. Aditya, how are these new funds, these retail funds which are being set up in GIFT, how are they different from the regular funds of funds? I mean, the ones that you described, like the Axis Fund, the non-GIFT funds, which also take money and then invest in global stocks. How are the GIFT City-based retail funds different, if at all?
So one is, if I am not, like, for example, we discussed there are only 5 schemes available right now, which can take money from Indians in India investing abroad. So GIFT City funds come under what is called a liberalized remittance scheme. There is no limit as to how much money can GIFT City funds invest outside India. As an individual, I have a limit of about $250,000, which I can remit outside, like remit to a GIFT City account and actually invest from there. So now the limit from an industry level of $7 billion shifts to actually limit at an individual. So if, let's say, if I have a portfolio of $10 million, suppose, and I want to invest, let's say, $1 million at 10% allocation through a mutual fund, which is Indian mutual fund, investing abroad, I may not be able to, because, most funds may not be able to take that money. But whereas in GIFT City, I can actually invest that $1 million by doing, in 4 years, I can sort of invest $250K each and end up. So I think the basic difference is that this is like a offshore transaction. You are sending money outside India, and then from there it is getting invested. So the $7 billion cap no longer applies, but at an individual level, the cap applies of $250,000 US. So that probably is the biggest difference. Otherwise, everything else remains the same. Your NAV calculation, the underlying ETF or the underlying index fund, everything else remains the same. Of course, the KYC etc. is slightly different on GIFT City. And then you also have this extra leg of going to your bank or asking your bank to remit that money outside India. And it is not, not all banks have made it seamless. So in some banks, it is actually a tough, it's slightly, there's a lot of friction in sending money under the LRS route. But I hear that there is a lot of development going on outside as well.
Nirmal, come in on this. So if I want to park money in one of these GIFT funds, then let's talk about the thresholds. And I mean, is it uniform? Is there a regulation around to it, or does it just depend on fund to fund? And translated into Indian rupees, we're talking about what? I mean, a minimum threshold of just under 5 lakh rupees? Minimum investment amount, that is.
So the minimum investment amount, the minimum initial investment amount is $5,000, which converts to about 4,60,000 rupees or so, so at current exchange rate. Incremental investments can be $500 or any amount above that, which is basically less than 50,000 rupees to put it. So that way the thresholds are low. They are not as low as Indian mutual funds. Again, I agree to that. Gradually, as the system evolves, as it grows, this is at a very nascent stage, having only been there for like 6-8 months. The ticket sizes will also start coming down. The biggest hurdle at present to ticket sizes is that there is a frictional cost, as Aditya described about going to the bank and doing LRS. Quite a few banks have made that journey digital. We have also had a few tie-ups with payment service providers to make it seamless. But from a rupee perspective, there's still a bit of frictional cost that comes in when sending money. If you're spending 1,000 rupees sending 5 lakh rupees outside, probably investors would still be fine with it. If you're spending 1,000 rupees sending something like a 5,000, 10,000 rupees outside, probably that's a pretty high frictional cost. So that is what limits the ticket sizes at present. But we are making efforts on reducing the ticket size further so that it becomes more and more affordable for retail investors in India.
Okay, all right. So now let's come to understanding the other regulatory aspects. Aditya, I guess, these funds would be regulated by what, market regulator SEBI or the IFSCA authority? And, does that matter for investors at all? And also the taxation, let's go over that, because Nirmal made that point that long term for these funds is 2 years. You have to hold for 2 years to enjoy the benefit of long-term capital gains tax, that advantage. So if you could just go over how the tax implication will play out and whether for investors it makes any difference if the IFSCA is the regulatory body for these funds.
I don't think for an investor it makes any difference because IFSCA is the regulator. And if you look at the fund management entities that are also being set up, they're all well-known names that are already being regulated in the country. And as you also said, right, GIFT City is being positioned as a global financial hub. So the regulations, the way it is all being set up, it is actually world-class. It is something that after a slow start, I think now we are seeing that, we are bringing really world-class standards. And as far as taxation is concerned, I think there is no difference in taxation. So you're not investing to a GIFT City because of taxation advantage. In fact, there is no advantage. It is same as Indian equities. So you pay 12.5% long-term capital gains for whole period of more than 2 years and, tax rate income slab for less than 2 years. So taxation, there is no advantage. The difference, the reason to invest is, again, an asset allocation framework where you want exposure to global equities, or if you have needs in the US or outside India in the future where you want to send your children abroad for studies. I think that is obviously the second use case where you should definitely look at probably investing outside India.
So final verdict then, gentlemen. Obviously, PPFAS has already launched some of these funds, as are other entities launching these funds in GIFT City. Aditya, do they get the thumbs up from you, these funds? And any final word of advice, things that people should keep in mind while going global through GIFT?
Definitely a big thumbs up. Only thing is that there is a lot of friction still in sending money abroad. One good thing that has happened is that, minimums have come down from $150,000 to $75,000 and now to $5,000. So clearly there is a decline in terms of minimums or thresholds becoming lower. So that is great for access. Obviously, you can't just chase last 12-month returns and 24-month returns. You have to build equities, ultimately long-term asset. It will only compound your wealth. It will only make you 20x, 30x if you hold it for 20, 25 years. So from a 20-25-year view, is a global allocation an important step in creating wealth for Indians? I think yes. So I think from us at Wealthy, it's a big thumbs up, this whole initiative.
Okay. All right. There you go, viewers. More options opening up and GIFT City really becoming a gateway, not just for the well-heeled, not just for the HNIs, but for you and me as well, in taking more exposure, informed exposure to global markets. Thank you very much, Nirmal and Aditya, for joining in and explaining this new investment route to our viewers. Great to have you on the show. Well, viewers, with that, we're completely out of time on this week's edition of Let's Talk Money. See you again next week.
Let's talk money. Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. These days, when we talk money, investors have realized that talking about money only purely from an Indian equity market context is many a times not enough. in the last 15 odd months, the Indian market has underperformed global markets big time. And in this entire duration, the US market, for instance, has continued to be fairly Teflon coated. The market has weathered so many storms, whether it is the AI disruption, whether it is, of course, what's happening geopolitically, and now even the war in West Asia. The US market has remained relatively insulated. But this is not a conversation just about the US market. This is a conversation about Indian investors waking up to the need of diversifying their equity bets, the need to perhaps spread your equity investments in markets beyond India, going beyond Indian shores. Now, the problem when we talk about this is not too many Indian mutual funds are right now giving the option of investing in global stocks in a simple way. Why is that happening? What should investors do? And are there new options coming up via the GIFT City? That is what we'll talk about on this show today. My guests are Aditya Agrawal of Wealthy.in and Nirmal Bari of PPFAS Mutual Fund. Now, I must say that PPFAS is one of the funds that has started offering some of these new concepts and these new options to investors via GIFT City. So this promises to be a really, really interesting conversation. Thank you so much for joining us on the show, gentlemen. Welcome to both of you on the show.
Thanks, Surabhi. Pleasure to be here.
So, okay, I want to take a couple of steps back before we get started. And I think they say that the market is usually the best teacher. And Aditya, opening thoughts with you, because the market has taught the lesson of patience to Indian investors in the last 2 years. So why diversify?
Yeah.
And where to diversify? Let's start right there with the basics.
Right. I think we all often say, right, don't put all your eggs in one basket. I think that is something that we all understand even as kids. And if you even look at the theory of wealth creation, I think asset allocation is one word that we talk about a lot. And we ideally want assets that are uncorrelated. And we saw, for example, first what happened with gold and silver, and then we've been seeing for the last 2 years that how global emerging markets and developed markets have outperformed India. Right. So I think that conversation that I should build a portfolio where I have as many assets as possible, which are uncorrelated to each other. I think that is something that, sort of has proven again itself to be the harbinger of wealth creation, and especially
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: no signs of de-escalation despite President Trump's claims of talks with Iran. U.S. and Israeli strikes target Tehran and other cities. Iran fires a barrage of missiles at Israel and Gulf nations after rejecting Trump's claims of talks as fake news. But President Trump insists that Iran wants to settle. Crude oil prices climb as optimism fades over a possible de-escalation in the Gulf. Brent crude back above the $100 mark. Bahrain floats a draft resolution at the UN Security Council to authorize the use of all necessary means to protect commercial shipping around the Strait of Hormuz. Stocks slide across US and Europe after a relief rally yesterday. Gold prices remain in bear market after declining over 20% from record highs. Markets bounce back after yesterday's brutal sell-off. The Nifty ends above 22,950. Broader markets outperform. All sectoral indices close higher. The rupee ends at 93.87 against the dollar. HDFC Bank appoints a global and a local law firm to review the abrupt resignation of its chairman Atanu Chakrabarti. The move is aimed at quelling speculation. Chakrabarti stepped down after saying some practices of the bank did not align with his values. Facing prosecution over a 40,000 crore rupee bank fraud case, Anil Ambani writes to the finance minister, asks if fugitives like Sanjay Sarah can settle pending cases. Why not me? Seeks a time-bound structured settlement of dues similar to the case of Sterling Biotech promoters. The National Company Law Appellate Tribunal refuses to stay the implementation of Adani's 14,000 crore rupee resolution plan for JP Associates. Also clarifies that any action will be subject to the final outcome of the case. This comes after Vedanta challenged Adani's bid, arguing that its offer is superior. Delhi's Chief Minister Rekha Gupta tables a 1 lakh crore rupee annual budget with a focus on welfare and infrastructure. Education gets the highest allocation of over 18% of the total outlay, but this is still lower than the 25% spent by the previous AAP government. The Supreme Court rules only Hindus, Sikhs and Buddhists can claim to be a member of the scheduled caste community, upholds the Andhra High Court order which ruled any person converting to any other religion, including Christianity, cannot seek benefits as a scheduled caste community member. 66 people are dead and dozens injured after military aircraft crashes in Colombia shortly after takeoff. 125 people were on board. The cause of the crash is under investigation. UP's Chief Minister Yogi Adityanath backtracks after signing a 25,000 crore rupee MOU on artificial intelligence with a little-known company called Pooch A.I. Chief Minister clarifies the MOU is not binding and promises a detailed due diligence. Well, straight to the top story this evening. No signs of a real de-escalation despite President Trump's claims of talks with Iran. Missiles and drone strike continue across West Asia. Now, Iran intensifying its strikes on Gulf countries as Israel after rejecting Trump's claims of talks as fake news. The Defense Ministry of Gulf nations said they continue to intercept Iranian drone attacks overnight. Saudi Arabia's defense ministry also said it intercepted and destroyed at least 5 drones over its eastern region. At least 21 people have been killed in Gulf countries since the conflict began. A barrage of missiles were also intercepted in Israel's capital city of Tel Aviv. However, 3 were injured as missile debris landed in a crowded street, setting several cars on fire and damaging residential buildings. Explosions also shook the central area of Tel Aviv. However, no deaths were reported. Meanwhile, Israel also continued its strikes on Iran and Lebanon as Prime Minister Netanyahu maintained that the attacks will continue until a deal is finalized. Netanyahu has maintained that strikes will curb missile and nuclear program and damage militant group Hezbollah. He added that President Trump told him, and I quote, "There is a chance to leverage battlefield gains into an agreement that realizes the war's objectives," end of quote. Israeli defense officials claim they've destroyed the intelligence headquarters of the Iranian Revolutionary Guard Corps and Iran's intelligence ministry. The attacks on Iran have killed over 1,500 people so far. Explosions also continue to rock the Lebanese city of Beirut overnight. The Israeli military said that strikes killed 1 commander of the elite Quds force of the IRGC. The Lebanese military said that 10 people were killed over the past 24 hours on account of the strikes. The death toll in Lebanon is now close to 1,100. Amidst the strikes, President Trump continues to maintain that Iran wants to make a deal.
To determine whether a broader agreement can be reached, we've had very good discussions, very good discussions. And you have to understand, I know my whole life has been a negotiation, but with Iran, we've been negotiating for a long time. And this time, they mean business. And it's only because of the great job that our military did is the reason they mean business. They want to settle, and we're going to get it done, I hope.
Well, that's President Trump with his claims on a deal with Iran. Oil prices, meanwhile, climbing after a sharp fall yesterday. Brent crude is back above $100 barrel. EU President Ursula von der Leyen has urged the US and Iran to return to the negotiating table, calling for an immediate end to hostilities and the effective blockade of the Strait of Hormuz being lifted. She also condemned attacks on commercial shipping, warning of worsening global economic disruption. Countries are now moving to secure energy supplies. Japan has announced its largest ever release from the strategic oil reserves, with nearly 80 million barrels set to be released to refiners. The move comes as Japan, which imports over 90% of its crude from the Middle East, braces for supply shocks. Vietnam Airlines plans to cancel 23 domestic flights a week from April amidst rising jet fuel shortages. The country's aviation authority is prioritizing routes critical to connectivity and trade. Meanwhile, Bahrain has put forth a draft UN Security Council resolution seeking authorization for all necessary means to protect shipping in the Strait of Hormuz. While backed by the US and Gulf states, the proposal may face hurdles, with Russia and China holding veto power. Now, just 15 minutes before President Trump declared a de-escalation with Iran via a post on Truth Social, the S&P 500 and oil futures witnessed a surge in volumes. Hormuz decodes the unusually sharp movement in the markets and what could have led to that jump. Hormuz, take us through what transpired in that 15 minutes.
We all know what has transpired overnight with the announcements made by Donald Trump, but someone on Wall Street may have known this before any of us knew, and that transpired in just a 15-minute window. Now, at 6:50 a.m. local time in the US yesterday, there was a very sharp spike in the volumes of the S&P 500 futures and the oil futures at the same time. Mind you, this happened in pre-market trading. Now, pre-market trading, the volumes are generally illiquid and there is not much liquidity in the market. But at 6:50 a.m., take a look at this spike in the volumes that you see on the S&P 500 futures. Otherwise, it's an absolutely flat line. And there you can see the volumes on the S&P 500 seeing a sharp spike at 6:50 a.m. There is nothing different in the oil futures as well. Now, on the West Texas Intermediate, if we flip the chart and we go to WTI, a similar spike is seen at 6:50 a.m. here as well. Otherwise, it resembles a flat line on the ECG. Now, it was at that point of time that there was a sign that something was transpiring on Wall Street that others did not know. This was at 6:50 a.m. Just 15 minutes later, Donald Trump puts out a post on Truth Social, and that post says that Iran and the US have had talks over the last 2 days, and as a result of which he has instructed the Department of War to not attack any of Iran's energy installations over the next 5 days. And this is what he said: to postpone and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Immediately after this post, there was a very, very sharp reversal in the futures on Wall Street. The S&P 500 futures were up almost 2.5%. At one point, they were down 1%. Crude prices, which were at elevated levels, fell anywhere between 10 to 15%. Of course, as more clarity emerged and the denial that came in from Iran, the markets cooled off as well, but then still ended higher. Oil prices ended lower.
Well, somebody on Wall Street clearly knew. Now, the Wall Street bouncing back after yesterday's brutal sell-off. The Nifty and the Sensex holding on to opening gains to close the day 2% higher. Nifty ending above 22,950. All sectoral indices ending in the green. The broader markets did outperform the blue chips. That's the story for you. The Nifty up by 400 points, 13 points higher on the Sensex, 1,100 points higher on the Nifty Bank, and 1,300 point gain there on the Nifty Midcap. From currencies to the commodity markets, gold prices continue to be in bear market territory despite pairing losses after a steep sell-off. Gold spot has now lost over 21%. It hit a record high in January, if you remember. Silver continues to recover and is currently near the $70 mark. Goldman Sachs has lowered its forecast for India's GDP growth in FY26 to 5.9% from 7% earlier. That's a sharp cut there. Goldman cites currency pressures and rising external risks. It has also predicted a 50 basis point increase in policy rates. Now, as the rupee faces sharp depreciation, that is the cut that's come in there from Goldman Sachs as far as India's growth estimate goes. Amidst rising tensions in West Asia, India continues to navigate LPG supply concerns. Consumers continue to queue up outside gas agencies in select areas across cities as online booking remains affected. The shipping ministry says 2 Indian LPG carriers have transited through the Strait of Hormuz. The ships are carrying 93,000 metric tons of LPG. One vessel is expected to reach Gujarat's Kandla port by Thursday, while the second is scheduled to reach New Mangalore by Friday. Defence Minister Rajnath Singh chaired a high-level review meeting as the situation in West Asia continues to evolve. Top defence officials met to review India's defence preparedness. The government has also called an all-party meeting tomorrow to discuss the ongoing conflict. Pakistan is reportedly trying to broker peace between Iran, US and Israel. Reports say Pakistan has proposed hosting the talks as early as this week in its capital Islamabad, involving senior representatives from the US administration and Iran. The White House has not confirmed whether Pakistan was acting as an intermediary with Iran. US Press Secretary Caroline Leavitt said the situation in West Asia is fluid and speculation about meetings should not be deemed as final until they are formally announced by the White House. Tensions in West Asia forced Indian automakers to increase prices. Tata Motors has hiked its commercial vehicle prices by up to 1.5%. Eicher has also increased prices of its trucks and buses by up to 3%. The increase will be reflected from the 1st of April. Both companies have cited rising steel prices and higher input costs as their reason. It's not just commercial vehicles. Even paint makers and quick commerce companies have hiked prices across the board. Shilpa standing by with the details. Shilpa, what does this mean now for consumers?
Well, you know, now it's probably looking like food bills, if you order online, will get more expensive because days after Zomato raised its platform fee, Swiggy has followed suit, hiking it to about 17.58 rupees per order. Now, this effectively brings it on par with Zomato, whose effective platform fee with GST also comes up to about 17.58 rupees. And this, at this price point, is a 7.5 times rise from when platform fee was first introduced at just 2 rupees in 2023. Now, analysts say that these hikes, which both players have rolled out in tandem, are less about demand and more about margins and profitability. Every 1 rupee hike adds roughly about 26 basis points to their take rates, and it directly boosts profitability. And even at about 15 rupees per order, the fee is just about 3% of the average order value, which keeps it low enough to not impact order volumes. So analysts say that for platforms like Swiggy and Zomato, it works as a buffer against rising costs like fuel or delivery payouts, while allowing margins to expand without relying solely on higher order volumes. But moving on, it's not just your food bill, right? Paint companies, they're also raising prices as crude-linked input costs rise sharply due to the West Asia conflict. Now, Asian Paints has announced a 6 to 8% hike in April in 2 phases, and this is across its segments. And this, remembers, in addition to a 2 to 3% hike that other paint companies had implemented earlier. Berger Paints too has hiked prices by about 1.5% effective tomorrow, with more price hikes anticipated by the end of April. Now, remember, higher crude prices are a negative for paint companies as crude derivatives form a key component of their raw material costs. And now paint companies are closely watching the crude oil prices to decide the further course of action through the next quarter as well. Back to you.
All right, Shilpa, many thanks for joining us. Now, HDFC Bank has said it has appointed external law firms to examine the reasons cited by former part-time chairman Atanu Chakrabarti in his resignation. Now, Chakrabarti stepped down after saying some practices of the bank did not align with his values. HDFC Bank has maintained that Chakrabarti did not mention any specific issues or specific reasons that were incongruence with his personal values and ethics. And staying with HDFC Bank, sources say the bank's executive Sampat Kumar may appeal against his termination. Kumar was fired last week after an internal probe found that he and 2 other executives were found mis-selling AT1 bonds to NRI customers. Furkan Morkhan has the details. Furkan.
So what we learn is that Sampat Kumar, the senior most of the 3 executives terminated for the mis-selling of AT1 bonds, will appeal against his termination. Kumar's appeal would be heard by the appellate authority, which in this case is the bank's board. Sources have told CNBC TV18 that Kumar had no direct involvement in the alleged mis-selling. His was the case of oversight, sources say. Kumar was the group head of branch banking for the West and South zone of the bank. He was also in charge of the international banking operations for the bank. This is what landed him into the problem, as DIFC operations were his lookout. We tried to reach out to Bank and Kumar for the official response on the issue. None of them have commented till now. It would be interesting now to see what Bank's board will decide on the matter. Back to you.
Furkan, many thanks for joining us. In a setback for Vedanta, the National Company Law Appellate Tribunal has refused to grant a stay on the implementation of Adani's resolution plan for JP Associates. The company said that its bid of 12,500 crore rupees was the highest compared to all the proposed plans. Vedanta also added that its bid was at least 1,000 crore rupees higher than Adani's bid. The company further said the committee of creditors had not accepted the highest available value and declared Adani's lower bid as the winner. Now, facing prosecution over a 40,000 crore rupee bank fraud case, Anil Ambani has written to the finance minister asking if fugitives like the Sunday Saras can settle pending cases, why not me? That's the question he's asking the finance minister. He's also written to banks and has sought a time-bound, structured settlement of views. Ashmit is standing by with the details. Ashmit, take us through what Anil Ambani has said in his letter to the finance minister and what is he essentially proposing?
Well, what Anil Ambani has reached out to the finance minister is essentially seeking a Sunday Sara-like treatment for resolution of the outstanding dues. Bear in mind, in November of 2025, the Supreme Court had given its nod for closure of all liabilities, all cases against the Sunday Saras brothers for payment of 5,100 crore rupees. That's the same treatment that has now been cited by Anil Ambani in the letter that has been written to the finance minister. In that letter, Anil Ambani clarifies that, look, as far as the Sunday Sara settlement is concerned, qualitatively it's on a different footing. Sunday Saras were fugitives. Anil Ambani is not. Also then going on to say that this was a settlement, the Sunday Sara settlement, where the center, the banks, the investigating agencies, CBI, ED, regulators such as SEBI, the income tax department were all on board with that settlement. So with that in mind, Anil Ambani is citing that as a precedent, saying that similar treatment should also be meted out to him, to Anil Ambani. And to that end, he's also written to SPI as well as the Bank of Baroda with a proposal for, number one, setting up a lenders committee that will help crystallize the total outstanding dues payable by Anil Ambani as well as the companies that he's been leading. And secondly, to formulate a structured repayment schedule, a resolution schedule, which should lead to elimination of all pending liabilities. That's the proposal. That's what has gone from Anil Ambani to the finance minister and to the banks. The banks, however, are yet to respond to this proposition that has been floated by Anil Ambani.
All right, many thanks for joining us, Ashmit. We'll take a break, but coming up next, UP Chief Minister Yogi Adityanath backtracks after signing a 25,000 crore rupee MOU on an artificial intelligence project with a little-known company called Pooch AI. That and more when we return. Delhi's Chief Minister Rekha Gupta tabling a 1 lakh crore rupee annual budget with a focus on welfare and infrastructure. Education has received the highest allocation at over 18% of the total outlay, but this is lower than the 25% spent by the previous AAP government. Timsy standing by with the details of the Delhi budget. Timsy.
The Delhi government has unveiled over 1 lakh crore rupees of budget for FY 26-27 with a clear focus on welfare, infrastructure and future-ready sectors. This being the second budget presented by Chief Minister Rekha Gupta. Top of the spending chart is education with an allocation of over 19,000 crore rupees, the highest among all sectors at 18.64%. But when given a closer look, this is significantly lower than the close to 25% spend that was earmarked by their opposition Aam Aadmi Party in their last budget of FY 24-25. Some of the other key schemes announced by Delhi government today included free bicycles for class 9 girls, introduction of artificial intelligence in classrooms and medical rooms in all government schools. Healthcare follows closely with an outlay of over 13,000 crore rupees, coming out to be 12.57% of total outlay. And again, if compared to the last budget presented by Aam Aadmi Party, they had also kept the outlay in the similar bracket of about 13%. Some of the other major highlights of today's budget included the proposed medical college at Dwarka, along with launch of the Anmol scheme for newborn screening and early intervention. Infrastructure and transport continue to see strong spending by the government. The government also allocated 2,885 crore rupees for Delhi Metro expansion and 568 crore rupees for RRTS corridors. In addition, significant investments have also been earmarked for road redevelopment, flyovers and a new drainage master plan for the city. On the welfare front, subsidies remain a key pillar. 3,500 crore rupees have been set aside for electricity subsidy, while free bus travel for women continues with an allocation of over 450 crore rupees. The government has also announced free LPG cylinders during festivals.
All right, many thanks, Timsy. Now, UP Chief Minister Yogi Adityanath has backtracked after signing a 25,000 crore rupee MOU on artificial intelligence with a little-known company called Pooch AI. The Chief Minister clarified that the MOU is not binding and has promised detailed due diligence, saying this is only a preliminary first step. Rachna Dhanrajani joins us now with more details. Rachna, this came to light after the Chief Minister himself tweeted about this 25,000 crore rupee MOU. There has been a social media backlash with questions being raised about the company and its ability to execute on this scale. And now a fresh tweet coming in from the Chief Minister.
That is correct. But, you know, this could be one of the most ambitious and closely watched AI bets in India right now, because Uttar Pradesh has signed a 25,000 crore MOU with Pooch AI. Now, Pooch AI is a Bengaluru-based startup that is less than a year old with no disclosed institutional funding and is still largely unknown outside the tech circles. And the scale of the deal stands out immediately. 25,000 crore rupees is about 3% of the state's annual budget and more than 11% of its capital expenditure. And the vision is sweeping. AI parks, data centers, an AI university and an AI city near Lucknow. The government is calling this a step towards building an AI Pradesh. But the company at the center of this has emerged very quickly and pretty much out of nowhere. Pooch AI was founded in June 2025. It runs on WhatsApp, supports over 22 Indian languages and claims nearly 1 million users. Around 60% of those are first-time AI users in regional languages. Now, this is a segment, particularly when it comes to regional languages, this is a segment where global AI platforms have struggled to reach, especially reaching out to the masses. But beyond all this traction, there are gaps. No institutional funding, no known large investors, and no track record in executing projects at this scale, especially when it comes to physical AI, data centers and everything. Now, considering this is a government project, which one can believe would have had other companies in the running for, we have reached out to the UP government to understand the process, but haven't received a response yet. But at the center of this whole story is founder Siddharth Bhatia. He's a BITS Pilani graduate with a PhD from the National University of Singapore with research experience and stints at Google and AWS. He co-founded this company with Arjit Jain, an alumnus of IIT Bombay. Bhatia has also built a high-visibility social media profile, including a widely discussed attempt to bid for Google Chrome for $50 billion when his startup was reportedly at $50 million valuation. This, and along with a series of other viral campaigns, he has a strong social media profile. And the founder is known for more of
those things on social media than his startup. Apart from that, just the contrast between the UP ambition and the company's current scale is what has triggered the pushback. On X, the announcement by Chief Minister Yogi Adityanath drew heavy criticism, and so the state government has now moved to clarify. Chief Minister Yogi Adityanath has said this is only an MOU. He's explained that MOU is a memorandum of understanding and is non-binding in nature, and any project will go through detailed due diligence, evaluation and approvals. He also said that if the company does not meet the required criteria, the MOU will be terminated. So for now, this remains a very large headline, an early stage company, a debate around whether ambition, credibility and execution can align. But what happens next will decide the direction of this story. All right, Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. News will continue right after this. Stay tuned. We're back in a moment on CNBC TV 18 with the latest.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. OZ, a quick commerce platform for baby and kids products, has raised $6.2 million in a Series A funding round led by RTP Global with participation from existing investors, Bloom Ventures, Huddle Ventures and Zero Pearl VC. The fresh funds will be used to deepen its presence across Gurugram and NCR, invest in technology and operational capabilities.
Pediatric wellness startup RN Kids has raised 7.1 crore rupees in a pre-seed funding round. According to the company, 6 signature products are set to launch by the end of July on Amazon, Flipkart and its D2C website, followed by expansion into quick commerce and offline retail.
Randro raises 4.12 crore rupees in a pre-seed round to build AI-powered interior design workflow platform. The round saw participation from Stargazer Fund along with prominent angel investors. The firm said it is on track to close the current financial year with approximately 14 to 15 crore rupees in revenue.
Uttar Pradesh Chief Minister Yogi Adityanath backtracks after signing a 25,000 crore rupee MOU on artificial intelligence with a little-known company called Pooch AI. Chief Minister clarifies the MOU is not binding and promises detailed due diligence.
Amazon said its Amazon Web Services region in Bahrain has been disrupted amid the current conflict in the Middle East, marking the second time in a month that its operations have been affected by the war. The disruption is due to drone activity in the area, an Amazon spokesperson told Reuters.
On what's brewing today, only days after Zomato hikes its platform fees, Swiggy follows suit. The company has hiked fees by 17% in a bid to improve margins amid intensifying competition. Shilpa Ranipeta is here with all of those details. Shilpa, what does this mean for consumers?
Well, you know, food bills, if you order online, are definitely going to get a little more expensive because days after Zomato raised its platform fee, Swiggy has also followed suit. It has hiked it to 17.58 rupees per order. Now, this effectively brings it on par with Zomato, who first hiked it to about 15 rupees, but then with GST, that also comes up to about 17.58 rupees as well. Now, at this point, this marks a 7.5 times rise from when platform fee was first introduced at 2 rupees in 2023. Now, analysts say that these hikes, which both players have rolled out in tandem, as they've always done, are less about demand and more about margins and profitability. Every 1 rupee increase roughly adds to about 26 basis points to take rates, and it also directly boosts profitability. Even at around 15 rupees per order, the fee actually is just about 3% of the average order value, which keeps it low enough to not impact order volumes. So analysts say that for platforms like Swiggy and Zomato, it works more as a buffer against rising costs like fuel or delivery payouts, which while allowing them to for their margins to also expand without relying solely on higher order volumes. So it's unlikely that it will impact consumers very much, because we've seen that not really impacting order volumes throughout all the platform fee hikes so far. Back to you.
All right, Shilpa, thank you for those details. Appreciate you joining us. Moving on, Green NBFC EcoFi, backed by Eversource Capital, has raised over 380 crore rupees in fresh equity from global impact investors, including British International Investment and FinFund, doubling down on a model that finances everything from electric vehicles to rooftop solar for households and small businesses. In 3 years, the company has built a 1,400 crore rupee loan book, serving over 1.2 lakh customers, signaling strong demand for climate-linked financing at the grassroots. Joining me now to talk about the road ahead at EcoFi is its co-founder and CEO, Govind Sankaranarayanan. Govind, welcome to Startup Street. You've raised over 380 crore rupees from global DFIs like BII and FinFund, long-term impact-focused investors. So tell us, what does this vote of confidence say about the maturity of India's retail green finance market? And are we at an inflection point for green finance in India, or still in the early innings?
So, Shruti, thank you for having me on the show. It's clearly a mature market. We know that we have over 1 million two-wheelers, several 100,000 three-wheelers, more than 10 lakh residential rooftop solar installations and so on, which are there. We have significant investments that have been made by companies like TVS and Hero and Ather and Tata Power and so on, both across different segments. So I think that it's fair to say that the green market is actually not just here to stay, but where the future is.
You know, EcoFi is positioning itself as a retail-first green NBFC. Govind, what's fundamentally different about underwriting a solar rooftop customer versus a traditional retail borrower?
Well, there are some differences. Firstly, solar rooftop customers don't sort of congregate together in a dealership in the same way that people do when they're buying a car, for instance. So you find that you need to have a distinct customer journey, which enables people to sort of be, the dealer particularly, to be able to finance and service the customer. We've created precisely such a customer journey. Secondly, we have been able to actually, with the consent of the customer, access their electricity bill directly from the DISCOM and assess how much of solar power they actually need, and then fund them in accordance with that. There are also a couple of other nuances. The funding is done in 2 tranches because solar installations don't sort of happen overnight. So all of that has really helped us to be actually the leading sort of residential player in the space.
Sure. Govind, you've built a 100% retail loan book. Why take that call in a sector where many lenders still lean heavily on corporate exposure? And what gives Ecofi the edge in a space that could soon see banks, fintechs and NBFCs all chasing the same green customer?
Retail is really where the funding need is.
Okay.
These are new asset classes. These new asset classes require, they usually cost a little bit more. So naturally, customers need financing. And that's therefore where a new NBFC ought to start out. Secondly, thanks to the India stack, it's possible to use technology actually to reach out to these customers. And I think that's something that Ecofi has done fairly well over the last 3 years. So that's really why I think we think retail is where we would start. There are also a number of unique products that we offer. For instance, we have been able to sort of disaggregate the funding of the chassis from the battery for 2-wheelers and for 3-wheelers. That's not something too many people do. We also, have fairly deep relationships with some of the manufacturers, who therefore offer us special subventions, which we can pass on to the customers. All of that is, makes us different.
Okay, Govind, currently with 1.2 lakh customers and 1,400 crore rupees AUM in just 3 years, you're now targeting a 3x scale up. What are the key levers? And also, if you could take us through your current revenue growth numbers.
Well, we have way to go in order to grow. There are new markets we need to tap into. Our wallet share in some of these major OEMs still can grow. For instance, with Ether, we've just signed up a arrangement relatively recently with Bajaj, TVS, etc. There's a lot more that we can do on 2-wheeler space. The SME business that we actually are planning to expand is an area that we hope to sort of grow into over the next couple of years. So these are all areas that we would look at. The revenue currently, if you look at both interest as well as fees and so on, is around 200 crores a year. We think that is going to grow at least 4 to 5x, close to 1,000 crores in the next 3 years.
All right, so 1,000 crores in the next 3 years. Govind, you're sitting on an approximate 50% capital adequacy ratio post fundraise. How do you balance aggressive growth with disciplined risk management? And as RBI tightens norms for NBFCs, how are you future-proofing your model while scaling fast? Also, if you could quickly tell us, beyond EVs and rooftop solar, what's the next frontier that you're looking at?
Risk management is obviously critical in any NBFC. We need to have as many diversified sources of funding. We've been fortunate to get funding from a number of development financial institutions and others. Obviously, we use AI and machine learning in order to identify early warning signals within our portfolio. We're fortunate to have both great investors as well as a strong board. So they kind of make sure that the company sort of sticks to the straight and narrow. We have a fairly diversified portfolio, and importantly, the portfolio is granular. So all of these are ways in which we manage risk.
Okay.
To your question about, where else?
Yes.
As I said, green is going to be mainstream. 5 or 7 years from now, I think many asset classes in SME, in vehicles, in homes, etc., will all basically be green or sustainable in some form or fashion. And I think over a period of time, we will move to expand to all of those asset classes.
Yes. All right, Govind, on that note, it's time for me to wrap up our conversation. Many thanks for joining us on Startup Street today, and wish you the very best for all your growth plans.
Thank you, Shruti.
Moving on, Bengaluru-based Vimag Labs has raised $5 million in a Series A round led by Accel as it looks to build a next-generation electric motor platform for a world rapidly shifting to electrification. At the core is its patented virtual magnet technology aimed at delivering better performance while cutting costs and reducing dependence on rare earth materials. With applications across automotive, defense and industrial sectors, the startup is betting big on becoming a foundational layer in the global electrification story. But can this deep tech innovation scale and disrupt a decades-old industry? Joining us now to discuss this further is Manish Seth, the co-founder and CEO of Vimag Labs. Manish, thank you so much for taking time out and being here with us on Startup Street. You know, electric motors are a decades-old technology, right? What gap did you sort of see in the market that made you believe there was still room for a fundamental breakthrough? If you could sort of take us through or explain what you have on offer.
Sure. Thank you for having me on this program. As you said, you know, electric motors are old technology. So it's not decade old, but you know, almost 200-year-old technology when Nikola Tesla invented the first electric motor. You know, throughout the 200 years, what has happened is motors have, you know, in search of efficiency, have started getting in too much dependent on magnets. And we have all seen what happened during COVID when the supply chain bottleneck, the magnets and the rare earth minerals, which are all coming from China, they suddenly stopped. We also saw it recently, you know, over the last 6 months or so when the licensing agreements were being put into place by China for magnets, and that created a lot of issue. So now you think if everything is going into, you know, green and electrified future, if the motors are still dependent on magnets, that's not very sovereign and sustainable way to do it. So we saw this opportunity. And over the last 5 years, we have been working on this technology to take magnets out of the motor. And at the same time, we have developed the technology which we call as virtual magnets. Why we call it virtual magnet? Because it delivers the performance, which is as good as a magnet-based motor, without having any magnets. And it's purely dependent on mostly electronics and software, which is our proprietary knowledge. So with that, you know, taking care of supply chain disruptions and the full stack ownership,
sure,
I think we can bring a lot of value proposition.
Absolutely. And you're sort of targeting the automotive, defense and industrial sectors, right? How large is this combined electrification opportunity and where do you see the fastest adoption? If you could sort of, you know, take us through some use cases.
Yeah, so of course, we are starting from automotive. That's because, you know, I come from automotive background and it was easier for me to understand the final use cases. So we do start with two-wheelers and three-wheelers initially, going to small four-wheeler products up to 20 kilowatt range of power. We are also going to launch our products in the categories of 250 kilowatts and above. So you can think about trucks and buses. So those are our, you know, that's our beachhead market, the automotive. In addition, we are also working on technologies for drones and robotics, but they are still in the development phase. So that takes some more time. The market itself is huge. Automotive market itself is, you know, more than $5 billion. If you add on top of it, you know, drones, robotics, and anywhere data centers where the motors and pumps go, the market is very, very huge. And there is a room for a lot of companies to play. I would put it somewhere close to more than $10 billion overall market for the motors, which we are looking at.
Absolutely. So big market opportunity there. You've raised this $5 million that was led by Accel, right? The round. What are the key milestones this capital will sort of help you unlock over the next 12 to 18 months? Where do you plan to spend the funds?
Yeah, so we will be spending, you know, let's say 30 to 40% in keeping our technology leadership intact, because that's very important. In addition, we are going to commercialize our first generation of products. So as I mentioned, two-wheelers, three-wheelers, small four-wheelers. So that would help us, you know, getting into the market. We are putting some money into CapEx. We are building capacity because we are getting into a huge volume market. And in addition, we will also be building up a structure, you know, ramping up the team here in India so that we can have a technology development team and an application-oriented team. So those are some of the key milestones which we will achieve with this.
And you've sort of taken a route of integrating with existing ecosystems rather than sort of disrupting them abruptly, right? So how does this strategy help accelerate adoption with OEMs and industry players? Give us a status check of where you're at right now when it comes to the automotive play.
Yeah. So, you know, any regulated industry, whether it's automotive, aerospace, medical, you cannot disrupt immediately. It's too risk averse, right? So you need to get step by step. So you cannot, someone is not going to change the total architecture just because you have something. So our strategy is to first go and start integrating into the existing platforms. That takes, that gives a comfort level to the existing OEMs, and also helps us to speed up the deployment plan. So we take, first the electronic strategy. So we integrate the electronic systems, then we get into the final magnet-free motor system, and then further on we go for, software and firmware-enabled magnetic fields to give them comfort. So that helps taking the risk out of the portion, get us certifications earlier, and help us to get into the market and get the, the vital information from the market earlier to de-risk the tech itself.
Sure. And if you could quickly tell us, deep tech hardware is notoriously hard to scale, right? What are the biggest challenges you foresee in moving from innovations to mass commercial deployment?
So the character of our company is that we are de-risking that. The first thing when we started with the motors, we got issues with magnets, so we removed that. So what we are doing is we are moving all the hardware-related issues into software, and software is easy to iterate. Having said that, when we go more into electronics and software, the issues in terms of scale are the typical, what you call it as a production hell. So you need to get into the supplies of electronics with all what is going across the world. It becomes difficult. So just to manage the supply chain, get things into time. But our strategy is to own the total tech stack and the manufacturing stack. So over 5 years, we know a lot about manufacturing as well as technology. So that helps us to scale up. And also our background is, helps us to scale the manufacturing. So we are not too much worried about scaling the manufacturing.
All right, Manish, thank you. Thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you very much.
Well, on that note, it's time for us to head into a short break. But coming up, AirChain has raised $13 million in a funding round led by Wavestone VC. We put the firm's co-founders on the hot seat to break down the details. Stay tuned.
Bengaluru-based AI-native enterprise procurement platform Airchain has just raised $13 million in a Series A round that was led by Pavestone VC with participation from IndiaMart. The company is building what it calls a spend operating system using AI agents to automate procurement, drive savings, and shift teams from execution to strategy. Joining us now are Harsha Kadimi Sethi and Himavant Jasti, the co-founders of the company, to talk about what this means for the future of enterprise decision-making and the importance of this fundraise for the company. Gentlemen, thanks very much for joining us here on Startup Street. Harsha, I'll start with you, with a big picture on the company itself. What is the gap in the market you're trying to solve for with your product? How large is the opportunity? And where do you see Airchain's biggest advantage?
Thanks a lot for having us over. So we have been in the procurement space for quite some time, and what we have realized is that there are system of records which have been there for decades now, which is nothing but giving the system to the users and asking them to do their work. And that's not something which is required in the AI age or today's enterprises, right? Enterprises are looking for outcomes to be driven with a combination of human and AI agents. And our system exactly accelerates that for these. So it's an army of agents working for the enterprise and coming to the humans whenever they need a decision support or anything else in the decision-making process. And coming to the market opportunity.
Yeah.
Procurement overall is a multi-trillion-dollar market being across the globe, and we are just getting started, and we are looking to disrupt and very soon make this multi-billion-dollar company.
Okay, multi-billion-dollar company. Well, we will see about that. But Himavant, building this as a multi-agent AI system from scratch, what does that actually mean in practice, and how is it different from just adding AI on top of the existing ERP systems?
You can think of it this way. So most of the systems right now were for workflows where humans used to do it, and AI is bolted on top of them where agents do the exact same work that humans do, right? So, but AI is intended to be used differently by us, where we reimagine the entire workflow of how spend has to be orchestrated with these enterprises. So with this happening, so AI will help humans take the decisions that they have to take and act on behalf of them instead of humans being there in every action that they have to do, right? So that is what we're trying to do differently as a company.
Okay, well, Harsha, then let me get to this $13 million that you've just raised. How are you going to deploy the capital? Where does it go when you look at your growth priorities, products, capabilities, expansion? Where will you allocate the money?
First and foremost, which is what has led us to being here, being obsessed with customer value generation. So that is done by enhancing our spend operating system, integrating all the latest AI advancements into the platform. So the product innovation and getting it ready for the future, right? As we know, is changing every single week. This is the first and foremost priority. And the second is to make sure we are able to add value to these enterprises at scale. So today we have 50 plus enterprises globally, and we want to be able to take it to 500 plus enterprises in the next few years. And that's where most of this capital is going to be deployed, setting up global offices, R&D, and then making sure we are strengthening our team to be able to service these multinational companies.
All right, from 50, global enterprises to 500 plus, Himavant, what's going to be the biggest driver of adoption when you move to these 500 plus companies? And as you scale, how will you adapt the platform to different procurement systems, different regulations, perhaps different data requirements in each region?
So we have been working on procurement for the last 6+ years, and we have seen so many nuances in procurement. Different approval hierarchies, fragmented ERPs, and a lot of these issues in the current landscape, right? So these rules differ by category, by country, by spend. And by looking at all of these, we have come up with a platform that can solve all of these issues with the help of AI for all the customers that can be set up and be driven by the platform itself. So I don't think we'll be at a stage where we need to rewrite our systems when new regulations or when we go to new countries, because we have that inbuilt in our system that we have already done.
All right. So then, Harsha, finally, give us a sense of what the growth roadmap looks like from here on. I mean, both in terms of financials, also, what are you targeting in terms of new geographies, larger enterprises, these 500 plus, deeper wallet share within existing clients as well? Give us your growth strategy and also the financials.
Right. So, like I said, we are already serving customers in India, Middle East, and the UK, and we want to extend this, and of course, the US as well. While we have the footprint, we want to penetrate these markets much deeper. So, we are trying to set up these offices in respective regions, set up teams, and make sure we are able to consult on the value and deliver the value much more seamlessly, right? And these are geographies where we are targeting, and going from each of our customers today pays anywhere between $200,000 to $300,000 a year, and you can do the math in terms of where we will be when we reach 500 clients.
All right, and we wish you the best with that, Harsha and Himawant. It's been a pleasure having the both of you on CNBC TV 18. We wish you the best of luck and hope to speak to you soon. Thanks very much.
Thank you very much for having us.
On that note, we're going to wrap up this edition of Startup Street. Thanks very much for tuning in. Stay with us. More news and updates will continue after this short break.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. These days when we talk money, investors have realized that talking about money only purely from an Indian equity market context is many a times not enough. In the last 15 odd months, the Indian market has underperformed global markets big time. And in this entire duration, the US market, for instance, has continued to be fairly Teflon coated. The market has weathered so many storms, whether it is the AI disruption, whether it is, of course, what's happening geopolitically, and now even the war in West Asia, the US market has remained relatively insulated. But this is not a conversation just about the US market. This is a conversation about Indian investors waking up to the need of diversifying their equity bets, the need to perhaps spread your equity investments in markets beyond India, going beyond Indian shores. Now, the problem when we talk about this is not too many Indian mutual funds are right now giving the option of investing in global stocks in a simple way. Why is that happening? What should investors do? And are there new options coming up via the Gift City? That is what we'll talk about on this show today. My guests are Aditya Agrawal of Wealthy.in and Nirmal Bari of PPFAS Mutual Fund. Now, I must say that PPFAS is one of the funds that has started offering some of these new concepts and these new options to investors via Gift City. So this promises to be a really, really interesting conversation. Thank you so much for joining us on the show, gentlemen. Welcome to both of you on the show.
Thanks, Surabhi. Pleasure to be here.
So, okay, I want to take a couple of steps back before we get started. And I think they say that the market is usually the best teacher. And Aditya, opening thoughts with you, because the market has taught the lesson of patience to Indian investors in the last 2 years. So why diversify?
Yeah.
And where to diversify? Let's start right there with the basics.
Right. I think we all often say, right, don't put all your eggs in one basket. I think that is something that we all understand even as kids. And if you even look at the theory of wealth creation, I think asset allocation is one word that we talk about a lot. And we ideally want assets that are uncorrelated. And we saw, for example, first what happened with gold and silver, and then we've been seeing for the last 2 years that how global emerging markets and developed markets have outperformed India. right? So I think that conversation that I should build a portfolio where I have as many assets as possible, which are uncorrelated to each other. I think that is something that, sort of has proven again itself to be the harbinger of wealth creation, and especially creating a portfolio that is sort of, that is able to test the test of all time. So I would say that's why, global as a theme has emerged very, very powerfully in last 2 years. And as we all know, ultimately investors pay attention to, returns in recent times.
Okay, all right. So lots of important and very important reasons that Aditya highlighted there. Diversification, de-risking your portfolio, looking at markets which are uncorrelated, and obviously developing a currency hedge as well, not holding all your assets in just one currency if it were to constantly depreciate. So these are some of the reasons why we need to look overseas. Let me bring in Nirmal as well. Nirmal, but let's face it, a lot of Indian investors end up doing things because they track price movements. So this whole conversation of investing in US tech really goes back to, I think, 23, 24, when, this creature called NVIDIA was capturing our imagination and the stock would just keep rising and rising. The NASDAQ was soaring. That's when a lot of Indian investors said, hey, I need to be in US tech. I need to have Apple and Facebook and so on and so forth. So let's start right there. Tell us why that is not the way to approach global markets, and how should one look at blending global exposure in their existing India portfolios?
One thing that clearly needs to be there when looking at global is that it should have a very long-term horizon. The investors, if they are looking at one particular stock and investing in that, and if they make some good money in the short term, they redeem, they'll be exposed to very high taxation in India. And short term, when I say it is not 1 year, it is 2 years when we look at global markets. So one should clearly have this. Equities anyways are a long-term product of 5 years or more. So build it as a part of your portfolio strategy, as a part of your overall allocation, rather than looking at one index, one stock over a shorter period of time.
Okay, very well said. And those are really important points that you've raised there, Nirmal, including taxation. Must always keep that in mind while we're planning our investments, anywhere, any asset class in any market. So let's get started. First and foremost, let's talk about the impediment. Now, not too many regular Indian mutual funds give us the option of investing in global stocks. Now, on this show, you've heard us tell you about those limits. So let's just quickly go over and revisit something that has been an RBI regulation for many, many years, Aditya, right? This limit of $7 billion that overall mutual funds can't invest in global markets beyond $7 billion. This is a very old limit, isn't it?
Yeah, it is. So, even if you look back at history, as a country, we've always been a little bit cautious about our money flying abroad, right? And it's something that has stayed. Obviously, we live in a different world now. As a country, we've become more powerful. We are, recognized as a world power now globally. But still, that limit is very paltry. So still, if you look at as a country, our mutual fund AUM is about $1 trillion now. But our mutual funds combined are only allowed to invest about $7 billion. And if you include ETFs, that's about $8 billion. So that's not even 1% of your industry's AUM that is allowed to be invested abroad. So I think those controls have remained. I think there have been talks about relaxing those limits. But I think instead of that, I think this gift city option, which is where through liberalized remittance scheme, you can actually remit money instead of remitting in the US, you're actually remitting to Gandhinagar, and from there it gets invested abroad. I think that's something probably a very welcome move that government has made, and simplified this whole international investing in last 7, 8, 10 years. So yeah, I would probably say that limit is probably here to stay, but I think government opened up another route to gift city products, and AMCs like Parag Parikh, DSP, Edelweiss have already launched retail products as well to allow people to invest abroad through the gift city.
Yeah. I must say, though, Parag Parikh Mutual Fund has been one of the early mutual funds that even within their regular India schemes, they were always taking some exposure in international stocks. And their early bets were in a lot of the US tech names, well before, investing in US tech became fashionable. So compliments to the fund managers who've been picking those stocks rightly. But, Nirmal, come in on this. And now here, let's get a little granular in terms of understanding markets as well. Now, if I look at the last 1 year, then the divergence between India and US is stark. Now, for the reference of viewers, in the last 1 year, the S&P 500 has gained about 20%. The Nasdaq has gained about 28%, and the Nifty has gained only 4%. So it's been a unbelievable year. We don't usually see such huge divergence. On a 5-year basis, the divergence is only 8-9%. The Nasdaq, for instance, is up 70% in the last 5 years. The Indian market, the Nifty, is up about 61-62%. So first and foremost, Nirmal, are we in an aberration phase right now? And if we are, then what would you tell investors? Investors tend to, move in herds. So following US tech right now in terms of a sort of a bit of a herd mentality, could that be a risky strategy?
Are we in an aberration phase right now? The answer is clearly no. This is how the markets perform. Despite saying that the world economy is very much correlated and all, we have seen that over a period of time, except for very unusual periods like the 2008 global financial crisis or the 2020 pandemic, world markets tend to not move in tandem. So every year, if you look at the history, there is one or the other country which does superbly well, while there are other countries which are way below average. And that is what we have seen between US and India in the last 1.5 years, where Indian valuations have seen a time correction maybe, while US driven largely by the amount of investments that are going into AI and related sectors, have seen those companies surge.
Fair enough. Aditya, so let's get your take. A scientific way of diversifying the portfolio. How much would you allocate outside India right now? And I'm talking about, let's say, the pure equity component out of 100. How much would you keep in Indian equities right now? How much would you give to, say, US, any other geography? And within the US, should it be a broad diversified index like the S&P 500? Let's just go over thematically, in what proportion should we allocate the money?
Sure. So I think fundamentally core will remain India, simply because we are a country that is growing at 7.5%, and we have, by all accounts, we have 15-20 years of growth ahead of us at a similar pace. So no other country in the world, no other broad index in the world, can sort of claim that. But at the same time, we have certain sectors which we are not exposed to. So I think global tech is one very clear area where, as a country, we have not been able to create those kind of companies and that kind of cash flow profitable businesses. So I think for me personally, and that's what I tell my closest friends as well, and wherever clients seek my advice, that you should limit your US exposure to between 10 to 20%. Slightly on the higher side, if you have plans of sending kids to the US, because as Nirmal also said, there is you're protecting your money against the so there is a hedge to currency depreciation. But otherwise, and I would probably go all in only on just the tech sort of sector of the US, because that's one sector that we don't have exposure to. It's going to be highly volatile because it's like any other thematic fund that we have in our portfolio. So it's going to be very volatile. So it's not something that you can accumulate in one go, and you have to sort of pace it out a little bit, because there'll be buying opportunities, there'll be sometimes profit booking opportunities. So that's probably the only bet that I would take outside of the US, and maybe not allocate more than 20%. Maybe start with 5, but maybe gradually take it up to 20% of my equity portion of my portfolio.
Okay. All right. Got that. So it's very clear that we do need to have some global exposure. The levels can vary. The choice of indices or markets can vary, but we need some global equity exposure. Now, the question is how? We're going to take a break. After we come back, the really interesting part. There are some regular Indian mutual funds that are taking money. We'll tell you which ones they are. But more importantly, a lot of Indian mutual funds are now exploring the route through Gift City, through which you can take exposure to global stocks. More about this after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing how Gift City is emerging such an interesting route for us retail investors to look at investing in global equities, in global stocks. So let's get back to our conversation with Aditya Agarwal and Nirmal Bari. Both of them have been talking to us about the importance of global diversification. And now, Aditya, before we talk Gift City, first just recap for us these few funds in India that are still taking money, when it comes to global stocks.
Yeah, so there are actually very few. I think off the top of my head, the one fund that is taking money is the Axis Global Equity Fund of Fund, Global Equity Alpha. And it's something that, but it's such a dynamic environment that today one fund is taking money, and in a few days you will not find that that fund taking money. But one fund that we are seeing inflows on global scheme, global investing theme, is this Axis Global Equity allocation, which is called Global Equity Alpha Fund of Fund by Axis. And Axis, as you know, has launched this product in partnership with Stodders, which is a very well known and global asset management company. So that one fund is definitely taking money right now.
Okay. All right. I think we have a few other names on the screen as well. But again, I mean, these things can turn any day. Any day the funds can decide to switch off the tap. So make sure you check. Some of the names are on your screen. Now, gentlemen, let's talk about what Indian asset managers are doing in GIFT. Now, we know that the Gujarat International Financial Technology Center, the IFSC, is India's big financial global hub. And all kinds of financial products are available in GIFT. But just explain to us, Nirmal, what are Indian asset management companies doing? Regular Indian mutual funds, what kind of structures are they setting up in GIFT City so that someone like me, someone like viewers of this show, they can take part in global markets?
Sure. So that's a great question. The first thing is that till last year, about a year back, all the FMEs, the fund management entities that are present in GIFT City, instead of AMCs, they are called FMEs. They had the option of launching only an AIF, where the minimum ticket size was $150,000 US, which made the accessibility very limited. Now, last year, the new FME regulations came in, which provided sufficient clarity on retail funds. And after that, there was some tax clarity which came in last year in the month of April. Post that, quite a few FMEs have started making a move towards launching retail funds. We have also launched a couple of them in the last month as well. Now, what a retail fund is basically to simply put, it is the counterpart of mutual funds in India. It has similar simple onboarding process as the Indian mutual funds. It also has lower ticket sizes, significantly lower ticket sizes as compared to the AIFs, which makes it affordable for a large segment of the population. And the ticket sizes can gradually keep going down as well. Right now, most funds are at $5,000 US. The final thing is, it further simplifies life for Indian investors because the taxation is at the fund level. So whatever the redemption proceeds that the investors receive at the end are net of tax for them.
Okay, so let's try and understand these structures and the nature of these funds in a little more detail. Aditya, how are these new funds, these retail funds which are being set up in GIFT, how are they different from the regular funds of funds? I mean, the ones that you described, like the Axis Fund, the non-GIFT funds, which also take money and then invest in global stocks. How are the GIFT City-based retail funds different, if at all?
So one is, if I am not, like, for example, we discussed there are only 5 schemes available right now, which can take money from Indians in India investing abroad. So GIFT City funds come under what is called a liberalized remittance scheme. There is no limit as to how much money can GIFT City funds invest outside India. As an individual, I have a limit of about $250,000, which I can remit outside, like remit to a GIFT City account and actually invest from there. So now the limit from an industry level of $7 billion shifts to actually limit at an individual. So let's say if I have a portfolio of $10 million, suppose, and I want to invest, let's say, $1 million at 10% allocation through a mutual fund, which is Indian mutual fund, investing abroad, I may not be able to, because, most funds may not be able to take that money. But whereas in GIFT City, I can actually invest that $1 million by doing, in 4 years, I can sort of invest $250K each and end up. So I think the basic difference is that this is like a offshore transaction. You are sending money outside India, and then from there it is getting invested. So the $7 billion cap no longer applies, but at an individual level, the cap applies of $250,000. So that probably is the biggest difference. Otherwise, everything else remains the same. Your NAV calculation, the underlying ETF or the underlying index fund, everything else remains the same. Of course, the KYC etc. is slightly different on Gift City. And then you also have this extra leg of going to your bank or asking your bank to remit that money outside India. And it is not, not all banks have made it seamless. So in some banks, it is actually a tough, it's slightly, there's a lot of friction in sending money under the LRS route.
Yeah.
But I hear that there is a lot of development going on outside as well.
Nirmal, come in on this. So if I want to park money in one of these gift funds, then let's talk about the thresholds. And I mean, is it uniform? Is there a regulation around to it, or does it just depend on fund to fund? And translated into Indian rupees, we're talking about what? I mean, a minimum threshold of just under 5 lakh rupees? Minimum investment amount, that is.
So the minimum investment amount, the minimum initial investment amount is $5,000, which converts to about 4,60,000 rupees or so, so at current exchange rate. Incremental investments can be $500 or any amount above that, which is basically less than 50,000 rupees to put it. So that way the thresholds are low. They are not as low as Indian mutual funds. Again, I agree to that. Gradually, as the system evolves, as it grows, this is at a very nascent stage, having only been there for like 6-8 months. The ticket sizes will also start coming down. The biggest hurdle at present to ticket sizes is that there is a frictional cost, as Aditya described about going to the bank and doing LRS. Quite a few banks have made that journey digital. We have also had a few tie-ups with payment service providers to make it seamless. But from a rupee perspective, there's still a bit of frictional cost that comes in when sending money. If you're spending 1,000 rupees sending 5 lakh rupees outside, probably investors would still be fine with it. If you're spending 1,000 rupees sending something like a 5,000, 10,000 rupees outside, probably that's a pretty high frictional cost. So that is what limits the ticket sizes at present. But we are making efforts on reducing the ticket size further so that it becomes more and more affordable for retail investors in India.
Okay, all right. So now let's come to understanding the other regulatory aspects. Aditya, I guess, these funds would be regulated by what, market regulator SEBI or the IFSCA authority? And, does that matter for investors at all? And also the taxation, let's go over that, because Nirmal made that point that long term for these funds is 2 years. You have to hold for 2 years to enjoy the benefit of long-term capital gains tax, that advantage. So if you could just go over how the tax implication will play out and whether for investors it makes any difference if the IFSCA is the regulatory body for these funds.
I don't think for an investor it makes any difference, because IFSCA is the regulator. And if you look at the fund management entities that are also being set up, they're all well-known names that are already being regulated in the country. And as you also said, right, Gift City is being positioned as a global financial hub. So the regulations, the way it is all being set up, it is actually world-class. It is something that after a slow start, I think now we are seeing that, we are bringing really world-class standards. And as far as taxation is concerned, I think there is no difference in taxation. So you're not investing to a Gift City because of taxation advantage. In fact, there is no advantage. It is same as Indian equities. So you pay 12.5% long-term capital gains for whole period of more than 2 years, and tax rate income slab for less than 2 years. So taxation, there is no advantage. The difference, the reason to invest is, again, an asset allocation framework where you want exposure to global equities, or if you have needs in the US or outside India in the future where you want to send your children abroad for studies. I think that is obviously the second use case where you should definitely look at probably investing outside India.
So final verdict then, gentlemen. Obviously, PPFAS has already launched some of these funds, as are other entities launching these funds in GIFT City. Aditya, do they get the thumbs up from you, these funds? And any final word of advice, things that people should keep in mind while going global through GIFT?
Definitely a big thumbs up. Only thing is that there is a lot of friction still in sending money abroad. One good thing that has happened is that, minimums have come down from $150,000 to $75,000 and now to $5,000. So clearly there is a decline in terms of minimums or thresholds becoming lower. So that is great for access. Obviously, you can't just chase last 12-month returns and 24-month returns. You have to build equities, ultimately long-term asset. It will only compound your wealth. It will only make you 20x, 30x if you hold it for 20, 25 years. So from a 20-25-year view, is a global allocation an important step in creating wealth for Indians? I think yes. So I think from us at Wealthy, it's a big thumbs up, this whole initiative.
Okay. All right. There you go, viewers. More options opening up and GIFT City really becoming a gateway, not just for the well-heeled, not just for the HNIs, but for you and me as well, in taking more exposure, informed exposure to global markets. Thank you very much, Nirmal and Aditya, for joining in and explaining this new investment route to our viewers. Great to have you on the show. Well, viewers, with that, we're completely out of time on this week's edition of Let's Talk Money. See you again next week.
Let's talk money. Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. These days, when we talk money, investors have realized that talking about money only purely from an Indian equity market context is many a times not enough. In the last 15-odd months, the Indian market has underperformed global markets big time. And in this entire duration, the US market, for instance, has continued to be fairly Teflon coated. The market has weathered so many storms, whether it is the AI disruption, whether it is, of course, what's happening geopolitically, and now even the war in West Asia, the US market has remained relatively insulated. But this is not a conversation just about the US market. This is a conversation about Indian investors waking up to the need of diversifying their equity bets, the need to perhaps spread your equity investments in markets beyond India, going beyond Indian shores. Now, the problem when we talk about this is not too many Indian mutual funds are right now giving the option of investing in global stocks in a simple way. Why is that happening? What should investors do? And are there new options coming up via the GIFT City? That is what we'll talk about on this show today. My guests are Aditya Agrawal of Wealthy.in and Nirmal Bari of PPFAS Mutual Fund. Now, I must say that PPFAS is one of the funds that has started offering some of these new concepts and these new options to investors via GIFT City. So this promises to be a really, really interesting conversation. Thank you so much for joining us on the show, gentlemen. Welcome to both of you on the show.
Thanks, Surabhi. Pleasure to be here.
So, okay, I want to take a couple of steps back before we get started. And I think they say that the market is usually the best teacher. And Aditya, opening thoughts with you, because the market has taught the lesson of patience to Indian investors in the last 2 years. So why diversify?
Yeah.
And where to diversify? Let's start right there with the basics.
Right. I think we all often say, right, don't put all your eggs in one basket. I think that is something that we all understand even as kids. And if you even look at the theory of wealth creation, I think asset allocation is one word that we talk about a lot. And we ideally want assets that are uncorrelated. And we saw, for example, first what happened with gold and silver, and then we've been seeing for the last 2 years that how global emerging markets and developed markets have outperformed India. Right. So I think that conversation that I should build a portfolio where I have as many assets as possible, which are uncorrelated to each other. I think that is something that, sort of has proven again itself to be the harbinger of wealth creation, and especially creating a portfolio that is sort of, that is able to test the test of all time. So I would say that's why, global as a theme has emerged very, very powerfully in last 2 years. And as we all know, ultimately investors pay attention to, returns in recent times.
Okay, all right. So lots of important and very important reasons that Aditya highlighted there. Diversification, de-risking your portfolio, looking at markets which are uncorrelated, and obviously developing a currency hedge as well, not holding all your assets in just one currency if it were to constantly depreciate. So these are some of the reasons why we need to look overseas. Let me bring in Nirmal as well. Nirmal, but let's face it, a lot of Indian investors end up doing things because they track price movements. So this whole conversation of investing in US tech really goes back to, I think, 23, 24, when, this creature called NVIDIA was capturing our imagination and the stock would just keep rising and rising. The NASDAQ was soaring. That's when a lot of Indian investors said, hey, I need to be in US tech. I need to have Apple and Facebook and so on and so forth. So let's start right there. Tell us why that is not the way to approach global markets, and how should one look at blending global exposure in their existing India portfolios?
One thing that clearly needs to be there when looking at global is that it should have a very long-term horizon. The investors, if they are looking at one particular stock and investing in that, and if they make some good money in the short term, they redeem, they'll be exposed to very high taxation in India. And short term, when I say it is not 1 year, it is 2 years when we look at global markets. So one should clearly have this. Equities anyways are a long-term product of 5 years or more. So build it as a part of your portfolio strategy, as a part of your overall allocation, rather than looking at one index, one stock over a shorter period of time.
Okay, very well said. And those are really important points that you've raised there, Nirmal, including taxation. Must always keep that in mind while we're planning our investments, anywhere, any asset class in any market. So let's get started. First and foremost, let's talk about the impediment. Now, not too many regular Indian mutual funds give us the option of investing in global stocks. Now, on this show, you've heard us tell you about those limits. So let's just quickly go over and revisit something that has been an RBI regulation for many, many years, Aditya, right? This limit of $7 billion that overall mutual funds can't invest in global markets beyond $7 billion. This is a very old limit, isn't it?
Yeah, it is. So, even if you look back at history, as a country, we've always been a little bit cautious about our money flying abroad, right? And it's something that has stayed. Obviously, we live in a different world now.